Obviously, for the special purpose machines or for a model specific machinery, you have to do that kind of capex. So there'll be a certain capex, but we want to also leverage on our current capex that we have.
And it all sounds, very positive in terms of the IPO. But if you have to list down probably one of your biggest threats going into FY26, FY27, considering that you have so much domestic market exposure, what do you think is the biggest challenge for the company that investors need to know about?
So, from a threat perspective, we've grown at a. I wouldn't say it's a threat. It's about for us to be able to deliver on our past track record, and we believe we can do that. So I think we're in a good spot to be able to capitalize on that.
Skill level is always a need of an hour, and I think as we become diverse, multiple locations, multiple customers, I think I always say you need to replicate your clones who will match your commitment and your dedication towards customer. I may give my best, but my team should also match that. So making more clones.
We keep pressing for numbers. I think the one thing that I'll watch out for going forward is the increased content per vehicle from your end. If you could give us a sense on how that has grown, because 1.4% volume growth over the last 10, 11 years, your revenues have grown nearly 10 times of that. What has the rise in increase per content per vehicle been for you, and how is that likely to go forward?
So value addition per vehicle has gone up for us. So earlier we were doing the components like frames. We are not doing surface treatment. So we started doing surface treatment. That is the value addition that we do.
Yes. So if you can give an absolute number,
surface treatment, then there is the ED coating is there. Then there's for the sub assembly is there. So at multiple levels, we are adding a process which is giving to a higher value addition.
I'll add to that. So see, our strategy there is to work on multiple different products, work on increasing content per vehicle, and also focus on the premium segment where your content per vehicle automatically increases. So the same part that goes into a commuter segment would say cost 100 rupees. Now when it goes to the premium segment would be close to 200 rupees. So that is the lever that we can pull, and we're currently, that's our focus area for growth.
All right, gentlemen, we appreciate you coming down. You've given us a brief understanding about the company. We wish you all the best for the issue, and on listing, we re-invite you all on, and at that point of time, we'll push you all a little bit for the numbers.
Sounds good.
Thanks a lot for joining in.
Perfect.
Thank you. Thank you very much.
Well, on that note, though, we'll have to slip into a short break. Come back. Deven Choksi is waiting for us on the other side. We'll get some fundamental stock analysis going. Don't go anywhere.
Welcome back. You're watching us here on Bazaar Morning Call on CNBC TV18. In case you've just tuned in, the overnight cues from Wall Street slightly soft, but the Gift Nifty is indicating a 15-point uptick after a big gash that we saw in yesterday's trading session, particularly in the mid and small cap end of things. We welcome Deven Choksi from DR Choksi FinServe. Deven, good morning. There was a big cut yesterday, but moments before we came to you, we were having this conversation with the management of Bellrise. The IPO season seems to be picking up. There are a couple of press conferences for IPOs lined up in the next few days as well, including that of Hotel Leela. Amidst all that is happening right now, have you had a chance to look at this offering, and what's your sense on Bellrise and the auto ancillary space in general?
Yes, good morning, Mangalam. Well, I believe that I think Bellrise appears to be a promising company. Given the kind of product range that they are catering to, both for ICE engine as well as for the EV, in respective categories, be it two-wheelers, be it four-wheelers. I think they have got probably a good amount of lever as far as the ability to maneuver the product range from one end to another end is concerned. That's what we gather from the subject understanding of the company. More importantly, this particular money which they are raising is getting utilized for the purpose of debt repayment, which means that if you take balance sheet fast forward, I think for next full year, probably, I think the amount of saving that they would have in the business because of the cost of interest, etc., will significantly enhance their profits going forward in the next financial year. So that is a promise which I believe that I think is likely to pay well in the marketplace. As such, we remain positive about the prospects of the auto ancillary companies, largely because of the fact that the India adoption of most of the global vehicles is happening at a faster pace, and including in EV space, I think this is happening now. So to a greater extent, the ancillary companies are likely to see the major benefit going into their books. So selective companies in the portfolio, I think we remain bullish about their prospects. Of course, the valuation at current level appears to be slightly expensive for this company. But as I said, that I think if they end up saving money on the interest cost and end up, I think, adding to the bottom line, which they could, in such situation, I think the valuation could get rationalized, a little bit expensive at the current levels.
Okay. Deveen, hi, welcome to the show. Morning. Wanted your thoughts on IndusInd Bank. It's coming out with numbers today. What are you expecting in terms of commentary, which I think would be the most important to watch for?
Yeah, good morning. Well, I think the most important part would be that they are going to be announcing probably as to what kind of efforts it would take for them to clean up the balance sheet. Already the major numbers are known of close to around 2,700 crores, which they probably had taken a significant amount of the damage into the balance sheet. In my viewpoint, I think how the corrective actions would take place, there probably the eyes would be what kind of management changes and what kind of team building that will be happening. I think that's where I think people will be keeping an eyes on. But as I see it, I think for next 1.5 to 2 years, I think major efforts will go in repairing the balance sheet as I see it at this point of time. So frankly, from investment perspective, would like to seek more clarity before taking any view on the subject.
Do you have a chance to look at the results that came in from Dixon as well as United Spirits overnight? United Spirits actually beat street expectations. Dixon, while it did beat street expectations, there are signs of a slowdown in a couple of their segments with some uncertainty around manufacturing going forward as well. Your thoughts on both of them?
So Dixon, the numbers are on the profitability front, that is the margin front, I think they appear to be relatively more stable than in the previous quarters. So that's a good sign. But whether it's something which is an opportunity, I'm not too sure. Everything is in price. Maybe I think this kind of fancy valuations, even though they have a high amount of growth and growth programs undertaken, I don't think that I think easy to accept I think this kind of valuation. So maybe we'll have to wait for corrections of any degree, maybe price correction or the time corrections to get into such kind of businesses when they're expensive.
And United Spirits?
Not too sure about that number, so haven't looked into it.
Okay. Oh, what about Hindalco? Did you have a look at Hindalco and what it reported in terms of its India business? It did well. Net debt is looking better.
So overall numbers, I think they are definitely appealing. They are better than what all expectations were. And certainly, I think the forward outlook, I think, from the company is appearing more promising than before. As such, I think we believe that it is time for some of the metal commodity companies, the ferrous and non-ferrous. I would think that next 6 months to 1 year, we are likely to see on one side the higher amount of global output emerging from metal commodities, and on the other side, for companies in India particularly, where they are having the advantage of lower input cost, lower manufacturing cost because of the energy cost prices are under control and they are mixing the renewable energy. So in my viewpoint, the profitability on one side and the market conditions improving on the other side, they are very well for many of the metal commodity companies. And that's where probably I think one could see the direction on the positive side. Once again, maybe some small corrections here and there, but I think the opportunity appears to be opening up for a big upside going forward.
Did you look at NHPC's numbers? I mean, some of their key projects have been commissioned in April as well. So post the Q4 numbers as well, the outlook seems fairly strong. The EBITDA was lower because of a couple of one-offs. So if there is a decline in today's trading session, would you look at increasing exposure to NHPC?
Not too sure, Mangalam. I haven't thought in that direction whether I would be considering this particular company from investment point of view. Maybe certain amount of reservations on this kind of businesses. That's where probably I think we are not completely applied our mind on taking them into investment portfolios.
And what about Eternal? Because that stock ended at the low point of trade yesterday, was 4% lower. It's that liquidity event which is likely to happen here, which is possible exclusion from the MSCI index, and that would lead to about $1 billion worth outflow because of the passive outflows. Because the company is recognized itself as a domestic-owned company, shareholders have given that note as well. Would you look at this dip as a buying opportunity, or do you think concerns around quick commerce will continue to plague the balance sheet of the company?
Yeah, we have reservations on the business model per se, and I think we feel that in the quick commerce game, probably the Reliance JioMart is basically putting in significant amount of efforts to probably meet the competition and beat the competition. So maybe I think one would not like to immediately buy into the companies which are relatively expensively quoted at this point of time. Yes, I think they have been trying to overcome this situation by adding different revenue streams into the portfolio. But in my viewpoint, I think they're still expensively quoted. So we stay away from it because the larger players are going to put significantly big amount of money behind the business. And that's where I think this kind of companies may remain a little vulnerable. I think unless they raise more money, they will remain a little more vulnerable.
Well, Devin, more of a short-term question, and I don't know if you're probably getting some client queries on it, but given this little bit of caution which is emerging with regards to COVID-19 cases, are you seeing a lot of queries probably come in for hospitals as well as diagnostic stocks?
Not yet. I don't think that is coming on the surface immediately, but maybe I think one will have to keep an eye on.
Okay. In general, how would you approach, say, a Fortis and an Aster that came out with its numbers on the hospital space? Any of these stocks that you've looked at?
Yes, we keep on having a good look at these companies, but we feel that most of the things are in the price. They are not the attractive proposition at all. Every company is talking about growth, adding number of beds, new facilities, etc. But the fact remains that I think they are leveraging on the market cap value that they are having, and they are probably, I think, rightfully doing so. But at the same time, for investors, I think they remain expensive proposition. So unless we see some meaningful price correction for at least, I think, seeing the headroom up to 20-25%, one would not like to buy into at current price. Maybe wait for some more time actually.
All right, Devin, thank you so much for joining in and giving us your views on a whole host of stocks and sectors. With that, we'll take a short break, come back on the other side. We have the pre-opening rates, and alongside that, we have the management of Nazara Tech joining in as well. We'll also get you technical ideas from Sudarshan Sukhani and Shilpa Rao. Nitesh Mithasen joins in to discuss their latest acquisition and investments.
Welcome back. Well, this is the Open Exchange live from the CNBC TV18 Motilal Oswal studio. Well, let's get talking about a couple of technical calls that you need before market opens. Sudarshan Sukhani and Shilpa Rao join in for their check on the market today. Sudarshan, Shilpa, welcome to the show. Well, Sudarshan, I'll start with you. What's your call in terms of where the Nifty could head today, considering that it has been cautious for the past 3 trading sessions?
Yeah, good morning. Well, yesterday was a disappointment. The idea yesterday was that we had a 2-day dip and perhaps we should be going long. And that exactly turned out to be the opposite. So once the market breaks support levels, I mean, by the market, I mean the Nifty, it becomes very difficult to suggest what the next trade will be. Today, we don't have a clarity on the short-term trend. Are we sideways? Are we up? Or are we heading down? So with a complete absence of clarity, my suggestion would be avoid the Nifty completely today. Let the market decide whether it at all finds support, whether it is willing to go higher. If we have to buy it tomorrow at a higher level, that's much better than entering today in a sort of a puzzle of confusion. So the Nifty is an avoid. The Bank Nifty still has a long opportunity going and buying the Bank Nifty with a tight stop around 54,500.
All right. And Shilpa, your calls on the index?
Good morning. My call would be, probably a wait and watch scenario. But if you're a compulsive trader, then, the support of 24,700 should act likely a brief, support zones as of now. So if it holds there, then maybe 100 to 150 points on the upside cannot be ruled out. And you can see 24,900 to 25,000 zones again hitting there. Bank Nifty, again, with a stop loss of, 54,700, you can still attempt a long there. And if there is some sort of consolidation or some sort of pullback happening today, then you'll see 55,500 levels coming in again.
Okay, and Sudarshan, stocks today?
Well, the Nifty is uncertain, but the stocks are still on the long side because the market hasn't turned yet. At least it may not turn. So Sun TV is a buy with a stop under 627. Dabur from the FMCG pack is a buying opportunity with a stop under 467. FMCG has been in my list yesterday also, so there is something going on hopefully in that sector. NTPC is a buy with a stop under 335. And Lal Patlab is again a buying opportunity with a stop under 2770. It's an all buy list for small and mid caps.
All right. Shilpa, your stock picks?
I will have one buy. The buy would be in Coal India. Coal India, despite the fall yesterday in the market, we saw some sort of strong consolidation happening and it was holding well. So with a stop loss of 400 from here, keep holding Coal India. It should do 430 to 440 zones from here. The other one would be a sell. Sell would be an Indian Hotel. Indian Hotel has broken down some crucial levels of 780. So with a stop loss of 780, keep a sell target there for 720 zones from here. The other one would be a buy in Muthoot Finance. It has seen some substantial correction yesterday, but 2000 levels continue to be a support. So if it holds that, then levels of 2100 and above can be seen.
Okay, all right, Shilpa as well as Sudarshan, thanks very much for joining in and giving us all of your pre-market calls. Well, let's talk about Nazara Technologies. The stock's been buzzing this month with nearly 30% gains. The company is on an expansion spree as well. They've interestingly acquired UK-based Curve Games for around 247 crores, while their subsidiary Fusebox Games has partnered with Banijay Rights. To discuss all of these developments, we have with us Nitesh Mitterson, who's the joint MD and CEO at Nazara Technologies, joining in. Nitesh, hi, morning, welcome to the show. Well, let's start with, the reason why you've purchased Curve Games, which is you've shelled out around 247 odd crores. If you look at the numbers, the revenue has actually been declining for the company in CY24, CY23. So what's the reason for that?
Sure. As you know, our stated objective has to be double down on the core gaming business that we have. And we have been expanding globally through these acquisitions of gaming studios and publishing houses. I think we found Curve very interesting because it's a very reputed firm in the PC and console publishing space. And the PC and console publishing space globally is a $100 billion business. And we also see a lot of synergies between our mobile gaming business and the PC and console gaming business. So it was very attractive for us. The valuation we got was very attractive. I think the decline you see is largely due to post-COVID normalization and a few other issues, but we believe that much of the pain is behind us. If you actually look at the EBITDA numbers and the PBT numbers, they have improved over the last 2-3 years. So we believe we've got a company that can grow well in the future and add a lot of synergies and business to us.
Right. That's a fair point because while you bought it at one-time sales, trailing sales, your EBITDA is roughly 35-40% is the margin that the company operates on. So that's a positive. But I wanted to understand what proportion of this revenue is recurring on account of the games that they have developed already, and what's the publishing pipeline that you have out here? What can this scale to?
They have a very strong back catalog and some very popular IPs such as For the King and Human Falls Flat, which have been running and monetizing for many years. So we believe there is underlying stability in the business. And on the top of it, the company, as a publisher, they are working with developers on a continuous basis. Now that Nazara has stepped in, we will accelerate that process and ensure that there's an even stronger pipeline going forward. One more big synergy is that India is seeing mushrooming large number of PC gaming developers due to the fact that Nazara is very embedded into the Indian ecosystem. We are usually in good contact and relation with all these Indian developers. And I think we can create this entire very exciting bridge between Curve partnering with Indian developers and building a strong publishing pipeline globally.
So what does this do to your blended margins, this particular acquisition?
Sorry, the overall margins?
Yes, your blended margins.
I think it's a little early to say. It'll obviously have a significant uptick on our margins, but we'll just let it play out in the next quarter or so.
And what's the scale that you're looking at here from, say, this roughly 25 million euro pounds outlook annually? How much can your acquisition scale this business up to?
We'd like to see the first year the business stabilize. We focus on long-term growth and take the right decisions. But I think 2-3 years out, this business should be compounding at least at a 15-20% year-on-year kind of metric.
Okay. You also announced, before we get to that global launch of Big Brother, before we talk about that, I just wanted to understand how you, paying for this particular acquisition, what does it leave you with in terms of the balance sheet, and what might your pipeline of M&A now be?
Sure. So we're paying about 240 crores for this, 247 crores for this. It's from internal accruals that we have. Cash is 100% cash transaction. Post this, we will have about 200 crores of cash with us. In addition to that, as you know, we had done a preferential placement of 495 crores, and we expect that money to come in the next month or so. So I think including that, we will have about 700 crores of cash on our balance sheet. We will continue to look at opportunities throughout this year and double down wherever we can, purely on the gaming business, especially global gaming studios.
All right, 700 crores comes in, no real problem for cash for you. You are M&A heavy anyway. Just wanted to understand now to what Ekta was asking about, the global launch of the Big Brother. If you could give us a sense of what the revenue share here is, how does that aid your overall performance in the gaming vertical?
Sure. This is, launched through the Fusebox Studios in the UK, which we had acquired last year.
Yes.
We own 100% of that studio. They already have a very popular game in Love Island, and this is the next game that they have launched. Big Brother is a global franchise. We've also acquired rights for Big Boss in India, which we will launch in the next 2-3 months. So we think this should do very well for us. It's early days. The game has just launched yesterday, but early signs seem very promising. We usually pay the license holders somewhere between 15-20% of net revenues after user acquisition spends. That's a general template when we are working with third-party IPs.
So how much will it add in terms of your P&L? If you could just break it down for us.
Yeah, it's early to say because, games can take off at different scales. So it's very difficult to predict a number. But if you look at Love Island game from Fusebox, that has been generating about 200 crores a year in revenue, doing about 40-50 crores of EBITDA. We'd love to see Big Brother kind of, repeat that. But we'll have to see how it goes.
What about Big Boss? Because while there is a fair amount of viewership for that show,
yes,
I'm not sure how that translates into game and net revenue for you on that. Similar is the case with Big Brother as well, because if you could, say, give us correlations between Love Island and the game in terms of viewership and the conversion to game revenue, and whether that is likely to replicate in Big Boss and Big Brother as well.
Big Brother, I think globally, because it's a popular franchise,
Yeah.
Love Island in the Western markets should monetize well for us. Big Boss obviously is a target to the Indian market. We are, having 7-8 languages that we are launching in. And India is a strategic market for us, right? We want a large user base, even if it monetizes a bit lower than the global markets. So we are okay with that, but we'll see how it goes.
Okay. What's the pipeline of more such tie-ups and how much are you willing to shell out on those?
Yes, of course. In recent times, we, for example, in Kidopia, which is another flagship product of ours, children, we've done many IP licensing transactions, including Barbie for Mattel, etc. So we're seeing a lot of opportunity where we can take global IP, integrate them in our games, and then launch these games globally. This monetizes well. It helps us overcome the challenges of user acquisition, which we have discussed many times in the past. So it's a path that we are on, and I think it will pay good dividends to us.
And since we have you with us, if you could give us an overall outlook on all the verticals of your company for the next year or so.
Sure. Of course, results are due soon. So
Yes.
I won't go into specific numbers, but we have, our esports business, which continues to do fairly well. Our core gaming business with higher margins is doing well for us, and some of these acquisitions are focused on it. So I think overall, we are on a good growth track for this year.
Okay, all right. Thanks very much for joining in and giving us all of that perspective on Nazara Technologies. So, big acquisition of over 200 odd crores is what they've made in the UK. Quickly, then, Sudarshan, coming back to you, what's your 9-10 call?
But that's NTPC. Buy NTPC with a stop under 335.
All right, Sudarshan, thanks a lot for that. I wonder how United Spirits will play out in today's trading session. In the pre-open, it had seen a big uptick. Let's see whether that sustains in the open or not as well. In fact, the pre-open uptick itself hasn't sustained. But be that as it may, it's a good performance that the company has reported. The revenue as well as the EBITDA have beat street expectations by a wide margin for the EBITDA and the net profit as well, further boosted by other income. The prestige and above volume growth at 9.2%. In line with good expectations of 8 to 10% growth out there. Revenue growth of 18%, again in line of 12 to 14% expectations there. What did not do well was the popular business, which saw volume decline of 2.2% versus an expectation of 3.5% growth. But that is not a focus area for the company as well. They've said that there has been a challenging consumer environment in that there has been resilience of their portfolio. Business in Andhra Pradesh led to the growth coming by in their P&A volumes, which is something that we saw across the board in the Alcobev space. The con call tomorrow at 4:30. We'll get more details from that on the leadership strategy. But for now, opens mildly in the green as per what the pre-open is indicating. But that's about Daru. Ekta, what about Dawa? Torrent Pharma.
All right. Well, for Torrent Pharma, the revenue was up around 8%. It is, a stand better than what the street was anticipating. 2,959 crores is what they reported, and the estimate was 2,904 crores. EBITDA 964 crores is what they've reported, and versus estimates of around 956 odd crores, which resulted in a margin which was in line at 32.6% and profit of around 498 odd crores. Now, what stood out was that the India business was up around 12% year on year. It was led by the chronic segment for Torrent Pharma. India was up around 12 odd percent. US sales were a little better than estimates. So US sales came in at $35 million versus estimates of $32 million. And the management is expecting mid-teen revenue growth in FY26 versus what the street is working with of around 9.5 odd percent. Brokerages, Nomura has written on it, neutral, target price 3,580, except for the US revenue across geographies was behind estimates according to them. Citi buy with a target price of 4,000. Margins at 33% was up 60 basis points Q on Q versus a guidance of flattish margins. They believe the margin expansion trend will continue. Nomura has a buy and a target price of around 3,760. So let's see what Torrent reports. Let's go across to Sudarshan. I think he's watching JK Tyre.
So in pre-opening session, the stock is down more than 2%. It's on the back of operationally weak Q4 that company has reported, both India business and Mexico have seen a decline, both EBITDA and margin. If you talk about the overall EBITDA, it was down 24%. Margin has fallen to 9.7% against 13%. India business, which forms nearly 90% of total revenue, their margin has fallen to 7.8% from 11%, and EBITDA was down 25%. Mexico business, which is very small, there also revenue was down 27%, EBITDA has fallen 93%, and margin has come below 1% against 5% in the same quarter last year. But more than the Q4 numbers, what would be in focus is the internals have improved for the tire industry in the last few months. So we'll have to watch out for in the analyst call what exactly company says about the outlook going forward, especially about Q1 FY25.
Okay, all right, Sudarshan, thanks very much for that. So that's JK Tyre. But I'm looking at Zydus Life. So it came out with its numbers yesterday, but the commentary seemed positive. It came out with numbers during market hours, but the management commentary was positive. So let's see what the stock does. They expect single-digit growth in the US revenues in FY26. This is despite a high base of FY25. For example, they had Revlimid generic, Mybetriq generic, Asacol HT generic. They are expected to continue selling Mybetriq in the US despite the recent patent litigation. So that's something that Lupin had also indicated, that they will be looking at, some kind of legal add-ons when it comes to this. Large US launches like Adempas generic as well as Ibrance is expected to add in FY27 and FY28. They're guiding for EBITDA margins of around 26% plus in FY26. So let's see whether that comes through. That would probably be something that the street is watching out for. It would be lower than what they did in FY25. But the US business, the fact that they can sell Mybetriq generic, continued sales of that, and this is when Revlimid generic is sort of weaning off for most of the companies, should probably go down as a positive, guys.
All right, we look at how the street takes that on Zydus Life. But for the market opening, 60-point uptick is what the pre-open has settled at right now. The mid-caps a tad lower in terms of comparison with the frontline index. But we'll keep an eye out on how it pans out from an index level. A couple of individual stocks actually really stand out. We have NHPC, which is among the top F&O gainers this morning, up around 2.64%. Results are good. Profits rose about 57%. We're also seeing some traction in a name like Siemens, which is up around 2%. DLF up about 1.5%. On the way down, though, we do have Supreme Industries and GMR Airports down about 3% and 1%. In the broader markets, a stock that really stands out in terms of gains with decent volumes backing it is Dredging Corp, up around 11%. So let's see whether that sustains again once we open or not. But by and large, looks like a fairly stable opening, pretty in line with what the GIFT Nifty was indicating. We have about 3 seconds to go, so the bell rings.
Well, that's right. 60-point uptick is what we are seeing, but I guess, the markets could be a little bit nervous, so at some point of time that could get sold into. For the time being, good green, 70 points higher. Coal India is up close to 100%. BEL as well as returned to its winning ways, that's up close to 100%. Dr. Reddy's, that's up 1.5%. So good move is what we're seeing on that name as well. What's dragging? Trent is down mildly lower. It's down close to around 0.5% or thereabouts. Trent as well is down. Eternal is seeing another downtick of close to around 0.5%. The mid-cap index as we speak, that moves into the red. Yes, the mid-cap index has now done a bit of a U-turn as we speak. Number of stocks advancing still around 1,000. The number of stocks declining, they've crept up to around 600 number of stocks. KPR Mill, we're expecting a large trade out there. The stock is down close to around 5.5%. Kochi Shipyard, pausing for breath. Stock is down close to around 2.5%. Ircon, though, is up close to 2%. And Vivek told us that NHPC as well, those numbers were quite good. So that one's up close to around 2.5%. Hindalco, the numbers look quite good. For the time being, the stock is holding with a gain of around 1%. Investec and some other brokerages, they're pointing out that maybe, in fact, the past quarter was peak performance. But for the time being, the stock's building on gains up 1%.
In the mid-cap end of things, I'm looking at a couple of stocks, Nigel. Whirlpool, that is top of the pops this morning, up around 6%. Good numbers coming in. Upasna did tell us that margins increased by 80 basis points. EBITDA up by 27% as well. Seasonally strong quarter for them. That stock is up 6%. We are also looking at Dixon Tech, though. Despite good numbers, the stock's seen a bit of a sell-off, down about 5%. Right now is among the top losers in the F&O space today. And giving company on the way down is PI Industries as well. PI Industries is another one which is down 4%. Surprised by the move that we're seeing on United Spirits, though. The results weren't bad. They were good results. The stock opened in the green, and from there itself, it's seen a sharp sell-off, down about 3% right now. Will be very interesting to see whether it is on account of valuations, it's on account of the street awaiting clarity coming in from the conference call or not. But right now, swift profit booking is what we're seeing on United Spirits. Delivery, Gale are the other ones which are lower. Torrent Pharma, Ekta spoke about it. Good numbers, stock up about 1.5%. And we spotted dredging the pre-open. Actually, post-open, that up move continues. Dredging is up 10% as we speak, with decent volumes backing that stock as well. Ekta.
Okay, yes, absolutely. I think Whirlpool and NHPC are really the big stocks of today. But I just want to point out, without adding too much of drama to it, but a couple of these diagnostic stocks are higher. So Metropolis is, in the green. We have Thyrocare, which is up around 2.8%. Maybe there could be a little bit of incremental testing which could take place because of COVID-19, and that is possibly reflecting in terms of the stock performance at this point in time. Separately, JK Tyres, just watch out for that because that stock is lower post its numbers, so it's down around 2.7%. We have Dixon Technologies, which is down around 4% at this point. Pfizer, which was up around 11% yesterday post numbers, is showing some amount of profit booking today. So that stock is down around 1.7%. You were talking about, a couple of these AC makers. Blue Star is showing some amount of traction on the upside. And just watch out for Aster DM, Fortis. Both these stocks are moving in opposite directions as we speak in opening trade. But
all right, just a few more stocks I wanted to highlight. Finiotex Chemicals, the stock has got smacked. It's down close to around 8.5%. So big downtick is what we're seeing out there. Sangvi Movers, that's the other one that's down close to around 5%. In the last few trading sessions, the stock had run up very, very hard. But now, in fact, it's coming for profit taking. So that's another result reaction. Finiotex Chemicals. We have Sanghi Movers as well that's coming for some profit taking. And Arvind Smart Spaces, that stock as well has seen some mild profit taking as we speak. So just keep an eye out on that one. In terms of Whirlpool, the reason that the stock is up, I think the margins that they delivered was the best that we have seen all the way since Q4 FY21. And this is even after they saw some kind of gross margin compression. So that's why the street likes it. That's why the stock is up close to around 5%. I think in the last 45 days or so, the stock actually is up close to 35%. So big move is what we're seeing. Valuation support is what is there in comparison to its past. And also you see the margins that are perking up, though the overhang with regard to what the promoter entity will do, that will continue. On Dixon, I'm going through a note, that's come in. There is a bit of a downgrade that's come in from GM Financial as well. They have downgraded the stock because the stock is valuation-wise not very, very cheap is what they're highlighting. They've trimmed their guidance as well. EPS cut of around 6 to around 7% or there on terms of an EPS cut. So even after good numbers, no valuation comfort. So the stock is selling off.
Just looking at solar industries, yesterday in the last hour of trade, we had some commentary coming in from the management con call out there. And this morning, it's done well. The stock was at a near record high a few days ago itself. But after there were the numbers, the management gave good commentary, and the stock has recovered about 4% from lows and currently at the high point of trade.
Okay, so just about consolidating for the indices as we speak, though. Nifty is up around 48 odd points. The mid-cap index is just about flat with a little bit of a positive bias. Let's get talking about a couple of cues for the markets. We have Nimesh Chandan, who is the Chief Investment Officer at Bajaj Finserv Asset Management, who is joining in now. Nimesh, hi, welcome to the show. Thank you very much for taking the time out. If you could just start with your overall call for the markets, just about consolidating today. We had a large FII sell figure yesterday. What is your take? Is it more stock specific? Are we going to see consolidation in the frontline indices to continue?
Good morning and happy to be on your show. We are quite bullish. So while there is volatility expected in the near term based on certain headlines that come, certain numbers that come of the previous quarter, actually, fundamentally, India is actually positioned very well for this year. There are many positives that have come up in the last 4 months, which actually strengthen this up move and possibly can continue this bull market. We've seen fiscal policy being more demand-oriented, and you will start seeing that reflected in generally savings and consumption growth in the coming year. We've seen accommodative monetary policy with 2 rate cuts already come in and 2 more expected. So lower interest rates, better liquidity, better credit growth will start showing up, and it will impact the FSI positively. It will impact consumption positively. Even in the trade talks, if you see, the worst case scenarios didn't turn up, and India actually benefited from some of these trade talks, and possibly we have another agreement to be signed with US also. And trade is a relative game. So if your neighbors are being taxed more and you are at a lower tax rate, then it's fine. So a lot of positives that have come up in the last few months. I think markets are reacting to that. Yes, some volatility based on international headlines as markets stabilize will come in, but very positive outlook for India, especially the large cap space and selectively in mid caps and small caps.
So what is your positioning right now when it comes to sectors, Nimesh? And based on your investment philosophy, what are some of the things that seem attractive to you beyond the financials and consumption names that you just spoke about? If you could get a little more specific.
I'll just give a perspective and try to slice and dice our portfolios in various categories of segments. Let's say if we've been accumulating mid cap and small cap in the last 2 months, and we've increased allocation there. We have increased companies with a combination of quality and growth as a factor because they give you upside as well as they are a bit defensive. On the third, if you cut by themes or sectors, we are positive on BFSI, consumption, and healthcare. Within BFSI, NBFCs will see immediately the benefit of lower costs, and we believe that rest of the year you will see good credit growth helping the banks. In terms of consumption, we are bullish from everything from groceries to real estate, and especially certain segments like alcohol beverages, real estate, and ancillary plays to real estate, we are quite positive on. And healthcare, we believe that after some clarity on this US tariff, valuations will get back to normal because there's a huge runway for growth for generics. Indian markets, in terms of pharma, diagnostic, hospitals are giving you a steady growth and the numbers are good. And CRAMS and CDMOs, I think this is one segment which will see a very good growth in the next 3 years.
All right. Hi, Nimesh. Good morning and good to see you. When, just to sort out a couple of details, earnings were not expected to be that great for the past quarter. And I think, most estimates, they are indicating that maybe, in fact, it's a little bit better than those weak estimates. However, FY26 is going to be the big year because we need to get back to that mid-teen double-digit growth. What are the odds? How do you read last quarter's earnings and your expectations for this year?
Good morning, Nigel. Actually, you see from the first quarter end of last year, so from Q1 FY25 end, we've been seeing downgrades in numbers and people have been reducing their estimate because outlook was a bit slow. You saw the pickup in GDP also coming in the second half. In the first half, we had a slow growth almost throughout the economy. Now we are probably out of this worst phase where we were seeing some downgrades. Right now, also when we see the numbers on reduced expectation, I think now everything is even Steven in terms of beats and misses. You have to be selective in each sector to pick up the right companies. But it looks like that the downgrades, that cycle that we were in, seems to be now at a pause. From here on, if I listen to all the conference calls in various sectors, one noticeable thing is every major sector leader, every large cap company in the sector is looking for a better FY26 than FY25. And except maybe some sectors which are internationally exposed and they see uncertainty, like for example, the IT sector. Most other sectors, if you see the commentary of market leaders in those segments, they are guiding for a better FY26 than FY25. We have to choose on valuations where large caps right now look very attractive. Mid caps, small caps, in pockets, they've become attractive after the correction.
Okay, fair enough. Nimesh, you did mention CDMO players in the pharmaceutical space that you would be looking out for. We have this entire semaglutide opportunity which is going to emerge in next year. And that could be probably a big positive for a lot of pharma companies and ancillary companies within that space. Is that an opportunity that you've looked at, and how would you play it?
Absolutely. So if I look at the numbers that are projected till 2030 and 35 of GLP-1 molecules, and obviously their derivatives and other modes of delivery, I think there is a huge opportunity there. And Indian companies have the expertise to take benefit of this, whether it is supplying on the CDMO side or competing on the generic side. So I think this is a big opportunity for pharmaceuticals in India. we obviously have to go company by company in terms of what major impact they will make on the revenue of that company. But I think this is a very long story to go. I mean, next 5-7 years. See, some of these CDMO stories and GLP-1 stories, investors have to look at the mega trends and be a little patient with them. They will go through their cycles of expectations being a little volatile because people are still grappling with what exact numbers will be there. But these are definitely big opportunities for Indian pharma.
Right, and just a final question, a little more specific on the consumption space. You said you like everything from groceries to real estate. That's a wide variety. Anything that you like more than the other? And if I had to play consumption, do I play it via FMCG or do I play it via quick commerce?
I think quick commerce, discretionary, these will give you faster growth for sure. And you will see even FMCG doing better. So from what I see that the majority of the results are out and the outlook given by most of the FMCG companies is they are looking for, say, many of them are looking for a double-digit kind of growth and some expansion in margins also, except for some which are investing in the businesses and they may see margin pressure there. FMCG-like companies, they get their major re-rating when people are confident about steady long-term growth because their cash flows are very good. These are very good brand businesses, good cash flows. Once people get convinced, okay, I'm not seeing any market share loss or I'm seeing better times for the next few years, then those guys get rated upwards. So it will move selectively. I think from January onward, we've seen some selective re-rating upwards in them. They will give you steady growth. The delta may come in Alcobev in terms of discretionary spending in consumer and real estate is what we are quite bullish on.
Take that point, Nimesh. Thank you so much for joining in and giving us your perspective on the markets and the way you feel about the markets. A little more optimistic than what the screen has on board for you right now. Though there is consolidation, the one stock which is on our radar all through this morning is Dixon Technologies. Good numbers coming in as expected, but the stock under pressure. That's largely on account of perhaps the fact that they fell short of their full year guidance on revenue, but more importantly, lack of valuation headroom available out here. Saurabh Gupta, who's the Chief Financial Officer of the company, joins in now, down 7% for Dixon Tech. Saurabh, thank you so much for joining in. You did see good growth. For the year, it was 120% on the revenue, but still short of that 40,000 crore target that you had for the entire year, and higher contribution coming in from lower margin products like mobile segment, etc. So if you could give us a sense on what your prognosis for FY26 is when it comes to revenue and product contribution.
Yeah, clearly we have a very strong order book across all the verticals led by mobiles, and even the IT hardware now from this fiscal year will start to deliver numbers. And we've already formed a large partnership with Inventec, which will really add to the profitability and revenues in the coming years. There's a huge focus on backward integration. We are getting into 4 component categories. We will leverage this component scheme announced by the government. So my sense is in revenue-wise, we can expect a 40-45% revenue growth this year. And we feel that through operational efficiencies and also through backward integration play, and also through higher contribution of some of our refrigerator business, which is higher margin business, I think so there can be some margin expansion, which one can expect in this current fiscal as compared to the last year.
How much could the expansion be?
My sense is we can expand the margins by 20-25 bips in the current fiscal as against last fiscal on a much higher top line growth.
Okay, all right. You know, Saurabh, there have been some reports of slowdown in mobile phone sales post the festive season, you know, in the earlier part of this year. What were your volumes like in Q4? I do understand that it was quite flat on a sequential basis. And what is the ramp up that you're expecting, and what are the headwinds that you're facing when it comes to these sales?
Yeah, one of the reasons our revenues are flat on quarter basis is basically the mobile revenues were kind of flat. Of course, the margins were slightly better. So we closed the year with around 28 million smartphone volumes. Last quarter, my sense, it was somewhere around 7 odd million. But we are expecting a significant growth this year. This 28 million can potentially go to 43-44 million, out of which 10 million can come from exports. So there'll be a significant jump in export volumes. So last fiscal year, we just did 1.5 million of exports for our anchor customer. And this year, we are expecting almost 10 million worth of exports. So that will be a large jump for us. And our big upside can happen in 26-27 when our JV with Vivo should start delivering. So then we can expect a volumes of somewhere closer to 65 odd million. So clearly, in the next couple of years, I think so we should be able to more than double our revenues and volumes in the mobile business.
All right. Hi, Saurav. Good morning. Good to see you in. Nigel on this side.
Hi, Nigel.
A quick question with regard to this, this export contribution that you have. As a percentage of business, how much is exports? Where do you see this number headed?
Yeah, so Nigel, last year it was around 5% of our revenues. So on 39,000 crores, broadly 5%, 1,700, 1,800 odd crores. This year, my sense is that that number can be almost closer to 9 to 10,000 odd crores. So both as a percentage and both in absolute numbers, that number will increase for the company. And exports is a natural trajectory for our growth. We think that exports as a percentage of revenues will keep increasing given the geopolitical tailwinds now in India's favor, and also companies like us really investing in backward integration, companies like us attaining a particular scale and size, and matching those cost structures at a global level.
Okay, all right. Just one more question with regard to these exports. Could you tell us, is there a realization difference between exports as well as domestic? And in turn, would there be a margin difference as well?
Yeah, so definitely both in terms of realization, definitely, Nigel, it will be at a much higher selling price because the global markets, it's more high-end products and all more 5G products. And also some of the customers are also from whom we are manufacturing have higher selling prices. So clearly it will definitely much higher on the selling prices. And I feel it will be margin accretive for the company as well.
Right. In realizations, what is the difference and how much margin accretive? If you could just give us a brief idea, that it'll help, it'll help us going ahead as well.
My sense is every year the ASPs are going up, and I expect that the selling prices should go up by another 8 to 10% this year. So that should lead to a significantly better growth than the revenue growth here, but then the volume growth, yeah.
You know, from a industry standpoint, what are your thoughts? Because you said that there are manufacturing tailwinds for India. There definitely are, but some say the tailwinds may have slowed down largely because of the US-China trade deal that has happened. So maybe increased manufacturing orders may not come to us at the pace at it would be earlier. I wanted you to chime in on that. And what's the growth visibility that you have beyond FY26? You said 40-45% for FY26, and thereafter you have the Vivo contract coming in. With the kind of capacity addition that you're doing and the contracts that you've been signing, if you have a visibility for beyond FY26, maybe all the way up to FY30?
Yeah, just to answer your second question first, I think so 27 can be even a larger growth for us. Of course, led by mobiles, IT hardware, and of course, the other verticals as well. So we expect that in next 2 years, I think so the revenues for the company has the potential to more than double from 39,000 odd crores that we closed in the last fiscal with a decent margin expansion. And as far as your first question was concerned on the tailwinds, clearly for some of our anchor customers, we have expanded our capacities by 50%, and we are seeing a 50% growth in that order book. And when I said that 1.5 million potential exports for last year can go to 10 million, it is mainly on account of this geopolitical things which are evolving right now. So my sense is even after the tariff on China or the trade deal that China and US are having, there's still a decent arbitrage and will be an arbitrage between India and China as far as the duty structures are concerned.
Okay, so you're expecting a positive arbitrage to play out for you. Your consumer electronics division, Saurabh, your TV category especially continues to be under pressure for many quarters now. What were sales this quarter, and why is that? What are you trying to do to revive it?
Yeah, so TV definitely has been in pressure. This has a structural issue, and not only in India, globally, TV sales are coming down. People are consuming entertainment on other mediums. So clearly, there's a shift in consumer preference. So one, we are getting into more categories like displays, IFPDs, and all. And also, we are trying to forge some partnerships in this category, which will, of course, help us get some more business, and we'll try to bring this business back on track. So a lot of efforts are being made. But our other piece of consumer electronics, which is refrigerator, is doing very well. In a short period of time, we have been able to take a large market share in this category. And we expect a 45-50% growth in that category, and which is also coming at a very high margins for us. So yeah, TVs, yeah, my sense is there was a dip in volumes, but yeah, we are making some efforts to get into more categories, getting into some more ODM-driven products, and try to get into some kind of a partnership.
Okay, all right. Saurav, there's this big China plus one and India being the beneficiary. Now, considering the tariff uncertainties, is there any possibility that Samsung, Vietnam as well as Motorola will shift their global production basically from the Vietnam to other countries, to India? That is the hope. And is Dixon expected to be a beneficiary of the same? That entire shift from other countries to India? And has your phone been ringing with these kind of inquiries? Go ahead.
Yeah, so Nigel, definitely the inquiries have significantly increased. And one of the customers that you mentioned two customers. The second customer, definitely, I mentioned that is a customer we are expecting a significant increase in volumes by almost 45-50%. And out of which 50% of those volumes will be for the export markets. So clearly that shift or that the movement has already happened for us now, at least for one of our anchor customers.
If you could give us a couple of more details here. One is what is your current ODM share of your overall revenue? Because that's a margin accretive business. Where do you intend to take that? That's point number one. And secondly, while the benefits of PLI start to wane off, you are doing the backward integration. So what is that offset likely to be? Because you're targeting revenues doubling, say 80,000 crores over the next couple of years with significant margin expansion. What are the drivers for the margin expansion? How much of that will be because of increasing ODM mix, increasing export mix, and your backward integration? And how does that get offset by the PLI benefits?
See, as an overall number, ODM is significantly increasing for us, but as a percentage, it may not be reflecting because a large part of our growth will be coming from mobiles and IT hardware as a category, which is majorly prescriptive driven. And we don't have our designing solutions as of now on both those categories. But my sense is the margin will expand. One, on account of the backward integration play. So we have narrowed down on 4 components. Displays, we have already signed up with partnership on HKC, which is expected to, the trial should happen by Q4 of the current fiscal, and the mass production should happen from Q1 of next financial year. Secondly, we are in advanced stages of closing our partnership on camera modules. And then 2 other components, which is lithium-ion batteries and enclosures, we are actively working on. So we feel that all this component play will come at a very high margins for us. It adds a lot of strength more into the business, and from getting into this backward integration, I think so we should be able to overcome the loss in the PLI income that we are booking in our books. And also we are working a lot on driving our operational efficiencies, working a lot on automation, robotics. So that's a continuous work right now. And we feel that through a combination of all these 3 things, not only will we be able to mitigate the loss on the PLI thing, but also we'll be able to expand our margins in the next couple of years.
So what margins are you targeting on an 80,000 crore top line?
And next couple of years, if everything goes as per the plan, I think so there can be possibility, if not more, at least a 90 to 100 bips kind of a margin expansion is possible.
All right, Saurabh, we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's Dixon Technologies. But now let's shift focus to the entire hospital space. We have Max Healthcare. They've reported what was a stable performance in Q4 with occupancy coming in at around 75%. The company's seen a decline in the EBITDA per bed due to a new hospital addition in Dwarka. To discuss more on this and the company's Q4 performance, we have Abhay Soy, who's the chairman and the MD of the company, joining in now. Abhay, hi. Thanks very much for taking the time out. This is Ekta. If you could just start by giving us a sense in terms of the EBITDA per bed. It's come down this quarter, 73.9 lakh versus, say, 76 lakh same time last year. Tell us on a normalized basis, what was it and what were the key trends, considering that you did have Max Dwarka, which was added into the mix this quarter?
Well, Max Dwarka wasn't added in the mix this quarter. It was added earlier last year, month of July. It broke even in a record time of about 6 months. And presently, at the exit of Q4, it was operating, it's a 300-bed hospital. We've operationalized 235 beds over there. It was operating at a 73% occupancy with about approximately a 30 crore revenue for the month. But having said that, it's sort of marginally brought down the overall EBITDA per bed. But I think the thing to focus is on really ROCEs, right? I mean, we've also done 3 other acquisitions last year. We acquired Lucknow, which in the first year of its acquisition has grown by 56% revenue and 106% as far as EBITDA is concerned. We acquired Nagpur earlier on in the year, which was March last year, which again has grown at 26% top line and 56% on EBITDA. We acquired JP Hospitals, which is the marquee hospital in Delhi, which was in October, November last year. And that is, yet being integrated, but yet it's has about 21-22% EBITDA margin. But having said that, some of these acquisitions, obviously, they don't have the same EBITDA per bed presently, but that's exactly where the opportunity lies in moving that up.
Exactly. You have a lot of moving parts, Abhay, considering that you have a lot of these acquisitions which will be integrated into the fold in the next couple of quarters. So give us a guidance in terms of what we can expect on the EBITDA per bed, or what we can expect in terms of occupancies and possibly the ARPOBs going forward.
With respect to ARPOBs, you've seen, our previous hospitals have had an ARPOB increase of about 7.5%, which is pretty much in line with how it's been performing every year prior to that. We've also had occupancy of 78% of erstwhile hospitals. If I take out the occupancy of Dwarka, which obviously has been ramping up, which is the new hospital, then the overall occupancy again is close to 77-78%. But because of the newer hospitals, and particularly what we acquired in the month of October, November, which was the two JP hospitals in Noida and Chitta, they have overall occupancy of 46-47%. And that is what is sort of dragged down, at least optically, the occupancy. But having said that, we've reported a year-on-year increase of 29% as far as revenues are concerned, 26% as far as EBITDA is concerned, and 21% on profit after tax. And that's a fairly sort of healthy growth, we believe.
Absolutely. International patient revenue, you've had some issues with regards to Bangladesh and Yemen. Has that shown any kind of improvement this quarter? And what are you guiding for, considering that, there was around a 28% growth in Q4 when it came to international patient revenue?
So clearly, we haven't had those issues because, last quarter we grew by 24% year-on-year. And this quarter we've grown by 29% year-on-year. So we've been able to sort of make up those loss of those businesses through other sort of direct-to-home fly channels that we've been able to create. So, this business, again, like I said, has been growing by 29%. And again, that's a fairly healthy growth.
I just wanted your thoughts on the run rate for Max at Home and Max Labs. You did about 100 crore combined in both of these in the fourth quarter. At what quarterly run rate can it grow from here?
Well, I don't give forward-looking statements, but consistently they've been around 20 to 24% growth, I think, for many, many, many quarters now. And Max Lab has grown by 22%, whilst, Max Lab has grown by about 20%, whilst Max at Home has grown by 22% in the present year.
Okay. Are you seeing any kind of incremental testing in Max Labs, hospitalizations because of, the recent increase in COVID-19 cases?
We haven't really seen any increase in COVID admissions. Anecdotally, there have been COVID cases, and but these are very mild COVID cases. I think it's very unlike perhaps what's happening in Hong Kong and Singapore at present. But it's been very mild, I think, all across.
You don't think that could increase in India? I mean, the cases are mild. It's happened in Hong Kong and Singapore, which is a little more. We don't need to worry, right? I mean, not a business question, but this is a genuine question from everyone who's watching and for everyone who wants to know what the trend would be.
It's so difficult and so hard to sort of predict that trajectory because, how this virus morphs, will it morph into something different, etc. It's very, very hard to call. I think it's important to sort of keep an eye out and monitor. And the isolation is a great thing. Anybody gets fever, gets temperature, or any of the symptoms of COVID, or even one believes may not be COVID, right? But it's prudent to get yourself tested and isolate. That is something which has clearly worked in the past, and that should hold us in good measure.
Okay, I just want to come back to the business. wanted to understand what was the increase in, say, complex cases that you all probably serviced this quarter. I was looking at another hospital company. Robotics revenue has been, over 50% in terms of growth on a year-on-year basis. What was yours in terms of, say, complex surgeries, oncology, robotics, and what are you guiding for, and how is it adding to your margins?
Clearly, I think the 7% RPOP that you see, I think about 2.25% every year is due to price increase. I think everything else is largely due to, and you must keep in mind, when you're already operating at 75% to 78% occupancy, it's incremental. But that would mean it's about at least a 12 to 15% increase on more complex cases, more oncology cases, and so on and so forth. So that has been our mainstay. I mean, you've seen some tower specialties, particularly like oncology, that has been growing at 24-25% per year by itself. So I think, it's just a lot more awareness of it, and perhaps a lot more people are getting sick because of oncology, and some of the other tower specialties as well.
Okay. You're expanding in Thane, which is like a micro market. What's the reason behind that? It's around a 500-bed hospital that you're looking at, and it's going to be an asset-light model, I understand. What is the kind of growth that you're looking at from a micro market like that? And is that a strategy that you're probably going to adopt going forward?
Right. I think a place like Mumbai can host at least 3 to 4 hospitals from us. I think Thane is a extremely robust market, and we've seen some of our peers do extremely well over there. So I mean, it's clearly been on the agenda for a long time for us. We've been seeking land over there, and we were happy to sort of engage with really a blue chip partner over there. To be able to set up an asset light. This is in line with what we are doing in Zirakpur in Mohali, what we've recently announced in Pitampura in Delhi as well, and in line with what we've done in Dwarka. So this asset light sort of model works for us, where somebody else who has the land builds out the hospital and gives it out to us, for a long period. 50, 60 years is typically the lease. And, that's how we've been, it's an asset light model. It has high ROCEs for us, and it's in line with what we've sought out to do.
Okay. Just quickly, then, Abhay, just wanted your perspective in terms of the competition rising within the entire hospital space. We now have Adani's entering into the Ahmedabad as well as the Mumbai market. What is your sense, considering that there's so much PE money within the entire space as well? And you have bigger names, conglomerates, which are entering as well.
See, typically PE money is finite, over a finite period. They look at an investment over 4 to 5 years. What we need in India is creation of quality healthcare assets. Just the extent that we are underpenetrated. In today's date, we have a baby boomer population, which every year is getting a little older, is getting a little sicker. Awareness is going up, and as we are moving towards being a $5 trillion economy, you have people's affordability index has moved up, and just frankly, our expectations of public spaces has significantly improved. I mean, look at the kind of airports we go to, right? PE money, fortunately, unfortunately, is largely deployed towards M&As and then exits, because to build out a hospital can take you 4 to 5 years. What you do need is money, long-term money coming, from the likes of Adani and others, etc., to build these healthcare assets, because that's how assets are going to get created. It's not necessarily going to be done by PE money. In fact, I would vouch that perhaps won't be done by PE money. I mean, we ourselves are opening in the next 90 days or 120 days. We're going to be opening 3 new hospitals. Mumbai hospital will be ready, the Saket one in Delhi. Then we are going to be opening Mohali, and so on and so forth. I mean, last year we were 3,500 beds. At present, we are close to 5,000 beds. By end of the current financial year, we'll be 6,500 beds. And, by 2028, we should be 9,000 beds. But, clearly what we're also doing, all the profits that we generate, all the profits that we make, and I can say this for the entire industry, it's not really a dividend-paying industry. The entire this thing sort of goes back to creating more healthcare assets, which are so needed in the country, right? I mean, we're just the extent of under-penetration. And you require all sorts of formats. You require all sorts of investors. Adanis have a deep sort of pockets, and also have been nation builders in so many ways. So, we're welcoming all of this.
Okay, all right, Abhay, we're going to leave this for a longer conversation next time, the changing landscape of the entire healthcare hospital market. Thanks very much for joining in and speaking with us. Well, that's Max Healthcare. They are expanding to around 9,000 beds in the next couple of years. We need to take a short break. However, on that note, up next, we'll be talking to Akshay Kumar Singh of Pet Tech LNG, who'll join in to talk about their earnings. Stay tuned.
Welcome back. Well, the markets actually have zoomed up. So the initial dip got bought into, and now we're at the high point of the day. So good move out there. And one stock that's standing out actually is Tejas Networks. I don't think we have yet referred to it. Post its numbers, the stock got slammed because there was no big order win that they saw. Now, earlier today, TCS had put out a disclosure that they had won an order, and in turn, Tejas benefits as well. So Tejas as well has put out that they have won close to 15 to 1600 crores of order inflow. So it seems, at least in terms of the order book, some part of that is getting resolved. Now we'll have to track the receivables and the operating margin performance as well, because the last quarter had a couple of one-offs. So keep an eye on that, up close to around 3.5% after getting slammed more than 20% post its numbers. Well, let's get chatting with Mr. Akshay Kumar Singh, the MD and the CEO at Petronet LNG. Hi, Mr. Singh. Good morning, and thanks a lot for speaking to us here on CNBC TV18. Well, in the past year, your volumes got hit and your utilization levels as well were under pressure. However, the street is optimistic that demand will come back in the coming year. So in terms of number of units, what kind of volumes can you guide us for in FY26 that compares with FY25? And also, if you could break it up for us, how do you expect capacity utilization levels to improve at Dahej as well as at Kochi that was very, very low in the past year? Please go ahead, sir.
Good morning. And I would like to express my heartfelt gratitude to CNBC team for inviting me to share insight. Last year had been very good for the gas market. There was almost increase of 4% gas utilization across the country. And particularly the LNG side, there was almost 10% increase in the import and consumption of LNG. And PLL, being a leader in the LNG business, both the terminals have utilized the maximum capacity with respect to the previous year. Our volume total combined is highest ever in the history of Petronet LNG. We processed 934 TBTU of LNG, both combined our terminal. Going forward in FY26, we expect that this momentum will continue. The basis of this assumption is that in the latter part of this FY26, it is expected that almost 40 million ton of LNG capacity added across the globe, particularly in US, almost 25 million ton per annum, and Canada, 15 million ton per annum. So with increase of the LNG availability in the market, the prices are expected to be softened, and that will help the more import of the LNG in our country. We are in the process of expanding our capacity at Dahej, which is presently at 17.5 million ton. And last year, almost we utilized 17 million ton capacity at Dahej. And in coming 3 to 4 month times, we will be increasing the capacity from 17.5 million ton to 22.5 million tons. And that will give us the leverage to handle more volume at Dahej. Dahej is being the unique terminal in the country which has a unique feature of world's busiest.
Mr. Singh, yeah. Mr. Singh, just wanted a couple of numbers, sir. We've got that. You know, the graphic plate is telling you about that capacity expansion from around 17.5 to around 22.5, MMT, which is good. But for the year, last year you did 17 from Dahej. And from Kochi, I think it was in the ballpark 1.5 approximately. For this year, what kind of a volume, sir, can you do?
Yeah, see, as we know that the import of LNG is largely dependent on the prices, and the expectation is that when the more capacity is added, the more volume will be coming, and we will be able to handle the large part of those volumes. Our four of the off-takers, major off-takers, that is IOCL, GAIL, BPCL, and even GSPC have signed 5 million ton term contract in recent past, and those supplies are expected to flow from the end of this FY26, and that our expectation is that they have already booked the capacity at Dahej, and large part of those volumes will be flowing through our terminals, and that will improve the capacity utilization of Dahej. Coming to Kochi, as we know that the constraint is the connectivity to the Bangalore, and we expect that by this year end, by December 2025, the connectivity will be completed, and then the Kochi terminal will be connected with the national gas grid, and our utilization will substantially improve from the present 23-24% to maybe gradually it will go to 50, 60, 70, 80 like that.
So short point from the 930, 940 TBTU that you did all of last year, this year it can go to about 1050 TBTU. Is that a possibility?
Yes, it is a possibility, because it only the prices may hold, but our expectation is that the prices will be stabilizing in this year.
You know, just one question before we let you go, Mr. Singh. The PNGRB recently announced regulations with regards to registrations of the LNG terminals. Now, you have 2 tanks which you're looking to set up, one in Dahej, which you pointed to, and the other one is in Gopalpur. Now, because of these new regulations, do you think there could be a delay in implementing these? Because you may have to then, you know, ask for a separate registration requirement, even in existing places. That's one. And the second one was the petrochemical project. Is it on time? Is it likely to open in FY27?
So, first of all, the PNGRB registration process, which is notified, we don't see any challenge to the Petronet LNG, particularly our major terminal, Dahej, which was set up before the appointed date. There is no need of any registration for the Dahej terminal. We have to just intimate to the PNGRB. And even for the Kochi and coming Gopalpur, which has already been approved, we don't foresee any challenge. And in fact, these registrations requirement was a part of the act which was passed by the parliament in 2006, but nevertheless it has come now, and it is a process of registration, nothing to do with the regulation of this infrastructure development and the tariff regulations. So that is the first part. Second part, on the petrochemical, our project is going in the full swings. It is a 20,685 crore capex project, where the hard cost is around 14,600 crores. And the entire project has been divided into 300 packages, and 11 packages, which are the long lead items, has already been floated in the market, and we have already received 7 bids against that. Also, there are 13 EPC packages costing around 7,000 crore, which has also been floated in the market, 8 packages worth 6,000 crore, and we have already received the bid of 3 packages. So entire petrochemical project is on schedule, and we are targeting to mechanically complete by October 2027, and by March 2028, the entire process of commissioning and stabilization of plant will be done. Everything is moving as per the schedule and on track.
Sure. All right, so we're going to leave it on that note. Thanks very much for joining in. That's Petnet LNG. They are expecting the volume growth momentum to continue into FY26 as well. Well, let's move on. Fortis Healthcare reported what was a good operational performance in Q4. The margins improved both sequentially and annually, led by stable hospital and improved diagnostic margins. Our colleague Vinny Motiwala spoke to Dr. Ashutosh Raghuvanshi, who's the MD and CEO of the company, and began by asking him about the margin outlook for FY26. Listen in.
We have stated in past that we would see almost a 1.5 to 2% year-on-year improvement in margin, and we have delivered on that. I think that trend will continue. It's coming on basis of a lot of factors, essentially, which are driving this progress.
Okay. And what are these factors and how much more improvement can we expect in terms of margins now in FY26?
So there are many factors. One of them is, of course, occupancy, which has been sturdily improving. So last quarter, we had about 69% occupancy levels. We expect this to go above 70% in the coming year. And that is one of the drivers. But the case mix is another driver. A lot of our hospitals have been equipped with robotic services, and we have done large number of robotic cases. So that area has been growing. Oncology has been growing steadily as well, where the ARPOBs are typically higher. Our bone marrow transplant units have been doing very well. The hematology service is one of the largest in the country. And at the same time, we also are adding brownfield capacity. As you might be aware that some of that about 800 beds which are supposed to come during this year, some of them will come in early part and some of the beds will come towards the end of the year. But early on within this quarter, we will see some beds getting added in Noida and Faridabad. That will also give us further flip to our profitability.
Okay, further improvement with all these factors in terms of profitability. Mr. Raghuvanshi, you spoke about ARPOBs also. You spoke about, we are talking about occupancies. Both these have actually started seeing an improvement. I have seen an improvement actually in the quarter. How much did key segments, I want to know, like surgical revenue and complex cases actually contribute in this quarter? Was there a significant increase on that front?
Yes, so our surgical cases is approximately about 60%, and 40% comes from medical patients. So that has been a big contribution. And as I said, complex surgeries have been happening more, and that has contributed to bring this number.
Okay. Mr. Raghuvanshi, one more point you highlighted was in terms of robotics side. You just touched upon it, but I want to know robotics, that was up by 72% when I look at it in FY25. And neurosciences, that also is up significantly, 17% YOY. Could you give us a sense in terms of how much did they contribute in the quarter in terms of revenues, EBITDAs? What is the outlook for this in FY26 as well?
Yeah, so neurosciences has been going steadily, and that is on basis of the new equipment we have done. We have got a gamma knife, which is a precision therapy, and that has done very well. We have got other radiation oncology facilities also, which are very specific for neurosciences. So that has contributed. But all these segments have been growing. But the fastest growing segment for us has been oncology, where we have seen about 21 to 22% CAGR over the last couple of years. And that trend seems to continue. Earlier on, our cardiac sciences formed the largest segment, which still does, but the oncology is catching up fast, and so are the other specialties. Robotics, especially as you asked, a couple of our units we have got 2 Da Vinci robots, and many of our other units have got 1. And the numbers have been growing very fast over there. There are a lot of advantages in robotic surgeries, and that's why many patients are opting for these procedures.
Sir, what I also want to know is in terms of occupancy as well as ARPOB. Now, overall also, occupancy for FY25, I'm looking at the full year, that's at 69%. ARPOB, 2.42 crores. Manesar Hospital, that has also done well, right? We're picking up traction in that front, operating at 38% occupancy. That's very interesting. So for FY26, overall, what are we expecting in both these numbers? Occupancy, what will that be? And what is the ARPOB that we're looking at?
So yes, I'm expecting about 72% occupancy at a network level. Manesar facility is a new facility, as you know, and we are currently operating only 90 beds. But month on month, the occupancy numbers are going up, and we expect those numbers. We expect to add another 120 beds within this year, and also close the year by at least about 50% occupancy in Manesar specifically. But overall, at the network level, we expect it to be about 72%. ARPOB has steadily been growing quarter on quarter here for last many quarters, and I think that trend will continue. However, that will be slightly moderated as we go further because of multiple factors, primarily the capacity enhancement. And for that capacity enhancement, we would also be accepting probably more scheme business than what we do at the moment. And that might moderate the ARPOB a little bit. But ARPOB growth has been very significant over the last, I would say, about 8 to 10 quarters, and that trend will continue.
Okay. Sir, a question just in terms of diagnostic front, right? Because the growth has just been 3%, though margins have seen a very good improvement. I want to understand, the scenario that is playing out here. What is the outlook also that comes in from the diagnostic front of the business?
Yes. Our diagnostic business certainly has underperformed compared to the industry peers. There have been multiple reasons. One of the major ones was our change of brand, which we did about 1.5 years back. That impact is now gradually weaned off, and now we are seeing a steady growth happening. And that's the reason why the growth numbers are so low. However, profitability this year has increased compared to the last year. And that trend will continue. This year focus is to build this business further and improve the profitability profile as well. We are very hopeful that this business will do well for the simple reason that we have a lot of focus on genomics and other specialized tests. At the same time, we are strengthening our retail network of patient touch points. We have almost increased about 800 touch points in the last year. So that will improve our lab economics per lab as well, and that give us an upside on the lab business. Our objective is that in this year, we want to achieve industry level of growth, both on the top line as well as have the similar margin profile.
So that is going to be almost around, we could expect at least double-digit growth, right? High single-digit to double-digit growth is what we could watch out for?
Absolutely.
And margin profile, you said, will improve further, right? Because there's so much lab economics is going to be improving. So right now, around that 18% mark, how many more basis point improvement could one see in FY26 here?
We expect to go to at least about 21%.
Okay, that's going to be interesting, 21%. So that's something that we're watching out for as well. So, in terms of international revenue, I just want to touch up on that point, international patient revenue that's there. Contributing to around 8% of your total contribution, 17% increase YOY. What are we watching out for in terms of a guidance there? Any bit of a worry coming in there, or you expect this to see an increase coming in, given the current scenario that we're seeing in terms of geopolitics?
Yeah, in the current scenario, we are a little cautious about how much growth we are going to see here. But we are pretty certain that the numbers are going to remain steady. So we may not see the same level of growth, about 17% growth we saw from last year to this year. That level may come down to maybe 10, 12%, but we will certainly see a growth in international patients. There were many events which sort of reduce the numbers of international patients coming to India, especially from Bangladesh. And now with the current situation, there is also a hesitation from other places. But so far, we have not seen any numbers going down, and we are seeing a steady number of patients coming.
Okay, all right. So that is Fortis Healthcare talking about what they are expecting in terms of improvement of margins. 1.5 to 2% improvement in terms of margins is what they're looking at. The stock is up around 1% They've seen a huge rise in terms of robotic surgery this quarter gone by. But Chandan Taparia joins in to tell us what he's strategizing. Chandan, quickly, if you could just tell us what your calls would be now.
Yeah, good morning. Thanks for having me. So I believe that Nifty has taken support at lower band of the trading zone. So till it holds about 24,444, we are expecting index to again hit to us 25,100 to 25,200 levels. Looking at the trading ideas, first trade is buy on BL, positive on the defense name. And after the consolidative move of last two trading session, most of the defense counters are likely to see the positive momentum. So here we are suggesting to buy on BL. The stock has seen the open interest addition of around 3 to 4%. Longs are intact, has been making higher top, higher bottom. So recommending to buy with support of 370, and this stock has potential to rally towards 395 to 400 level. Second trading idea, that is buy on escorts. Selective auto counters are forming the bottom, and escort has been holding well above 35.50 zone. We are witnessing a consolidation breakout of last 5 to 6 trading session, and technically it is a pattern breakout of bullish pole and flag. So expecting further rally in the counter with support of 34.95. We are expecting a rally in escorts which can take it towards 3700 zone. Apart from that, I believe M&M can do well in auto pay, has been consolidating, but supports are intact. With support of 3030, it can head towards 3250 level. So two auto pick, and most of the defense counter could be on radar for the day.
Take that point, Chandan. Thank you so much for joining in. As you speak, the market continues to surge, 24,850 on the Nifty at the high point of trade, being led by all the sectoral indices. The Nifty Bank up around 0.2% as well. Take a short break, come back on the commodity space. Manisha Gupta joins in.
पता है।
Welcome back. Well, for the markets, definitely picking up pace. We have the Nifty, which is up around 185 odd points. The mid-cap index is also doing well with a gain of around 0.7%. Just watch out for GSK Pharma. That stock is doing well, up around 7.5 odd percent. JK Tyre has now moved into the green, so that stock is up around 4 odd percent post a sluggish start. But shifting focus to the commodity markets, Manisha is here to tell us what she's tracking today. Manisha.
Well, thank you so much for that. I'm looking at the precious metal overall as a sector because we've seen stronger gains in the overnight markets. To begin with, it is the decline in the dollar index, which has been supportive. And then the markets also are taking cognizance of the ongoing tensions between Russia and Ukraine. While there have been some conversations, but we are far away from that ceasefire or even both the leaders sitting together and talking on. And then it is about European Union and Britain now putting further sanctions against Russia from European Union. This is the 17th package of sanctions that we have seen come in on Russia. So the sanctions is on 75 entities now, which brings the total list to 2,400. It is inclusive of individuals, institutions and companies as well. Also, what we have seen that there are measures also for tackling chemical weapons, human rights abuses and hybrid threats. Also in the list is sanctions on shadow fleets and oil companies therein, and even a couple of mining companies feature in that list there. It's not just about gold, which has gained up by 2% overnight, but silver price has also gained a couple of percentage points on the higher side. For silver, it also is about safe haven demand, not in sense of jewelry or artifacts, but in sense of bullion. And the industrial demand for silver also seems to be picking up quite strongly. The higher investments in solar panels across globe is what is supportive of demand going forward. If you look at the numbers therein, the Chinese wind and solar industry for the first quarter has seen very strong numbers come in to the tune of 1,500 gigawatt. And within this, 50 gigawatt has been only from photovoltaic power. Not just China, European solar power output also has surged in the first quarter, supporting silver demand. And it's not just gold and silver as well, because when you look at platinum, palladium, we are looking at prices surging there as well. Palladium is trading at a 3-month high, trading above $1,000 an ounce there. Now, remember, Russia is the world's largest producer of palladium, and we are looking at a deficit for this year and the next as well. Last year was a deficit of 400,000 tons, and this year the markets anticipate a deficit of 254,000 tons. That in turn would be supportive. Coming to platinum, and we've seen 5.5% of gains overnight. This one also is trading at a 7-month highs, and we are trading above $1,050 an ounce for platinum as well. Russia is the world's second largest platinum producer, and last year was a deficit, and this year we're looking at a third year of deficit continuing to the tune of around 476,000 tons. Markets are anticipating that you could be looking at gains continuing for precious metals in the day-to-day.
Right, Manisha. Right, Manisha, thanks a lot for that. With that, we'll take a short break. On the other side, we have the management of CMS Infosystems joining in to detail their earnings. On the other side, Rajiv Kaul joins in on the back of their earnings.
Welcome back. Markets doing well, but as promised, let's get going with a chat with Mr. Rajiv Kaul, the Executive Vice Chairman, Whole-Time Director and CEO at CMS Infosystems to discuss the past quarter's performance and the way ahead. Hi Rajiv, good morning and good to see you in as always. Well, FY25 was a year of consolidation. It's a perfect storm going by what your press release says. Just a single-digit growth is what you all did in FY25. What's the revenue guidance for FY26? And give us some color as well. How much can managed services contribute from around this 37% odd mark? And give us a hint about how AIoT as well did in the past year. Go ahead. Revenues, mix, and AIoT.
Thank you, Nigel. Mangalam, good to see you again. I don't know what the karma is in my interviews with you, but it always happens around cricket or IPL. So, and I also was reflecting, I think when we started CMS in 2009, 8-9, that was the first year of IPL. So it's actually been 17, 18 years at CMS, along with the IPL editions, the way it's been sort of panning out. Coming to your questions, Nigel, I think for us, last year was a year of modest growth. I think we alluded to a set of unforeseen events. However, what was in our control, I think we've done a very good job in execution. We've gained market share across all our businesses. Our market position is strengthened across, again, all of our 7 lines. We entered the year with a very strong balance sheet, maintained a strong margin profile and high return ratios. Coming to the next 2 years, basis the order book we have and how we think about executing this, we have a strong opportunity to grow our revenue CAGR at 14 to 17%. I'm talking about FY25 to FY27. Which is sort of historically, our revenue CAGR over the last 17, 18 years is roughly in that range. So we hope to aspire to be back at that trend line, despite the little dip we had last year in line with the broader economy in India.
What about the mix? How much can managed services contribute as a percentage? And AIoT, that was a small vertical that was growing at a faster clip. Where have you reached?
So our managed services business unit, which is roughly 25% of our revenue about 5 years ago, is already at 40% revenue contribution. We hope this will inch up and grow rapidly to almost a 45% contribution in the next 4 to 5 quarters. From an AIoT, which is our Vision AI business, which we incubated in 2021 and did a couple of small acquisitions after that, it scaled very well. We have given a guidance already that a broader software business, and including Vision AI, should contribute 10% of revenue by FY27. At the end of FY25, it was already at 7%. And I think we're tracking very well to meet that estimate.
You know, you spoke about the asking rate, you spoke about the IPL and the asking rate. If you look at 14 to 17% CAGR over the next 3 years basis, what you've guided so far, at the lower end, you would actually not meet your FY27 aspiration of 3,800 crore on the revenue. But at the higher end, you might beat it to around 3,900 crores. So we'll keep that as it were. You did allude to market share gains in the 4th quarter. If you could give us a sense on where your market share was in the ATM business. You were targeting 60%. Have you reached there? And even the split, cash and managed services, where does that number stand at? What's your aspiration here?
So, Mangalam, thank you. Tough question as usual. Let me remind you that this was an aspiration we set on FY22. Having said that, we still have 2 years left. And we will obviously try our best to make sure that we can get to not a target, but an aspiration. In terms of when I look at our market share, not just Q4, I think the entire year, in our cash management related businesses, we have gained almost 200 bips in market share. Now, keep in mind that we are already the market leader with a significant gap to a number 2 player. But we still got a 200 bips increase in market share. In the managed services space, where we used to be amongst the top 5, we are now amongst the top 3 players in India. And maybe in the next 1 to 2 years, we'll be in the top 2. So I think the market share, market positioning is improving dramatically. I think the market is also seeing consolidation. And that consolidation will lead to growth opportunities for stronger and end-to-end integrated players. And right now, I think in the sector, there are only a couple of people who have a variety of service offerings which meet the needs of our client set.
Okay. So for the cash logistics segment, then your market share, if it's a 200 basis points improvement, would stand somewhere close to 45%?
It should be about 44-45%, Ekta, yes.
44 to 45%. And the aspiration to 60% still stands?
Aspiration. No year set for it right now.
All right. This managed services and technology space, give us a sense in terms of the order win, considering that majority of your revenue is actually from the reoccurring business segment. Tell us what you did this quarter and what are you executing?
So H2 in FY25 was 800 crores of wins. Q4 was 500 crores of wins. We have a pending order book to execute, which we hope to finish by September of this year. We are roughly at about 52% execution done by March, and we hope to get to 100% by September.
Okay, all right, Rajiv, for this year, will it at least be double-digit growth? I get that 14-15% over 2 years as a CAGR. But for this year, could it be in, it will be mid-teens?
We don't want to come and bat in the last 5 years. We want to be going out strong and make sure that we can be consistent in all the quarters.
Okay, all right. Just a couple of more questions. In the past year, what was impressive is the OCF upon EBITDA. That number went up, I think, to around 75%. Will you be holding to maintain it at these levels? And since the business is throwing up a lot of cash flows and you're already sitting on 1,000 crores, me and Mangalam tried to get this out of you last time as well. Inorganic growth. You said possibly. Nothing seems to have worked out, at least as of now. Should we hear about something in the next couple of quarters?
You guys should know me better, but let me go back to the main question. I think our last 3 years OCF has been above 70%, right? So yes. 71, 73, 76. I think we'll aim to maintain at that level. Just the quality of the business, I think, is strong. The second thing to note is that we've maintained a fairly high PAT margin profile at about roughly above 15% again for these 3 years. 2 of those years were at 20% revenue growth. 1 year that had only 7% revenue growth. But across those 3 years, we have been able to manage with technology investments, automation to maintain a high margin profile. From cash on books, I think what we've got a very robust balance sheet. We've been building this up and waiting for the right opportunities. A lot of effort around organic and inorganic growth. I think we have a trend line of roughly investing about 200 crores on capital per year average, if you think over chunks of time. And from an M&A perspective, while we can't predict what will happen and when, but I think as a team, we are very sure that one, it has to be aligned culturally to what we are as a firm. Secondly, it has to be synergistic with not only our businesses, but our earnings. And given how frothy IPO markets were in the last year, or a majority of the last 1 year, I think it was better to wait and watch. I think it's a fantastic asset to have with us right now, as we scan the market and look to engage in conversations with founding teams of becoming part of the CMS network.
Just a final question. How many touch points do you, intend to reach this year? I remember the last number was close to 150,000. What's the target for FY26? And how many ATMs come up for renewal? How many ATMs get added?
So I think for us, when we look at our touch points over time, we'll have to start defining touch points a little more broadly and not just cash management. I think one thing which you should track is really how we're doing in our Vision AI business. Vision AI business was roughly 25,000 sites live end of last year. We aim to double it in the next 3 to 4 years. So get to at least 50,000 sort of sites there. In our cash-related businesses, we are at 150,000 touch points. I think that we will look to get to 160, 170 in the next couple of years. I think fundamentally, I'll go back to what I keep repeating, revenue growth, margin profile, market share, all of these three is what we need to keep balancing as a management team every year. I think last year we got market share and margin profile. I would tick the boxes of that.
Okay, all right, Rajiv, thanks a lot for joining in. Wishing you all the best. We look forward to chatting up with you as the year progresses. I'm going to be watching the IPL game at the stadium. I try to get my mind off it, but seems you have diverted my attention yet again. Thanks a lot for joining in. We'll track you to all of these numbers. Well, we've completely run out of time on Bazaar, though. Stay with us. Chartbusters comes up next.
Dixon Tech down 5% on the back of its fourth quarter numbers. Profit and revenue meet estimates, although FY25 revenue below the company's 40,000 crore guidance. The management tells CNBC TV18 they expect 40 to 45% revenue growth in FY26.
Torrent Pharma climbs closer on 3% after the India business revenue rises by 12% on a year-on-year basis, while the US sales also come in better than expected. Brokerages, Citi and Nuvama, they issue buy calls on the stock.
Good performance from Dredging Corp. The stock rallies more than 13%. We have the revenues that climbed 66% and the EBITDA too rose significantly.
On the other hand, Aster DM slips closer on 3% despite an operationally good performance as the company reports a 5% revenue decline on a sequential basis.
Titagarh Systems rallies more than 5% on the back of stock coming out of F&O ban.
Hello and welcome to Chartbusters. We're coming to you live from the CNBC TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. Well, Mangalam, markets booming away.
Markets booming away. So let's get you some ideas for profit coming in from our colleagues at Money Control Pro today. We have colleague Neha Dave joining in with a stock. Neha.
Today's stock idea is State Bank of India. SBI saw a strong finish to FY25. The country's largest bank reported its highest ever annual profit of over rupees 70,000 crore in FY25, a growth of 16% YOY. The profit growth was aided by healthy loan growth, controlled operating expenses and contained credit cost even as margins contracted. Asset quality improved further and very low credit cost continues to surprise positively. Overall, the operating performance was strong and SBI delivered return on asset of 1.1% in FY25. However, the return ratio seems to have peaked. Margins will come under pressure due to potential further rate cut. Cost to income ratio improvement will be very gradual due to cost rigidities. With credit cost already at lower level, there is a limited scope of further improvement. So then what will drive the earnings going forward? The biggest cushion to ROA in FY26 can come from treasury gains with softening of GSET yields. Moreover, the management has guided for a loan growth of around 12 to 13% in FY26. SBI has taken enabling board resolution for equity capital raise in the coming year. However, the stake sale in Yes Bank will give the cushion in the near to medium term. In terms of valuation, the stock is trading at around 0.9 times core book value after adjusting the valuation of subsidiaries for FY27. And this valuation is very attractive given that return on asset is above 1% and return on equity is 19% and offers a favorable risk reward. While the earnings growth will normalize, the stock upside will be driven by expansion in valuation multiple.
Got that. Thanks, Neha, for joining in and giving us, the analysis on that stock. But let's focus on Hindalco. I discussed the numbers with Mr. Satish Pai, the managing director of Hindalco earlier today, and began by asking him about the aluminium prices and whether or not there's a deficit in the global aluminium supply. Let's listen into what he had to say.
The aluminium market worldwide is finely balanced. It's a plus minus 100 KT market on a 77 million production of aluminium that happens. So it's true that the market is very tight and hence the aluminium prices are trading in a band of which I've always maintained between 2300 and 2600. So depending on how the general economic macro environment works out, the aluminium prices can very quickly start to trend upwards because then market sentiments improve. Or when the uncertainty is there, it trades at the lower end of that band between 23 and 2400, which is what we have seen in April and May.
All right, but do you believe that by the first half of this year, we should see aluminium move towards the higher end of the band? That's around $2,600 per ton. And also, if you could give us your take on alumina prices, because that hit a low of around $330 per ton, and that quickly has bounced up because of the fear there's going to be a bauxite shortage with what's going on in Guinea. What's the outlook on alumina prices?
So, see, alumina is, as you said, very much dependent on what happens in one country, Guinea. Because Guinea is a big supplier of bauxite, both to China, Middle East, and everyone who's short of bauxite. So the volatility in what happens in that country has a big impact on alumina prices. Traditionally, alumina prices have been in the range of $350 to $400. But when there is a problem in Guinea and bauxite cannot be moved out, it jumps to $600, $700. So I think that the volatility in the alumina prices is here to stay because of what happens in Guinea.
Got it. Okay, sir. Before we get to your segmental performance, some part of the street is calling out that this was the peak performance for Hindalco for the next few quarters. What is your comment on that? Because you had everything working, right? Aluminium prices had perked up. Alumina prices as well did move up in Q4. You got the benefit of higher prices. The rupee was weaker. And now some part of that has reversed. So would you believe that Q4 is peak and now we'll see more subdued set in Q1 and Q2?
So the way I look at performance is actually a bit more simpler than that. I think that a company should focus on what it can control. So we focus on our operations, safety, quality, keeping our customers happy, and producing both aluminium and copper for the market. I think the top line, as you very much know in our business, is decided by macro forces like LME prices of aluminium and copper. So I personally believe that peak performance means maintaining our operational excellence at the level it has been for the past so many quarters. And I'm quite sure that that peak performance of operational excellence can be maintained.
Interesting. You know, because I'm looking at the business on a per ton basis, upstream are doing $1,700 per ton, which is fabulous. Do we work with a little bit of a lower number if you want to give us a range on a per ton basis?
So I think that, again, I'll repeat, I cannot sit here and predict what prices will be on a month-to-month or day-to-day. What I can assure you is that we will be producing at a very good cost of production with the right quality for the market.
Okay, let's finish the India business then. Copper, you've been telling us realistically, the number should not be that 700 crores, 800 crores per quarter. This time around, it was closer to around 600 crores per quarter. Looking at the TCRC spreads as well as the value addition, do you think that on a quarterly run rate, this is what you will be looking to maintain?
Yeah, absolutely. I think that the 600 crore per quarter is the run rate that you will see for this financial year, largely because, as you said, TCRCs have dropped dramatically. But, you know, we are supported by the value chain of copper, the downstream of copper that's coming in place. So our guidance of 600 crores a quarter for copper, we maintain for this financial year.
Okay, all right. There's one more aspect, Mr. Pai, that I wanted to understand. Because of this entire trade tariff battle, you all have already guided the market that there will be a hit of close to around $40 million on a quarterly run rate. My question to you is, if in case this gets sorted out, then I guess you'll save some part of that $40 million per quarter. But also the Midwest premium that moved up from around $450 per ton, that moved up all the way to around $900. Is there a risk that that comes down if in case this trade war comes to an end? So how do both of them offset each other? You get a benefit because of the import, but however, the premium as well will come down. So how do these stack up against each other?
So look, net, what happens is that the 25% premium that's there on most countries is what's built into the Midwest, and hence the Midwest went from $400-500 to the $800-900 that you see today. So I think that if the 25% stays on each and every country, then the Midwest premiums will stay at those levels. But what is probably going to happen is that different trade deals on a bilateral basis will be struck. The UK-US was the first one, and we are hoping that India is going to be the next one. So I think in the coming months, you're going to see a lot of trade deals being struck. The net exposure of Novelis today is Canada. So we are waiting for the NCA 2.0, which is the Canada-Mexico-US deal to get settled out. So if that does get settled, then we have net. I go back to what I used to say the previous quarter, neutral to slightly positive impact on our business.
Got it. Okay. All right. Yeah, that's the hope out there because, you know, you have said that in the past as well. It'll be neutral to mildly positive. Got it. What about CapEx plan for this year? What is the amount? Because for the next 2 years, we are building a higher CapEx number. So what is that number? And what does it do to your debt number? That's come down because India's net cash, there was some working capital release as well, which has contributed to this net debt number coming down. But how do you see both these two pan out, CapEx, debt?
So on the, we did an investor day in the first week of April, and we announced a broad strategy which we call doubling down on upstream and taking the downstream EBITDA to a 4x. So the downstream investments have been done in the last 3 years, And we are now embarking on a 45,000 crore upstream capital investment program. So a new alumina refinery, a copper recycling plant, a copper smelter, an aluminium smelter. So the next 3 years are going to see a big upstream capex program. Our capex for this current financial year, FY26, is 7,500 to 8,000 crores. And over the next 3 years, we'll be spending that 45,000 crores. Now, we have, as you said, a very strong balance sheet in India, and we think that we can do this capital program without going above our net debt to EBITDA guidance, which in India is about 1 to 1.5. We will not breach that.
Final question, sir, on Novelis. What could be the broad range on an EBITDA per ton basis? For the year, if you tell us what could be the lower end and what could be the upper end?
I think I'll tell you that our target is to get Novelis consistently about $500 per ton. And we hope that during this year, especially in the second half, we'll get there.
Okay, all right. Well, the markets, by the way, are still holding with a gain of around 240 points or thereabouts. That's Novelis's big takeaways out there. Copper will be maintained at around 600 crores per quarter. Aluminium prices should be in that vicinity of around $2,300 to around $2,600 per ton. And they're hopeful that there's a favorable agreement between the United States and Canada because they source some part of their raw material from Canada, which in that would be a neutral to a mildly positive event. For the time being, we'll slip into a short break. On the other side, we'll be joined by the management of Zydus Wellness. Stay with us.
What a strong move we're seeing in the market right now. A lot of the stocks which had opened lower are now recovering at the high point of trade for Bajaj Twins, Bajaj Finserv and Bajaj Finance. We also have an up move that we are seeing on Trent, opened on the back foot, currently at the high point of trade. But the stock on our radar is Zydus Wellness. The company is reporting an overall good set of numbers, revenues climbing 17%, margins also at around that 21% mark itself. Tarun Arora, the CEO and director of the company, joins in to discuss the numbers in detail. Tarun, the important part, what happens to your summer portfolio is what everyone on the street wants to know. On the back of that, what's your guidance for this entire year? And if you could break that up in terms of growth coming in from your foods business, your nutrition business, and how much comes in from your personal care business.
Thanks for having me, Mangalam and CNBC. We've had a good 2025 financial year, and we do believe that we are up for a continued double-digit growth journey. into FY26 as well. We've seen a bit of rains in some of our markets of East and in the April, and May has also seen something in North. So may impact the party a little bit, but we still stay committed that a double-digit growth is on.
So when you say double-digit, what do you mean? Because the last time you said that 15% mid-teens is the revenue that you can actually do. You've done about 16% in the entire year. So with the offtake problems that you have in the first quarter, what does double-digit mean? Should we look at more like 10 to 12% or maybe 12 to 15%?
Look, I don't have a specific number, but I'm clearly hopeful of early teens upwards, but it may swing a little bit here and there depending upon how eventually the whole quarter goes by and eventually what we can catch up on.
All right. Hi, Tarun. Good to have you on the show. Nigel on this side. As of now, the margins that you've reported is close to around 14% approximately. Yes. But you all have indicated that you want to head towards 17 to around 18%. Give us the glide path. How do you see the improvement on a year-on-year basis?
So we believe that a fair number is 17, 18%, and it'll take us probably about a couple of years to get there. One clear driver for us will be consistent focus on driving our gross margins up, which should give us a good 1 to 2 percentage points upward movement. If we stay on the path to what we are looking at, a double-digit growth journey over the next couple of years, that should also translate into operating leverage, which should also help us there. So these are two fundamental drivers. Of course, we constantly remain focused on better operational costs and delivering better margins.
Right. Early teens revenue growth, better margins over the next couple of years. I just wanted your view on how the portfolio grows, because in FY25, food and nutrition, which accounts for, I think, about 70-75% of your revenues, grew 13%. Personal care grew 33%. What's your prognosis for both these segments for the next year?
So my view is that personal care, we have hit something fantastic. Both our brands, Nycil and Everyuth, have been on a good run. We believe that this is something more systemic to the brands. The equity of these brands work very well, so they will continue to drive us in the same zone. Whether what number will play out, but a high double digit is on the cards. Food and nutrition portfolio is also doing rather well. There may be some challenges on summers, but there are so many other brands which are on a consistent growth journey, whether we look at Nutralite, which is dairy and spreads, our new acquired business that we've got, which is Max Protein. That's also seen over last 4 to 5 years. Before the acquisition was about 25% CAGR. We have seen a much higher numbers, like almost 40-50% plus in few months that we've won. So we believe that's also going to be on a good tailwind to build us up. Our sweetness portfolio is building rather well, including new launches of sugar-free delight. Our Light portfolio is gaining. So we believe both the parts have good momentum behind it.
I was just trying to understand what the delta between the two would be, because last year the delta was 3:1. This business, personal care, grew 3 times the pace of foods. So what the delta between that should be in FY26 and beyond. And you spoke about Max Protein growing at 40-50% CAGR. In absolute terms, what was the revenue that you did in FY25, and what can we expect in FY26?
So not a CAGR. CAGR has been more 25-30% before the acquisition. It's since acquisition we got those numbers. We believe 25-30% is what we believe this acquisition will continue to deliver on. Right now, last 5 months have been more exciting. Talking about the delta between the food and nutrition and personal care, I believe personal care will continue to drive a little faster than the food and nutrition, but food and nutrition is also catching up. So I won't say a 1:3 is really on the cards. I would be happy if it is a similar zone, but 1:2 is also more exciting, but no specific numbers really.
All right, Tarun, MFD, milk, food and drink, as a category that's facing challenges. What's the strategy to grow Complan?
So yes, this nutritional beverages or HFD, whichever way you want to call it, it's faced a little bit of headwinds, largely because of fatigue in the category. There are spaces which will continue to move faster. We've seen some new additions in the consumers in the digital space. There are some new brands which have come up in digital space. So we do believe that making it more relevant to the new age consumer remains one of our core tasks. We're looking at new formats to also deliver. So the way we are going to build this category or recover growth in this category, which itself is a big challenge for us, is to play the whole segments. We were largely a kids play. We've launched adult nutrition through VMAX. We'll have probably more expansion around it. We already have a toddler place with a Complan Nutri-Growth. We are also looking at few more formats and segments to play in. I think it's just keeping the brand more relevant for today's consumer who's seeking more than just the regular nutrition that they've expected from this category. And maybe the sugar story has been extraordinarily highlighted. The kids need some bit of sugar. It's actually required some bit of energy. So building newer segments and making it more relevant to the new age consumer is how we believe it'll get its growth back.
You know, I asked you this about the last time as well. Your intra-brand synergies, you have on the one hand Right Bite, on the other have Complan, and then you have sugar-free as well. I mean, just club all of them and bring out a product, right? Everyone would want something that fortifies their milk without any sugar and a high amount of protein.
So you're bang on. I think if we really look at it, our claims, our way of working has a huge amount of synergies. It's just that the cross-brand consumer claims may not happen. So I have Max Protein, no added sugar products. I've not put sugar-free because there are a different set of consumers having a different set of associations with each of these brands. So I will keep those separate for now. There are some one or two opportunities which we'll explore, but when we are putting these brands together, the platforms we are putting together, there's a lots of synergies and we are seeing a good value out of those.
Just a final question before, just a final question before we let you go. Your update on distribution reach, where are you at right now? E-com and Q-com penetration, what does that mean in your overall mix right now?
Yeah, so overall, modern trade plus e-com, digital commerce contribute to almost 23-24% of our business at a current run rate, of which 10% comes from 10.5% comes from the online space, of which 40% is quick commerce. So quick commerce is growing at a breakneck speed. It's becoming more and more relevant for the urban consumers. When I go to GT, which is the bulk of our business, like any other FMCG, that is about 3 million outlets that we reach. Our desire remains to cross a 4 million numbers, and we're moving towards it. It will be more driven by smaller population towns, rural, where we are continuing to expand and put more energies behind it. So across channels, we're seeing a good traction for our business.
All right, take that point, Tarun. Thank you so much for joining in and giving us those outlook. As a consumer, I think Nigel and I, we grew up on Glucon-D, and now as we age, we perhaps will move towards the sugar-free products that they make a lot more. Thank you once again.
Also try Max Protein. It's
Complan
very good
as well,
for you.
right?
Yes, we do try Max Protein, but my grouse with that is it has a lot more calories for the protein that it provides. So maybe that conversation another time. Complan, yes, Nigel, we grew up on Complan too.
Grown up on Complan as well.
Complete plant food. All right, Tarun, thank you so much for joining in. We take a short break, come back, getting more on the markets and a lot of stock-specific action on the other side.
Welcome back. As you can see to the top of the screen, all the frontline indices are doing very, very well. Whether you look at the Nifty Bank, Sensex, and even the mid-cap index. It's a good start to trade, but we have run out of time on this edition of Chartbuster. Stay with us, though. The team of Trading Hour is waiting for you on the other side.
It's a wonderful day if you are a bull, and it's a wonderful Wednesday. You're watching Trading Hour live from the CNBC TV18 Motilal Oswal studios. I'm Hormuz Patakia. Joining me today is Vinny Motiwala, and it almost feels like, Vinny, the fall that we saw yesterday is almost distant memory. A very good move both on the Nifty and the broader markets as well. And the earnings season is gearing up for one last hurrah in today's session.
Absolutely, one last hurrah for the earnings season. We'll also be cheering it because finally we could maybe get some breather. But 24,900 is what the Nifty is holding on to as of now. Not at 25,000, but look at it. Almost at the day's highest point as of now, up almost 1% in today's trading session is what the Nifty is trading at. Let's look at the Nifty Bank also, because that's also managing to hold on to some bit of a green in today's trading session. So Nifty Bank also is what is holding on to 0.7% of gain. Broader end of the market too, performing in tandem with the benchmark indices. So yes, that's also something that has led to some bit of an up move. That outperformance is not there right now from the broader end of the market, but at least in tandem with the benchmark indices, Hormuz, there's nothing to complain, right? Because yesterday was a bit of an underperformance.
You know, from a fear of testing 24,500 on the downside, you would take 24,900 any day, right? Hoping that it would go towards 25,000 as well, tomorrow being the weekly expiry. So we keep an eye out on that. But of course, there are a lot of stock-specific reactions. As we just mentioned, the earnings season is going to take one last hurrah in today's trade. There are a slew of results that are lined up today, be it on the Nifty, be it on the broader markets as well. So a lot to talk about as we go around on the show. But with corporate conversations, then Arvind Smart Spaces is the first management on our radar today. The stock is trading lower, bucking the trend in what is an otherwise a very strong market after its fourth quarter results. Collections remained flat. Bookings have grown 18%. Now, to discuss more on this, we are now being joined by Kamal Singhal, the managing director and CEO of the company. Kamal, good morning. Thank you for joining in. Your bookings growth, you had earlier mentioned at the start of the year that you are going to have around about 30% growth in bookings. You finished the year at half, which is at around 15%. What has led to this, and are you expecting things to normalize in FY26? What is the bookings growth target that you have set for this year?
Yeah, very good morning. And you very rightly pointed out that the booking growth normally is supposed to be between 25 and 30%. That's what we have been always talking and achieving in the last few years. This year has been 15%. It is mainly on account of a couple of launches which we missed in the Q4 of last year. And this essentially means that this will be shifting to Q1 and Q2 of this year. And hence, on a long-term basis, on a block of 2 to 3 years, the growth trajectory remains the same. And on an average basis, we should be able to continue to achieve 25 to 30% growth. And this loss of a couple of hundred crores of fresh sale that we saw in the last year should be covered up in the coming year, in the current year.
Sure, Mr. Singhal. Good morning. This is Vinny joining in the conversation as well. While you said that, launches were delayed from Q4, now maybe we could see it in Q1 and Q2. So what is the outlook in terms of pre-sales growth that we have for FY26 and over the medium term as well, if you could highlight that?
Sure. Our long-term CAGR on fresh sales has been 25% thereabouts. And because we've lost some bit of it in the last year, obviously this will get pent up in the coming year. So if the growth was supposed to be around 25%, 30%, this year we're looking more like 35 to 40% growth put together within 2 years.
But what about collections, Kamal? Because your collections were flat, that you missed the 1,000 crore mark here as well. Do you expect to achieve that this time around? And if you could share what is the kind of number that you're anticipating in the ongoing quarter, considering you're almost halfway through the June quarter as well. Can we expect, would it be fair to say that 10% growth in collections for FY26 is a fair assumption?
Yeah, it will be a very fair assumption to make. And of course, collections are dependent upon how much we are able to launch and sell fresh. And that is expected to be getting covered up this year. And hence, there will be a healthy collection growth as well that we are expecting to see this year.
What about the launch pipeline this time around?
Our launch pipeline has been absolutely great. We are hoping to launch almost like 4,000 crore rupees of fresh projects this year. And these are very well distributed between all the 3 cities, Ahmedabad, Bangalore and Mumbai put together. Mumbai will be our entry this year for sure. Yes. And all in all, 4,000 plus crore rupees will be the fresh launches this year.
Okay, 4,000 crores fresh launches. I want to specifically now just talk about the MMR region. I want to know one, you said your entry coming in, right, for this. So expansion strategy there. Any acquisitions that you may be looking at in the near term, your target in GDV as well as strategy for redevelopment in this area. So a couple of questions I'm putting in over there together, but all for the MMR region.
Sure. Mumbai is one of our important growth pillars now from here onwards. This is the 3rd city that we want to add in our portfolio after Bangalore and Ahmedabad. We sometime back announced one big project in Pen-Khopoli area with a top line of around 30 and 50 crores. This is going to be our first weekend home project getting launched this year. Apart from that, we are very seriously looking at society redevelopment. In fact, we are very close to announcing one society redevelopment project in near future. This remains our very clear focus area. Our strategy in Mumbai has been slightly differentiated. It's going to be focusing on weekend homes and society redevelopment on the other hand. And we are hoping that at least a couple of more projects will be acquired this year in our portfolio from Mumbai.
So where is this redevelopment project? Announcement expected in Q1 itself?
Yes, it's expected to be announced in Q1, yes.
Okay, and what would be your target GDV, especially coming in for the MMR region? And also in terms of the area, if you could highlight which area are you looking at in terms of redevelopment?
So redevelopment will be all these areas which are not very high priced areas like a lakh rupee, lakh&a half rupees per square foot. We are more focused on something which is in the region of 30 to 40,000, 50,000 rupees per square foot. Your Mullans of the word or your Bandras and other things. So that's what we are targeting when it comes to society. And weekend homes, of course, is in the periphery of like your Mumbai 3 and areas like those.
Kamal, if I heard you correctly, you mentioned that you're planning to launch some weekend homes in Mumbai. But for an average Mumbaiker, you would wait for a weekend to get out of the city. What is the rationale behind this, if you could explain a little bit? And I'm just adding on to the on-ground demand as well. What's the current situation like this quarter? And have you seen any slowdown in terms of mid-income housing?
Sure. Well, coming to the first question first about the weekend homes in Mumbai, I think Mumbai has not seen the kind of action that other cities have seen. For example, Ahmedabad has a very evolved market on weekend homes. Bangalore has caught up in a very significant way. We in fact had very interesting and successful launches in both these cities. Now we want to replicate our experience here into Mumbai market. Mumbai market is very significantly underserved on weekend homes. We sincerely believe that the kind of cramped houses and the cramped living space that Mumbai has, it needs more weekend homes which have fresh air, open areas and lawns and gardens, etc. Of course, it has to be within the limit of time that one can spend on travel. So that is more like an hour and a half. That's what we are very clearly focused on. Atal Setu, for example, has opened up this venue for us, and we are focused on that. So we are very excited. There's a lot of innovation to be brought into the market. And given the size that Mumbai is, it's very underserved. And that presents us with a huge opportunity in our understanding. We are up to it. So that's one. On the demand side, I think demand is still very healthy. Of course, it varies from micro market to micro market. For example, Bangalore will have pockets which are a little slow, and there are pockets we are doing absolutely great. So it's about choosing the micro markets correctly and smartly, and market thereafter is supporting pretty well, and the demand is still holding.
Okay. Also, what would be the range of these weekend homes in terms of the pricing? Is it going to be, the luxury side? Given that, that's going to be more space, then it's going to be expensive.
Yeah, but we are very clearly focused on upper mid and slightly below ultra luxury. So it will be more like a ticket size starting from 1.5 crores, 2 crores thereabouts, and it goes all the way up to 4 to 5 crores. So in that sense, for a weekend home, this is a price which is above mid-priced homes, but at the same time, it's pretty affordable.
Okay. And what's the update in terms of the Surat project that you had over there? Because I believe at some point of time there was some issue with the JV partner. So what is that? Has that been resolved, and when can we expect the launch?
So we are still in the process of resolving it. We are very hopeful that it should get done very soon. And Surat is something that we are very excited about entering. Hopefully, it should be getting resolved. It's a very large project. It has a very large land parcel of more than 500 vigas, which is more like a 300 acres. So it's getting resolved. It's a large one, and we are working on it.
Do you expect a resolution by the end of this quarter, Kamal?
Maybe not this quarter, but next quarter for sure. Yes.
All right, Kamal, thank you so much for sparing time and joining us today. Wish you good luck for FY26 as a management there of Arvind Smart Spaces. An interesting insight there, looking at holiday homes in Mumbai. Of course, maybe on the outskirts, as Kamal was mentioning, around an hour and a half or 2 hours away from the city. But yeah, that is the strategy for Arvind Smart Spaces. And of course, that cramped up homes was a little personal as well. But we'll take a short break here on Trading Hour. Up next, we discuss what's buzzing in the commodity space. Manisha Gupta on the other side. Stay tuned.
Welcome back to Trading Hour on CNBC TV18. Now let's shift focus and talk about what's happening in the world of commodities. We have Manisha joining in with us as always to take us through what's happening there. Manisha, today we're focusing on crude oil prices.
Oh, yes.
You know, they've remained at that 60-66 mark. Are we expecting an uptick now there? Is it a worry?
I hope not, because, you know, if you look at the last 2 weeks, it has been gains for the crude oil prices. And this week is no different, because we're trading at around $65, $66 a barrel right now. It was a percentage point of gain in the New York session yesterday, and Asian markets have opened more than a percentage point of gain yet here again. Well, there are reports of Israel preparing to strike Iran nuclear facilities, and that is what really seems to have bothered the market. If that happens, then you are looking at a more larger regional concerns coming in there. And apart from that, Iran, remember, is the third largest oil producer within the OPEC as a segment, and there are fears of then Iran as well disrupting the Strait of Hormuz, and that is where you see most of the Middle East oil flowing into the Europe and the Asian markets there. So this could really become large, and that's the premium that we are seeing in prices exactly because of that. The second factor is about the uncertainty between Russia and Ukraine. There is still no conversation about ceasefire, and ceasefire clearly seems far away there. So these are a couple of things which seem to be supporting. The third factor is about the dollar index, which has seen a decline, and that has led to a lot of these tangible commodities actually trading in the positive right now. Couple of factors which are also capping these gains. One is the U.S. crude stocks, which have continued to increase, and the U.S. production itself is near record high. So that is something that the street is looking at. And then within the OPEC members as well, Kazakhstan being one of them, also has seen an increase in production. So supplies is not a concern, but supply disruption can be a bit of a problem, and that is a premium because of that.
Supply disruption, a concern indeed. And back to these geopolitical tensions, right, that are supporting prices for crude oil as of now. Manisha, thanks a lot for that update. By the way, the Nifty continues to remain around that 24,900 market. Look at JK Tyres. The earnings call is set to take place in just about a few minutes from now, but the stock is up 8% after its results, which were on the weak side. On the operational front, both India and Mexico businesses saw a decline, but the stock is at the highest point of the day. GSK Pharma is up 6%, Amber Enterprises is up 6%, and this is in contrast to the fall that you're seeing in Dixon Technologies. Although Dixon has recovered from the lows of the day, still trading with losses of around about 4.75%. So keep an eye out on all of these names. We'll continue the markets conversation just after this short break. Vishal Malkan joins in with a chart check and some trading ideas.
You focus on the gemstone side of the story?
So I think it's really making our customer the true north. So when we introduced the good, better, best heirloom, no one else had done that before. So we pioneered in introducing different qualities, different sizes, different metals all together. And so no matter who the customer was, you could get exactly what you wanted, provided you like that design sensibility. And that's really helped us take off.
What we're seeing in the jewelry market worldwide today is this big takeoff as far as lab-grown diamonds are concerned. In fact, you believe that this is the Kodak moment for the diamond industry. Why do you say that?
The Federal Trade Commission in the US said a lab-grown diamond is a diamond. They're chemically, physically, optically identical.
Okay.
So all of a sudden, it legitimized the entire industry for everyone. And now, you fast forward 7 years, you can get a lab-grown diamond for 90 to 95% cheaper. It's going to be very difficult for natural diamonds.
Welcome back. Earnings reactions, potential earnings. There is a lot to track as we go into the second half of the today's trading session. So we'll get you a mix of both in this segment. We have Upasana joining in for Dixon Technologies. We have Vivek also telling us why Dredging Corp is surging in today's session. And Abhishek is also here to tell us what to expect from IndusInd Bank, which has been in the line of fire recently. But first up to Upasana on Dixon, on the numbers, brokerages, management commentary. Upasana, summarize it for us.
Well, the company's growth this time around was continuously led by the company's mobile and EMS segment, and company has also reduced its contribution in all the other segment barring the mobile segment. Now, if we talk about the FY25 revenue, it stood at 38,860 crore and company has missed its 40,000 crore FY25 guidance. Now, talking about the Q4 numbers, while the margin remained upbeat, revenue and PAT was in line with our poll. Now, coming to the brokerages, Nomura on the back of this has given a buy rating on the stock with a target price of 21,202 per share. It says that the mobile ramp up on track across domestic and exports and rising value addition is likely to aid margins going forward. CLSA has given a high conviction outperform rating on the stock and has also raised the target price to 19,000 per share. It says that the Q4 was largely in line, and on strong top line growth and better margins, company, the brokerage expects 45% PAT CAGR over FY25 to FY28. Now, management joined us today morning on the back of its results, and it has indicated some of the important highlight. Management expects 40 to 45% revenue growth in FY26 with 20 to 25 bips margin expansion in the current year. It expects revenue to more than double in the next 2 to 3 years is what they have indicated, and the company is anticipating export contribution, which is currently 5% of their sales, to also increase going forward. Company has also indicated that it is in the advanced stages in closing partnership for camera modules, which remain one of the key highlights in the past few quarters. And also in terms of margin expansion guidance, company has said that it expects that 90 to 100 basis points is quite doable in the next 2 years. So all in all, a beat commentary, and even from the brokerages and management as well.
All right, Upasana, thanks a lot for that. Dixon Technologies there, possibly the stock of the morning, slightly off the lows of the day, still holding on to losses of around 5%. But on the flip side, the other stock that is doing very well as an earnings reaction is Dredging Corp. The stock is up 13%, and Vivek is here to tell us why, Vivek.
Well, that's right. So Dredging Corp, not a stock you talk about too often. And in fact, whenever we speak about it, it's always been in back of slightly unfavorable light. But today, the story is quite different. Q4 FY25, now off a very low base of Q4 FY24. It's been a substantial increase across all of the parameters that we tracked. So revenues higher by close to 67% on a year-on-year basis. EBITDA at the 77 crore mark, up 4 times from what it was in the same quarter last year. Margins expanding almost 1,000 basis points. Profitability this time around versus the loss that was seen last time around. But if you have to look at the sequential comparison as well, even there has been substantial improvement. Revenues on a sequential basis, has actually gone up almost 42%. Profitability up 33%. However, one thing that investors do need to keep an eye out on is the fact that on a year-on-year basis, when you're comparing FY25 to FY24, revenues, the growth over there looks slightly subdued. So revenues at 1,140 crore versus 945 crore. And it's actually a loss that the company has seen this time around, impacted by a one-off exceptional item of close to 18 crore. But despite that, it was actually a loss in FY25 for the company. Nevertheless, on the back of very strong Q4 FY25 to close off the year, it's a significant up move that you're seeing in Dredging Corp today.
Okay, now let's go across to Abhishek, who's here to tell us what's happening with IndusInd Bank. Abhishek, over to you.
Well, IndusInd Bank will be reporting its numbers today. Watch out for the fact that they can report a net loss as per analyst poll this time around. So they have already given a business update, which is one of the weakest that you are seeing in last 17 to 19 quarters with respect to deposit and advances movement on a year-on-year basis. Now, net interest margin can decline both YOY and quarter-on-quarter. Analysts like Kotak Securities estimate 67 basis point decline, YOY and about 21 basis point decline sequentially in net interest margin. Now, operating profits that can be on the weaker side. Again, Kotak Securities estimates 67% of YOY decline and about 63% on a sequential decline in operating profits. Credit costs can remain elevated. We know that they have to make provisions with respect to that derivative loss as well as the MFI segment. So let's watch out for the provisions which can remain elevated this time around. Slippages to rise quarter on quarter led by microfinance sector. Kotak Securities estimates a slippage ratio of 2.7% versus about 2.2% in the previous quarter. Now, asset quality is expected to remain stable as per Motilal Oswal. So high write-offs can be one of the reasons that you might see asset quality stabilizing despite higher slippages. So Motilal Oswal estimates a gross NPA ratio of 2.4% versus 2.3% in the previous quarter. Now, commentary with respect to new management team formation as well as business momentum going ahead will be a key important factor to watch out for from the management side. Our poll suggests NII to decline by 11.5% YOY and about close to 9% sequentially. We are working with a loss of close to 514 crores versus a profit of 2,349 crore in the same quarter last year and about 1,400 crore of profit in the previous quarter. Back to you.
We'll be watching out for IndusInd Bank, possibly the result of the day that we'll be keeping an eye out for. And as Abhishek was mentioning, the lender could report a net loss in today's trading session. But time for a quick chart check then. Vishal Malkan of Malkan's Views joining in now. Vishal, good morning. Thank you for joining in. A dip yesterday, got bought into very swiftly. What next for the Nifty and for the Nifty Bank as well? Which among the two looks better to you?
Yes, I think we are into that zone where the undercurrent of the market is so strong that every time there's a dip, there's a strong buying coming up, and there's a strong support zone on Nifty, which is 24,700 to 24,800. That's where it gets a bounce from. And on the higher side, it's 25,200, which was the high made a few days back. So that's a very tight range, but overall undertone is bullish. And I would look at Bank Nifty as slightly subdued compared to Nifty, with support around 55,000 and on the target on the upper side is 56,000. It's a very tight range, so I'll go more of stock specific rather than trading the indices in these days.
Okay, Vishal, are you looking at any specific stock? Like you're saying, you're looking at more stock specific, right? So which stocks, which sectors is that coming from?
So the first one which I look at looks very good on the chart, has given a great breakout and continuously making higher highs is MFSL, and it's all bullish on monthly, weekly, and daily chart. The RSI, the patterns, the momentum, everything is on the positive side. So I'll go with a buy on that with a stop of 1370 for targets of 1430 and 1460 in the next few trading sessions.
And any other on your radar, Vishal?
I'll go with the defense, which is BEL, which is the favorite, and I think it's again same thing happening on that, making higher highs continuously. No signs of resistance, and because it's a new zone for the stock, so there could be the next target for this would be 400 with a stop of 365. It would be a good pick.
Okay, Vishal, thank you so much for joining in with us, talking to us about your top picks as well as in terms of the levels of the market that we're watching out for right now. But on that note, we're going to slip into a very short break. Up next, we'll discuss market fundamentals with Chakri Lokpriya from LGT Wealth India. So don't go anywhere. Welcome back to Trading Hour on CNBC TV18. Now let's bring on board Chakri Lokpriya from LGT Wealth India, joining us to discuss the market fundamentals and his top sectoral picks. Chakri, good morning. Thank you so much for joining in with us. Let's just start by talking about the defense pack. Railways, defense, that's been the trend last couple of weeks. Seems like it's losing a bit of steam. But for your view coming in here, is it still something that you would look at fundamentally?
Good morning and thanks for having me. If we look at the defense pack and railways, first defense. Now, we've had the India-Pakistan problem at the border, and post which, now the government is ordering an emergency order worth about a fairly big order, and this will benefit a number of defense companies. So that revenue estimate will actually be bumped up for Bharat Electronics, Hindustan Aeronautics, including Mazgaon Dock, for multiple reasons. One is, the surface-to-air missiles, drones, all these which were used in the war that we had with Pakistan, those need to be replenished and then ordered some more. So against that backdrop, the revenue and margin outlook for the defense companies, in spite of running up, looks pretty strong. And therefore, we would continue to be holders and maybe incrementally buy into these stocks.
But even at these valuations, Chakri, despite the kind of move that you have seen in a lot of these defense names, some of them were up 30-40% last week.
Excellent question. They have run up. But if you look at the outlook, both domestically as well as new orders are concerned, and plus export orders to Europe, I think both these things have upside estimate risk to the upside potential, and therefore we could buy. But clearly, as you said, that they're not trading at these levels. They're investments worth buying at current levels too.
Okay. Chakri, any specific name you would like to give us in both these spaces, especially defense and railway, that one could still look at right now?
In defense, it will still be, stick to Bharat Electronics, Hindustan Aeronautics. Hindustan Aeronautics supplied drones for the latest India-Pakistan war. And, outside of that, Mazgaon Docks as well. Now, if you go to railways, I think, it's a slightly different cup of tea. They're also looking strong. If you look at a company like Titagarh Wagons, it's trading at probably about 19-20 times. Now, post this warlike situation that we had, we are likely to see an increase in railway spending along the northeast border and against, of course, the various parts of India. This will again boost the order book for the railway companies as well. And, the government has the budget. RBI is supposed to release a budget, and this will further help the companies.
Right. Chakri, a lot of these names that are reacting to results today, these electronic component manufacturing companies, say the likes of Dixon, they operate on very thin margins. Even this quarter, the positive was that the margin was 4% or close to 4.5%. At that sort of margin, at that profit, at that kind of market cap it trades in, does it still deserve the valuation premium that it has, especially considering the PLI is going to be phased out next year? The level playing field is going to be equal for all companies. What do you do in a stock like Dixon that has run up so much and now is positioning itself as the premium player in the segment?
Yeah, Dixon is, revenue has reported about 120% up. That's no mean achievement. And second, all the component areas, electronics, LED, TVs, as well as mobile, all these are growth areas. And even if PLI is phased out, still there will be another form of incentive scheme that the government is likely to introduce because, still Indian manufacturing has to pick up in many ways. Yes, these are expensive stocks, but stocks worth buying for the longer term, not for trading. From that perspective, Dixon, yes, for the longer term.
Okay. Chakri, your thoughts coming in on two sectors, that do have exposure to the US, and IT as well as pharma. Is there anything that you like in these names, or are both these avoid, given that there are tariff issues that are going on? IT itself, as of now, large cap companies have not given any sort of a very bullish, positive commentary. So what are we watching out for?
You're absolutely right. The commentary has been kind of uncertain. This is because of the tariff situation. But there is no tariff anyway on services companies. We know that. But the uncertainty is, will it slow down US IT spending? we will have to wait for another quarter. Meanwhile, the second fear is, will AI take away some of the growth from IT services? Maybe not, actually, because it'll actually prove to be margin accretive over the longer term. So I would incrementally buy into Infosys, TCS, Wipro.
What about auto, Chakri? Because even here, just like pharma, auto is a very broad gamut as a sector. You have two-wheelers, you have four-wheelers, you have tractor manufacturers, you have auto ancillaries. Where do you see yourself placing your bets in, especially considering that the on-ground situation currently is not the best for the industry, be it in terms of the tariff-related concerns or be it the own domestic demand? So where do you position yourself on the auto space?
The auto demand, like as you pointed out, is indeed weak. The first pick of growth was likely to come in the two-wheeler space, TVS Motors, Hero MotoCorp. TVS has done very well. Hero MotoCorp has kind of underperformed. There is valuation comfort. And moreover, second leg of growth, EVs, all these companies are expanding their presence. That will provide another leg of growth. So, the cyclical uptick in volumes for TVS Motors and Hero MotoCorp, we're likely to see, therefore, will buys. Now, ancillaries, companies like, Minda, Motherson Wiring, these companies are again expanding their product range, will benefit if the tariff talks with the US go well. Their export volumes can kind of improve. But that's more a wait and watch.
Okay. You have any specific thoughts coming in on the metal side as well? There is a lot happening. Hindalco also came out with its numbers. Anything you like there?
If you take Hindalco as, it trades at only about 5 times EV EBITDA, so it's not an expensive stock. The question is about, its outlook, growth outlook. And the growth outlook is kind of going to be subdued until about you have a free trade agreement between USA and Canada, because that's where one of its plants, Hindalco's plants, is located. And on the domestic side, I think largely things are still okay. So net at 5 times EBITDA, valuations are fine, could incrementally buy.
Chakri, pleasure having you as always. Thank you so much for sparing time and joining us today. Chakri Lokpriya there on his view on the markets and specific sectors as well. The Nifty has seen a slight cool off from the highs of the day, now at 24,850, still 170 points higher. So no reason to complain, but there is still some resistance seen at higher levels. Take a short break. We get talking with the management of J. Kumar Infra on the other side. Nalin Gupta joins us to discuss the road ahead for the company. Welcome back. Continuing with corporate conversations then, J. Kumar Infra had a steady quarter this time around. Revenues up 14%, EBITDA was up 16% as well from last year. Margins though were remaining flat from the year-on-year basis. To discuss this and more, we are being joined by Nalin Gupta, the Managing Director at J. Kumar Infra. Nalin, good morning. Thank you for joining in. You ended the year with a top line of around 5,700 crores, which was in line with what the street was anticipating. But margins have remained flat as well compared to last year. So despite this top line growth, what are the targets that you are projecting for FY26? And do you expect margins to be better this year compared to what you have seen over the last couple of years?
Well, so good morning. And Firstly, I would like to say that yes, we had made a EBITDA of totaling around 826 crore, which is a growth of around 17% on FY26, and as a margin we can say at 14.4%. And we are looking at improving this EBITDA margin going forward in 6 to 8 quarters from 14-15% to 15 to 16%. And also it is pertinent to mention here that if you look at the ROE of the company, which was 10.4% in FY22 and 13.2% in FY24, has gone up to 13.8%. And EBITDA as well, as I mentioned, in the coming 6 to 8 quarters, we look forward that we'll be able to increase it by 1 basis point.
Okay, Mr. Gupta, good morning. This is Vinny joining in the conversation. So you're saying margins 15 to 16% is what we could expect in FY26?
Well, I have mentioned it as 6 to 8 quarters. So in the coming 2 years, our endeavor is to increase it by 15 to 16% range.
Okay. And for FY26, what would be the top line growth that one could envisage? Would that, 6,300 crore, 6,500 crore be achievable?
Yes, if you look at the total order book of the company, we are already, we have an order book of around 22,000 crores plus as on FY25, March FY25. And there are good orders in pipeline as well. This year we have bagged orders of around 4,700 crores. And there are bids in pipeline worth around 25,000 crore that we are expecting. So we are very hopeful of bagging around 6,000 to 8,000 crores worth of order for the coming year, that is FY26. So we are very hopeful of making a top line of 6,500 crores plus for the coming year.
But Nalin, even if you bagged orders of around 4,700 crores in FY25, your guidance was anywhere between 6 to 8,000 crore, and you were also L1 in a lot of the projects when we spoke previously. What happened? Was there any delay in ordering, tendering, or was there any cancellation of any project that you have witnessed?
Well, so currently there is no order cancellation that we have seen, and the order movements are a little slow in terms of the one which we have already, we are L1 into. But this 4,000 crore, we are talking about the orders which we have been already awarded, which does not include the L1, which is close to like 4,000 crore separately. So means my target of 6 to 8,000 crore that we are saying that J. Kumar should be able to make is basically for the upcoming FY26. And if you look at the, if you talk about the top line for the next year or the coming 3 years, we already have a secured order book, which is of 22,000 crore plus, which is well comfortable to take care of the coming 3 years top line for the company.
What about the tendering pipeline, Nalin? Any projects that you have bid for, you are looking to bid for? What's the potential order pipeline they are witnessing in this quarter?
Well, so in this quarter, means we have already bidded for new projects worth around 3,000 crores. And there are some tenders that we have to submit within a month or two's time. So, which is like for the Pune Metro, for Thane Metro, which has come up. Thane Metro has come up with an integrated outer ring road metro for which will be submitted in the next month. Similarly, the Pune Metro has also come out with an underground project of around 1,700 crores. So both these projects will be submitted very soon in a month's time. So if the tendering process is free, means I would say a little faster, we should be seeing new orders coming in this quarter as well. But if you talk as an overall, 6 to 8,000 crore is something which is a comfortable number which we intend to back for this coming year.
Okay. Mr. Gupta, I want to understand in terms of metro projects. Previously, when we had spoken, I think you had mentioned about, metro projects being a major contributor in terms of whether you look at revenue or order book. Currently, that's here at around 17% for FY25. So how is that moving forward? When do you expect it to increase, to a major contributor? How much every year do you see this increasing by? And also, how is the margin profile for this? Is it better for metro projects?
Well, so if you talk about metro is one of our specialized segment, which is similar to the elevated corridors that we have been doing. So this percentage basically keeps varying depending upon the opportunities that's there in the industry. And currently also there are good amount of metros that are coming up. Like Delhi Metro is coming up with new projects, Pune and Thane. We can already see the tenders which has been floated and which will be submitted in a month's time. As well as Bombay Metro is also eventually coming up with Metro Line 10, Metro Line 13, and one more line of 13 and 10. These two metro lines are expected very soon. So metro or elevated corridors, if you look at my total order composition, you will see that 50% of the order book comes in from elevated corridors as well as flyovers. So this is basically a specialized segment where J. Kumar specializes, and we have a niche over the other companies. So that's how, if you see that 50% of the order book is coming in from flyovers and elevated corridors, 17% from metros, and road and road tunnels is around 18% and 16% others. So this proportion keeps changing depending upon the opportunity. And in both these areas, we have an upper hand, I feel.
You know, Nalin, at the end of FY24, you had given a vision 2027, where you're expecting around 25,000 crore plus in order book, $1 billion in revenue, 15 to 16% of operating profit margins. Are you on track to achieve all of that?
Well, I would say we are very much on the track. And if you look at the top line of this company, of J. Kumar, we had given a figure of close to like 5,400 to 5,500 crore, which we have already surpassed. So which I think the numbers itself speak about the performance of the company and the dedicated team of J. Kumar. We are very, very sure and confident that we should be able to surely meet the targets that we have planned for.
Okay, just a last word, Mr. Gupta. Execution, how is that shaping up? Is that in line? Is that seeing a pickup? What is the scenario right now?
Well, I would say the new orders that we have bagged in FY24 has already started contributing the revenue for these new projects. And in FY26, we should see a substantial contribution coming on from the new projects. So the government, I would say, is very, very particular about the execution, about the timelines. And I feel that there is a good support from the entire government sector. And this project should really see good speeding up and ramping up in the progress.
All right, Nalin, thank you so much for sparing time and joining us today. Wish you good luck for FY26. The management there of J. Kumar Infra maintaining that they are on track to achieve their Vision 2027. Take a short break, but just as we do that, here's some good news for our viewers. India's business news leader is now just a click away, and that, of course, is the all-new CNBC TV18 app, where you get breaking news updates, in-depth articles, and financial world stories right at your fingertips. You can download the app from the Apple Store or the Google Play Store, or even scan the QR code that comes up on your screen and download the app. Take a short break. Back on the other side.
Welcome back to Trading Hour on CNBC TV18. Markets and Nifty has come down a few points from the 22,900 as of now at 22,824 level. So let's keep an eye out on where it's headed in the second half of the trading session. But let's move on. And will they or won't they? That's the question on everyone's mind as digital payment firm PhonePe eyes the D-Street debut. CNBC TV18 Shireen Barnes spoke to Sameer Nigam, the founder and CEO, as well as Rahul, the Chief Technology Officer at PhonePe, on IPO plans at the startup space and much more. Listen in.
Can you look me in the eye and tell me what's changed today? What gives you the confidence of wanting to go for an IPO today?
I think the profitability part of it, we reported we shared our annual report for FY24 already, and we were adjusted PAT positive for the first time, so I'm very happy about that. I think directionally too, I think the company's at a stage where I feel like the core payments business, consumer and merchant combined, is at a stage of maturity and market leadership where we should, hopefully from here, remain sort of very, very stable and hopefully quite profitable in years to come. Conditioned well enough to say without setting any targets or goals. I think it's the right time. I think the business is in a good place, the org is in a good place, the sector is in a good place. Payments is still growing very rapidly. So if you're a market leader in a growth sector, I think it's a good time.
So Rahul, did the two of you sit and have a conversation about it makes sense to do it now? This is the right time, this is the moment, and we should go all in?
Oh yeah, we have a conversation about everything. I think we have more conversations with each other than our wives.
Well, you've known each other longer than you've known your wife, so it kind of makes sense.
That is true. No, we did have a conversation. I think like Sameer mentioned, just given the current state of the org and the business, specifically on the core offering that is payments, given how exciting financial services and payments in India is, and the fact that we also have a few new businesses that we are diversifying into, we felt that this is the right time where the core business on the path to profitability, being able to actually nurture new businesses, is the right time to take PhonePe to the public markets. It is also a reflection of our maturity as a company from a compliance and governance perspective, that we are ready to actually take on this larger role. So yeah, we did have the discussion and felt that it's perfectly the right time to actually push forward.
But as you pointed out, this is not your first rodeo. You've both have been around the block and you've done this several times over. And I want to go back to the Flipkart days and the Flipkart Association, because I was telling Rahul before we started that in many ways, what HUL is to sort of the legacy companies as the CEO factory, Flipkart kind of has done that for the digital ecosystem, has it not? And you're kind of part of that story in many ways.
Flipkart, I think
over 100
people talk about the Flipkart mafia and all the startups that came about. I think
you're part of the mafia.
I'm saying, I don't think people understand. It's not just in Bangalore. I think the change in psyche in 20-year-olds and even late teenagers today, where everyone wants to actually get out there and ride the sort of startup wave and try their luck at building something, being innovators, that fearlessness you see today, which I think we all celebrate. I think so much of it can be mapped back to that one company, and I think the two Bansals, but they also had a phenomenal group around them. They're early believers.
Yeah.
We joined a little later. We were missionaries, but we were late missionaries. They already had a very strong core. I tell people at PhonePe this often. I have a tremendous amount of pride in the talent and our bench strength, but there was a point at Flip where the caliber of the bench strength was actually scary good. Right? I mean, every IIT graduate and every IIM graduate was working there, and every lateral, peak of their career, sort of smart person that I know of. And I think the country, forget markets and IPOs and all this stuff. The country owes companies like that just as much as we do in this generation, just as much as you do for the Tatas for creating haloed institutions. Definitely the OGs in this space. I mean, there's no doubt in my mind.
Right. I think it's the startup university.
Still are.
Equal number of good decisions and bad decisions.
Yeah.
But the fact is that looking back, vision is always 2020. And I think we have that advantage building PhonePe after having seen the Flipkart journey, because there's so many learnings, right? There's so many learnings in terms of, you're talking about incentivization, cashback, use of data, building for scale. I think a lot of us who have graduated from that startup university called Flipkart enjoy having that 2020 vision when it comes to actually building a startup today.
How do you look at competition? Do you look at competition from the perspective of focusing on your competitors' strengths or your competitors' vulnerabilities?
Definitely not the vulnerabilities, because that's a perverse game, right? I think even on the strengths, I think we definitely look at whether they're innovating in interesting ways.
Who's innovating today, to your mind?
I think shamelessly, I think in our sector over the last 10, 15 years, the most innovative by far and away has been Paytm. And we talk about this. I think it's fair to say that.
Yeah.
They brought the wallet to market, they got the QR to market, they got the soundbox to market. They've done a lot of things. I think that's perfectly all right. Like, I should be able to say that my competitor is actually very innovative, right? I think Cred got gloss to design. It's glossy. It looks like really polished. I think each of our competitors, there's certain things that they do better. BillDesk is the OG in payments for 20, 25 years. They've gone into the hardest work in the entire sector. They've gone and taken state utilities and digitized them, right? So huge respect, because we all benefit. There's no BBPS if there's no BillDesk.
The top brass of PhonePe, or shall I say IPO-bound PhonePe. We'll hear from them soon on the Dalal Street debut. Of course, the market has come off the highs of the day, almost a 70-point downtick now from the day's high of somewhere close to around the 24,900 mark. So we are trading around that 24,800 now. So almost an 80 to 90-point downtick that we are seeing off the highs of the day. Dixon Technologies is back down to trading 6% lower. So the bounce that had come in from the lows of the day has now been sold into again. So they keep an eye out on Dixon, still the top loser on the Nifty 500. Newgen Software is down 5%. KPR Mills, after the block deal that took place earlier in the day, is also down 5% in today's trading session. On the flip side, though, look at Tata Tele. That has sprung up among the list of gainers now, 5.5% higher on Tata Tele Services. So that stock is on the radar as well. A lot of these mid-cap pharma names are doing well for themselves, be it the likes of Kaplan Point, GSK Pharma. Gland Pharma, of course, is a results reaction, and Piramal Pharma too, trading with gains of anywhere between 3 to 3.5% in today's trading session. So mid-cap pharma is one. We're counting down to at least 7 PSU earnings we need today, be it ONGC, Oil India. There are railway names that are reporting results. There is Nalco that's reporting results. So a whole host of PSU names. We'll keep an eye out on that in the second half of trade. But for now, Vinny and I take your leave on Trading Hour. From us and the team that put this show together, thank you so much for watching. Halftime report for the next 60 minutes.
After a brutal late session sell-off on Tuesday, likely powered by foreign investors, stocks bounce back. Realty, healthcare and auto lead the charge. Consumer durables and energy bring up the rear. Mid-cap index gains in line.
Listen, Bank is expected to post a sizable loss in Q4 on the back of weak business momentum, tighter margins and elevated credit costs. But the biggest concerns are over any fresh revelations.
Dixon Tech misses the mark on revenue on stagnant mobile sales and weakness in consumer electronics and home appliances, but the company aims to more than double revenues in the next 2 to 3 years with 90 to 100 basis points margin improvement.
Oil flares up on reports of a possible Israeli strike on Iran, the OPEC's third largest producer. Fears of Iran disrupting movement in the Strait of Hormuz and lingering uncertainty over the Russia-Ukraine war also add to the mix. Hello and welcome to Halftime Report, live from the CNBC TV18 Motilal Oswal studio. I'm Ekta Batra and with me is Mangalam Malu. Well, it's turning out to be a good session for the markets. It's at least stable at this point in time. We have the Nifty at around 24,800. Let's see whether we manage to make a dash towards 25,000 or not. But for the mid-cap index, also holding with a gain of around 256 odd points, and the Bank Nifty just about higher by around 0.16%, consolidating with a positive bias. A lot of stocks in focus on account of news, and that's what we'll be focusing on in the next 60 odd minutes. Hi, Mangalam.
Hi, Ekta. Thanks a lot for that. Yesterday was a bit of an excess on the way down, and today at the start was a bit of an excess on the way up. Now we're, what do you call it, coagulating around that 24,800 mark for the Nifty. And we're looking at 200 points on either side for the frontline index right now, 24,600 to 25,000 itself. The Nifty Bank, which was powering up ahead, has seemed to come off a tad from the highs. And we have the mid-cap index as well, which, while is gaining in line with the frontline indices, has come marginally off the highs. So where we close today will be a lot more important than how we opened and how we performed so far. A couple of things really stand out. The metals pack continues to do well for the second day running. Maybe prospects of better Chinese economy, helping their cause. And the other part is the IT index, which also did slightly underperform in yesterday's trading session, has made a bit of a comeback today, whether that sustains or not. But amidst all of this, there are a bunch of result reactions that we're tracking. Texmaco Rail and Engineering is the first management on the show today. Reported a steady set of fourth quarter numbers. The revenues, came in around 17% higher year on year. We have Sudipta Mukherjee, who's the MD of Texmaco Rail and Engineering, joining in. Sudipta, the first 3 quarters of the year, you did a lot better. The last quarter, while the revenues grew, the percentage of growth actually slowed down. In light of this, what is it that you can guide for in FY26 when it comes to revenues and margins? Also, if you could give us a sense of what kind of order inflow are you targeting for the next financial year?
Good afternoon, Mangalam and Amraj. Thanks for having us. I think Texmaco has put up a very strong performance while our revenue has grown over 46% and the EBITDA was 58% higher year-on-year basis. And if you see the PBT, that's also 112% higher. So in a sector like railway, one should not look at things on a quarterly basis. It is on a year-on-year. If you see that we have significant growth, which we have put up as a company. And we foresee, of course, we are confident that we will continue with this momentum of growth. And while in the journey, we'll definitely improve few key ratios of the business significantly.
Okay. Could you just give us a sense in terms of the tenders from the Indian Railways in FY25? We do understand that it wasn't that much. We didn't see many large tenders. What is FY26 looking like?
Umraj, if you kindly analyze, if you kindly recognize the fact that Indian Railway first time came up with a long-term contract 2.5 years back. And it is in the history of the Indian Railway and the government of India's push for a long-term plan and development for the country to become the third largest and second largest economy. So consequent to the National Rail Plan, the largest tender was awarded. So no one can expect that every year such kind of tender will come. And the delivery period of that tender was, of course, up to 2025-26. So everybody is sitting, I mean, at least Texmaco is sitting on a significant order book in spite of the fact that last year, whatever be the performance, and perhaps we are the highest supplier of rolling stocks to Indian Railway. And that is very much within the timeline of the mandate which we had as per the contract. And there has been few specific tenders in between, and which was more because, you know, in this budget, government had a more focus on the removing the track congestions and add on the infrastructure part of it. So there were certain specific rolling stocks which started coming in. We have also got a share of that contract, and it's going on. And we envisage that very soon there will be further contracts which will be awarded or tenders will come up. So for the conventional rolling stocks are concerned. And just to briefly appraise you that Texmaco is very uniquely placed because of its very good joint ventures with global conglomerates. And we had been one of the pioneers in, propagating for the technology and advanced products. And we are very happy to learn that government is looking forward for optimum solutions and more advanced railway wagon design, including the components and the bogies, and which as a company we are really looking forward to because we are very uniquely placed and robustly placed to get into that. Other than the infrastructure and all other things whichever we are doing, we'll be continue to focus on those signaling system solutions and many other parts.
What about execution for FY26 and the revenue that you're likely to recognize? Because FY25, like you pointed out, you did 46% growth in the revenue, 77% growth in the EBITDA, which implied a 200 basis points, near 200 basis points margin improvement. Do you think this 35 to 40% sort of revenue run rate is sustainable for FY26 and beyond as well? And what levers do you have for margins going forward? Do you think you can manage them between 9 to 10%, or there is a possibility that it sustains above 10%?
So, Mangalam, as I have mentioned that, of course, it cannot be, the growth will be sustainable for Texmaco. We believe if you recognize that what are the various parts of, various segment of business of Texmaco. One is the primarily the freight car division, which includes the component part of it. And we have this electrical part of the infrastructure. And then we have the rail infrastructure system and solution. So, so far what you have seen is the growth which is in the core business, which remained as a core business for the company in and around freight rolling stock. We feel that there is enough room for us to grow there because we are very technologically advanced and very uniquely poised so far the domestic market is concerned. And perhaps we are the only company in India who are significantly exporting the freight rolling stocks and its components. So we believe that there is enough room for growth in that segment. But what I can also assure you that we have a very focused approach to grow the electrical engineering part of it and the rail infra system and solution, which is going to get demerged from the company as a wholly owned subsidiary. And with government push on and huge financial allocation in rail infra and the signaling part of it, we feel with our kind of qualifications we have and with the focus approach and this management restructuring, and that business has a huge potential to grow and it have a potential to be mirrored in a very near time.
Okay, all right. Just a quick last question then. You did tie up, you've entered into 2 partnerships in Q4, which is with a European firm and a leading US company as well. What will that bring to the table in terms of revenue for you?
So if you see that our revenue growth in terms of the numbers, if I have to mention of the turnover, it is around 8. It remained 8% of the revenue, but it has significantly growth in terms of the value. And we have been the one of the company who has all the accreditations to supply materials of red rolling stock and castings to US market. And Trinity is one of the largest rolling stock manufacturer of the world. And Texmaco and Trinity is poised to set up the first of its kind global capability center in India. And you know that the whole world is thanks to the government of India's initiative and to all the Indians and all of us, that everybody is looking at us as a potential supplier for the global requirements on a sustainable basis, who are very uniquely placed in terms of cost advantage. And of course, we are neutral. So more and more companies are coming towards us. So this initiative of putting up a global capability center in Delhi will also have a component called global supply sourcing. So that is an aggregation business for the rolling stock for the world. So one part will look for the innovation and technology upgradation and bringing new designs for India as well as the rest of the world, where we want to fight with the global major today, maybe, which is perhaps CRRC. And, then, of course, to fulfill the dream and work better out of India, being a global sourcing partner for the US market and rest of the world.
All right, we're going to leave it on that note. Thanks very much for joining in and speaking with us and giving us that perspective. So that's Texmaco Rail. The company has indicated that they have a healthy order book. The stock, as you can see, is up around 0.3%, and they will continue to focus on signaling solutions. They do have an export outlook as well. We'll take a short break, but up next, the management of Acme Solar Holdings will be joining in to talk about their Q4 performance. Stay tuned. Welcome back. Well, for the markets, it's holding up with a gain, but the bank Nifty is now slipped into the red, so just watch out for that, down around 66 odd points. We have a lot of the pharma stocks which are gaining today, so Cipla is up around 2 odd %. They did launch a complicated UTI drug, or a drug which is used for complicated UTIs in the Indian market. But separately, Sun Pharma is coming out with its numbers tomorrow, so that one is holding up with a gain of around 1.6%. And Divi's Labs came out with its numbers already, so we're seeing some amount of buying there, so up around 1.5%. Some defensive flavor really playing out in the markets, so probably why you're seeing a lot of these pharma stocks gain. But in any case, let's talk about one particular company. Acme Solar Holdings is the next management on the show. The company reported what was a strong set. Revenue and EBITDA margins came in healthy. Do note that Q4 did see a one-off exceptional gain of 697 crores. To discuss this and more, we have Nikhil Dhingra, who's the CEO of the company, joining in. Mr. Dhingra, thanks very much for taking the time out. If I can just start by talking about the capacity, at the end of FY25, it stood at around 2.7 gigawatts, and it's doubled from FY24. You do have plans of increasing it to 7 gigawatts by FY28. Tell us if it is achievable and your eventual target of 10 gigawatts by 2030.
Sure. So, in terms of the one correction I would like to make before we started, you mentioned that there was an exceptional profit. That exceptional profit happened in FY24. This year, FY25, we didn't have any exceptional profit. So, FY24, we had exceptional profit. So, the growth you see is much more exceptional if you adjust for that in the FY24 numbers. And in terms of the this year, we have expanded our capacity from 1.3 gigawatts to now 2.7 gigawatts since we commissioned a plant last week. And of course, this is slated to go up 3 gigawatts over this quarter and next quarter. In terms of moving to the 7 gigawatts operational capacity, as you know, we are in the long-term PPA business. We have contracted capacity with the central government of India, wherein we have to build the plants in those 2 years. So all our commissioning are driven by the PPA signing, which are there with the central counterparties for 25 years. So they have slated staggered commissioning timelines. Some is concentrated around May, June of 26, and some of them are concentrated around December 26. And the last phase is, you can say, around May, June of 27. So these are the timelines where we will go from 3 to 5 gigawatts of contracted capacity. And another thing is, with our contracted capacity is, since we are doing a lot of FDRE projects and hybrid projects, the installed capacity number is much higher than the contracted capacity numbers. So when you are looking at these numbers of 7 gigawatt, the installed capacity will be much higher in terms of the installed capacity, because in an FDRE, typically you install 2 megawatts for a single megawatt of contracted capacity. In terms of the 10 gigawatt, of course, this 7 gigawatt target is for calendar year 27, reaching that operational capacity. And we do have all the PPAs in place, which is the first thing, the connectivity in place. We have around more than 50% of land for solar and 60% land for the wind. We plan to do for these FDREs. And we have tied up the long lead items for the capex. So we are on track to execute these projects. We do have the financing in place for the signed projects. So that's how we are doing it. And this is a very stable business in terms of the post-operational cash flows. From reaching from 7 gigawatt to 10 gigawatt, of course, we need to win only 3 gigawatts more of projects in the next 2 years to reach that capacity. Because once you win the project, it typically takes 2.5 years adjusting for PPA signing. So we are well likely to exceed the 10 gigawatt of operational capacity target by 2030.
Well, that is quite heartening. You will exceed the 10 gigawatt capacity by 2030. You'll probably do that in advance as against the earlier target that you had. If you could give us a sense of how this EBITDA ramp up will take place then, because from the capacity jump, the EBITDA jump will obviously be a lot more because of the operating leverage, and at the same time the rates, which may be slightly higher than what you had earlier written them for. I remember you had said that average tariff is 3.5 per unit for the 2.5, 2.7 gigawatt capacity that you have, and bulk of the built-in capacity that you are, the capacity that you're building is likely to be bid between 3.5 to 4 rupees per unit. Can you give us a sense on how that is panning out, what your current realization per unit is, and what in increased capacity will the realization be, and as a result of which, what your EBITDA is likely to grow? Because I remember that 7,000 crore target by 2030, you said, is easily achievable.
So, in terms of you have a very good memory. So I think the 3.5 is the average tariff for our operational capacity. You are indeed right. And the average tariff for the under construction capacity is around 3.9 to 4. So you're right that the average realizations will go up, and also the per unit generation for a megawatt of contracted capacities goes up, because the capacity utilization factor for solar currently we are at around 25.6%. We have increased it by 200 basis points this year. In an FDRE, typically the CUF will be 45 to 55%. So that effectively for a contracted capacity generates that much revenue by a factor of around 1.8 to 2 times. So so definitely in terms of the EBITDA expansion, you are right that there is an operational leverage in this business. And in terms of the capital efficiency, if you look at our ROEs, ROC, we have industry leading ratios on that. So when we look at the revenues and EBITDAs, of course, this year we did around 90% EBITDA margin, improving on the last year. And that is, of course, resulting from the higher capacities of our plant. The cost from revenue to EBITDA is typically your O&M cost. And the larger your plant is, single location, the lower your costs are. So that is one bit of leverage. And of course, the other bit of operational leverage is the same sort of EPC team is able to build out larger capacity if you do larger plants on single location. So that will play out, of course, because most of our sites are upwards of 500 megawatts each. In some places, we are building more than a gigawatt. So that is because we have been able to gather connectivities and the PPAs required to get those connectivities at the appropriate locations, high radiation locations for both solar and wind. In terms of the EBITDA numbers, they will grow very steeply as we execute from 3 to 5 to 7. Of course, our capex also will go up in sync. And the key thing for us is, other than the EBITDA margins, is the return on capital employed, because this business is basically linked to that. We are not only after the P&L, we are all equally care for the ratio of P&L and balance sheet. So definitely the numbers will be in terms of the PPAs we have, that number, of course, is something we will try to achieve.
So 7,000 crore happens before 2030, your target, because 10 gigawatts happens before 2030 as well.
Yes, it of course, in terms of the exact revenues and EBITDA, of course, EBITDA is 90%. So as we go to the 10 gigawatt target, there'll be a steep jump in our revenues. Right now, we are at around 2,200 crores annualized sort of revenue. As we grow our capacity 3 times, and that too at a higher tariff, it will be definitely possible.
And just quickly, what would this do to your balance sheet, your current net debt, and what would it rise to, or how would you manage it? Just a quick question as you increase capacity.
Right. So this business is capex intensive. So the key thing for us is how quickly we are moving from taking debt to getting the capacity operationalized. And the other thing for us to look at is in terms of what is the net debt to EBITDA number for our operational capacity, and what is the net debt to EBITDA number on the let's say next 12 months EBITDA we are targeting for operationalizing capacity. So we have a stated target that we will never cross a debt to EBITDA of 5.5 on the operational capacity. As far as under construction capacity goes, we have a typical 2-year execution period for a project. The first year we don't draw any debt because we do land, transmission line, and we do the project with our equity contribution. The rest of the debt contribution comes in the second year. And that EBITDA starts coming up after 12 months of the debt incoming. So we will always try to be within the band of debt to EBITDA of 5.5 for the operational assets.
All right, Nikhil, we're going to leave it on that note. Thanks very much for joining in and speaking with us. Well, we need to take a short break, but here is some good news for our viewers. India's business news leader is now just a click away, introducing CNBC TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.
As we speak, the Nifty Bank has moved back into the red, so we'll keep an eye out on the decline that we're seeing from the highs. The frontline indices, as we speak, there have been some recovery from yesterday's lows, but that has been sold into. Where it goes from here is, the most important thing to watch out for will be what happens to the mid-cap index from here, because the market breadth, there were more stocks advancing than the number of stocks that were declining. Now those lines have come fairly close and on the verge of intersecting. And, it's a pretty even keel in terms of the number of stocks that are advancing versus the stocks that are declining. 24,800 call writers have covered their positions, as have the 25,000 call writers, telling you that maybe on the way up, we can see some moves. But we're also seeing some writing at the 24,800 put and the 24,700 put, telling you that the supply on the way up will find demand at around 24,700 to 24,750. Yesterday's low, extremely crucial. The Nifty put call ratio, which had gone to levels of 0.69, has now moved higher to 0.8. And the Nifty Bank, which was above its 20-day moving average, has now fallen once again below its 20-day moving average of 54,990. So let's see where it goes from here as well. T-Tiger will enter F&O ban after exiting it yesterday, as will Dixon, with the kind of up move that we're seeing on that stock. With that, let's take a short break. On the other side, more markets and stock-specific action.
Welcome back. Well, Schloss Bangalore, which owns the Leela Palaces Hotels and Resorts, will be hitting the Lal Street with its 3,500 crore IPO on the 26th of May. Brookfield-backed company aims to reduce its debt by around 23 crores through its IPO proceeds. Our colleague Reema Tendulkar caught up with Ankur Gupta, who's the managing partner, head of real estate for Asia Pacific and Middle East at Brookfield, to discuss the IPO offerings, and began by asking him, when will the company become profitable? Listen in.
In 2019, what we acquired was this very unique business which needed experience, which needed growth, which needed stability. And very proud that in 5 years, through a period of a lot of global turmoil in the hospitality sector, the business today is bigger by almost 3 times. It has an amazing appeal internationally. It has been ranked as one of the best hotel brands in the world consistently for several years. And I would like to believe that the best years, through the effort that we've put into this business, are still ahead of the business.
So will it be profitable from here on?
The Leela business recorded an EBITDA of more than 700 crores in FY25. And as I said, the best years are still to come.
You're bringing down your debt. You've earmarked about 2,300 crore to bring down your debt. What would the debt number stand at now?
The net debt number post...
After?
So the net debt number post the IPO will be almost zero, which was our strategy for the IPO all along, that we'll deleverage the company, which will poise it for a lot of liquidity in future for growth.
You know, you said that how the sector had gone through a long period of a downturn, decade long, and you've come in, turned it around, and in fact, post-COVID, things have dramatically improved. Do you think for the industry and Hotel Leela, a double-digit revenue growth is par for the course from here on?
So again, going back, as you mentioned, the hospitality industry went through a period of you could call it no growth, or in certain cases, negative growth. In real assets, supply, demand, and fundamental economic growth matter the most. Now in India, economic growth has been solid, but the demand-supply dynamics for the hospitality sector, or 20 years ago, got fractured a little bit. Now, as a result of what's happening in the underlying growth, demand for hospitality has changed. Per capita GDP, the rise of affluent and middle-class India, that's all real numbers, and that's now snowballing into what has made India one of the best economies in the world to invest in. So now the demand side is solid, the supply side is very, very muted.
For investors, double-digit revenue growth, do you think it's possible from here on medium term?
As we've disclosed in the financials, we've achieved that in the past, and as I said, the best years are in front of us.
Fair enough. EBITDA margins, 46, 49%, best in class, sustainable?
So there are 2 parts that make EBITDA margins. One is a solid focus on technology, where we've really focused on the revenue management side. At the same time, you have to have your expense control. All of this in a B2C business is aided by how well your customers perceive your business. So the third point in your data that you just mentioned is our NPS score. Our NPS score is industry leading. Yes, we have highest EBITDA margins, but what really contributes is how well our customers in Leela like us.
But margin sustainable, and what do you think is the key reason why your margins are higher than peers? So for instance, Indian hotels, FY25 margins were 35%. Is it just because you are operating in the luxury segment vis-a-vis them, and therefore you're commanding higher average room rents? Is that the explanation for your higher margins?
As I said, Leela is a unique business. Our focus is on luxury hospitality. Our focus is an asset-right model. And as I said, our NPS scores drive everything. The second part that we've done in the last 5 years is severely invested in technology, renewable power, making sure our expense control do not compromise the level of service.
We know luxury comes, at a price, but the way the average room rent has gone up, for your company, on an average, it's about 16,000. For the properties that you own, your average room rent is 22,500, and that's not it. The CAGR growth over the last 2 years was 14.5%. I mean, that's double or triple the inflation. What is your view on ARRs from here on?
So I would say, when we acquired the Leela platform, we realized that this brand has the potential to be what came from other countries and became a global phenomena. And that does not mean that properties have to be in every country. The brand has to be globally recognized. Four Seasons came from the West, Mandarin came from the East. Both have become globally recognized brand. And that has been our motto to grow the Leela business. In that context, if we compare the room rents today in India, they are still a fraction of most cities in the world. And hence, I believe that for the right service, for the right brand, for the right quality of property, the built environment, this is more of an experience story, not a consumption story.
Every hotel is a destination, not just an accommodation, right? At the end of the day.
Every hotel is an experience for lifetime.
Every experience for lifetime. In fact, you're also talking about experience. You're also getting into heritage tourism, spirituality, wildlife. Tell us more about this, because that's clearly high on your agenda.
India is a multifaceted country. In a way, Leela business is a celebration of Brookfield's business in India, which spans almost $30 billion. And the one thing that India has is we are home to 38 UNESCO World Heritage Sites. We have the largest and the most diverse population of the wildcat. Our castles, our forts, our palaces, and palaces at the core of the Leela business. And it was time that we invested back in these experiences, not just in the urban palaces that we have, but also taking this brand. People always talk about when will Leela go international. There will be a time for that, but there's so much scope in bringing international back to India, and not just to the Mumbai, Bangalore, Delhi of India, but to the Ranthambores and to the Bandhavgars, Ayodhya.
So today your keys are 3,500 approximately?
That's correct.
Okay, you've got a capex lined up. I think 7 new hotels?
8.
8 new hotels. So the total hotel count would be what, 20, 21?
More than 21. More than 20.
And what would your keys stand at, say, by the end of 2028?
So again, we mentioned what we have currently on the pipeline, but as I said, the momentum behind the Leela business is very strong. It's stronger than ever before. So this is what we have today, but this business has the legs to be even larger.
But your occupancy is low, right? Like 65% vis-a-vis peers. Is that just the price of exclusivity? And are you looking to close the gap?
Look, occupancy and price points are a mathematical equation sometimes. I would say that we have maintained our premium factor. We've maintained the luxury factor. Our occupancies are inching up. And we are not just changing, occupancy levels on the fly. We are making structural improvements into our business, which will allow the occupancies to be sticky. People always say, real estate or hospitality is a cyclical business. Now, how do you make it counter-cyclical? What we are seeing is trend lines now. Post the pandemic, people are staying longer. People are using the Thursdays and Fridays and Mondays as, shoulder dates for extending their, work and, personal travel.
Your positioning has always been luxury. You're not even present in what you call upscale or upper upscale. Right? Is that going to change as you expand?
Ultimately, economics and what you stand for are the two fundamental things that define a business. Sticking to your roots, as long as the business and the expansion plans in that particular segment are in front of us. So we have massive tailwinds right now in the luxury space, almost no competition. And I think this is a great place to be.
So you will stay a luxury hotel?
That's the ethos for Leela.
So just answer in yes or no as we wind down this interview. Double-digit revenue growth, margin sustainable, because the best is yet to come.
The best is yet to come.
Welcome back. You're watching us here on Halftime Report. The market's picked up once again. The Nifty Bank up above the 20-day moving average, up around 100 points. Let's get chatting with the management of Solar Industries. The stock's been doing well in today's trading session, especially after the management commentary that came in yesterday, where they are targeting 10,000 crores in revenues, with 30% of that coming in from the defense sector in FY26 itself. What is guiding this optimism and what their order inflows are likely to be? We have Manish Nuwal, who's the MD and CEO, joining in. Thanks a lot, Manish, for joining in. A fairly optimistic guidance that you've given for next year, with defense portfolio crossing 3,000 crores as well. If you could give us a sense on your current order book and what are the kind of order inflows that you're expecting over the next 12 months and what's executable over the next 3 years.
Yeah, if you look at the total order book at the end of the last financial year, it was only 5,000 crores and now it is around 17,000 crores. Out of this 17,000 crore, defense products are for almost 15,000 crores. So the optimism is coming from that, which is yielding a big confidence in our management that we should do 10,000 crores in this financial year.
Okay. Just wanted to, before we get down to the numbers, just wanted to understand what the incremental order inflow might have been or queries might have been post Operation Sindoor.
We are always watching all the media articles which shows that the Operation Sindoor has been done and our products were being used. So because of the current geopolitical situation, demand for such products are likely to go up drastically. And we are waiting for those orders which can come through the emergency procurement route. Apart from this, we are also expecting variety of products and orders in the normal course of procurement. We have developed many products in last almost 7 to 8 years, and those are starting to commercialize now.
But just if we could get, maybe you can't talk about specifics here, but if you could just give us a sense in terms of the incremental increase in queries or the incremental increase in the possibility of your order book expanding just in the past couple of weeks, and hence maybe your capacity utilization as well.
So if you look at the current situation, it is very natural to receive lots of queries on our capability or to supply the products to meet the current requirement. So we are receiving a lot of queries, not only from India, but from international market also.
Have you closed in on anything? Is there anything certain that you can talk about in terms of orders closing? And if not, by when do you probably expect it to convert from queries?
Those queries are likely to be converted very soon. And I think probably in next 1 or 2 months, we should get the orders.
Which brought me to my first question once again. Manish, you did not answer that. You said your order book has increased from 5,000 crores to 17,000 crores. What I wanted to know is what are you expecting this year in terms of orders? If you could give us a quantum, say, are you expecting 5-10,000 crore worth orders? Because defense orders, while they are large in quantum, they are not very frequent, right? You get one, say, 3 or 4 years to be then serviced over the next 3 to 4 years. What are you expecting this year? How much from the Indian defense side and how much of that for exports?
We are expecting, we have already participated in many programs like Pinaka program. We have concluded the few more ranges or few more variants of Pinaka are likely to come very soon. We have participated in air defense programs also. We have participated in many international programs also. So as those will come, we will keep sharing. So we are expecting the order flow to continue in this year as well.
So 10 to 12,000 crore worth order inflow is achievable this year, or will that be an optimistic expectation?
We are expecting huge orders in next 1 or 2 years.
All right. And what about this investment that you've done with the government, or the announcement that you've done, 12,700 crores for drones, etc. Over how many years is this likely to play out? How are you funding this? And what's the expected revenue potential from this?
This MOU we have signed for 12,800 crores and to be invested in next 10 years. But based on our current success of the products, we believe that those 12,800 crores we can do in next 6 to 7 years. And based on the current cash flows, we are very confident that we should be able to meet all these capex program from our internal accruals or little more debts from the bankers. That's all.
And what is the revenue that you expect from that?
We expect revenues over a period, whatever we invest, it should be at least 1 times or 1.25 times whatever we invest. But it takes time. As you know that defense product takes time to qualify and then commercialization. So it's a long gestation sector and we are fine with that.
Okay. Understandable. Just wanted to understand that if we were to have this conversation, say 1.5 or 2 fiscals from here on, defense would be how much as a percentage of sales? I think you said 30% eventually, but what would the, say, 3-year plan be for the company?
I think in 26 we should do definitely 30% plus of the total revenue. And as we move forward, we expect it should be reaching to around 40% in next 3 years.
40% in the next 3 years. You know, you have a fantastic order book. You're supplying to the international markets. You're seeing queries increase. What is the biggest risk to all of this, according to you, which you are probably trying to mitigate?
If you look at Solar's business model, the products which we handle are always hazardous or risky in nature. So our company's system has very well fine-tuned to handle these kind of things. And if you look at the global risk, definitely war is also one of a big risk. But from this risk, we are getting these opportunities. Apart from this, if economy slowdown happens or some kind of bigger conflict happens.
But anything more specific in the supply chain?
I think supply chain, we are well tuned because most of our products we are buying from indigenous routes, and in defense sector, 80% plus is from our own captive manufacturing or through our associate vendors. So I don't see much risk in that side.
And this 6,000 crore Pinaka order, when does execution start on that one? Will it be this year or will it be next year?
Pinaka execution should start in this calendar year. Probably in Q2 or at best or in worst situation, it will start from October onwards. So we are expecting the big ramp up for Pinaka programs. Our team is ready, system is ready, but definitely procurements take some time. So that is the only factor. Otherwise, we have already produced Pinaka rocket for international markets. So we are very confident.
And how much revenue every year will you recognize from this?
I think as of now, we have orders for 2 variants and we expect revenue of around 550 to 600 crores on annualized basis. And more variants will be coming up very soon. So we expect around 900 to 1,000 crores from Pinaka products in next couple of years.
Any associate vendors which you can probably highlight for us?
Because of various non-disclosure agreement and confidentiality, it is not wise on my part to share those names. But we have a very solid relationship with our vendors, and we have been proving those relationships, helping us to company grow on a year-to-year basis from last 27 years of our existence.
Okay, all right, Manish, we're going to leave it on that note. Thanks very much for joining in and speaking with us and giving us your perspective. Well, that Solar Industries, needless to say, the stock is doing very well. The stock is up around 4% at this point in time, over 14,000 odd rupees for that one. We'll take a short break. Manisha Gupta joins in with a check on commodities. She has with her Ashok Kumar Gautam, who's the MD and CEO at IIBX. Stay tuned.
Welcome back, and joining us on the show now is Ashok Gautam. He is MD and CEO at IBX. Mr. Gautam, hi, thank you so much for joining in. Would need your reaction really on the latest DGFT notification, which has put gold and silver of higher purity in restriction. What does it really mean, and would that impact business at home?
Okay, let us make the things clearer for the audience. If you remember, we had this discussion earlier. In the Finance Act, under ITC, some of the HS codes were harmonized. And they had said that this will come in effect from 1st of May. And around that time, Customs came up with their own notifications. And what DGFT has now notified is they have aligned their harmonized system codes along with the Customs code which have been issued. So in this, there is a clarity has been brought in. So now the gold which will be traded through IABX will be coming under 7108-1210. So and then there is another category which has been notified where the Dore will be coming, that will be under 1290. So this has just been clarified, and this has been aligned with what the Customs has notified as per the Finance Act. So this is one piece which has come in this notification. Second piece which has come under this notification is related to 711011 category, which is platinum, where it has been now clarified that when anybody is importing platinum, that platinum content should be there of 99% purity. As you know, earlier there was a little bit of a gap in the notifications where in the garb of platinum, the gold was being imported, calling it as a platinum alloy, while the platinum itself was less than 5% or around that. So that has now been, that route has been plugged, and it has now been clarified that if the platinum has to come in, it will have to have a purity of 99%. So I think this is a very welcome step taken by DGFT, and this will bring in more clarity for the traders, for exchange, and also at the apex level, when the data is being collated, government and Ministry of Commerce and other authorities will be able to find out how much gold has come in the form of bars and how much gold has come in the form of Dore. I think this is a very welcome step which has been taken.
Mr. Gautam, also when it comes to IBX, how was the previous financial year for you, and how is this one begun?
Touchwood, Manisha ji, with the good wishes of all of you, we had a very good year last year, and if it is not out of place to mention, we had a first full year where we had a net profit. That is not so important, but what is important is that there is a trust of the market which has been received. And
what really have been the numbers in sense of imports?
Yes, and the numbers. So we clocked more than 93 tons of gold import last year, and are taking total import till last year to 101 tons. So imagine previous 2 years we had done only 8 tons, and after that we crossed 93 tons. And this also gives us a way ahead that where we'll be going. And this year we have already geared up ourselves. As you know, we had issued a circular whereby we had invited from the TRQ applicants to give us their application so that we are ready at the pre-allocation stage itself. And now when the allocation has already come in, around 1,480 entities have been granted this TRQ quota. And we are hopeful that we will do minimum of 120 tons, if not more, this financial year. Because the more I am now talking to both the suppliers, in fact, I had running meetings since morning with the suppliers as well as the large buyers. They have all been saying that they are now very happy the way Customs has supported. The inbound is getting cleared in just 4 hours. The BDR gets created as soon as it touches the GIFT City SEZ, within 1 or 2 hours it's ready. We have now from 1st of May extended the T+0 trading hours by another 3 hours. So now we'll be trading from 9 a.m. till 9:30 p.m. We'll be
wow.
settling BDR right from starting from 9:30 a.m. till 9:30 p.m. every 30 minutes. And we are also made an arrangement to settle the funds 4 times in a day for the suppliers. So with all these steps taken, we are now seeing a surge of applications which are coming to IBX. We already have around 600 entities, QJ plus TRQ holders, which were with us by end of last financial year. And the 600 applications are in various stages of approval. So I think the signs are very positive for IBX, and we hope to show to the market and to everyone a great year ahead.
Mr. Gautam, as always, thank you so much for joining in and for suggesting those numbers ahead as well. Well, absolutely look positive. And as you said, the last financial year clearly has been very, very bullish for you, and we hope for more this financial year as well. But with that, it's all the time that we have on Halftime Report. But Business Lunch will take all the action. Stocks bounce back after yesterday's brutal late session sell-off, but come off the day's high. Realty, healthcare and autos lead the charge, while consumer durables and energy bring up the rear. Mid-cap index gains in line with the benchmarks. IndusInd Bank is expected to post a sizable net loss in the fourth quarter on the back of weak business momentum, tighter margins and elevated credit costs. But the bigger concern is over any fresh revelations. Dixon Technologies misses the revenue mark on stagnant mobile sales and weakness in the consumer electronics and home appliances businesses, but the company aims to more than double its top line in the next 2 to 3 years. Oil prices flare up on reports of a possible Israeli strike on Iran, the OPEC's third largest producer. Fears of Iran disrupting movement in the Strait of Hormuz and lingering uncertainty over the Russia-Ukraine war also add to the mix. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV18 Motilal Oswal studios. I am Hormus Vatakia. Well, it's a good day for the markets. At least the first half was a good one. We are off the highs of the day, but we are still holding on to some bits of gains on the Nifty. The index now below the mark of 24,800, where at one point of time
was trading above or nearing the mark of 24,900 at the highest point of the day. So it's almost a 200-point cut of the highs of the day for the benchmark index. The broader markets too are moving in tandem today after days of outperformance. They took a break yesterday. The mid-cap index is also recovering from the lows, 0.4% higher. The small-cap index too is trading right at the flat line as we speak. So that too is recovering from the lows of the day. So all of the indices are off the highs and now are looking to recover from the lows. Of course, we are counting down to some very, very important results, predominantly from IndusInd Bank, predominantly from Indigo, and also from 7 other PSU names that will be reporting results over the course of the day. IndusInd Bank currently at the lowest point of the day, Indigo too recovering from the day's low. We'll get to stock-specific action in just a bit, but there are, of course, a lot of stocks that are moving around in today's session, and Vinny is joining in to tell us just that. Vinny, good afternoon.
Hi, Urmas. While we were waiting for a lot of numbers that are expected to be reported today, but the numbers that have already been reported yesterday, we're seeing a move coming in on those stocks. Some of them are Dixon Tech. Now, the growth had continued for the company, mainly led by the mobile as well as EMS segment in Q4 FY25. They're expecting mobile segment revenue contribution to reduce in all 3 segments. So that is going to be a reduction. And in FY25, the revenue came in at 38,860 crores, which is a bit of a miss coming in versus the guidance of 40,000 crores. Do not forget that Dixon Tech has seen, such a run up that valuations are high. So obviously it merits that despite a good number, we're seeing the fall coming in, one miss in terms of guidance as well as valuations are high. Other than that, Dredging Corp, good set of numbers that's coming from the company, good growth in terms of revenue, 66.5%, margins, a sharp expansion on that front, and profit is what the company reported versus a loss last year. So overall, a good performance coming in from Dredging Corp in Q4. KPR Mills, now according to sources, what sources are telling CNBC TV18, that the promoter is looking to sell up to 3.2% stake via block deals. The floor price is expected to be at 1,107 rupees, which is a discount of almost 10% to yesterday's closing price. So keep an eye out on that. JK Tyre is the last one I'm keeping on my radar. Now, while the numbers weren't anything great, it was operationally a weak performance that came in. Profits were down by 43%. Margins were also seeing a contraction coming in. Revenue just up 2%. But what is interesting is that the raw material costs now for them, whether you look at fuel or in terms of rubber prices, they have seen a bit of a decline in the last couple of months, and that is what is expected to trend going forward as well, which will lead to better performance, better cost saving, and maybe some bit of a stable performance in terms of demand is something that is keeping JK Tyres up in trade today. So seems like a worst in terms of at least costing is behind them, and cost saving could be a measure for them that will lead to improvement in terms of EBITDA and margins for the company.
Oh yes, top gainer on the Nifty 500 today is JK Tyres. Came slightly off the highs, but now after the earnings call has surged back to the highest point of the day, 9% higher now on the stock for JK Tyre. Now, some of the other mid-cap pharma names too are doing very well for themselves. Kaplan Point is up 7.5% as we speak. Gland Pharma is an earnings reaction, of course, but these mid-cap pharma names doing well for themselves. And the other one that has sprung up is Solar Industries, and that is, of course, after the results that they reported yesterday. Management commentary as well coming in on the stronger side. The stock too has surged to the highs of the day is Solar Industries. But moving on then, India and the European Union are looking to fast-track negotiations to seal a free trade agreement. Abhimanyu is here with the details. Abhimanyu.
Well, India's negotiating team, led by the chief negotiator Satya Srinivas, is expected to travel to the European Union, to Brussels today to expedite the talks. The previous round had taken place last week in New Delhi, and government sources have indicated that the talks are progressing well, and both the sides are looking for an early harvest deal similar to the one India had signed with Australia. Now, several issues continue to be discussed which are on the anvil, around 23 areas, including goods and services, as well as investment protection, and several other areas like customs procedures, intellectual property rights, and technical barriers. Now, a case in point is the kind of demands which have been made by the European Union so far with respect to amendments in India's Patents Act to allow for evergreening of patents. Now, that is something which has been resisted by India and has also not been permitted in the FTAs which already have been signed with the United Kingdom and with the European Free Trade Association, which comprises of Switzerland. So it remains remains to be seen till what extent any accommodation of demands would take place from India's side, while India is also seeking increased access for its goods. And both the sides are also discussing an investment protection agreement as well as mutual recognition of geographical indicators. So it's not just a free trade agreement for goods and services merely, but a larger pact which is being looked at with the 27-member bloc. It remains to be seen how early there would be any conclusion which would be reached, even as both the sides are also engaged in talks with the United States, which is a big trading partner of both India and the EU.
Abhimanyu, thanks a lot for that update. Shifting focus onto the primary markets now. Will they or won't they? That's the question on everyone's mind as digital payments firm PhonePe eyes the Dalal Street debut. CNBC TV18 Shireen Bhan spoke to Sameer Nigam, the founder and CEO, and asked him why he thinks this was the right time to go public. Listen to what he had to say.
I think directionally too, I think the company's at a stage where I feel like the core payments business, consumer and merchant combined, is at a stage of maturity and market leadership where we should, hopefully from here, remain sort of very, very stable and hopefully quite profitable in years to come. Conditioned well enough to say without setting any targets or goals. I think it's the right time. I think the business is in a good place, the org is in a good place, the sector is in a good place.
And staying with the primary markets, then Sloss Bangalore, which owns the Leela Palaces hotels and resorts, will be hitting Dalal Street with its 3,500 crore IPO on the 26th of May. Now, Ankur Gupta, who is the managing partner and head of real estate for Asia Pacific and Middle East, discussed the IPO offerings and explained when the company will become profitable.
It has an amazing appeal internationally. It has been ranked as one of the best hotel brands in the world consistently for several years. And I would like to believe that the best years, through the effort that we've put into this business, are still ahead of the business. I would say, when we acquired the Leela platform, we realized that this brand has the potential to be what came from other countries and became a global phenomena. That does not mean that properties have to be in every country. The brand has to be globally recognized. Four Seasons came from the West, Mandarin came from the East. Both have become globally recognized brand. And that has been our motto to grow the Leela business.
We'll take a short break here on Business Lunch. When we return, we give you a whole host of global news updates. Stay tuned. Welcome back. Now, following the US reduction of tariffs on Chinese imports and vice versa, inflation worries and recession concerns seem to be simmering down among analysts. CNBC's Steve Leisman breaks down the key insights from the latest Fed Flash survey.
In the wake of the U.S.-China trade agreement, respondents to a CNBC Flash Fed survey have dialed back their inflation and recession concerns, but both remain elevated and policy uncertainty continues to be high. The 34 respondents, including fund managers, strategists, and economists, put the recession probability at 41%. That's down from 53% in April following the massive tariffs imposed by President Trump. But concern about a recession remains above the 36% from March, and it's nearly double where it was in January. Compared to March, the growth outlook is a touch better at 1%, but that's still pretty weak. The inflation forecast also high, but better than it was at 3.1%. Unemployment seen to be at 4.5% by the end of the year, up from 4.2% currently. Forecasters have low confidence in their numbers, more than 80% saying they were uncertain about the outlook for tariffs and their economic impact. John Donaldson from Haverford Trust writes in, the volatility of policy proposals, reversals, and restarts results in less confidence in all of my responses. In almost every case, there's a possibility of giving an entirely different answer in the next 24 hours. Forecasters also beginning to focus on the impact of fiscal policy. 70% said proposed deficits in the current budget bill in Congress were larger than previously expected. But a 36% plurality said the bill makes them more optimistic about the economic outlook, 39% saying it made no difference, and 26% are actually more pessimistic. A majority say the recent tariff reductions on China will have no influence on the Fed, 32% saying that it makes rate cuts less likely this year. The average forecaster now looking for a 3.9% funds rate by year and a bit more hawkish from where they were in May. And that's about 2 cuts built in part because the economic outlook has brightened just a bit. Steve Leisman, CNBC Business News.
Steve, thanks a lot for that. And Elon Musk now, in an interview with CNBC's David Farber, says that he wants just enough control of Tesla to not get outsed by activist investors at some point in the future. He also spoke about the growth of humanoid robots and the possible rollout of robotaxis in the coming months.
We have cars driving 24/7 with drivers in the cars, and we see essentially no interventions. So we want to be very careful with the first introduction of unsupervised full self-driving, meaning that the car's driving around with no one in it. We want to deliberately take it slow. I mean, we could start with 1,000 or 10,000 on day one, but I don't think that would be prudent. So we'll start with probably 10 for a week, then increase it to 20, 30, 40. And I think by, say, we'll probably be at 1,000 within a few months. And then we'll expand to other cities, so expand to San Francisco, California, Los Angeles.
That was Elon Musk, but just before we move on to other global updates, just pull up PFC. The numbers were flashing at the bottom of your screen, a 10% growth in its consolidated net profit, and the net interest income also going up by 41% on a year-on-year basis. We'll hear from the management shortly, and the focus will also be on its asset quality and on the road going ahead for FY26 as well. The stock has surged to the highest point of the day after its results, as more granular details of the results are still awaited. So that's PFC numbers just out a few minutes earlier. Moving on to now some geopolitical updates. The European Union's bloc foreign policy chief Kaja Kallas has said that the EU foreign ministers have agreed to lift sanctions on Syria. Take a look at this detailed report.
The European Union agreed on Tuesday to lift its economic sanctions on Syria. That comes 1 week after President Donald Trump announced the US would lift its own Syria sanctions. However, EU Foreign Policy Chief Kaja Kallas said the move was contingent on what she called progress.
There can be no peace without the path to economic recovery, and we all need a stable Syria. Is everything really ideal there? No, it is not. It's very clear, but I think we need to give the Syrian people a chance.
It's been 6 months since the collapse of Bashar al-Assad's rule over Syria. Its new rulers are trying to move quickly to revamp an economy shattered by more than a decade of civil war. the new leadership has prompted the EU and the US to rethink their Syria policies. After the EU announced its decision Tuesday, Syria's foreign minister said the move will boost his country's security and stability. Also in Tuesday's meeting, EU ministers discussed the situation in Gaza and relations with Israel. Pressure has grown on Netanyahu's government as it renews its offensive in Gaza. Callas said the EU will review its trade deal with Israel.
What comes to the association agreement and the discussion around that, I will not say numbers and I will not say member states, but I can say it was a huge majority for this. I think what it tells is that the countries see that the situation in Gaza is untenable.
There was no immediate comment from Israel on the EU decision. Israeli officials says its Gaza offensive targets Hamas for cross-border attacks on October 7, 2023.
Shifting focus now, Israel's Prime Minister Benjamin Netanyahu says he's seeking full control of Gaza after days of strikes which have killed hundreds. He also doubled down on allowing basic aid into the Strip after nearly 3 months of blockade. This comes as the UK suspended the free trade talks with Israel and announced sanctions over West Bank settlers. NBC's Matt Bradley with this report.
We heard from the United Nations and the Israelis that there were about a dozen aid trucks that went in. Our own teams on the ground in the Gaza Strip said there was no evidence that aid had actually entered the Gaza Strip. Those trucks are on the move, and the United Nations had said that they have permission for 100 aid trucks to enter the Gaza Strip. But as we heard from the UN's humanitarian chief, he said that this is just a drop in the ocean for the more than 2 million people in the Gaza Strip who now have been without aid from outside that enclave for nearly 3 months. So we're talking about a need that is very, very strong, and one that Benjamin Netanyahu, the Prime Minister of Israel, said he is trying to meet, but he said he's only going to be doing that because he's facing substantial pressure from his allies. A lot of folks here in Israel are angry that aid could be let into the Gaza Strip, and they are determined not to let it fall into the hands of Hamas, who they say, and they have consistently accused, of taking the aid to profit for themselves and to give to their own fighters. Now, Hamas has denied these claims, but the fact is that the situation in the Gaza Strip is getting worse militarily as well. We heard that Gideon's Chariots, and that is the Israeli term for this new offensive in the Gaza Strip, was launched over the weekend with massive bombardments up and down that enclave. That is going to make the situation for civilians there even worse.
We'll take a short break. Up next, India begins its diplomatic outreach post-Operation Sindoor with all-party delegations visiting countries to expose Pakistan's role in spreading terror. More on this up on the other side. Stay tuned.
You focus on the gemstone side of the story?
So I think it's really making our customer the true north. So when we introduced the good, better, best heirloom, no one else had done that before. So we pioneered in introducing different qualities, different sizes, different metals all together. And so no matter who the customer was, you could get exactly what you wanted, provided you like that design sensibility. And that's really helped us take off.
What we're seeing in the jewelry market worldwide today is this big takeoff as far as lab-grown diamonds are concerned. In fact, you believe that this is the Kodak moment for the diamond industry. Why do you say that?
The Federal Trade Commission in the US said a lab-grown diamond is a diamond. They're chemically, physically, optically identical.
Okay.
So all of a sudden, it legitimized the entire industry for everyone. And now, you fast forward 7 years, you can get a lab-grown diamond for 90 to 95% cheaper. It's going to be very difficult for natural diamonds.
Welcome back. Now, India's diplomatic outreach following Operation Sindoor will begin today with the first of the 7 all-party delegations departing for the UAE. Parikshit is joining in with more on this. Parikshit.
45 MPs across party lines, 6 former union ministers and 7 former ambassadors. This is going to be the composition of 7 all-party delegations leaving for over 30 nations to expose Pakistan's role in sponsoring terror attacks against India over the last 40 years. There is political consensus in India about the need for strong action against Pakistan for the Pahalgam attack on the 22nd of April, in which 26 civilians were killed mercilessly. The members of parliament from both the opposition and the ruling party will engage with foreign governments, civil society members, think tanks and the international press to make them aware about why India launched Operation Sindoor on the 6th of May. The all-party delegations will show that all political groups in India are united in asking the international community to not let Pakistan off the hook on terror. The politicians and diplomats will focus on the role of Lashkar Offshoot, the resistance front, which was responsible for the Pahalgam attacks. Sources say the all-party delegations will tell foreign leaders that India has already provided evidence about the role of the TRF and LET in Pahalgam attack to the UN Security Council. Not just Pahalgam, the 7 all-party delegations will emphasize that Pakistan has been involved in 26/11 Mumbai attacks, the attack on Pathankot Air Base and an army camp in Uri in 2016 and Pulwama attack in 2019. The aim is to show that India has been a continued victim of cross-border terror, and Pakistan government, the army and the ISI have only further nurtured terror groups and sheltered them. The MPs will also speak about India's stand on Kashmir and how there is no role for third-party intervention or mediation there. Also, how the only discussion between India and Pakistan can be about handing over Pakistan-occupied Kashmir territories. Indian delegations will also explain that the reason for suspending the Indus Waters Treaty is Pakistan's continued use of terror against India and also preventing India from utilizing its rights by refusing to take part in any negotiations to modify terms of the treaty. There have been geographical and demographic changes since 1960 when the treaty was signed, and Pakistan has refused to join in any negotiations to modify the treaty. The 7 delegations are led by Congress MP Shashi Tharoor, BJP's Vijayant Panda and Ravi Shankar Prasad, DMK's Kanimoi, Sanjay Jha of the JDU, Supriya Sule of the NCP Pawar faction. They would be travelling to Saudi Arabia, Qatar, Kuwait, US, UK, France, Brazil and Germany, among other nations.
Parikshit, thanks a lot for that. In fact, Parikshit also spoke to American Attorney John Bolton on the role of the US in these India-Pakistan tensions. Listen in.
Well, I wouldn't take it personally in the sense this is Donald Trump at work. This is what he does with friend and adversary alike. He likes to be the center of attention, and one way he can be the center of attention is that he announces that he was the center of the solution. It's not something I think most Americans experienced in national security affairs think is helpful, and indeed I think it can sow misunderstanding. But it wasn't particularly directed against India. He's done it, as I say, to friend and foe alike.
John Bolton also spoke to Parikshit on Donald Trump's comments regarding trade with Pakistan and whether India should trust the US president. Listen in.
Well, I think it shows he doesn't know much about the history here. And to him, the part of the problem with Trump is that trade is about all he thinks about, unless forced to think about other things. There's no doubt in any country's foreign affairs agenda, trade is important, but it's important for the economic well-being of the countries themselves. There's no way you can underestimate it.
With that, we call time on this edition of Business Lunch. From me and the team that put this show together, thank you so much for watching. We leave you with the Nifty at 24,800. Mid-cap radar on the other side.
Good afternoon and welcome to Midcap Radar live from the CNBC TV18 Motilal Oswal studio. I am Bamakshi Doria and with me is Vivek Iyer. Vivek, a very good afternoon to you. It's turning out to be a good afternoon for the markets. Of course, we did see the markets cool off from the intraday highs, but we've also managed to recover from the day's lowest point.
That's right. Good afternoon, Bamakshi. So the brief intraday dip that we saw got bought into, and that's good news as far as the bulls are concerned. The bank Nifty, in fact, was the one that was significantly underperforming, but that too has recovered from the day's lowest point. We have quite a lot lined up on the show. Let's start off with the top headlines. Market comes off highs but trades with some gains as caution prevails on Dalal Street. Mid-cap index also gains in line with key indices. Realty, pharma and healthcare lead the charge while consumer durables and energy bring up the rear.
Dredging Corp stocks witnesses strong run today following its fourth quarter results. Revenue climbed 66.5% on a year-on-year basis. EBITDA also rises significantly.
Solar Industries rallies over 3% on a strong set of earnings. The company's revenue surges 35% and EBITDA margin grows 215 basis points. The management tells CNBC TV18 that defense will contribute 40% to their total revenue in the next 3 years.
Dixon Tech under pressure despite reporting a good quarter. The company misses FY25 revenue guidance of 40,000 crores. Management tells CNBC TV18 that they expect 40 to 45% revenue growth in FY26.
Gabriel India rallies in trade on the back of a strong set in Q4. Revenue and net profit see healthy growth of over 30%, while margin also expands by over 100 basis points.
Well, 24,800 thereabouts is where the Nifty is at. It has managed to recover almost 100 points off the day's lowest point. It's a green-looking screen for now. The mid-cap end of the market is also holding up quite well. The mid-cap index is at 56,480, a nearly 300-point uptick out here as well, briefly outperforming the benchmark indices. The small-cap index, though, not doing as well as the mid-cap index. It is trading with minor gains of around 0.1%. As far as some sectoral indices are concerned, most of them are in the green. Look at Nifty Realty. It's being driven by Raymond, DLF, Phoenix. Nifty Pharma also has picked up. We had several earnings reaction as well as, some sort of positive momentum out here as well. But let's move on now to our special segment, Mid-Cap Movers. We now have Hormaz joining us to take us through the mid-caps that are moving around in trade. Good afternoon, Hormaz.
Good afternoon, Bamakshi. You just heard numbers from PFC and the stock has now surged to the highest point of the day, a 41% growth in its core income, asset quality also improving from the previous quarter. So good numbers from PFC. The stock surging to the highs of the day, now almost 3% higher there. But there are a lot of other earnings reactions also that we are tracking today. JK Tyre is one of them, and despite weak results, the management commentary has been strong on the road ahead and 10% higher on the stock, continuing to move from strength to strength. Dixon, any bounce that has been seen on the stock has been very swiftly sold into, and Dredging Corporation too at the highest point of the day, now 15% higher after its results. So defense stocks are seeing a bit of a recovery after that bout of profit booking that we saw earlier in the week. Bharat Dynamics, Data Patterns, of course, positive commentary, and Solar Industries too, positive commentary from the management, 5.5% higher on that stock as well. Midcap Pharma is one segment that has been buzzing since the morning. Biocon, of course, after the drug launch that they had in Japan. Kaplan Point is doing well for itself, as is GSK Pharma. Some of the other stocks that are doing well on the volumes front, here Tata Tele is one of them, 5% higher. Amber Enterprises off the highs of the day, still 3.5% higher, and Go Digit is trading with gains of around 6.5% on very strong volumes. And lastly, some of the other losers in the broader markets, and Newgen Software is one of them, was an outperformer earlier in the week, so seeing some profit booking here. Signature Global too, one of the few real estate stocks not doing well. Radico Khaitan as well, and KPR Mills recovering from the lows of the day, still down around 3.5%. Back to you guys.
Thank you so much, Hormaz, for joining us, giving us a sense of what exactly is transpiring today as far as the broader end of the markets are concerned. But it's a good time to welcome Rajesh Palvia from Axis Securities for a technical check on the market. Good afternoon, Rajesh. Thank you so much for joining us. Well, the brief dip that we saw intraday has actually got bought into. Yesterday, last hour, you did see some selling pressure. Have we decisively broken out of that particular negative selling pressure?
Good afternoon. So, looking at the volatility in market, we believe that stock-specific action is likely to be there in the market, but the benchmark indices are likely to remain in the range only. For Nifty, 24,600 is the important put-based concentration support area, and again in intraday dip also we have witnessed that again Nifty managed to defend those the put-based concentration support area. On the higher side, the major call concentration is placed at 24,900, 25,000 strike. So until the Nifty not crosses above 25,000 level, 24,900 decisively, I think we may remain in range only. And I think Nifty may consolidate furthermore. Breakout about 25,000 may attract short covering action, and then possible rally can extend further to 25, 200, 300 zone. But I think for some couple of days, it would be a range bound kind of activity for Nifty, 24,600 on the downside, 24,950 on the higher side. For Bank Nifty, it's trying to negotiate with its major call concentration area of 55,000 to 55,200. This is the range where major call writing activity has been witnessed in last couple of days. So until the Bank Nifty not process above 55,200, it may also remain in the range of 54,700 to 55,200. This could be the possible range for next couple of days, and either side breakout or breakdown will decide the major direction from here onward. But in this volatile market, some of the pockets like real estate, pharma, metal, defense, these are all pockets are showing good strength, and I think buying interest is clearly visible in this segment for intraday perspective.
Sure, thank you so much for that, Rajesh. This is Vamakshi joining in. So where would your buying interest lie as far as some stocks are concerned?
So I think real estate space is looking attractive, and DLF is clear outperforming stock from that segment. The stock managed to give breakout of falling channel on the weekly chart, and the way open interest has been added in last couple of days for the stock, we believe that DLF can extend its gain. The next target we are projecting towards 800 to 810. One can buy and accumulate this stock with stop loss of 758. Another stock is from the defense space, that is Bharat Electronics. Stock is clearly enjoying its new all-time high trajectory. The way stock managed to view breakout of its July 2024 swing high, I think here we could see further buying action to emerge, and then next target towards 410 would be there. So BL can be looked at for buying and accumulate in the range of 378 to 372 with stop loss of 365. And the third stock where we are focusing from the PSU banking basket, that is Union Bank. This stock is also looking very attractive. We believe that here also we could see next target towards 145 to 148. So one can deploy long trade here also with stop loss of 135.
Thank you so much, Rajesh, for joining us, giving us both your view on the markets as well as your top trading bets. Well, as we now slip into a short break, here's some good news for our viewers. India's business news leader is now just a click away. Introducing CNBC TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.
Families have been in the gems and jewelry business for centuries. In your case, centuries. In your case, how long?
Decades.
Decades, okay. And you didn't want to do anything with the jewelry business, but yet in 2005, both of you decided that it sparked the fire within. What happened there?
Aditi's always loved jewelry. I grew up watching my dad in wholesale gemstones, and I always thought it was a sleepy, antiquated business, so never really wanted to get in. Life, of course, comes full circle. So my first brush with jewelry was in college. Kind of crazy story. Ratan Tata came to speak to campus for us, and I introduced myself and I said, I'm such a big fan, but I just want to let you know that when I go from Delhi to Jaipur, I'm behind a Tata truck, and the exhaust is coming straight into our car, and I fall sick. And so if you can fix that, that would be great. And we had a couple of minutes of conversation. He said, give me your details. And so when he got back to India, he then wrote me a letter saying, next time you come to Bombay, I would love to meet you there, which is insane. So go to Bombay, and we had a 3-hour conversation, and he's like, why don't you visit Tanishq? Tell me what you think. And that was my first brush with jewelry retail.
Investing.
Welcome back. You're watching Midcap Radar on CNBC TV18. I'd just like to highlight a few stocks for you all. Some of these counters have hit an all-time high. This includes BEL, from the defense space. That stock has again roared back into action today. APL Apollo is the other counter that has also managed to touch its all-time high. CEAT is another counter that is also a buzz and trade and has also managed to touch its all-time high. As far as some capital market plays are concerned, they also seem to be gathering momentum in trade today. Look at the moves on Motilal Oswal. That stock is seeing a very strong uptick. As far as GM Financial is concerned, that also stock is trading higher, and so is Angel One. But let's also speak about some digital platforms. PhonePe is the one that is in focus. Will they or won't they? That's the question on everyone's mind as the digital payment firm PhonePe eyes the D-Street repute. CNBC TV18's Shireen Bhan spoke to Samir Nigam, the founder and CEO, and Rahul Chari, the Chief Technology Officer at PhonePe, on IPO plans. Listen in.
You on stage in August of 2024 said that I want to have the ability to look somebody in the eye and say that I have a clear path to profitability before I can say that I will IPO. Can you look me in the eye and tell me what's changed today? What gives you the confidence of wanting to go for an IPO today?
I'm not sure I said exactly that, but
paraphrasing, but broadly that.
I think the profitability part of it, we reported we shared our annual report for FY24 already, and we were adjusted PAT positive for the first time, so I'm very happy about that. I think directionally too, I think the company's at a stage where I feel like the core payments business, consumer and merchant combined, is at a stage of maturity and market leadership where we should, hopefully from here, remain sort of very, very stable and hopefully quite profitable in years to come. Conditioned well enough to say without setting any targets or goals. I think it's the right time. I think the business is in a good place, the org is in a good place, the sector is in a good place. Payments is still growing very rapidly. So if you're a market leader in a growth sector, I think it's a good time.
So Rahul, did the two of you sit and have a conversation about it makes sense to do it now? This is the right time, this is the moment, and we should go all in?
Oh yeah, we have a conversation about everything. I think we have more conversations with each other than our wives.
Well, you've known each other longer than you've known your wives, so it makes kind of makes sense.
That is true. No, we did have a conversation. I think like Samir mentioned, just given the current state of the org and the business, specifically on the core offering that is payments, given how exciting financial services and payments in India is, and the fact that we also have a few new businesses that we are diversifying into, we felt that this is the right time where the core business on the path to profitability, being able to actually nurture new businesses, is the right time to take PhonePe to the public markets. It is also a reflection of our maturity as a company from a compliance and governance perspective, that we are ready to actually take on this larger role. So yeah, we did have the discussion and felt that it's perfectly the right time to actually push forward.
I think we knew that we'd want to actually eventually list.
Because
a few years back, because we moved to India with that whole view.
Exactly. I mean, to pay a hefty bill of 8,000 crore rupees to reverse flip and move back to India, I would imagine had its roots in this eventual decision, right?
Of course.
I think directionally, if the right answer for a business like ours is to list, then this is the right market. I mean, I think we're very proud of the fact that we are a household name or brand in the country today. It doesn't make sense to list anywhere else. So I think the reverse flipping was a precursor towards an eventual listing someday.
But, I want to understand for the two of you, what's the motivation to list? I mean, we've had this conversation with several founders. Some have decided to go the IPO route and some have decided not to go the IPO route.
Sure.
Another one of your peers next door, Zerodha, choosing not to go down the IPO route, even though that is a very real possibility for them. What is the motivation to IPO, besides, of course, providing exits to whoever would want an exit?
So I think that last part is a big motivation for companies like ours that actually have outside investors. So Zerodha is a good example where
they have
wildly profitable and the family owns the entire company. So I think they can get the liquidity that they desire through dividends, but more importantly, they can keep investing in the future of that company also through their bottom line. We took a path which is, well, the sort of tried and tested path of getting outside in capital.
Yeah.
And it's also a very fiercely competitive market when you're actually trying to build on microtransactions at population scale. So we needed that capital. We didn't have it. So I think in this case, you have to have a steady liquidity environment, not just for us, employees, shareholders, current and future. I think that's one part of it. We're blessed. We don't have a rush on that front. We have the money to invest in all the businesses that we need to. We have really good investors, both. I think for us, it's more the nature of our business. We're just so heavily regulated across all the financial regulators now.
Yes.
Wanting to operate not just in payments but in other sectors also at population scale. I think the governance the stamp that comes with public governance standards is a higher order stamp than being privately governed.
Well, that was a very interesting conversation our managing editor Shireen Ban had with the founders of PhonePe. All eyes now on the likely listing of that particular company. But we'll now slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned.
CNBC as well.
Welcome back to Mid-Cap Radar. Well, a couple of stocks on the radar. First up, you just saw the numbers of Power Finance Corp flash on your screen. That particular stock is holding quite well. The stock is up almost 2.5% in the session. You'll hear from the management soon in another 10 minutes or so as to what exactly transpired in the quarter gone by. More importantly, what will be the AUM guidance as far as the coming years are concerned. The other stock, a couple of stocks actually that have hit fresh intraday lows are two stocks from the Aditya Birla Group. Have a look at Grasim Industries as well as Ultratech Cement. Both of these stocks now trading near the day's lowest point. All eyes will also be on one stock from the banking pack, and that is IndusInd Bank. Remember, IndusInd Bank will deliver and report its results later today, and lot of news flow has come about in this particular counter, and IndusInd Bank now near the day's lowest point, and all eyes will be number one on what are the kind of provisions that they've taken in Q4 and what is the way forward as far as IndusInd is concerned. But moving on, one stock from the broader end of the market that's doing very well is Solar Industries. Riya joins in with details on the Q4 earnings, the takeaways from the management call as well as brokerage notes.
Well, yes, Solar Industries reported its Q4 and FY25 numbers yesterday. For the full year FY25, we've seen a revenue growth rate of around 24%, which is below the company's guidance of around a 30% revenue growth rate. On the margin front, that has been above the guidance of 25%. Margins have come in at around 27% in FY25, up around 365 basis points over the previous year. The international business grew by around 18% over the previous year, and the FY25 defense segment revenue was up around 162% compared to FY24, but still missed the company's guidance of 1400 to 1500 crores of revenue, coming in at just about 1355 crores. The order book for FY25 stands at about 17,000 crores, of which defense constitutes almost 90% to the total order book. Now, coming to the guidance for FY26, the company has said that they are going to grow their revenues at around 33% over the previous year. Defense will constitute more than 30% of the total revenues compared to the 18% contribution in the current year. Capex will be around 2,500 crores for FY26. Today, in an interaction, the company also told us that they are expecting emergency procurement order finalization to happen in the next couple of months, and they're expecting substantial order inflows on this front. For the Pinaka order, execution will start by around Q2 of FY26 or latest by October onwards, and they're expecting around 550 to 600 crores of revenue on an annualized basis from the current two variants of the Pinaka orders that they've received. As more variants come up, they are going to see a revenue of around 900 to 1,000 crores from these Pinaka orders over the next couple of years. They've also highlighted that defense is going to contribute around 40% of revenues over the next 3 years. Now, on the back of this, Antique has also upgraded the stock to a buy rating. They have a target price of around rupees 15,570 on the stock, which is an upside of around 15%. And reacting to all of this, the stock has been trading higher in today's session.
Well, thank you so much for that, Riya. That was Solar Industries for you. A good set of numbers. The stock is trading higher by almost 5%. But another counter, Dredging Corp is firing up in trade today. As of now, the stock is trading with a gain of almost 15% after its Q4 numbers. Vivek, how are the numbers for this company?
Well, it's clearly not trudging, it's dredging in today's trading session. Have a look at the Q4 results. The Q4 results optically very strong, but you have to remember that it comes off a much lower or a muted base when it comes to Q4 of FY24. Well, revenues for Q4 higher by 66.5%. The EBITDA has gone up fourfold as far as Q4 is concerned. Multiple one-offs and also of a lower base. Margins have gone up more than 1,000 basis points. Profitability this time around of a little over 20 crore versus a loss seen last time around. But it's also a good idea to have a look at the numbers on a sequential basis. There too, there is significant operational improvement that we are seeing. Revenues higher by a little over 40%, EBITDA higher by over 45%, margins again expanding over 40 basis points, and profitability up 33%. However, one thing that you need to recall is FY25, the company still not managed to turn in a profit. So Q4 operationally very strong, a clear, the company finished FY25 on a strong note, but there's a loss on the bottom line as far as FY25 is concerned. Company has very strong long-term targets as far as FY27 profitability is concerned. But on the back of the sharp improvement in the quarter gone by, you're seeing a 15% uptick on strong volumes today.
Well, absolutely, Vivek, so hoping for a good recovery for dredging crop in FY26 as well. But apart from that, if you can pull up the chart for JK Tyres, of course, it was not a great set of numbers coming in from the company, but, largely with the crude prices now falling, the internals look very attractive for companies like these, especially going into Q1 and Q2. We saw similar moves despite a weak set of numbers. Apollo as well as MRF, both after the numbers perked up in trade. But with that, that's all we have on this edition of Midcap Radar. From Vivek, me and everyone who put the show together, thanks for tuning in. Don't go anywhere. We will have your stocks when we return.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in as always. A quick look at what the market is doing. While today we've seen sharp moves coming in, where 24,700 approximately around there, the Nifty open went to 24,900, about that mark, but again it's come down, and as of now again trading around the 24,776 levels. So that's something to watch out for, whether it's going to go furthermore up in terms of a recovery, or maybe we'll see a fall coming in. That's something that we're watching out for. Mid and small cap continue to perform in tandem with the benchmark indices today as well. But let's move on, and PFC, that's the stock in focus as well. They reported their Q4 numbers a short while ago. The company saw best loan growth in 39 quarters, and asset under management also grew by 12.8% on a year-on-year basis. My colleague Rachna actually spoke to Parminder Chopra, chairman and managing Managing Director of Power Finance Corporation, and began by asking about the levers of growth in Q4 FY25 for the company. Listen in.
We have, I think we have a good loan book growth that leads to this profit, along with the KSK Mahanadi interest income, which we have received that under NCLT. It was more than the admitted claim that has led to this highest ever profit.
Right. Ma'am, if we were to speak about the interest rate environment that we're in, we're seeing a decline in interest rates. The environment is such that where do you see asset yields going forward to?
I think for any of the financial institution, it's more important to focus on the spread rather than on yield, because yield is a factor of the cost of borrowing also. So we expect that our spreads are going to remain in the same range in the guidance which we have earlier given at 2.5%. And that is going to have, I think, neutral impact on our profitability going forward on the existing assets.
Right. Speaking of going forward, your loan book also saw quite a significant growth this quarter. Which are the sectors that you're seeing most amount of growth from, and where do you think the next phase of growth will come from?
As you know that there are a lot is going on the distribution front and the renewable. And these are the two segments from where we are driving our growth also. 55% of our disbursement happens in the distribution sector, and around 17% has happened in the renewable. So this constitutes the major part of disbursements, and accordingly our loan book, even for the renewable, we have had now the highest ever disbursements of 30,000 crore in a year, and the loan book stands at around 80,000 crore as on 31st of March 2025.
Right. Like you said, the renewable loan growth saw a remarkable milestone at about 80,000 crore, showing a 35% YOY growth. So is clean energy financing becoming a very strategic focus now? Is that the key focus for you going forward?
There are few factors that definitely, one, that the clean energy is the focus area. When we talk of the renewable, when we talk of the intermittent nature of the renewable sector, and adding the storage and whether it's pump storage or the battery storage. So these are going to remain on the focus area, apart from the government push for the green hydrogen, if you see. And the government is also focusing under the Vikasit Bharat mission for the nuclear power energy and adding 100 gigawatt of the energy as the nuclear power. So that definitely is going to remain there. But apart from that, the DISCOMs act as the backbone of any of the power system. So the government's strategic focus on reforming the DISCOM is again one of the highlights of the policy measures. And we also think that our growth is going to come from these two areas.
Right. You spoke of the KSK Mahanadi case, which brought about this substantial reduction in your NPAs. When we talk about going forward from here, where do you see the NPAs would go forward? Also, if you could take us to the successful resolution of KSK Mahanadi.
I think it's already in the news a lot that KSK Mahanadi, all the lenders have got more than the claim admitted. For PFC, our exposure has been to the tune of 3,300 crore. And apart from getting the 100% principal, we have also got approximately 1,200 crore for the interest. So we have already provisioned around 55% against the principal amount, which this quarter Q4 has seen the reversals for the KSK Mahanadi. So that is the one part, and as a result, our net NPA ratio has drastically reduced from 0.85 to 0.39%. During this current year, we have also resolved the Lenco Amarkantak, in which also we have had the reversal of provisioning, and I think we have been taking the what you can say that we have been doing enough provisioning wherever to mitigate our risk, wherever there is assets have been NPA in our books.
Right. There's also a growing discussion within the government and outside, even in the industry, about thermal as the next phase of growth. Do you see an uptick coming in the next quarter, in the next year, in the disbursements towards thermal?
Yeah, I was talking earlier. So one was the clean energy, the other was the energy security. When we talk of the energy security to provide the affordable and regular power 24/7, I think that's the focus of the government. And accordingly, the government is looking for almost doubling its capacity. So we can't rule out the role of thermal power project, renewable having the intermittent nature. So the government has planned for around 80 gigawatt of additional thermal capacity by 2030. This will be coupled with the nuclear power energy, which NTPC has announced around 10 gigawatt of adding to the nuclear power. So I think these are going to be the focus area for energy security point of view.
Right. Speaking of a regulatory overhang from here on, there's a lot of market anticipation towards RBI's upcoming ECL norms. What is your expectation, or what do you think could be the potential implications of it?
See, NBFCs have been following ECL. I think now we have stabilized our processes, but definitely we are open to the regulatory guidelines if how they are perceiving that to be implemented, especially by the banks, because the banks are still following the IGAAP norms as far as the provisioning is concerned, and hence the RBI prudential norms, they are doing their provisioning. So it could be a big change for the banks going forward, but NBFCs, especially the bigger NBFCs, have matured on following the ECL norms. But let's see that how these regulatory guidelines come up.
So no major changes expected.
We are, if you talk of our non-performing asset, we are already 80% provision has been created through the ECL model. So we don't see any major hits on that, but we are still like to watch out for the RBI detailed guidelines.
Okay, that was the management of PFC. As of now, the stock is managing to hold on to 2% gains. But on that note, we're going to step into a very short break, and here's some good news coming in for our viewers. India's business news leader is now a click away. Introducing CNBC TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC TV18 app now from the Apple Store or the Google Play Store, or you can just scan the QR code on your screen. Welcome back, and you've tuned into your stocks on CNBC TV18. Now let's get started with all your stock-related queries for today. And we have with us Asta Jain of M Securities, as well as Somil Mehta of Mirae Asset Sharekhan to answer all your stock-related doubts. Asta, as well as Somil, very good afternoon, and thank you so much, as always, for joining in with us. I'm going to get started with the queries for today. We have the first query coming in from Kamini Jain, who's writing to us from Pune. She's holding 200 shares of Piramal Pharma. This is at a price of 100 rupees per share. So she's She's made a good profit on this, wants to know the future prospects of her investment for Piramal Pharma. Asta, coming to you. Piramal Pharma, they reported their numbers as well. Steady quarter that came in from the company. Margin recovery was seen on a quarter-on-quarter basis specifically. Overall, what's your view for Piramal Pharma, given it does have that CDMO side as well, right?
Right. Hi, good afternoon to all of you. See, talking about this counter, yes, the results were good. And in fact, for the first time, they have clocked the revenue of $1 billion. In fact, what we have seen that management is very, very much optimistic for the FY 2030. I mean, they are giving the guidance to those levels where they are aspiring to achieve much higher revenues from here. In fact, what we have seen is multiple rise in their EBITDA as well. Talking about their CDMO business, I think that yes, CDMO business is doing good to them, and in fact, their net debt to EBITDA ratio has also shown good improvement. So overall, I find this pharmaceutical company to be a good investment to be remain in, and hence we are recommending hold on this counter. Price target which we are setting for this counter is 225 to 230, and these are very small and a short-term price targets. But in the longer or a medium term, we are giving the price target of around 250 to 260 onwards.
Okay, 250, 260 in the medium to long term is what one could watch out for here. Piramal Pharma on the chart, Somil, afternoon, and given that this has seen a correction, everyone is talking about how maybe this could be one of those players or CDMO side working out for them. Do you think it's a good bet right now and continue to hold this, or maybe look to add some more or book out profits?
I think at this point of time, the short-term bias remains negative. This stock very recently has taken resistance at 200 daily exponential moving average, also trading below 20 and 40 daily moving average. So I'm a little negative on the stock. I will be expecting this stock to go down till 180, 185 levels where there is multiple support zone. That will be a very good zone to buy this stock, not right now. In the medium term outlook, however, if you have the appetite to hold the stock, probably it will be a very good bet, and it may go up till 150, 160 levels. But at this point of time, in the very short term, 180 would be the level to watch out for, and that will be the level to buy.
Okay. Keep an eye out on those levels over there for Piramal Pharma. Let's move on to the next query for today. Ramesh Kapoor is writing to us from New Delhi. He's holding 100 shares of Titagarh Rail Systems. This at a price of 1,000 rupees per share. He's asking if they should continue to stay invested in this one. Asta, your view coming in for Titagarh Rail? And some of these railway stocks do have very high valuations also. Right? Last 2 days, we've seen that bit of a correction coming in, but the run-up has been so high. So what's your view?
So now this is into the manufacturing of railway wagons, and it is holding 30% market share. So the kind of market share this company is holding and the kind of business they are into, definitely it commands a higher valuation, and that is what we are seeing in the prices also. However, we are still positive on this counter, and we are recommending a hold on this counter with a price target of around 1100 on the back of the strong orders that they are getting and on the back of the kind of industry tailwind which we are witnessing right now. So a hold is recommended from our side for this counter. Medium term target is 1100.
Okay, keep an eye out on those levels over there. Hold is the recommendation coming in on the fundamentals. On the technicals, Somil, your view for Titagarh Rail?
I totally agree with Asta. Positive on the stock in the short term, in the medium term outlook as well. High top, high bottom formation on the daily charts. The higher degree momentum indicators are on the buy side, so I'll be looking for a good target on the upside. On the upside, in the medium to long term outlook, 1370 would be my target. In the very short term, maybe around 1050 would be the target. And crucial supports around 800, 815. Those levels would be very crucial on the downside. If it breaks on the downside below 815, 800 levels, then probably sharp sell-offs. But at the moment, positive.
Okay, at the moment, positive. Let's move on to the next query. Asian Paints. This is a stock that we have a query on. It's coming in from PC Achaya, who's writing to us from Bangalore. He's holding 60 shares of Asian Paints at a price of 2,900 rupees per share. Making a loss on this one as of now. Wants to know the outlook on the stock going forward. Asian Paints, Asta, what's your view coming in? It's been very, very subdued in terms of a trading move, earnings-wise as well, in the last year or so, maybe we could say. So what's your view now for Asian Paints?
So I think the entry of the new players are really, spooking the streets regarding this counter. And what we have seen is that a steep cut in the stock prices. Now, what we are seeing right now, yes, they have launched a certain new products. In fact, they are revamping their whole strategy with the new packaging, etc. But still, we feel that the margin will remain a concern, and hence we are not very much optimistic on this counter as of now. But still, I would recommend a hold because I think that this counter has a potential to move till the levels of 2500, 90, 2600. So those are the levels where one can, take a call again. So right now, my recommendation here is to hold this counter with a price target of 2550 to 2590.
Okay, keep an eye out on those levels over there. But on the technical front, your view coming in for Asian Paints, Somil. Last 1 year, not done anything, right? Instead, it's a decline of 19%. So now, should the viewer continue to hold the stock or maybe just book out their losses?
I think the correction which we've seen in the last few years actually has been sharp from the highs of 3,600 to the lows of 2,100. I think almost 40% retracement is already done in the on the long-term charts, on the monthly charts or the weekly charts. 2100, 2200 would be a very good buying zone. That's what I think, and it'll be a support zone as well, very crucial support zone. I'll be expecting a good retracement till the buying levels of 2900. That's where the target would be for a medium-term outlook. But I'm not expecting too much from the stock. Just a bounce till 28, 2900 levels. Nothing for a very long term for an investor, and that's where you can probably exit.
Okay, keep an eye on those levels over there for Asian Paints. Let's move on to the next query. This is from SP Rao, who's writing to us from Hyderabad. It's an investment query. Wants to know if it's the right time to invest in Inox India. Asta, I've actually seen this name pop up almost every second day. Inox India, what's the view? And, a lot of viewers are asking about this.
So view is quite positive. In fact, we have recommended this counter a few days back to our clients as well. And we are giving the price target of around 1350. So yes, we are optimistic. It is one of the leading manufacturer of cryogenic equipment. It is getting very, very strong orders. And I think the kind of market share they are having, definitely it is signaling towards more upside and strong financial performance from here. So yes, this counter is on our radar. And in fact, we are giving a buy recommendation on this counter. So same, I am repeating here, buy as well as hold. Both are the strategies which one can apply to this counter with a price target of 1350 at the initial levels.
Okay. And Inox India on the charts and technicals, is it an attractive time to enter this one as well, Somil?
Definitely a good time to buy the stock for a medium-term outlook, not in the short term. Short term, we may see a sideways movement, but if you see it has been holding on to all the averages, trading above 200 daily exponential moving average, a high top, high bottom formation. I think the next target for the stock would be 1250, and above that 1330 would be the targets. If you see Inox Green, Inox Wind, all of them are doing great. So I think Inox India itself would do great in the medium term outlook.
Okay, keeping an eye out on that. Let's move on to the next one, and this is coming in on a fairly recently listed company, that is Sagility. Now, Rajan Iyer is writing to us from Mumbai. He's holding 10,000 shares of Sagility. This is at a price of 37 rupees per share. He says that he can hold this to a time period of almost 3 years. Wants to know the outlook for Sagility. Asta, have you reviewed this one? What's your view coming in for Sagility?
Yes, because we are really, tracking all the IPOs. So we have given a subscribe rating to this IPO as well when it has came. And now we are still optimistic on this counter. First of all, would like to recommend the price target, which is somewhere around 48 to 50 zone. And now this counter, the fundamental seems to be very strong. Why? Because what we have seen in the financial performance, all the main line of items in the financial statement, that is top line, bottom line, operating profit, all have grown with a growth rate of more than 20-30%. Apart from that, they have recently acquired Broadpath, and that will really help the company in showing very strong performance going ahead. So, and they are getting good traction despite the fact that we are seeing that because their main business is towards the US healthcare industry, and despite such economic uncertainties, they have able to show such kind of strong growth. So definitely it is a very strong counter to remain invested in, recommending it as a whole as well as buy with a price target of 48 to 50 at the initial levels.
Okay. Saumil, your view, do you have anything? I know there's not much in terms of a chart, but is there anything that you've looked here?
Not much data here, but it has broken out of a small triangle pattern on the upside. So in the short term, definitely positive. In the medium term outlook, also positive. I'll give you a stop loss, very strict stop loss at 37, and I'll be expecting new highs for this stock. So the view is positive.
Okay, view is positive, but maintain that stop loss that Saumil has mentioned as well, 37. So keep an eye out on that. Let's move on to the next query for today. This is coming in from Varghese Oman, who's writing to us from Kerala. Holding 300 shares of Nalco, it's at a price of 150 rupees per share. Currently, the stock is at 181. He wants to know if it's the right time to buy more shares of Nalco. Asta, your view?
So I think the results are they are set to announce today. The company is set to announce its result today itself. So it's better to wait for the results. Meanwhile, what we think that this time, what we can see in the quarterly result, there can be a 7 or 8% rise in the revenue, but we feel that the profitability will be, will not be that good from the profitability point of view. And this is, I'm talking about the Q4 figures, because what we have seen that the contribution from the alumina segment will be lower on the back of the lower prices. But overall, I believe that if results come on the expected lines or ahead of that, then definitely this counter has a potential to move above 200 level. So right now, just remain invested in. Initial price target which we are giving to this counter is 200. However, this is subject to change post the result analysis.
Okay. And Nalco, your view on the technicals as well. What is it, Saumil?
I think we should wait for a close above the 200 daily exponential moving average. It's been taking resistance at this average for a little while now. So any close above 193 would be a great time to buy the stock. Metals are anyways doing great. So 193 would be a good entry point, and the targets in the medium term outlook would be 220 levels.
Okay, keep an eye out on those levels for Nalco. Let's move on, talk about Tata Motors. Prashant Kumar is writing to us from Bangalore. He's holding 85 shares of Tata Motors. Price is 955 rupees per share. So currently the stock is trading much below his buy price. Wants to know if it's a good time to actually average at current levels. Tata Motors, we had the numbers also come in, Asta, a while ago. So what are you watching out for now from Tata Motors?
So I think that averaging is recommended, but not at the current level. Maybe some more dip can come, and why we are expecting some sort of dips to arrive in this counter, because what we believe that still there are uncertainties, and in fact, in their JLR business we have seen that the shipments were not there. So I think the Q1 of FY26 there will be hit on the volume front, and if that is the case, then definitely the numbers will be muted. So on that basis, I believe that this stock can move more downside from here, and there the averaging can be done, not at the present level. However, we are keeping the price target of 800 in the medium to long term. So yes, one can average this counter, but I think at the lower prices.
Okay, that's a coming in on Tata Motors. But on that note, we are absolutely out of time on today's edition of Your Stock. So thank you so much, Saumil, as well as Asta, for joining in with us and helping our viewers solve all their stock-related queries. And viewers, thank you so much for sending us your queries. We'll wind down this edition of Your Stocks. Thank you so much for tuning in. Up next, your closing bell.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC TV18 Motilal Oswal studio.
Asian markets seem to have largely opened up on the positive front. So when you're looking at ASX 200, Hang Seng, Shanghai, Taiwan Index, all of them are managing to hold on to gains of more than 0.5% in today's trading session.
Not yet worried because of a couple of factors, and I believe that maybe at some point of time today, we see a bounce from the lows of the day. Good green, 70 points higher. Coal India is up close to 100%. BEL as well as returned to its winning ways, that's up close to 100%.
So while there is volatility expected in the near term, based on certain headlines that come, certain numbers that come of the previous quarter. Actually, fundamentally, India is actually positioned very well for this year.
Yeah, one of the reasons our revenues are flat on quarter basis is basically the mobile revenues were kind of flat.
I think that the volatility in the alumina prices is here to stay because of what happens in Guinea.
24,900 is what the Nifty is holding on to as of now.
We realize that this brand has the potential to be what came from other countries and became a global phenomena.
The brief intraday dip that we saw got bought into, and that's good news as far as the bulls are concerned. The bank Nifty, in fact, was the one that was significantly underperforming, but that too has recovered from the day's lowest point. That was the day so far. Hello and welcome to Closing Bell. We are coming to you live from the CNBC TV18 Motilal Oswal studio. I'm Nigel and with me is Dreema. Well, Dreema, you know, earlier this morning there was that fear that the bounce will get sold into. That actually happened in the first 10-15 minutes or so. But I'll tell you what, a couple of technical indicators suggested that maybe we're getting into a bit of an oversold zone. I'm talking about the PCR that went down to 0.65 earlier today, and that's bounced back to around 0.8. So some green on the screen. Not very convincing, but I think the bulls will take it.
It's been holding with a positive bias, right? So the benchmark indices are up close to about 0.5%. The Nifty is above 24,800. The Sensex has gained close to about 400 points. 81,600 is the print on the Sensex. But the morning was choppy, as you can see. We started flat. We raced to about 24,950 from there. That recovery was sold into, and since then, from about 12 o'clock to about 2:30, markets have been holding steady with a gain of about 0.5%. Lots of individual stocks and sectors doing well. So top of the list today in terms of sectoral gainers is defense. The Nifty Defense Index is up 3%. Realty is having a good day. Pharma is strong across the board. The Nifty Pharma Index is up over 1%, but Cipla is higher. Sun Pharma ahead of numbers tomorrow is gaining. Apollo Hospitals is seeing buying. And then PSU banks. A lot of them are to do with the defensive names, but the Nifty CPSE Index also has a gain of close to about 1%, with BEL being the star stock, not just for the day, not just for the week, but for the month. BEL up 4.5% now, and its month-to-date tally stands at 22%. Fresh record highs coming through on BEL. We'll talk more about many of these stocks, but we've got an expert waiting by.
Well, that's right. And I'll tell you what, in terms of numbers that we're going to be looking forward to, it'll have to be IndusInd Bank, because not just the numbers, the commentary as well as something that we're looking forward to. And that's why the stock is going into its numbers extremely nervous. So let's see what happens on that.
Last time, Abhishek was telling us it came at 340, just towards the close of market. So let's see this time.
Okay, all right. Well, let's get in Shrikant Chavan from Kotak Securities, who joins us to help us out with the closing strategies. Hi, Shrikant. Good afternoon. Good to see you win. Not such a bad day, right, Shrikant? 130 points up for the Nifty. Yesterday, the way we ended, gave you a bit of a jitter. But today, the Nifty is higher. The Nifty Bank is holding above the 20-day MA. It's pretty okay looking screen. But what would your trade be?
Yeah, absolutely. Like the way yesterday it closed and today when it opened up with a gap, there was like a very clearly we can say that the market has started, we can say the consolidation sort of phase. And prior to that, we saw a spectacular rally on last Thursday. So maybe we can say that it's a time-based correction that is happening. And today, after hitting the levels of 24,950, which was very close to 25,000, we again saw a sell-off in the market. So the crucial part is that the market is consolidating. And today we need to see that where the markets are closing, whether it is closing at the highest point of the day or at the lowest point of the day. But in case, because of any reason, if we see the market is closing below the level of, let's say, 24,700, then in that case, some more worries will come in the market, because then we may see the markets falling to the next important levels of 24,500 or maybe 450, where the market is having next leg of support. But broadly, I am of the view that the market is consolidating, and today's closing is extremely important for us to know.
Okay, today's closing is important. What about stocks? Would you have any trading recommendations for the last hour?
Yeah, see, the best part is that when there was recovery in the market, we saw specific buying interest in those sectors where there was interest when the market was going up from the lower levels of 24,000, 23,000. So today also, when we saw buying interest, we saw buying interest in large cap banks, defense, as well as capital market related stocks, including metals. So I think all these sectors are definitely going to give some more upside. That's my view. We need to be more selective, and specifically, if we have to go through with few stocks, then in that we like Hindalco, which is around 664, 665. There I'm expecting a stock to move towards 700 plus in the near term. We also like Tata Motors, which is around some 720, 25. After a very long time, the stock has broken its all important averages. So the next level to watch out for would be 825, 850. And the other stock from the defense, which we like, is Bharat Dynamics. Here the stock has crossed its previous all-time high. It is sustaining comfortably above the mark of 1800. The next level to watch out for would be 2200 based on technical. So I think, yes, we need to focus on this particular major spaces.
Okay, all right. Thanks a lot for that, Shrikant. But let's focus on the result reaction actually of the day. And that tells you that, ye dil mange mo with regard to Dixon. The numbers were good. The commentary was fairly okay as well. But the valuations are very, very expensive. And also besides that, a couple of brokerages are saying there's a bit of a slowdown in the telecom space. Maybe in fact the competition is going to ramp up as well here in India. Upasana joins us to help us out with what went wrong on Dixon. Well, Upasana, stock is now down close to around 6%.
Certainly. Now, if we talk about the Q4 numbers, the Q4 was mainly driven by company's mobile and EMS segment, and company has made a few changes in terms of its revenue mix. Now, except EMS and mobile segment, revenue contribution has decreased in companies all the three segments. And now if we talk about the FY25 revenue number, it stands at 38,860, which missed the guidance of 40,000 crore that the company was guiding for FY25. Now, largely coming to the numbers, margins were a beat, but revenue and PAT was largely in line. Now, when we talk about the volumes in the mobile segment, on sequential basis, they were also quite flat, which is why we are seeing a bit of a stress out there. Now, in terms of brokerage view, Nomura has given a buy rating on the stock with a target price of 21,202 per share. It says that the mobile ramp-up is on track across its domestic and export book, and rising value addition is likely to drive margins further going forward. CLSA has given a high conviction outperform rating on the stock with the target price 19,000 per share. It says that on the back of strong top-line growth and better margins, it expects a 45% CAGR over FY25 to FY28. Now, management joined us today morning post its results to give us an outlook for FY26. It expects a 40 to 45% revenue growth in FY26 with a 20 to 25% margin expansion. It has also guided that the revenue can more than double in the next 2 to 3 years, is what the company is eyeing on. And company anticipates that the export contribution, which is currently 5% of its sales, to continue increasing forward as the quarter passes. Now, company has also highlighted that it is in the advanced stages in closing partnership for camera modules, which is in talks since a while. And lastly, company has also highlighted that the margin expansion of 90 to 100 bips, which the brokerages are also estimating, is doable in the next 2 years. So commentary remains quite positive, and numbers are largely in line. So let's see what happens ahead for Dixon.
Okay, all right. Thanks a lot for that, Upasana. Well, Prakash Diwan joins us on the show. Hi, Prakash. Good afternoon. Good to see you in. What do you make of the numbers, Prakash, and the way ahead? The problem is that, the street is saying that the operating environment itself could get tighter once the PLI expires. Then you'll have high amount of competition that will come in there. Valuations are not very, very cheap. And in select parts, this China plus one theme seems to be gradually getting factored in, at least going by the valuations. Would you buy the stock? It's already down 6%.
Good afternoon, Nigel. So, I think the key is that fading away of the PLI impact. Whatever favorable moves that you saw in terms of its operations, they probably don't seem to be, as juicy anymore. Of course, PLI also brought in the fact that some of the margins had to be passed on to the customers. But what urgently the company would need to do, and I'm sure they are aware of that, is diversify or not depend too much on just a few segments. They've grown on the back of a couple of these, product lines, and that's kind of helped them scale up. But once you reach this kind of a massive scale, it's very difficult to be growing incrementally using the same work, right? So that's where the key is. If they get some breakthrough in that, the stock will again kind of get into a bit of a momentum. But market needs an excuse to book profits on high valuations, and this was as good as any. So I would wait for it to consolidate. There could probably be another time correction for Dixon. This is something similar to a lot of the great players of yesteryears, not in the same segment, but look at Astral Poly, went through this whole Rara days, went into a segment which didn't really pay off very well, and it had to consolidate. So it's similar. So market leaders go through this kind of evolution, and my sense is you'll have to give them time to do that. But the management sounded confident of doubling revenues, and even on this scale. So that's very encouraging. So the slightest sign of improvement in terms of your product mix, there you have an opportunity to buy, but not at this point in time.
Got that. Now is not the opportunity to buy, but let's talk about JK Tyres. Big surge in the stock, 14% up. Q4 numbers are out. Sudarshan now joins in, 11% now up. Sudarshan, is it the numbers? Is it the commentary? What is it?
So for tire industry, one problem is that Q4 numbers are looking a bit dated because of the reason that internals in the last 2 months have improved significantly. So I'll give you two or three reasons. First, take a look at the crude price. In Q4 FY25, Brent crude average was somewhere around $70 per barrel. Now in Q1, it's down to around $62, $63 per barrel. Even rubber prices have seen a decline further. Now, company is saying that if you compare Q4 from Q3 of FY25, raw material costs were largely stable, but company had not taken any price increase. Now in Q1, in the last 2 months, raw material costs have fallen further, which is going to aid margin in Q1 of FY25. And all the other tire companies had said that in Q1, there will be a slight decline in the raw material cost. Real decline will be seen in Q2. So there is a probability of margin expansion for all the tire companies. Further, that's the reason you would have seen for most of the companies, while Q4 numbers were weak, but because of the outlook, especially on raw material cost, all the tire stocks after Q4 numbers had moved higher. Now for JK Tyre, another reason is Mexico business. Currently, it's very negligible, but company is saying due to no tariff on exports from Mexico to US, there will be a margin expansion there as well. Also, regarding the EV, companies saying that it has already started supplying to few companies related to EV, and it's going to be big for them in FY26. So, because of the positive outlook, we are seeing a big uptick in JK Tyre.
Prakash, you heard what Sudarshan has to say. What are your thoughts?
I just want to point out, morning when we started of the day, JK Tyre was expected to be in the red. It did start in the red, right? But nobody expected things could look up so much. So this is what happens when the past is okay, but the future is even brighter. And the management commentary, if you extrapolate that with, let's say, something like CEAT, they also mentioned about how things improved in terms of RM costs and how scaling up is happening. The same goes for JK Tyre. I think the big trigger here is going to be their ability to start getting revenue streams from the newer geography of Mexico. And there's nothing stopping it from doing it. They've already set up the unit. It's already rolling out products. It's kind of right for a re-rating. But it's also the percentage or the contribution that comes in from EVs. Because remember, EVs have a different set of treads, a different, they're much heavier. The dead weight is slightly differently handled. So If they were able to do that, then you have another stream growing without much of competition. As in the competition also is kind of starting at the same, is starting off on the same pace. So it's not that, JK has a disadvantage to that. So my sense is if that pans out, yes. But will I be exuberant and look at buying it at 10, 11% higher today? The answer is not yet, because there's still some room to establish all of those things.
Okay, all right. Prakash wanted your view on solar industries, but before we get your view, let's get in Riya. She's here to revise the Q4 numbers and the key takeaways from the interaction that we had with the management earlier today as well. Riya, take it away.
Well, yes, Solar Industries reported its Q4 and FY25 numbers yesterday. For the full year FY25, we've seen a revenue growth rate of around 24%, which is below the company's guidance of around a 30% revenue growth rate. On the margin front, that has been above the guidance of 25%. Margins have come in at around 27% in FY25, up around 365 basis points over the previous year. The international business grew by around 18% over the previous year, and the FY25 defense segment revenue was up around 162% compared to FY24, but still missed the company's guidance of 1,400 to 1,500 crores of revenue, coming in at just about 1,355 crores. The order book for FY25 stands at about 17,000 crores, of which defense constitutes almost 90% to the total order book. Now, coming to the guidance for FY26, the company has said that they are going to grow their revenues at around 33% over the previous year. Defense will constitute more than 30% of the total revenues compared to the 18% contribution in the current year. Capex will be around 2,500 crores for FY26. Today, in an interaction, the company also told us that they are expecting emergency procurement order finalization to happen in the next couple of months, and they're expecting substantial order inflows on this front. For the Pinaka order, execution will start by around Q2 of FY26 or latest by October onwards, and they're expecting around 550 to 600 crores of revenue on an annualized basis from the current two variants of the Pinaka orders that they've received. As more variants come up, they are going to see a revenue of around 900 to 1,000 crores from these Pinaka orders over the next couple of years. They've also highlighted that defense is going to contribute around 40% of revenues over the next 3 years. Now, on the back of this, Antique has also upgraded the stock to a buy rating. They have a target price of around rupees 15,570 on the stock, which is an upside of around 15%. And reacting to all of this, the stock has been trading higher in today's session.
Okay, all right. Prakash, what do you make of Solar Industries? I mean, we have discussed the stock. I don't think even at one-third the price, maybe even lower than that. It saw some profit taking, I recall, earlier this year. And we had Mr. Nuwal joining in on this show itself to clarify, I recall, and the stock was 8,500 rupees or thereabouts. From there, just take a look at the way the stock has done. I'm talking about February till May. But what do you make of the stock at around these levels?
No, absolutely. I mean, you're right. The levels 8,500 was where it went this time around. Of course, if you look at a 52-week high, it's even sub 8,000. But, it's a stock which has very low float, and people who own it from lower levels. As you rightly said, it's kind of moved up and had a wonderful journey. So it's very difficult for people to wanting to exit. And that's one of the reasons why you don't get enough of it. So you look at the volumes, it's hardly any volumes, and it probably, do a 8-10% very easily. Now, I'll just tell you one simple thing. Solar industry is at 115 trailing PE in spite of all these good numbers. And I really don't feel this miss is such a big issue. But the read-through from the commentary on the Pinaka rockets is very simple. Who makes these rockets and rocket launchers? It's actually L&T. So what happened is I went back to the L&T numbers and L&T commentary to figure out how much of that is already kind of actively contributing. So solar is something which is too expensive, so I've kept it aside. You want to buy it only when the market corrects and gives you that opportunity, risk reward being favorable. But the Pinaka rockets is something, the launchers are what L&T actually contributes to in a very significant way. And I don't think people have started talking about L&T in the same breath as a lot of these defense plays. So, that's the interesting part. Defense will open up so many other avenues and second order impacts that you'll probably find value somewhere else and not what's staring at in your face. So that's the kind of read through on this. But great to see the new capacities getting operational and defense becoming a big contributor for them, because they've really invested a lot of capital and resources into this. So 40% is good news, but the good news is already probably priced in at 14,000 plus.
You know, we thought BEL also, all the good news is priced in, and yet BEL is turning out to be like Solar Industries, a gift which keeps on giving. It's up another 4%. You know, we've had many experts pointing out that risk reward probably is not favorable. You know, the stock may correct, evaluations are too high. At these levels, 382, your thoughts on BEL?
I have a bit of a different view, and gladly, I have been talking about buying it even at 360, 350 zones, which, last week when it kind of scaled up. For the simple reason, look, the commentary is telling you that things are now going to start looking up as more units get operational. They're talking about margins in spite of the 7.5% lid that the government put on some of the contracts. There's so much more that they make, right? So the operating leverage is visible. They will start executing orders for overseas customers as well. So, it's no more PSU that's kind of just fulfilling some of the demand which compulsorily comes its way. But it has also kind of developed itself into a very market-oriented competitive business. So the BL, I fully agree, would be bought even around these levels, Rima. But solar, the upside is not too great. I mean, from 14,000, probably land up at 15.5 or 16 or wherever in the next 12 months. But here, you could have a re-rating that could continue because the order book is much faster in terms of build-up. And you would probably see 500 levels by the time we talk about this next year and things look up. So definitely, it's a bit of a different thing. While valuations, of course, we keep talking are stretched, but given the momentum, given the demand for defense plays, this is probably the poster boy of the defense industry at this moment. So you will have to live with that high valuations for the time being, but definitely makes sense to buy it, even if you nibble into it at these levels.
Okay, all right. Very quickly, Prakash, before we let you go, any view on Gland Pharma? Actually, the numbers were a little bit of a miss, but from the lows, actually, the stock has seen a sharp recovery. And as we speak, it's up more than 4%.
I mean, so, Gland Pharma has always had this sword hanging on its head in terms of, the Foseco connection. And there's so many other things that come around it. So it's something which is very difficult to analyze or evaluate in terms of, visible growth and how you would kind of want to pay for it. So, and especially pharma, Nigel, it's such a vast, this thing. You look at some of the smaller names out there, and you have Marksons and all of these, which are chugging along so brilliantly. And without it, they're boring businesses because, they're very steady state. But you'd rather make money in that than, something which is very mercurial in terms of its price behavior.
Thank you very much for joining in. We will slip into a break. On the other side, we'll get chatting with Tushar Pradhan, Director of Hexagon Partners. Stay tuned.
You focus on the gemstone side of the story?
So I think it's really making our customer the true north. So when we introduced the good, better, best heirloom, no one else had done that before. So we pioneered in introducing different qualities, different sizes, different metals all together. And so no matter who the customer was, you could get exactly what you wanted, provided you like that design sensibility. And that's really helped us take off.
What we're seeing in the jewelry market worldwide today is this big takeoff as far as lab-grown diamonds are concerned. In fact, you believe that this is the Kodak moment for the diamond industry. Why do you say that?
The Federal Trade Commission in the US said a lab-grown diamond is a diamond. They're chemically, physically, optically identical.
Okay.
So all of a sudden, it legitimized the entire industry for everyone. And now, you fast forward 7 years, you can get a lab-grown diamond for 90 to 95% cheaper. It's going to be very difficult for natural diamonds.
Welcome back. Well, the markets are holding with some gains, but the good news actually is that from the broader markets, there are a few more stocks that actually started advancing. So that's pretty good going out there. You have Thomas Cook that's moved to the high point of the day. As we speak, the stock, in fact, is up 18% for this week. So good up move out there. Indian hotels as well, that did see a sharp pullback. Now that as well is spiking up. Smaller name like a Trident that came out with the set of numbers that's at the bottom of the screen. Well, that as well has seen an uptick. And IDBI Bank actually been seeing a good amount of delivery-based buying. So we'll have to see how that goes. But let's get in Tushar Pradhan, Director of Hexagon Partners LLP, who joins us on the show. Hi Tushar, good afternoon. Thanks a lot for joining in. How are you feeling about the Indian markets? You know, after seeing 21,700, we have zoomed to around 25,000, 21,500 to 25,000. All of this in a matter of a few months. Earnings are yet to pick up. What would your outlook be on the headline index first, on the Nifty, for the remainder of this year? Do you think we can build onto this, or do you think we're getting a little stretched on the upside?
Yeah, it's an interesting time to take this review, Nigel. And I think what is important to understand is while the move has been very sharp, you have to remember that there were reasons for this downturn in the markets as we saw it due to geopolitical reasons, etc. So it is just not the up move, but you have to calculate, what we have done actually from the start of the year, which is not much. So I think that largely reflects or discounts the kind of flat earnings that we are likely to see for FY25. We've seen most of the results come out. I think some of them are a little mixed. But I think going forward, what is going for the market is that FY26 and then on that 27 is likely to be a very significant base impact on earnings growth. So reported earnings, in my opinion, are going to be fairly strong going into the next financial year. And we'll start to see that impact come in the first few quarters of the reporting season. So come June, when we will see the first quarter of the next year and into September, I think there's going to be a lot of momentum which will build on earnings. And that's why I'm pretty positive on the index itself going forward for the rest of the year from here.
I remember you saying that perhaps you won't be surprised if the index goes back to all-time high levels towards the second half of the year, towards the end of the year. But Tushar, in the earnings season so far, or generally, given the geopolitical shifts that we've seen, have you observed any new trends which have emerged that you'd like to highlight, which can make it to your portfolio? There is a play on it.
So, I mean, there have been some trends which we have been following for some time. So one of the things, of course, as we spoke about, has been manufacturing. Essentially, what we're talking about is 6.5% GDP growth sustained over the next 2 years. If that happens, that has a natural impact on process industries, on manufacturing, on capex in general. So I'm very positive on the capex cycle picking up in the next year or so. What the last year gave us was a little bit of an uncertainty around where the election came around and capex from the government came off a little bit. And we saw that reflected in the overall GDP numbers. But I think that is all behind us. We are also now coming to a fairly good conclusion in terms of what the yields are likely to be for some time. So the confidence that private capex has is on two counts. One is on general demand conditions, and second is the cost of debt and the cost of capex going in. I think in both terms, it looks a green signal from my perspective. Demand is likely to continue to pick up from here. And if we were to believe the GDP growth estimates, given that our interest rates are unlikely to go up from here, and as a result of which, we will have a very significant situation where it gives us a lot of impetus to think that general manufacturing, I would say central or core industries are likely to do well. And I would take a further bet in terms of Atmanirbhar, or what would you call as domestic manufacturing going forward.
Okay, all right. Well, Tushar, I wanted to ask you about, these various China plus one themes and that entire focus, that India could be a potential beneficiary. We have Dixon that came out with a set of numbers. The space clearly has a big runway, but valuations look expensive. From this entire shift towards India, what are the themes you like? Whether it's EMS, whether it's chemicals, CDMO, what would be your topic?
I think some of those are already prevalent, and we can see them already in the valuation, as you mentioned. I think some of the new ones which we don't yet know are likely to come more in specialty chemicals. I would still also bet a little bit on manufacturing and engineering, because in the past, what we have come to believe that large-scale manufacturing is really not replicable in India as it exists in China today. So we all know that Chinese manufacturing is absolutely world-class, and it has a potential to mass manufacture high-quality technical, or I would say technological products at a large scale. Now, to say that India will be +1 in that area in the past used to be a question mark. And I think that is what is changing at the margin, of course, but not significantly. I would think that, going by the headline about the iPhones being manufactured in India, I think that's a signal to say that now India might look at large-scale manufacturing, not really the lower end of the manufacturing like textiles or whatever, but I think the higher end of technological manufacturing, which is mass in nature. I think that is something that we are likely to see. Now, there may not be easy listed options there, but I think if you go down the supply chain a little bit, I think there might be some interesting opportunities there. So that's something which we are really very keen to uncover. The other themes on China +1, I would think, would be reducing the concentration risk that most of the OEMs may have. So it could very well go into automotive parts, components, and even to a certain extent, electrical components, which some of the manufacturers, the MNCs, already are existing in India, and all they need to do is to just expand capacity. So I think there is a plethora of these sectors which are opened up, but we will, of course, have to wait and see which companies actually come forward, put capacity, and offer a credible China +1 opportunity.
Got that. What have you made of the banking or the broader financial earnings so far? Today, we're awaiting numbers from IndusInd Bank, and that's going to be watched, if there is some sort of can of worms hidden there. But when it comes to the financial sector, what are your thoughts on the earnings?
I think the whole banking and financial sector, and I'm talking largely only the lenders here, has been taken, a little bit of a backseat, if you realize, in the last, I would say, even over a one-year period. And I would think that maybe the gloom that we felt, and it began with the microfinance bubble that we got seen a little bit of a bust off. We saw large private banks struggle to grow. We saw difficulty in raising deposits for the public sector banks, etc. But I think all of that is behind us. What I do feel going forward is that the growth, again, largely dependent on the GDP estimates going forward, is likely to ensure that our banking system will have adequate capital. They do not have too much of a charge on their capital. Their book sizes are extremely healthy, one of the lowest NPL ratios that we've seen for decades. And this ability and willingness to lend has come to it. Deposit growth has picked up. So all of this really looks to me like very, very combustible powder, gunpowder as we call it. And I think all it needs is a spark of sustained demand. And I think you'll see a turnaround in lenders per se going forward. So I think all of the bad news that we see probably already is in the price. If you look at average valuations, they are now well below median, especially the private banks as well. So I think I would be fairly positive, but not really overweight here. I would wait for some select opportunities to come up.
Any view on IndusInd Bank? So much of bad news. Bullish argument is it's trading at XYZ as a 0.0 times book value, and then suddenly you get some negative news. I mean, what's your take?
Well, I would defer to speak anything about specific stocks. I would just say I don't know.
Okay. All right, Tushar, appreciate you joining in. We'll have those numbers out later today. And as we speak, the stock seems to have cut some of its losses. But good to hear your thoughts, Tushar. We look forward to chatting up with you rather soon. IndusInd Bank, though, just pull up the intraday chart. I think it was perking up a little bit. It's cut its losses. Now it's down only around 1%. And the other one that I saw, I think that moved up a little bit is Asian Paints, a rank underperformer. Last quarter's numbers were disappointing. Even Nestle India, actually, both those two have moved up to the high point of the day. Slip into a short break, come back. We'll focus on some technical trading calls. Stay with us. Welcome back. Well, there's some big news from the fashion and retail segment. Aditya Birla Fashion and Retail is expected to demerge its lifestyle business. Vinny is with us to fill us in with more details. Vinny, run us through the details. How will the entities look?
Absolutely, Nigel. So, we do have that information that, Aditya Birla Fashion is demerging that lifestyle business, but the record date for that is tomorrow. So that's going to be important because now the price discovery will happen tomorrow for the new business and the new entity which will come in place. That is Aditya Birla Lifestyle Brands. The listing date yet has to be announced for that, but the record date is going to be tomorrow. The demerger ratio is going to be in the ratio of 1:1. Now, the resulting company that will be called as Aditya Birla Lifestyle Brands, that is going to be housing Madura Fashion Lifestyle Brands. Now, what brands actually come under this is going to be one, Western wear legacy brands are there. So that is whether you look at something like a Louis Philippe, Van Heusen, Allen Solly, Peter England, Reebok, American Eagle are some of the brands that will come there. Other than that, growth brands also of the company, which are there currently with ABFRL, that will come into ABLBL. That is that Aditya Birla Lifestyle business side. So that will be Reebok, American Eagle and Van Heusen Innowear. That goes into this as well. So currently, when you look at it, 85% of the revenue is coming in from these brands, which is going to be going into the lifestyle brands. Now, what will ABFRL still have? The Pantaloons business, that's going to be there. TCNS business, then they have those designer brands like Sabyasachi, Tarun Tahiliani, Masaba, that will still be under ABFRL. Premium brands will be there as well. And other than that, luxury retail still continues to be under ABFRL, as well as Tomorrow, which is also a brand, continues to be under ABFRL. Pantaloons currently 59% of the revenue is coming in from there, followed by ethnic wear. So that those two are important brands that will still be with ABFRL. Now, in terms of the demerger, when you're looking at it in terms of the revenue split, it's quite equal. Not much of a difference in terms of the revenue that will be there for both these companies. So just the latest numbers that we had was of Q3 FY25. Aditya Birla Lifestyle Brands is around 21,500 crores, while in terms of ABFRL, it's 22,180 crores. Now, in the recent meet that they had with analysts, they have given guidances for both these companies separately. So for Aditya Birla Lifestyle, the management is targeting a 13% revenue CAGR growth over the next 5 years. EBITDA margins also around that period is going to be 300 basis points to 11% is what they're expecting there, and a ROS of around 70% plus in FY30 for the lifestyle brand. Now, for ABFRL, the management is targeting a 20% revenue growth over the next 5 years. Margins expected in terms of an expansion to 7% versus currently, which is not doing well. It's on the negative side. So obviously 7% is what they're expecting there. And return on capital employed is around 18% plus by FY30 is their expectation. Now, according to Bernstein's report, the estimate in terms of SOTP valuation, that will be for the stock price for tomorrow, it is expected at around 185 to 215 for Aditya Birla Lifestyle brand, while for Aditya Birla Fashion and Retail, it will be now at 80 to 105. Tomorrow is the day that we'll keep an eye out on in terms of price discovery.
Thank you very much for that. NTPC Green's numbers are up for you on your screen. The profit has jumped 233 crore versus 81 crore. In the morning, I think the stock was a bit subdued. And I remember, Hormus telling us that I think the stock was even trading below its IPO price. But post the Q4 numbers and the big jump seen in the company's profitability, the stock is now up close to about 4%. Revenues too have gone up close to about 22.5%. The issue price on NTPC Green Energy was 108. The stock is trading just shy of that level despite the up move. 108 issue price, stock is now at 107. NTPC should also come up for you on your screen because that is the promoter of NTPC Green Energy. The other one to track would be Protean eGov. It comes out with its numbers today. The stock over the last 2 days has fallen more than 20%. Q4 numbers are not going to see any impact on account of not being selected for PAN 2. But I guess once again, the street will try and quiz the management on the possible impact in the future. So Protean eGov numbers are today. Shrikant Chauhan from Kotak Securities is back with us. Shrikant, any BTST calls?
Yeah, I think all these PSU banks, they are recovering from their lows, and few commodities. There also we are seeing good amount of strength. So from the PSU bank space, we like Canara Bank, which is around 107, 108. Based on its technical formation, we can see the levels of maybe 112 or 13 on the higher side. We can keep a stop loss somewhere close to 105 for the same, because there we are seeing good amount of put writing. The other stock which we like is Hindustan Copper. It is into ban period, but broadly, if we go through with its technical pattern, I think the stock is heading for the levels of 255 or 260 in the near term. So while looking at its technical pattern and the sector specific performance, Hindustan Copper also looks good and strong at current levels.
Thank you. Let's go across now to Abhishek. He's waiting by. Abhishek, PFC, best loan growth in 39 quarters.
That's on a sequential basis. We need to mention that also. So 39 quarter high with respect to quarter-on-quarter loan growth of 7.8% that they have seen. And on a YOY basis, the 12.8% growth in terms of loans is one of the best that you are seeing in last 4 quarters. Now, asset quality is the best in last 37 quarters. So a 37 quarter low gross NP ratio of 1.94%, while net NP ratio has fallen below 0.4%. In terms of P&L momentum, there is a strong yield that they have got in this quarter, which has actually made the NII jump by 39.5% YOY and about 26% sequentially. So the yield has been strong because interest income is up 10.5% quarter-on-quarter versus the loan growth of 7.8% on a sequential basis. Other income is robust, a growth of 62% YOY and about 92.5% sequentially. The provisions have remained elevated this time around at 445 crore versus 75 crore in the previous quarter. Looks like they might have used the provisions to make write-offs in the asset quality. The PAT is strong over here, growth of 23.5% YOY and about 23% sequentially. We also spoke to the management of PFC, wherein they said that they saw good loan growth in this quarter. They expect the spreads to remain in the range of about 2.5%. Clean out energy is the main area of focus for them. They cannot rule out thermal projects by government which they intend to finance. The government's strategic focus on reforming DISCOM is one of the key highlights. And in KSK Mahanadi, PFC's exposure is about 3,300 crores. Back to you.
Okay, all right, Abhishek. Thanks a lot for giving us that analysis. But Abhishek, this evening's going to be busy. IndusInd Bank will be reporting its numbers. What are the expectations?
Well, it may report a net loss as per the poll of various analysts that we compiled. So they have already given the business momentum, one of the weakest business momentum on a YOY basis with respect to deposits and advances in last 17 to 19 quarters. So the key thing to watch is that the net interest margin can decline both YOY and quarter-on-quarter. Kotak Securities estimates 67 bips decline YOY and 21 basis point decline quarter-on-quarter in the net interest margin. Operating profits can be weak. Again, Kotak Securities estimates 67% decline in operating profits YOY and about 63.5% sequentially. Credit costs can remain elevated. We know the MFI issue that they have reported, so credit costs can remain elevated over there. Slippages also rise quarter-on-quarter, led by microfinance sector. So Kotak Securities estimates a slippage ratio of 2.7%, up about 22 basis points on a sequential basis. Asset quality largely expected to remain stable, so there can be massive write-off. Motilal Oswal estimates gross NPA ratio at 2.4% versus 2.3% in the previous quarter. Watch out for management commentary on the new management team formation, as well as the fact that business momentum, how they see going ahead, will be a key factor to watch out for. Our poll suggests NII decline of 11.5% YOY and 9% sequentially. We are working with a loss of close to 515 crore versus PAT of about 2,350 crore in the same quarter last year and about 1,400 crore of PAT in the previous quarter. Back to you.
Okay, all right, Abhishek. Thanks a lot for that. Well, Sudeep Bandyopadhyay, Group Chairman of IndiTrade Capital, joins us on the show. Hi, Sudeep. Good afternoon. Good to see you. Sudeep, first your view on IndusInd Bank. It's going to be an interesting set of numbers. But numbers aside, what's your view at these levels? Are you in the camp that believes there could be value that will emerge ultimately? Or do you say there's too many moving parts, too much of negative news flow that keeps hitting, you rather stay away?
Well, there is absolutely no doubt, Nigel, that there are too many negative news flow coming out, and that's hitting us. First, we had this Forex issue of around 2,000 crore, then the microfinance issue of about 600 crore, and I believe there are some further issues which are being investigated. So, of course, there are too many issues which have hit the bank in the recent past. But having said that, I think it's a very valuable franchise which has been created. And going forward, I think there is value emerging. Of course, you have to be a little aggressive investor if you want to take a position. But if you are I think it's worthwhile looking at this bank. Maybe just hold on, wait for the results, and if there is further correction, that probably would be the time to take position in this stock. Probably we have seen the worst as far as this bank is concerned.
Okay, all right. So probably the worst to there, but we'll wait by for the numbers. Sudeep, what about PFC? What Abhishek just spoke about? The growth levels, the loan growth actually was very, very impressive. Even on a sequential basis, it's up 7-8%. The street likes that. Your view on the stock?
Nigel, I'm absolutely, focused on buying power sector related stocks, and I've been recommending power financials for some time. I clearly can see that power financials have a significant business opportunity coming up for them. Look at the amount of expansion which, whether NTPC is talking about, Tata Power is talking about, Adani Power is talking about, and the financing requirement of this expansion cannot be met by the commercial banks. So power financials will play a significant role, and probably we are seeing just the trailer of the loan book growth at this stage. There will be significant opportunity for all the three power financials, whether it's PFC, REC, or even IREDA, to scale up their book significantly. Asset quality also has been improving. The earlier challenges which they had have been taken care of. Assets, wherever there is a challenge, it has been written off. So the books are clean. Opportunity is staring at them, and it's going to happen in the near future. Under the circumstances, I believe PFC definitely is a good buy at current levels.
Okay, got that. That's about PFC. Let's talk about the aviation sector, because India has seen an air traffic growth of 8% in the last 2 months. Vinny is here with details on the growth and the market share.
Hi, Rima. So yes, in terms of the air traffic growth that we are seeing coming in during this time, that is the month of April 2025, air traffic growth in the last 2 months has been at 8%. And this time also we've seen that growth of 8.45% in April 2025. Domestic air traffic overall is coming at around 143 lakh passengers. This is on a month-on-month basis, that 8.45% that we're talking about. Indigo's market share 64.1% versus 64% in March. In Jan 2025, it was a much higher number in terms of the when you look at it in terms of the market share for Interglobe Aviation was at around 65%. So yes, right now we're seeing a recovery coming back on the month-on-month basis. Other than that, Air India, that has also gained market share by around 50 basis points in April 2025, coming in at 27.2%. Akasa remains constant at 5%, SpiceJet 2.6% as well. So yes, this is the data that we have coming in terms of air traffic, but do not forget that today we do have Interglobe Aviation's numbers as well. Good quarters, what we're expecting coming in Q4 FY25, revenue growth of 22%, EBITDA margin somewhere at 21%, and EBITDA margin at around 25% is what we're expecting. Profits at around 1,900 crores, and yields expected to be largely flattish. 5.3 is what we're expecting the yield at. Mahakumbh is going to be a key driver for Interglobe Aviation. Crude prices have been much lower, so that will be supporting the margins of the company going forward. Commentary on that front from the company. Commentary in terms of their engines, which they are more dependent on Pratt & Whitney. What is the current scenario there, as well as outlook in terms of international market, and what is the current global scenario in terms of air traffic trends that we're seeing is going to be key to watch out for.
Thank you very much for that. Nigel, we'll have another play on India's hospitality, travel, tourism sector, and that's Hotel Leela.
Oh, yes. You met them, right? Today?
Yeah, I met them. So, there is going to be one more hotel company getting listed. You already had Indian Hotels, EIH, ITC Hotels was the last one. And now you've got Hotel Leela, and they have best-in-class margins. So their margins are 46 to 49%. While Indian Hotels, say, is, for instance, at 35%. And the difference is that Indian Hotels plays in all the categories. They have the value ones, they have the ultra luxury, they have what they call upscale. But Leela, for instance, is purely in the luxury category. Wow. So their average revenue room rent is much higher than that of peers. And I think that's one of the reasons why, their margins are also higher. And the company just last year turned profitable. So it was loss-making. And then in FY25, they clocked in a profit. And the management said the best is still ahead of the company. Management now is, of course, Brookfield owned. That's the global asset management giant. They bought the company about 5 years back. And in 5 years, the business under them, Leela has gone up by nearly 3 times growth. Sudeep, quickly come in. Now you've got Hotel Leela as well. We'll analyze it threadbare in greater detail. IPO opens on the 26th. But in the entire travel, tourism, hospitality sector, what would your pick be?
Well, definitely the hotel segment. That's what I'm pretty bullish on. we have to necessarily look at the entire hotel industry and how the opportunity in front of them exists today. The way the entire industry has shaped up and the way the opportunity has come, I believe that there is absolutely a fantastic opportunity for the hotel players, and we can look at any of them from a long-term perspective.
Okay, all right. Thanks a lot for that, Sudeep. But we have a few more queries for you. For the time being, we'll slip into a short break. As we do that, here's some good news for all our viewers. India's business news leaders, now just a click away. Introducing CNBC TV18's all-new app. Get instant access to breaking news, in-depth articles. You also have financial news updates. All of this at your fingertips. Download the CNBC TV18 app from the Apple Store or from the Google Play Store. You can simply scan the QR code that's up for you on the screen. Welcome back. We've just got 7 minutes to close of trade today. And as we speak, numbers are coming in thick and fast. So you have Uno Minda that came out with its set of numbers. For the time being, we only have the net profit that's flashing for you on the screen. Remember, it's been one of those outperformers in a longer duration of time. But we'll wait by for the numbers. For the time being, only the net profit has shown a bit of a degrowth of close to around 7.5% or thereabouts. So we'll just hold on and wait by for some of these numbers. The revenues, though, have popped up by close to around 20%. So the top line growth continues on a higher base. The street will like that. Now we're waiting by for the margin performance. So operationally, I think on the top line at least, it doesn't look too bad. Sudeep, you want to comment on this one? Uno Minda, it's been a big wealth creator. They seem to be growing quite well. The margins are awaited, but otherwise it's been a fairly good company. And as we know, they're not impacted with regard to this entire shift to EVs.
Absolutely. I think auto ancillary, Nigel, has been one segment which has been my favorite for quite some time. And I believe that, the impact of the conversion from IC to EV is minimum or negligible or nil for most of these players. In fact, EV offers an incremental opportunity as, their component per vehicle goes up. And this is an opportunity which most of them are seizing. Uno Minda has been a fabulous wealth creator over the years. My only challenge as far as this ancillary space is concerned is this entire tariff-related uncertainty, which may or may not hit them favorably or unfavorably. We don't know that yet. So a bit of caution at this stage till the tariff clarity comes post. Hopefully 2nd June will be better. Maybe it's better to wait till tariff clarity before we make fresh acquisition here.
This Tejas Networks, there is some news over here which came out earlier. TCS has received an advance purchase order from BSNL. And part of that order, which is to supply RAN and equipment to TCS, will be fulfilled by Tejas Networks. And the potential value of Tejas's share in this will be about 1,500 crore rupees. And that's the reason why the stock is up 3%. The news is BSNL has given an advance order to TCS, and TCS will use Tejas Networks' help in executing that order, and that is valued at about 1,525 crore rupees. Now, Sudeep, Tejas Networks has been beaten down. Even the Q4 numbers were very, very disappointing. The company reported a loss this time. Their order book came down drastically. Is there value in Tejas Networks at these levels, or it's in a void?
Well, I'm a little careful. I think they were too dependent on this BSNL or BSNL related work. And once that is running out, I think their revenues are coming down. At this stage, yes, this is a good development. They've got a part of the TCS contract, and that will keep them going for some time. But I think they need to diversify. They need to get into other large clients. Till that happens, I think I will hold on from recommending a buy in Tejas Networks.
Okay, all right. Sudeep, what about, these other couple of companies? We had Hindalco, actually. I spoke to the management, Mr. Pai, today. And in the near term, the problem is their performance has been so good that some part of the street is calling out Q4 was the peak performance. Pricing was very good. Rupee was weak. Input costs were down. And there was no big impact of the trade war. That impact will start showing off in the coming quarters. What's your view on Hindalco? And also in the commentary they mentioned, Hindalco mentioned about alumina, which is the driver for Nalco. They're saying that because of the shortage of bauxite, owing to the lack of supply in Guinea, that's what could push up alumina prices. Your view on Nalco? Because if that is the case, then Nalco will be better placed.
Absolutely, Nigel. Nalco is definitely better placed with the current shortages which is developing. And Nalco has been our favorite stock for some time. And I believe Nalco is definitely a good buy. As far as Hindalco is concerned, I think Q4 numbers were fantastic. On top of everything else you said, I think the debt reduction process which they are undergoing also is on. And that's also a very good signal. Now, the only challenge is this entire tariff scenario and how that will particularly impact Novelis. I think, the commentary which Novelis gave didn't give any future projections. And they were also talking about some major impact of this tariff war or tariff issue on their P&L quarter on quarter. So I think the uncertainty regarding the entire tariff-related developments kind of clouds the future outlook of the consolidated entity. And I'll be a little careful on Hindalco at this stage. I'm not saying whether they've reached their peak or not, but fourth quarter was definitely fantastic.
Okay, Sudeep, do stay on. For now, just counting down to today's close. The Nifty's reclaimed the 24,800 mark as it snaps a 3-day losing streak, ending with a gain of nearly 0.5%. The Sensex is higher by nearly 400 points. All the sectoral indices close in the green, but the sector with the most gains include defense, 3.5% up on that, led by BEL. Realty and Pharma has had a very good session. The Nifty Pharma Index ending up close to about 2%. Some of the big winners today in the large cap space, BEL right on top, Tata Steel, Cipla, Bajaj Finserv, HDFC Life, Tech Mahindra. These are stocks with gains of about 1.5–2%. And the laggards, Innocent Bank ahead of its numbers. The stock is closing exactly at that 50-day moving average, 2% down on that. And you had cuts in JSW Steel, Kotak Mahindra Bank, Coal India. Stocks are down about 1% for these.
Well, in fact, from the broader markets, plenty of stocks are moving around. Tata Tele was up 20% in trade today. Apollo Microsystems, they've done a pref issue there. The street likes it. The stock was up. JK Tyres started off in the red. Street liked the commentary. The stock went up. Edelweiss Financial, you had Carnelian's Vikas Kemani that bought a large chunk in yesterday's trading session. The street took note of that, and that stock, in fact, was up close to around 5% in trade. IDBI Bank as well. There are hopes that maybe, in fact, the divestment could gather pace. We'll have to wait for a confirmation. But for the time being, that stock as well did do pretty well in today's trading session. NDPC Green Energy, well, the stock goes home with a gain of close to around 4%. Numbers look good, but it's returned almost back to the IPO price as well. A few more big winners from the broader markets. Ecos India Mobility, well, that one continues to chug along. It came out with its numbers a couple of sessions ago. But this week itself, it's up close to around 23%. So big move is what we're seeing on that particular name as well. And Banco Products, that's the other one for this week. It's up 35%, came out with its set of numbers. The stock has been running along, and it continues to do so as well. So we'll wind up on trade today with news that the Nifty goes home with a century of gains. The Nifty Bank ended above the 20-day MA. Breadth of the market, that was the big strong point today, because you had close to 2 stocks that were advancing for 1 stock that was declining. But on that note, though, we'll wrap up on this edition of Closing Bell. Don't go anywhere. Markets Forward comes up next.
Markets regained half of yesterday's losses. Nifty and Sensex end 0.5% higher. Nifty reclaims 24,800. Mid-caps outperform index, the benchmark indices, and gains nearly 1%.
Dixon Technology cracks in trade after it misses the revenue mark on stagnant mobile sales and weakness in consumer electronics and home appliances. However, the management guides for 40-45% growth in the top line next year.
IPO market warms up with 6 firms lining up for a listing in May. Bellrise Industries 2,150 crore rupees IPO opens for subscription today, while Leela Hotels looks to raise 3,500 crore rupees at a price band of 413 to 435 rupees. and welcome to Markets Forward on CNBC TV18, your go-to show where we aim to get you all the key data points to gear you up for the next day on the next trading session. I'm Vinny Motiwala and with me is my colleague Reema. Reema, hi.
Hi, a pretty good session, right? We managed to recoup part of yesterday's losses. The Nifty held on to the 24,800 mark. The Sensex gained close to about 400 points, and we pretty much snapped a 3-day losing streak. The mid-caps outperformed while the benchmark indices were up 0.5%. The mid-cap index was up nearly 0.8%. Good advanced decline ratio. The advanced decline ratio nearly had about 3 stocks advancing for 2 stocks declining. No sector closed in the red, but the big gainers include defense, realty and pharma led today. The Nifty Pharma Index was up nearly 1.25%. So you had gains in stocks like Cipla, Sun Pharma and BEL. That was a big winner on the way up. On the way down, Innocent Bank under pressure ahead of its numbers, stock ending lower by 2%.
Absolutely, Reema. While, yes, the Nifty did manage to close about the 24,800 mark, one factor that one should keep an eye out on that, we have closed below the 25,000 mark consecutively for the third trading session. Though today, that recovery has surely come in versus what we had seen in terms of the last 3 trading sessions. Nifty is up almost 0.5%. Broader markets, like you already mentioned, saw the outperformance. And other than that, we have realty as a sector that's doing well as well in the last couple of trading sessions. Nifty Realty, we had a lot of gainers coming in, DLF, Phoenix Limited as well, which was passing a trade. But yes, that's what is exciting in terms of market. At least we've seen some bit of a recovery. But well, here's what we have in store for you all in today's show. We'll start with the top movers and shakers of the day with Vivek. And well, the stocks of the day were Dixon Technologies, Sun Pharma, JK Tyre. We will give the key reasons why these stocks were buzzing in today's trading session. Last but not the least, we'll delve into the key market events to watch out for in tomorrow's trading session.
And let's get to our first segment of the day, and that's the big stock movers. Vivek is now at the big wall.
Well, thank you so much for that. Snapping a multiple-day losing streak, advanced decline ratio very strong. Not much to complain about for the bulls today. Well, in the list of gainers, the first stock on the radar has to be one from the defense pack. A very strong bounce back across most of the defense names. Solar industry, this particular stock, good set of numbers, strong management guidance coming about. Stock higher by over 5%. Bharat Electronics, one stock you alluded to. Remember, the company gave a very good set of numbers. The margin guidance that the company gave in the conference call is something that has led to EPS upgrades. The stock ended higher, over 5%, the top Nifty gainer today. Siemens, this particular stock, last couple of trading sessions was under a bit of pressure. But remember, yesterday the company actually held an analyst call, and the management guidance is something that the street clearly has liked. Over 5% higher for Siemens today. Quite a sharp up move for a size of Siemens. Dredging Corp, this particular stock, not one that we discuss too often, but very good set of numbers as far as Q4 were concerned. Operational efficiencies seen across all of the parameters. Stock ended higher by over 10% on good volumes. And to round off the list, another sector that you alluded to earlier is the pharma pack. The entire pharma pack, after quite a few days of underperformance today, bounced back in style. Sun Pharma over 1.5% higher. Names like Gland Pharma, Natco, all of them doing very well in the session. But a few laggards as well, few and far between. Dixon Technologies, delays as far as one key shipment to a supplier is concerned. That is something that actually kept the street a little worried. High valuations is the other key concern why this particular stock sold off today. Aster DM, good set of results, but despite that, the stock sold off after opening slightly higher, over 4.5% lower today, and one of the top laggards as far as the NSE 500 was concerned. And Newgen Software, this particular name, after a while, one of the top laggards as far as the NSE mid-cap index was concerned. So overall, a day where you saw more gainers rather than losers.
Okay, Vivek, thank you so much for that. But we do have with us Sudeep Bandyopadhyay, Group Chairman at IndiTrade Capital, joining in with us on the show as well. Sudeep, thank you so much for joining in with us as always. Any of the names that you find attractive in the market right now? Today, surely we've seen a bit of a recovery. One, do you think that will sustain? And what are you looking at in terms of a sector?
Recovery is definitely here to stay. I think, but it'll be a slow and gradual process. I also expect some amount of volatility. Look, we are now heading towards that, 90-day period of that tariff truce, which is going to end sometime in early June. So we have to keep the volatility in mind in and around that. As far as these results are concerned and sectors and stocks are concerned, I do like the power financials, and PFC results were pretty good as well. So one can definitely look at PFC and even the other power financials, REC and IREDA. The other bunch of numbers which I watched with care was the tire company results. Though the results were nothing great, I think the commentary around the significant cost reduction of their raw material cost as well as multiple other cost parameters, I think gives them a great leeway in going forward in Q1 and Q2 of the current fiscal as far as margin improvement is concerned. So tire is another segment, whether it's a JK Tire or a CEAT, which I will watch and I will recommend a buy from at current levels.
Okay, like PFC, like tire companies like JK Tire, CEAT. We also have with us Jay Thakur from ICICI Securities. Jay closed higher today, but we've still not made up for the losses of the prior session. In the near term, what's the trading call?
Good afternoon to you, Rima and Vinny. Well, 25,000 is where Nifty is clearly facing resistance, Rima. I mean, that's what we have been seeing, that Nifty bounced back quite sharply from, approximately 24,000 levels. But then it has taken a pause at 25,000 levels. And for this series now, we have seen the highest call base at 25,000. So until those levels aren't taken off, on the spot levels I'm talking about, till then, Nifty might just consolidate, or maybe, you can see some volatility going up as well, because since a couple of days, we have seen that India VIX is also inching higher. I mean, it's not able to sustain below 15 and a half. And from those levels, it's bouncing back about, 17 and a half. So I think that Bank Nifty 55,500 on a closing basis, Nifty 25,000 on a closing basis. Still, these levels are not taken off. These two indices are likely to consolidate. However, going forward, I think Bank Nifty would definitely help Nifty to inch higher, because eventually when 55,500 gets taken off on Bank Nifty, Rima, 57,000 would be the next target on Bank Nifty. So overall, positionally, I think the trend is positive. Short-term consolidation cannot be ruled out. However, the sectors which had performed quite well today, like that of defense, pharma, they are likely to, continue their up move, even for that matter, Nifty Realty Index. So I think a couple of stocks from these names, often these sectors, would likely to continue despite the index consolidation.
Absolutely, Jay. Surely we'll be keeping an eye out on these sectors as well and on the index and the levels over there. But let's move on and get more stock specific then and talk about Dixon Technologies. That tanked over 6%, and this came in after a miss in terms of the revenue mark, but the company remained upbeat, aims to double its revenues in 2 to 3 years. Upasana is joining in with us to give us more details on this front. Upasana, what are we keeping an eye out on in terms of Dixon Technologies going forward?
Firstly, let me highlight the Q4 numbers. The Q4 growth was mainly led by companies' mobile and EMS segment. And if we talk about the FY25 revenue, it stood at 38,860 crore, which was below the 40,000 crore mark given by the company in terms of guidance. Now, overall margins were a beat, but revenue and PAT was largely in line with our poll. Now, in terms of brokerage views, Nomura has given a buy rating and a target price of 21,202. It says that the mobile ramp-up is on track across domestic and export book, and the rising value addition is likely to aid margins going forward. CLSA has given a high conviction outperform rating with the target price raised to 19,000. It expects a 45% PAT CAGR from FY25 to FY28. But on the flip side, JM Financial has downgraded the stock to hold, and target price is cut to 15,650. And it has cited the key reason behind this downgrade. It says that the delay in commencement of production with Vivo and even display sub-assemblies with HKC has cut their estimates for FY26, and also likely increase in competition with the mobile PLI scheme, which is ending next year, is what the brokerage has cited as the key reason for their downgrade. Now, management joined us today morning. It expects 40 to 45% revenue growth in FY26 and 20 to 25 basis points margin expansion in FY26, and it says that the revenue can more than double in the next 2 to 3 years. Management has also indicated that the margin expansion of 90 to 100 basis points, which the brokerages were also estimating, is quite doable in the next 2 years. Listen into what management has to say.
My sense is, in revenue-wise, we can expect a 40-45% revenue growth this year. And we feel that through operational efficiencies and also through backward integration play, and also through higher contribution of some of our refrigerator business, which is higher margin business, I think so there can be some margin expansion which one can expect in this current fiscal as compared to the last year. I think so 27 can be even a larger growth for us. Of course, led by mobiles, IT hardware, and of course the other verticals as well. So we expect that in next 2 years, I think so the revenues for the company has the potential to more than double.
Okay, that's a management of Dixon Technologies in terms of the potential of revenues expected to double in the next couple of years as well. Sudeep, I just want to understand, what are your thoughts coming in for Dixon Technologies specifically? We had seen that very sharp run-up coming in, that PLI in terms of mobile really worked out well for them. But valuations are too high, right? Despite that split, also the stock again run up. What is your view now for Dixon Technologies? Maybe time for some correction and some newness, given that there are so many EMS players now in the industry.
You're absolutely right. I think the company is working in a segment or in an industry where the growth potential is immense. There is absolutely no doubt about it. And the management's commentary regarding the potential of margin expansion as well as the growth, I think is absolutely right. I don't doubt that. But the problem is the valuation. I think it's already run up so much that to justify the valuation, even based on the prediction of doubling revenue and business within 2 years, I think still will fall short to meet the PE multiples which they are already commanding. So my suggestion will be to wait instead of rushing into Dixon Technologies at this stage. Maybe at some stage there will be some further correction, and then it may be worthwhile looking at it, but not at current levels.
The 52-week high on Dixon Tech was about 19,148. So that's about 18% higher from where the stock currently closed. The IPO market, Sudeep, is also buzzed with 6 companies slated to list on bourses in the month of May. So Bellrise Industries' 2,150 crore IPO opened for subscription today. We chatted with the MD Shrikant Shankar Badwe, who said that 75% of the funds being raised will be used for debt repayment.
Our current debt stands at about 2,600 crores. We are out of the 2,150 crores. It's a completely fresh issue. All the money's coming into the company. Out of that, 75% is earmarked towards debt repayment and 25% towards general corporate purposes. Past 8 years, we've grown at a 11.5% CAGR, whereas the two-wheeler industry in terms of volume has only grown at a 1.4% CAGR.
And staying with the primary market, Schloss Bangalore, which owns the Leela Palaces, hotels as resorts, will be hitting the Dalal Street with a 3,500 crore rupee IPO on May 26. The firm's managing partner, head of real estate for Asia Pacific and Middle East, said that the best years were still ahead for the business. Take a look.
In 5 years, through a period of a lot of global turmoil in the hospitality sector, the business today is bigger by almost 3 times. It has an amazing appeal internationally. It has been ranked as one of the best hotel brands in the world consistently for several years. And I would like to believe that the best years, through the effort that we've put into this business, are still ahead of the business. When we acquired the Leela platform, we realized that this brand has the potential to be what came from other countries and became a global phenomena. And that does not mean that properties have to be in every country. The brand has to be globally recognized.
Okay, the motto is to stay in luxury and make the brand a globally recognized brand. Sudeep, you want to quickly weigh in? Have you looked at Bellrise? Do you have any thoughts on Hotel Leela?
So Bellrise, I did have a look, and I think what is most interesting is what they have recently done is acquired a company where the competency of them to serve the 4-wheeler and other segments increases. They were predominantly a 2-wheeler servicing company. They were focused on the 2-wheeler segment. Now with this acquisition, I think they are gaining the competence and capability to service the 4-wheeler segment as well, and that's a pretty large segment. And I'm reasonably confident on this company. I think it's a good issue to look at, and it's a good company to get listed.
Okay. That's a view coming in there in the IPO market. But let's move on. And pharma stocks, they are also in focus, and they were in focus today. What was the reason behind this? What is aiding these stocks? Ekta is here to give us those details. Ekta?
Thanks for that. Well, I'll start with Sun Pharma. That was in focus because its results come out tomorrow. So the street is anticipating a revenue growth of 9%, maybe margins of around 27%, and profit growth of around 10-odd%. Cipla is in focus because they launched a drug which is used to treat complicated UTIs in India. Separately, UBS had come out with a note on Cipla where they said that there could be more competition in one of their key drugs, Abraxane generic. As a pharma company, a Chinese pharma company has received US FDA approval for it. It is estimated that they could probably generate $50 million in terms of revenue from Abraxane and 5% of FY27 estimated EPS from it. Divi's Labs, that stock is up around 4% on a week-to-date basis, came out with its numbers over the weekend, so it's really continued in terms of momentum. Torrent was in focus on the back of numbers. Citi has a buy, target price 4,000. They believe the margin expansion trend will continue. And lastly, Gland, Nomura, neutral target price with of 1570. They believe that the management expects mid-teen growth in revenue in FY26. That's something that they've pointed out versus their current estimate of around 9.5% growth year on year. So a couple of brokerage notes and basically numbers primarily dominating the pharma space.
Jay, any pharma pick that you'd like? Thanks, Ekta.
Definitely, I think that Divi's Lab is one such stock which can, give good returns from these levels as well. And the stock is overall in a very good momentum as well, technically, or from the derivatives point of view. If we see relative to any other pharma stock, this is one of the stock which I would say has been trending higher, was quite immune to the kind of fall which we had seen or the correction which we have seen lately. And, the previous fall or the consolidation which we had seen, it was mainly on account of long unwinding and not short build-up. So we did not see any shorts in Davis, and rather it has taken now the multiple swing resistances, and with that we have seen a good long build-up rather. So I think yes, Divi's Labs is one stock which is likely to head towards the levels of 7,200 to 7,500 positionally, and I think that 6,200 now will act as a very, very crucial support. Until those levels are held, the overall trend positionally on Divi's Lab will be positive.
Okay, let's move on. And to the next stock for today is JK Tyres. That soared 11%, and this is despite a weak quarter due to a positive outlook from the company. Sudarshan Kumar is joining in with us to give us more details on this one. Sudarshan.
So JK Tyre today recorded a gain of more than 10%, biggest single-day gain in more than 1 year after reporting a weak, that was operationally weak Q4. But the reason stock has moved higher is due to company's strong outlook given for the next 2 quarters. And what's the reason of strong outlook? It's the company believes that raw material costs, which were largely flat in Q4 of FY25, costs are going to fall further in Q1 of FY26 and Q2 of FY26. For example, just take an example of crude. Brent crude average in Q4 FY25 was around in the range of $67 to $70 per barrel. In Q1, it's down to $61 to $62 per barrel. Also, natural rubber prices have fallen further. Now, because of these downtick in the prices, company believes that margin will expand in Q1 of FY26 and Q2 of FY26. Another reason that is positive is Mexico business. Company believes that US President has not announced any tariff on Mexico, and that's the reason in Mexico business also margin is going to improve. Regarding EV business, company is saying that it has already started supplying to few companies for the EV bus, and that is also going to improve the revenue going forward. So on the back of strong outlook, JK Tyre today was up more than 10%.
Thank you very much, Sudarshan, for that. We'll thank Sudeep and Jay as well for joining us on the show. Get into a break. On the other side, top corporate voices, along with that, the key market events to watch. Welcome back. These are the big corporate voices of the day. First up, it's Hindalco. The management says aluminium supply is tight but balanced globally. Further, the spike in alumina prices is owing to the bauxite shortage fear. The management expects LME aluminium prices to be in a range of $2,300 to $2,600 per ton. Next up is Solar Industries. The management expects demand for their defense products to go up post-Operation Sindoor. The company is anticipating emergency procurement orders to flow in soon. Added that defense is set to contribute 40% to revenues in the next 3 years.
Up next, we are Zydus Wellness. That was on our radar today. The management expects double-digit growth to continue in FY26. That's not all. It guides for early teens or high growth in FY26. In 2 years, it expects margins to reach 17 to 18%. Lastly, we also had the management of PFC on the channel. The management saw a good loan book growth and expects spreads to remain in the same range as guidance of 2.5%. Its distribution and renewable segment that are driving growth for the company.
And as we wrap the show, let's get you up to date with the key market events to watch tomorrow. Vamakshi.
Well, Reema, tomorrow is expiry day, so we'll be keeping an eye out for that. But lots of earnings reactions will also flow through. From the Nifty pack, we have Sun Pharma, we also have ITC as well as Grasim reporting their numbers today. From the broader markets, it's Astra Microwave, MTAR Tech, Honasa Consumer, among several others. Some stocks are also going ex-dividend tomorrow. This includes Imami, GM Breweries, Ashok Leyland. Keep an eye out for ABFRL as well, because the company will be going ex its demerger. As far as Ola Electric is concerned, that stock will also be in focus. A board meeting is scheduled. They will be considering fundraising plans via NCDs as well as other methods. Let's also look at some of the top economic cues then. From the US markets, we'll be keeping an eye out on S&P Global Manufacturing as well as PMI, Services PMI data. Apart from that, we'll also look out for the initial jobless claims.
Thank you. And that brings us to a close on this edition of Markets Forward. We'll be back with more news and updates on the other side.
Hello and welcome to Business 360. I'm Arundhati Ramanan and these are the top headlines that we're tracking for you this evening. Sensex and Nifty regain half of yesterday's losses, gaining over 0.5% each. Mid-caps outperform, rupee holds steady against the dollar. Respondents to a CNBC flash Fed survey dial back inflation and recession concerns on the back of easing USA-China trade tensions, but policy uncertainty continues to remain high. Over 80% of the forecasters, which include economists and fund managers, remain uncertain about the tariff outlook. Elon Musk commits to leading Tesla for the next 5 years, but says he wants more control of the company, similar to Larry Page and Sergey Brin at Google and Zuckerberg at Facebook. Also promises to spend less on political donations after spending over $250 million to help the Trump campaign. That's a CNBC exclusive.
I think it's the right time. I think the business is in a good place, the org is in a good place, the sector is in a good place.
This is the right time to list and India is the right market, says the top management at Walmart-owned fintech company PhonePe. Promises more diversification and profitability in the years to come. That's an exclusive. The government begins its diplomatic outreach to take India's stance on terror to the world. 2 of the 7 all-party delegations begin their campaign today. The delegations will focus on highlighting that Pakistan has sponsored multiple terror attacks on India since 2008. We'll explain why India had to suspend the Indus Waters Treaty. Former U.S. National Security Advisor John Bolton says India has an inherent and legitimate right to self-defense after Pahalgam attacks, adds that the United States must work towards ending Pakistan's cycle of terror. A former Trump aide turned critic, Bolton says the presence of prototypes of Chinese 5th-generation fighters in Pakistan during the recent conflict is a bigger worry. That's another exclusive. India moves to fast-track trade deal negotiations with the European Union. Sources say India's chief negotiator heads to Brussels to discuss an early harvest agreement similar to the one with Australia. Supreme Court grants interim bail to Ashok University professor Ali Khan Mudabad, who was arrested for a social media post on Operation Sindoor, but the Apex Court terms his post dog whistling and orders a special investigation team to probe the matter.
This moment feels like 1,000 fire files lighting up a single sky, brief, brilliant, and utterly collective.
India's Banu Mushtaq creates history, becomes the first author writing in the Kannada language to win the International Booker Prize for her book Heart Lamp. She shares the honor with translator Deepa Bhasti. Those were the headlines that we're tracking for you this evening, but straight to the day's market action. The market regained half of yesterday's losses. Nifty reclaimed the 24,800 mark, while the Sensex ended the day above 81,600. Nigel D'Souza joins us now with the day's market action. Nigel, a good day for the markets there?
Well, it was a pretty good trading session for the bulls today. The Nifty went home with gains of around 130 points. The Nifty Bank, well, that pulled back as well. And technical as well, it conquered that 20 DMA. The problem was that the volatility index perked up a little bit on the day that the Nifty went up. That's normally some kind of sign of caution, but that's more to do, I think, with the global environment because you don't know what's going to go on with the globe next. So that's a bit of an issue. But in terms of indices that did well in today's trading session, you had Realty as well as Pharma, both those two indices, the top gainers in trade today. From the Nifty pack itself, you had BEL. Stock was bursting away. Remember, it's seen a good rally in the recent past. Now the street is optimistic that they can garner some more orders. So that's why that was the top gainer. You had Cipla as well from the Pharma pack that was participating on the upside. But your portfolio will be feeling good today because the number of stocks that were advancing were more than the number of stocks declining. And that's always a good sign. And there were plenty of big winners from the broader markets. JK Tyres came out with the weakest set of numbers, but they're promising better times. The street liked it. That stock was up. Dredging Corp as well was up more than 10% in today's trading session. And Gland Pharma as well, a bit of a softer set of number, but the street is looking ahead. So that's why that one was up close to around 4%. Tejas Networks, the stock got slammed because of lack of order wins. Well, they won an order today of around 1,500 crores and the street liked that. However, weak numbers are getting punished. Fineotex Chemicals, the stock was down from the broader markets. You had Sangvi Movers as well. That one as well did get hit today, down more than 5% in trade. So the street clearly is differentiating between strong as well as weak numbers. Though on the headline index, you have the Nifty that seems to be in a bit of a broad band. On the downside, 24,500, which is the 20 DMA. On the upside, we need to decisively conquer the 25,000 odd mark, which will give the bulls further ammunition, and the Nifty bank as well needs to get past that 56,000 odd mark that's been rejected the last few times. So let's see how it goes. But for today, it was a good session.
Right, Nigel. Many thanks for those details. Now, easing trade tensions between Washington and Beijing has lowered inflation and recession worries in the United States. Respondents to a CNBC Flash Fed survey have dialed down their recession and inflation outlook. However, policy uncertainty continues to remain high. Over 80% of the respondents, which include economists and fund managers, remain cautious about the tariff outlook. Onto a CNBC exclusive, Tesla CEO Elon Musk has committed to leading Tesla for the next 5 years. However, he added that he wants more control of the company, citing Larry Page and Sergey Brin at Google and Zuckerberg at Facebook as examples. Musk also promised to spend less on political donations. This after spending over $250 million to help US President Trump's campaign. In an exclusive interview with CNBC, Musk also spoke about driverless cars and humanoid robots.
We have cars driving 24/7 with drivers in the cars, and we see essentially no interventions. So we want to be very careful with the first introduction of unsupervised full self-driving, meaning that the car's driving around with no one in it. We want to deliberately take it slow. I mean, we could start with 1,000 or 10,000 on day one, but I don't think that would be prudent. So we'll start with probably 10. For a week, then increase it to 20, 30, 40. And I think by, say, we'll probably be at 1,000 within a few months. And then we'll expand to other cities, so expand to San Francisco, California, Los Angeles.
India's all-party parliamentary delegation, comprising of 7 teams and 45 MPs, have left for foreign nations to expose Pakistan's role in sponsoring terror attacks against India. The delegations will visit 30 nations to engage with foreign leaders and think tanks. The MPs are expected to highlight the role of the terrorists in the Pahalgam attack and will urge the international community to take action against Pakistan. Speaking to CNBC TV18, John Bolton, the former US National Security Advisor, said that it is important for India to show that this was a terror attack emanating from Pakistan's soil. He added that the United States must spend more time talking to Pakistan about terror groups on its soil. Take a look.
This is a problem that we simply cannot live with, and it's why India's responses clearly constitute legitimate self-defense. I just say I think it's important to get the kinds of information that you've just described, get it out into the world press, make sure that the case that India can make, should make, is important to provide legitimacy for the steps it takes militarily. So I think in future discussions, it's worth getting the ground rules straight with President Trump at the beginning. I think the fact he made a call, that Vice President Vance and Secretary of State Rubio made calls trying to be helpful was a good thing. I don't want to discourage it, but I think he needs to understand how sensitive this is on both sides, and that in some cases, what goes on quietly out of the spotlight is a lot more important than what happens in the glare of the spotlights.
And you can catch the entire conversation with John Bolton at 5 and 9:30 p.m. right here on CNBC TV18. It's the third and final day of Commerce Minister Piyush Goyal's visit to the United States. Goyal has held meetings with Commerce Secretary Howard Lutnick and U.S. Trade Representative Jamieson Greer. Parikshit Luthra is here with more of those details. Parikshit, how are the negotiations progressing?
India and US trade talks have been positive over the last 3 days. Commerce Minister Piyush Goyal, who is in Washington, D.C., has not only had official meetings with top US government officials, but also dinner meetings with US Trade Representative Jamieson Greer and US Secretary of Commerce Howard Lutnick. Sources familiar with ongoing negotiations say that it is quite likely that India and US will be able to sign an early trade deal by July. US had imposed a pause on reciprocal tariffs on India and other nations till the 9th of July. Sources say the US may not impose the 26% reciprocal tariff on India in case a first phase trade deal is done before July, but there is no official confirmation on this from either the US or the Indian government. CNBC TV18 has learned that while negotiations have been intense and US is driving a hard bargain, an early trade deal with India will also give a political victory to Donald Trump. The president has been facing criticism for the disruption caused due to his tariff policies, and the trade deal with India will be the first to give America significant concessions and market access. India has offered zero duties on all goods, including automobiles and auto components, but wants to keep agriculture and dairy out of the trade deal. However, the US wants a bigger deal covering market access for US agriculture and dairy products. India has already said no to import of genetically modified agricultural products, and it remains to be seen whether India will give US concessions in sensitive areas like agriculture and dairy. Sources say India has already conveyed to the United States that if the objective of reciprocal tariffs was to reduce the $45 billion trade deficit, then that would anyway be done by more energy purchases from the US. Official CNBC TV18 spoke to said that India is the only country that has signed a clear terms of reference for a trade deal with the US, and there have been extensive negotiations between officials of both countries. India's top trade negotiator, Rajesh Agarwal, is also in the US for talks to resolve any pending differences. Hopefully, we will see an announcement on an early trade deal before the 9th of July and the signing of a larger trade deal when Donald Trump visits India later this year.
Right, Parikshit. Many thanks for those details. Now, ratings agency Moody's says India is better positioned than many other emerging economies to deal with US tariffs and trade disruptions. Moody's said India's robust internal growth drivers, along with a sizable domestic economy and a low dependence on goods trade, can help it withstand the tariffs and the related disruptions. Moody's also sees room for rate cuts. The rating agency says easing inflation offers the potential for interest rate cuts to further support growth. Moving on to IPO corner, logistics firm Shiprocket is gearing up for its market debut. Sources have said that the company has filed confidential papers with market regulator SEBI. Shiprocket has plans to raise 2,000 to 2,500 crore rupees from its public issue. The IPO will also include a fresh sale of shares worth 1,000 to 1,200 crore rupees. Walmart-owned PhonePe is also gearing up to go public. The top brass at the fintech company spoke exclusively to CNBC TV18 and said this was the right time and India was the right market for the company to launch its initial public offer. PhonePe is also planning more diversification and is hoping to achieve profitability in the years to come.
I think directionally too, I think the company's at a stage where I feel like the core payments business, consumer and merchant combined, is at a stage of maturity and market leadership where we should, hopefully from here, remain sort of very, very stable and hopefully quite profitable in years to come. Conditioned well enough to say without setting any targets or goals. I think it's the right time. I think the business is in a good place, the org is in a good place, the sector is in a good place. Payments is still growing very rapidly. So if you're a market leader in a growth sector, I think it's a good time.
So Rahul, did the two of you sit and have a conversation about it makes sense to do it now, this is the right time, this is the moment, and we should go all in?
We did have a conversation. I think like Sameer mentioned, just given the current state of the org and the business, specifically on the core offering that is payments, given how exciting financial services and payments in India is, and the fact that we also have a few new businesses that we are diversifying into, we felt that this is the right time where the core business on the path to profitability, being able to actually nurture new businesses, is the right time to take PhonePe to the public markets.
To pay a hefty bill of 8,000 crore rupees to reverse flip and move back to India, I would imagine had its roots in this eventual decision, right?
Of course.
I think directionally, if the right answer for a business like ours is to list, then this is the right market. I mean, I think we're very proud of the fact that we are a household name or brand in the country today. It doesn't make sense to list anywhere else. So I think the reverse flipping was a precursor towards an eventual listing someday.
In terms of the opportunity to grow, what's the kind of headroom for growth that you see in each of these businesses? They're nascent today. What could they look like 5 years on?
We pride ourselves as is a platform that can be an intelligent distributor.
Okay.
So we've always tried to stay away from being a manufacturer as far as possible, but partner with the ecosystem in terms of being an intelligent distributor, which means let's not just be another lead generation platform,
right,
but let's be a platform that is clearly looking at what kind of problems can be solved by a particular partner for which kind of users, and make sure that we are able to actually surface those products at the right price to those consumers, so that we are actually value additive to both.
On that note, it is time for us to head into a short break. But coming up next, Supreme Court grants interim bail to Professor Ali Khan, who was arrested for a social media post on Operation Sindoor, but terms his post dog whistling and orders an SIT probe into the matter. Welcome back. You're still with us on Business 360. The Supreme Court granted interim bail to Ashok University Professor Ali Khan Mahmoodabad, who was arrested for a social media post on Operation Sindoor. However, the Apex Court termed his post as dog whistling and ordered a special investigation team to probe the matter. Ashmit Kumar joins us now with the details. Ashmit, take us through what the top court said.
Well, to begin with, Professor Mahmoodabad of the Ashok University, he made a comment post-Operation Sindoor on social media where he essentially questioned the efficacy of Operation Sindoor, questioned the impact that it was having on people living in border areas, families of the armed personnel, also questioned, in fact, brought in the question of attack on minorities. And these were questions that were part of his post, his social media post. And that's the reason why an FIR was registered. He was arrested. said. Now, the Supreme Court, as of today, there was a brief hearing. Kapil Sibal argued for the professor. And importantly, the Supreme Court at this point has seen it fit to grant interim relief in the form of bail. But that comes at a cost. The Supreme Court was extremely unhappy with the post that was put out in light of Operation Sindoor. In fact, the Supreme Court has said that it sees no ground for quashing or staying the investigations in any shape or form. Far from that, the Supreme Court has now has directed for an SIT to be constituted, which will in fact probe these questions that have been raised against Professor Mahmoodabad. In fact, the Supreme Court also questioned the timing of it all, saying that, is this the correct time to be gaining popularity? That's the word used. In fact, the Supreme Court went on to say that this was extremely, very unfortunate that such comments were made, that the language used in this post is very specifically designed to insult, to humiliate, that this is not the time that there should be a sense of duty, especially in a professor at Ashoka University, and then going on to say that this is something that perhaps was very ill-timed given the context of it all, and that Professor Mahmoodabad should have been more sensitive, should have been more kind to the other sentiments at this time. On the back of all of this, the Supreme Court seeing it fit to grant interim relief, but the investigation continues, and also the hearing in the highest court continues as well. The hearing is scheduled next week.
All right, Ashmit, thank you so much for those details. Now, moving on, the Maharashtra government has issued its long-awaited general resolution formalizing its policy for app-based transport aggregators. The new rules range from regulating surge pricing to imposing fines on drivers for cancellations. Santya Gora joins us now with the details. Santya, take us through the new rules.
See, it is a big news, especially for app-based cab users in Maharashtra. The state cabinet on Tuesday approved the long-awaited aggregators policy, and here's what it means for all of us. So fare calculation is one of the key aspects of the policy here. The government says fares must align with public transport, auto and taxi rates. Surge pricing and discounts have been capped. Discounts at a maximum of 25%, and surge pricing cannot exceed 1.5 times the base fare. The minimum fare must cover a distance of at least 3 kilometers. Now, cancellation penalties are a key feature of the policy as well. If a driver cancels a ride, the user will be refunded 10% of the fare or 100 rupees, whichever is lower. If a passenger cancels without a reason, they will also be fined 5% of the fare or 50% rupees, whichever is lower. The government has also addressed carpooling in this policy. Drivers can accept a maximum of only 14 carpool rides per week. To access this feature, users must submit proof of their office and residence addresses. For enhanced women's safety, women passengers will have the option of women-only carpool rides. The GR also mandates certain requirements for aggregators. They must have a registered office in Maharashtra and ensure GPS tracking of cabs, emergency contacts, and thorough background checks on drivers. Training and insurance are compulsory for the drivers, and the aggregators will have to provide insurance cover to both driver and passenger. Drivers must earn at least 80% of the fare. The policy also mandates a gradual transition to electric vehicles and the establishment of a robust complaint redressal system. Most of these guidelines actually are already in place and are being followed by aggregators. While some points in the GR remain open-ended and a little unclear, the government claims that once officially implemented, the policy will further streamline operations and ensure compliance from both service providers and users.
All right, Santya, many thanks for those details. And before we wrap up, writer Banu Mushtaq has scripted history. The 77-year-old became the first Kannada author and the second Indian to win the prestigious International Booker Prize for a short story anthology named Heart Lamp. This is the first time that a short story collection has won the International Booker Prize. Heart Lamp features 12 short stories written between 1990 and 2023 and captures the hardships of Muslim women living in southern India. Heart Lamp was translated from Kannada to English by Deepa Basti, who will share the prize with Banu Mushtaq.
Heart Lamp.
If I may borrow a phrase from my own culture, this moment feels like 1,000 fireflies lighting up a single sky, brief, brilliant, and utterly collective. To even stand among these extraordinary finalists is an honor to me. I will never forget, and I accept this great honor not as an individual, but as a voice raised in chorus with so many others.
And with that, it is a wrap on this edition of Business 360. More news and updates coming up on the other side. Stay tuned.
Let's talk money.
Hello and welcome to another edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Now, you've often heard us talk about investments, when to invest, where to invest, how to invest, and of course, what to invest in. But perhaps not enough time and thought is given to the question around exiting our investments. When and how should we exit the investments which have done their job for us in our portfolios? Well, that is exactly what we will focus on this week, setting up a framework for scientific and planned exit strategies. And this can also, of course, help us plan our retirement more effectively, among other things. Joining me to do that this week is Mrin Agrawal of FinSafe India. Mrin, thank you so much for joining in. Welcome to the show. And this is, I admit, this is a question that even I don't ask enough. So I thought it's an important conversation to have. Do you agree?
Absolutely, Surabhi.
So, I want to tell you about the genesis of this thought. I think when the market was, going through a correction, that is when a lot of people were wondering that, yes, of course, you keep buying in when the market is falling. But people also wonder that, okay, I've made a lot of profits since COVID. Should I be now booking some gains? So you tell us, what is the overarching principle when it comes to exiting investments and, taking that profit home?
All right. So, yes, we often talk only about investing, and very often I do see that people do not have an exit strategy in mind. So, three things that you have to keep in mind when do you exit a fund, right? First is, of course, if it is near to a goal. So, if you have done goal-based investing and you are nearing your goal, then, of course, you do need to look at exiting the fund. Second is if the fund is underperforming, right? Or if there is rebalancing required. So in a situation where, for example, one asset class has become, has had a higher allocation, let's say if equities has gone up a lot and you're having more equity than what you really need to have, that's when, these are the three reasons why you would need to basically exit your investments, right? So when we talk about each one of these three cases, right, when do you check for underperformance or when do you check for rebalancing? It has to be only once a year. And also, once when you check this performance, it's not like you see that the fund is underperforming for 1 year. So then you just look at exiting it. You'll still need to track the performance of the fund for a period of time. And you have to do the right tracking, right? It's not like just saying this X fund gave this much, my fund gave this much, so I'm exiting. No, you need to look at what is the performance of your fund versus the category average versus the benchmark, and then track it for a period of time. And the same thing goes for the rebalancing as well, right? I mean, it's not something that you would do on a 3-month basis. You would need to look at it on a yearly basis. And the last thing is on the basic framework, especially when you are near a financial goal. And we saw this in COVID. We saw this earlier this year, a couple of months back when the markets were down, that when people wanted to withdraw their money for their goal, if the markets are down, obviously your investment value is also going to be down. So to protect yourself against some of these situations, especially if you're exiting before a goal, one of the things that you do need to do is that at least a year before the goal, look at what is the value of the investment. If it is somewhere near to the goal value, look at protecting whatever part of that investment by moving it out into a safer instrument, right? So this is basic framework.
Okay, that's a great starting point. Helpful thoughts there. But Bryn, I want to go back to the basics, really, financial planning 101. And I sometimes wonder, because obviously planners tell us to, plan for specific goals. Take a holiday in 3 years, buy a car in the next, 4 years, or look at retirement in the next, say, 20 years. But at the same time, when we look at our portfolios, usually people have a bouquet of mutual funds, mid-cap, large cap, small cap, thematic, etc. In your experience, how do we marry the two? Have a certain set of funds which are for specific goals, but then you have an overall bouquet, which could be mid, large, small, thematic, defense, etc., passive, active. So how do you set for goals within an MF portfolio?
So there are various ways of doing it. Some people would just like to do it on an overall basis to say, I have this portfolio, and then I'll decide at the time of exit. I think the better way to always do it is to say, this is my goal. To this, I will tag these 3 or 4 investments or these 3 or 4 funds for this particular goal, because then it becomes easier for you to basically do the exit, right? Because then okay, if this is my goal and I need this money, these are the 3 funds I've tagged, and you just exit those particular funds. So I think it's basically what works for each individual, but I would seriously suggest tagging in specific funds for specific goals.
Yeah, absolutely, because that's what I was wondering. I mean, you might have a huge chunk of your money, let's say in large cap funds. Now, your goal might be a holiday, but you really want to exit, your entire position in that large cap fund for a holiday that could cost you, say, 2 lakh rupees. So, okay, so you're saying that, bucket it in individual goals and then list the specific funds to arrive at that goal. Got that point. Mrin, on the point of when you're nearing your goal, and you said you then need to start, exiting before you hit the date of the goal. So give us some examples of how this may work. Maybe medium-term goals, short-term goals, even long-term goals. So say the plan is to buy a car over the next 2 to 3 years. How would you plan for it, and when will you start the exit process?
See, as far as short-term goals are concerned, like 2 to 3 year goals, in any case, you would only look at debt funds in such cases. So there it becomes fairly simple. You can pretty much withdraw at the time of the goal itself, where the short-term goals are concerned. But when you actually have longer-term goals that you've planned for, let's say child's education and you need to pay college fees, right? So what I did this for myself as well, wherein a year before the college fees had to be paid, and whatever that amount was for the 4 years, right? So that was in any case what the goal value was. So what I did is that, whatever, like it was pretty close to the goal value. So I actually removed that entire money and I went and put it in a debt fund. Now that may not be the situation for everybody. You may be still far away from your goal value, right? So in which case, I think one of the things to do is that maybe start withdrawing money over tranches. But certainly, if you have invested in equities for a goal, I would not look at withdrawing at the time of the goal, because you don't know what the market is going to be like, right?
Yeah.
So I would just play cautious in this case rather than saying, no, I want to maximize my returns or I want to wait and increase my corpus, right?
Okay. Yeah, fair enough, because you don't know. I mean, when you're about to hit the goal, suddenly there might be a 10-15% drawdown as well. May not be in your favor. Got that point. So, this whole conversation on rebalancing, let's take COVID as an example, Mrin, because a lot of people who entered the market at that time managed to buy the dips. They've seen sizable appreciation in their wealth, right? And now they're looking at a market which is range bound, and sometimes you've had volatility on the downside. So now let's apply the exit framework here. Should they exit? Should they not exit? What would be the route? What should someone be doing if they're sitting on 5 years of gains since COVID in their mutual funds?
See, I would always say that, it's like where mutual funds are concerned, it's not handled like stocks, right? And the point is that, let's say you've had some great gains, but you'll still have a reinvestment risk, which is like, where do you go and invest the money, and at what rate is it going to grow, right? And this is what I always tell investors, like when people say that I invested in this fund, but it's not doing well, and there's some other fund doing well, or this whole conversation that was happening around gold as well, right? To say that gold is better than equities, so should I move my money to gold? And my question is, how do you know that this performance is going to sustain, and how do you know that gold is going to do better than equity, right? So when you look at data, and I found this really nice data actually available, wherein they have looked at various tenure periods, and they looked at buy versus hold versus doing profit booking at 20%, 30%. Yeah, and reinvesting. And actually, if you pick up any data, it's going to show you that buy and hold always works in the long term. So I am a great believer of goal-based investing. And I would say if your fund has done very good, well, that's great. Continue to hold it. I mean, why are you penalizing the fund by exiting it, right? So I would just say stick on to your investment. If it's done really well, continue to stick on with it till the period of your goal.
That's really reassuring to know that, this propensity to book profit and then to reinvest, find that dip again in the market, that is not necessarily the path to long-term wealth and prosperity. Buy and hold. And that's the easier thing to do as well, right, Prince? So I think that would work well for retail investors. Brings me now to the next question of rebalancing. So if you could just elaborate over here, what all entails in rebalancing? When you sit with your planners or your advisors, what are the questions that I should ask? And when do I need to rebalance my portfolio?
So once a year is enough. You don't need to do it more than that. And you can decide if you want to do it on a calendar year basis or if you want to do it on a financial year basis, whatever works for you. Now, the first thing that you need to consider is what is the asset allocation, and what is the deviation from the asset allocation, right? So you need to set an internal benchmark as to at what number or at what deviation percentage are you going to do that rebalancing on an annual basis. Now, I think that number of 15%, 20% is a good number. So what it means is that, let's say that you have 60% in equities and you have 40% in debt, and that 60% becomes 75%. So there's a 15% deviation basically. So you might decide that at a 15% deviation on an annual basis is when I'll start doing the rebalancing, which means I will get my equity back down to 60%. So that number of that deviation has to be decided by the investor. As I said, it could be 15, 20%, right? Now, what funds do you exit? Then what funds do you rebalance? So let's say you have a set of equity funds and you have to bring down your equity allocation. So the easiest one would be to look at the funds that are underperforming or where you have very, very small holdings. And this is very common, because people just tend to buy these NFOs, or I would say, unfavorable funds, like, for example, if you have thematic funds or sector funds that you might have just got into, or if there are small holdings, or if you're having a lot of duplicate funds. So, now in this era of ETF investing, very often you see people having 4 Nifty 50 ETFs, right? Which is duplication. So, these are the factors that you look at first, either underperforming funds, small holdings, duplicate funds or funds which shouldn't be in your portfolio, let's say like thematic or sector funds. Now, if you don't see any underperforming funds, for example, you've had a good year and you've bought all the right funds and nothing is underperforming, then you basically have to go and see that which category do I want to reduce? Do I want to reduce large, mid, or small cap? So basically, essentially based on your risk profile, what risk profile you want to maintain or what risk profile you want to be in, you keep those funds, and the ones that you reduce those. So this is about reducing. But when we come to increasing, because there's also increasing exposure in a fund, right? It could be the other way around, where equities have had a bad year and you want to increase exposure. So of course, over there, you want to ensure that you're well diversified and that you're not over allocated in one fund.
Absolutely, absolutely. Well said. But Marind, the tough part is to reduce allocation to a fund or to an asset class that's working very well. It could be mid-caps one year. It could be gold this year. And we're getting questions on this as well. If you could just take up the gold issue, a lot of portfolios, because we historically have gold holdings, there people might have gold coins and bars, and there's obviously the jewelry exposure. Then a lot of people have invested in sovereign gold bonds or gold funds and ETFs. But it's hard to reduce exposure when that asset class is still doing well. So specifically, when it comes to rebalancing, what would you advise on gold now, looking at the market?
See, if you're very, very overexposed and you're finding it difficult to reduce, let's face it, as a financial advisor, it's easy for me to come and say that reduce your exposure, right? But if you're finding it difficult to do it, I would just say, okay, stick on to it, but don't add more, certainly, because the bigger issue that people have is that when mid caps are doing well or when gold is doing well, they will go and add on more. So at least if you're not reducing it, don't add on more, certainly. And end of the day, somewhere you'll have to keep in mind the allocation, because see, when the markets are going up or when everything is looking very good, it's all good, right? But then when you have that fall is when you're going to have a big fall. So somewhere I would say that we'll have to think about these factors for sure.
Absolutely, absolutely. Got that point. We need to take a very quick break. But when we come back, we apply this whole exit framework to a long-term goal like retirement planning. How do you ensure that you start coming out of funds? Which are the funds to start exiting as you're approaching a landmark moment like retirement? Back with that in just a bit.
Let's talk money. Let's talk money.
Welcome back. You're with us on Let's Talk Money. And this week we're discussing exit strategies, how to exit your funds smartly so that you maximize the output. Now, Mrin, specifically, I want to talk to you about systematic withdrawal plans. How important are they when we are talking about exiting funds where we may not need the entire lump sum money upfront?
Yeah, so very interesting. I've seen that SWP or systematic withdrawal plan is something that's gained a lot of traction in the last 1 year. And I'm often asked about it as a route to creating wealth, right? So I would like to clarify a couple of things. SWP is a product where you basically want to take out money on a regular basis. So it is the opposite of the SIP where you're investing. Here, what you're doing is that you're trying to set up a regular cash flow. So it's a product for regular cash flows. Now, couple of things that you have to keep in mind in the SWP, right, is that, see, whenever you want regular cash flows, it has to be from a product which is growing at a stable rate and which has surety of returns, right? Now, I'm seeing a lot of people talking about setting up SWP from equity funds, which is a little concerning for the reason that equity funds can be extremely volatile. So, for example, let us say that you have some amount, let's say 1 crore, and you think of setting up an SWP, but then the markets fall by 10-15%, as we saw earlier this year. So everything is going to go out of whack, right? I mean, all your calculations and everything are not going to hold good, whatever you've done, right? Like if you started with 1 crore and you're removing some amount every month and the markets fall, your 1 crore is going to come down, let's say, to 85-90 lakhs. Obviously, all the calculations that you've done are going to change, right? So very, very important that, you need to get the reason for doing your SWP correct. That first, the SWP is meant to generate regular cash flows. It has to be done from an instrument which gives stable returns like debt funds and certainly not equity funds. And point number 3, the SWP also needs to be planned well. And I'll explain this through 2 examples, right? So
yeah, so Mrin, so I get your point. What you're saying is that don't do SWPs directly from equity funds because equity funds can be volatile. Let's take an example. Let's say that, someone is looking at regular income after retirement. Let's say they've got a corpus. They've got either a 1 crore or 2 crore corpus. How should they plan the exit via the SWP route then?
Yeah, so 2-3 things. See, now if you make an investment, let's say, into a debt fund, and you start the SWP right away, it's like you just getting your money back over a period of time, right? So I think first thing is that you should actually invest in a debt fund for, let's say, at least a 3-year period, and then start the SWP, because then you've built some amount of gains over the last 3 years, basically. So that's the first thing to be kept in mind. Second is you have, I think, some SWP calculators that are available online, but actually I would actually suggest that please plan this with a financial advisor because it's not that easy. I'll give you an example. Let's say that you start with a 2 crores corpus and you want to withdraw 1.5 lakhs per month. And I'm assuming return on investment at 5%. I'm looking at a post-tax return on like a short duration debt fund. Okay. So you've got a 2 crores corpus. You've put that money in a short duration debt fund and you want to withdraw 1.5 lakh rupees every month. If you do the cash flow calculation, this money is going to get over in 16 years. Right? Let us say you wanted to plan for the next 20 to 25 years. You're actually going to fall short because the money is only going to last 16 years. So there is another plan that you can do with the SWP, which is that you invest part of the money. So in the same example, you invest 1 crore and in the short duration debt fund and you start the SWP. Same way, 1.5 lakhs every month. It's going to last you for 7.5 years, right? Now, the balance 1 crore, you can invest into a balance fund for about 5 years, move that money into a short duration debt fund, and then start the SWP. So what happens with that is that then you are able to have the SWP running for about 19 to 20 years. And that way, you're able to meet your requirement of getting that amount on a monthly basis, because what you've done is that the first part of it, you've invested, you've ensured that you're getting your cash flow for 7 years. The balance amount you invested into another instrument to grow the corpus and then start the SWP on that, right?
So this is interesting. Basically, you're breaking this up. You're letting one part of that corpus continue to compound in an equity instrument, and you're remaining, the other half of that corpus is being put in a debt instrument, which is more stable, and then you do a systematic withdrawal plan from the debt portion of it. Got that? That makes a lot of sense. Mrin, we are trying to just squeeze in some viewer queries here as well. If you can, quickly answer these. Because viewers have been writing in saying they have some doubts on mutual funds. So I want to take this query that's coming up on coming from Sam on Instagram. He's saying, what is the difference between value, growth and momentum funds? And how should I look at their composition in my portfolio? Do I need to rebalance? Do I need to add them? What should I do? Mrin, new fund categories, many of them on the passive side.
Yeah. So the value funds are funds which invest in stocks, which are basically trading, below their true value, basically, and they're expected to essentially grow in the long term, but they're undervalued at this point in time. Growth stocks are, of course, from sectors that are expected to grow well over a period of time and give you sustainable growth. And momentum investing is all about investing in what is basically trending, right? So in a very, very simple way. Now, what should be the allocation of each of these categories in your portfolio is totally dependent upon the risk that you want to take. Certainly momentum, followed by growth, followed by value. That is your high risk to lower risk. So if you want to take a very high risk, if you're able to take high risk, then you could have a higher amount in momentum. If you don't want to take high risk, if you want to be more conservative, you could do value funds. It's all dependent upon what is the sort of risk that you want to have in the portfolio, basically.
Okay, absolutely. So that, I guess, is the golden rule for rebalancing. First, assess your own risk profile, your own requirements and your goals, and then look at your portfolio. So final thoughts, Mrin. I mean, this is a very helpful conversation. So just recap this for us in a nutshell. Exit strategies and the question of exit via an SWP versus lump sum exits. Just what should be a holistic framework to follow?
Okay, so first and foremost, look at exiting only if you're close to a goal or if you're looking at doing rebalancing. That's point number one. Secondly, lump sum versus SWP. So lump sum, of course, you can withdraw and then you can design like whatever sort of strategy you want for your withdrawals. But there does exist a systematic withdrawal plan, which is actually a very good feature that's there in mutual funds to get regular cash flows. But point number one, always, I would say, of course, do it in a debt fund because equities are really, really volatile. And secondly, plan it well. Use the SWP calculators online to figure out as to how long the money would last based upon what is the sort of withdrawals that you're doing. And as I said, if it's really not tying in with your time frame, then see how you can work with a financial planner or get someone to basically design it out for you.
Okay, all right, Mrin. Thank you very much for joining in. Sometimes, something that sounds so logical and commonsensical escapes our mind. So it's important to discuss it and put it out there for everyone's reference. Thanks very much for joining in and sharing your thoughts with us. Well, folks, that's a wrap on this edition of Let's Talk Money. Hope you found this conversation useful, simple and systematic, not just when it comes to your investments, but when it comes to your exits as well. Keep sending us your feedback, comments and queries. We'll see you with another conversation next week.
Let's Talk Money.
Hello and welcome to News Centre with me, Parikshit Luthra. India's all-party parliamentary delegation comprising of 7 teams and 45 MPs, along with former diplomats, have left for foreign nations in an attempt to expose Pakistan's role in sponsoring terror attacks against India. Delegations will visit 32 nations to engage with foreign leaders and think tanks. The MPs are expected to highlight the impact of the Pahalgam attack, which left 26 people dead, and India's Operation Sindoor targeting terror infrastructure in Pakistan with precision strikes. The United States urged both India and Pakistan to exercise restraint. US President Donald Trump claimed credit for the ceasefire announcement, but Foreign Secretary Vikram Misri told lawmakers that US had no role to play in the cessation of hostilities between both nations. The ceasefire is holding for now, but what next? And should the US play any role in the conflict when India has dismissed any third-party intervention? Joining me now to discuss all of this and much more is former US National Security Advisor John Bolton. He served in the first Trump administration for a period of 18 months as NSA. Mr. Bolton, thank you very much for joining us here on CNBC TV18. What has the India-Pakistan conflict, which began on the 7th of May, shown in terms of India's response to Pakistan-sponsored terror?
Well, I think there's no doubt that India has an inherent right to individual and collective self-defense under Article 51 of the UN Charter, which it exercised. It did a few days ago. It did in 2019 when I was National Security Advisor. And I think it's important that India always show that this was a terrorist attack emanating from bases on foreign soil, Pakistani in both cases, to justify what it's doing. But that right, I think, is pretty clear. The question then obviously is what happens if Pakistan decides to up the ante, which happened again both in 2019 and this year, and to underline that this is a solution. There has to be a solution to this problem of Pakistan not controlling these terrorist forces on its own territory. I think that's sort of the most important place to start. But there are a number of other issues, particularly raised by this year's attack, notably the role apparently played by Chinese-supplied fighter planes to the Pakistani Air Force. 5th-generation fighters, it appears, and what that means to the bigger picture of strategic stability on the subcontinent and really globally.
Right. India's military response via Operation Sindoor included targeting terror camps in Pakistan, which were the hub and command and control centers of terror outfits like the Lashkar-e-Toiba and the Jaish-e-Mohammed. Do you think India has sent out a strong message and was able to eliminate the ability of these terror camps to carry out attacks on India?
Well, certainly the response was much more vigorous than in 2019, and perhaps that is the result. I think the fact that, at least as we understand from publicly available information, it was the Pakistani military that ultimately contacted its Indian counterparts to say, let's bring this clash to a halt, let's have a ceasefire. So it took a little bit longer than it did in 2019. I think people were concerned it might escalate even further, but it did come to a stop, and I think that's important. But I think from India's point of view, certainly the Pakistani response in the intervening 6 years has not been sufficient, that these terrorist groups are still able to attack and recover from whatever damage was inflicted on them. I've certainly argued, as have other people, that this support for terrorist groups, if you want to look at it that way, or at least acquiescence in terrorist groups operating from Pakistani territory, is not good for Pakistan itself. It's not the world's most stable government, even though in Pakistan they call the military the steel skeleton. It's still at risk of falling to terrorist groups inside Pakistan, which would be bad for that country and bad for the neighboring countries too. So these issues have been there for a long time. It obviously means they're difficult to resolve, but this latest incident proves anything. It's that this cycle needs to be stopped at an earlier point, and that every country has a responsibility to control its own sovereign territory and prevent these kinds of terrorist assaults on its neighbors.
India has said that the progression towards Operation Sindoor began on the 22nd of April when Pakistan-sponsored terror attacks took place and there were civilians who were killed in Pahalgam. The attack involved religion-based segregation, which has been recounted by the victims themselves. What does this show about the intention of the resistance force and Pakistan's role in this?
Yeah, I mean, this obviously has been a continuing source of difficulty, and India has felt the blow of terrorist attacks, not just in Kashmir, but at its own parliament building. So like the United States, which has also suffered attacks from radical terrorists in Southwest Asia, this is a problem that we simply cannot live with, and it's why India's responses clearly constitute legitimate self-defense. I just say I think it's important to get the kinds of information that you've just described, get it out into the world press, make sure that the case that India can make, should make, is important to provide legitimacy for the steps it takes militarily. And I think it's something that the United States government should spend more of its time talking to Pakistan about. We've obviously had a long and complex relationship given the war in Afghanistan. But even the fact that under the Trump plan and the Biden administration withdrew American forces from Afghanistan, this continued threat of terrorist attack out of Pakistan, stemming, many people believe correctly, from elements within the Pakistani military, is not something that can go on for a long period of time. This is the sort of thing that indicates that the influence of China in Pakistan, which is growing, unfortunately, is hardly beneficial to peace and security in the region.
Right. Ambassador Bolton, what we were really shocked by was how US President Donald Trump took credit for a ceasefire even hours before the Indian government could announce that it has had any conversation with US on it. In fact, there is a lot of discomfort within the Indian government that President Trump said that he mediated for the ceasefire to happen. What do you make of all of this?
Well, I wouldn't take it personally in the sense this is Donald Trump at work. This is what he does with friend and adversary alike. He likes to be the center of attention, and one way he can be the center of attention is that he announces that he was the center of the solution. It's not something I think most Americans experienced in national security affairs think is helpful, and indeed I think it can sow misunderstanding. But it wasn't particularly directed against India. He's done it, as I say, to friend and foe alike. So I think in future discussions, it's worth getting the ground rules straight with President Trump at the beginning. I think the fact he made a call, that Vice President Vance and Secretary of State Rubio made calls trying to be helpful was a good thing. I don't want to discourage it, but I think he needs to understand how sensitive this is on both sides, and that in some cases, what goes on quietly out of the spotlight is a lot more important than what happens in the glare of the spotlights.
Do you also think that President Trump has gone ahead to hyphenate India and Pakistan together, as he said that he's spoken to India and Pakistan and told both of them that if they want to continue trade with the US, then they need to stop fighting? President Trump also remarked that he is going to do a lot more trade deals with Pakistan. Do you think that statement by President Trump was insensitive to the Indian government, which is a close ally of the United States?
Well, I think it shows he doesn't know much about the history here. And to him, the part of the problem with Trump is that a trade is about all he thinks about, unless forced to think about other things. There's no doubt in any country's foreign affairs agenda, trade is important, but it's important for the economic well-being of the countries themselves. There's no way you can underestimate it. But in the big picture, it's one of several things competing for attention, and we found in efforts to advance the Asian Security Quad in Trump's first term, the idea of Shinzo Abe to have India, Japan, Australia, and the United States cooperate more closely, that we were lucky to get any strategic discussion in at all, and the meetings tended to degenerate. There weren't, I think, but two, but they tended to become trade meetings almost immediately. And I think, look, I think Prime Minister has a very good personal relationship with Trump, and that, in Trump's mind, is critical. He sees most of international affairs through the prism of whether he has a good personal relationship with his counterpart in another state. So the prime minister's built up a significant asset there, and it would be worth using that to try and explain to Trump a little bit more of the complexity of what's involved here and the legitimate sensitivities.
Can we still trust President Trump, is the question.
Sure, but what you can trust is he will look for the most publicity he can get out of almost anything. And I was saying you should try and establish ground rules. Don't necessarily have complete faith he'll follow them once you set them. But in this kind of affair, we know that what really triggered the ceasefire was a communication from the Pakistani military to their counterparts on the Indian side. That's the kind of thing done without public attention, and sometimes that can be extremely important. And if the effort at a ceasefire is diverted by public statements by one country concerned about the outcome, it can wreck an awful lot of work that's been done behind closed doors.
Just to speak about China, you've referred to China earlier. What role do you think China played in this conflict between India and Pakistan, and what is the big worry?
Well, I think the biggest news about China out of what just happened is the presence of sophisticated Chinese fighter planes on the Pakistani side. And there's some disagreement about exactly what they did, but a lot of stories about how effective this, what we believe is probably a fifth generation prototype of Chinese fighter planes. And the accompanying information in the public domain that Pakistan may be buying as much as 80% of its sophisticated weapon systems from China, a real reversal from decades ago when much of it was bought from the United States. So I view these indications of increased Chinese influence over Pakistan, particularly on the aerospace and defense side, is very, very troubling. And I think that is something that obviously should be troubling to India as well, given the geography that you face with the shared border with Pakistan on the west of the country, and given what we know about China's hegemonic aspirations all around its periphery. So I think that is something that we need to give some very careful thought to.
All right, just shifting for the moment away from the India-Pakistan conflict, Trump has said that he now favors direct talks with Iran and how they are very close to a nuclear deal with the nation as well. Where does this leave US's traditional ally, Israel?
Well, I don't think they're close to a deal. I think this is salesmanship at work. If they are close to a deal, it would be a duplicate of the 2015 Obama nuclear deal, which was unsatisfactory and Trump was right to withdraw from back in 2018. So my guess is in Steve Witkoff, the president's personal envoy, you have somebody who knows nothing about nuclear weapons, nothing about Iran. I think the Iranians are just out maneuvering him. And my guess is that they're really not that close to a deal at all.
Moving on, Donald Trump has announced cessation of sanctions against Syria during his Gulf tour. He also recognized Syria's new ruler, Ahmad al-Shara. What kind of message does this really send out to U.S. allies?
Well, I think he did it at the instance of Saudi Arabia, which has a grave concern about the potential expansion of Turkey's influence in northern Syria and in the Middle East as a whole, given the Erdogan regime's neo-Ottomanist imperial ambitions. So I could see why the Saudis wanted it, and I think that's an interest the U.S. shares. But Trump made a mistake in lifting the sanctions before he got more indications of performance from Ahmad al-Shara, as you say, the new Syrian leader. He can trim his beard and he can take off his combat fatigues and put on a coat and tie, and he can abandon his nom de guerre and pick up what he says is his real name. That's all well and good public relations, but I would like to see action to show that he's no longer really the al-Nusra Front, the al-Qaeda affiliate in Syria, that he wants to turn the page on terrorism. And there are a number of practical things he could do. Release all the archives and information from the Assad regime about American hostages, all foreign hostages really, that the Assad regime took. Completely open their archives and facilities to international inspection on Assad's chemical and biological weapons programs. and make full disclosure of everything the Assad regime did with Iran during the Assad period in power, including the building of the nuclear reactor Deir el-Zor, a reactor being built by North Koreans, financed by Iran, obviously part of the Iranian nuclear weapons program. That, to me, real concrete action, as opposed to just talk, is what you need to lift the sanctions.
My final question now, what is the biggest threat for India going forward, considering China and Turkey's support for Pakistan?
Well, look, Pakistan is the immediate, imminent threat given the actions of the past few weeks. I think it's really, though, China that's the bigger threat. And I think one course of study in the near term here is the difference between Pakistan's reaction in 2019 and 2025, the growth of Chinese influence. In other words, this is not simply the material contribution China has made to Pakistan's military, but is this an indication of much greater political influence as well? Because I think that would indicate a very serious problem. It would take the Pakistan issue to a much higher, more dangerous level if the Chinese influence is really responsible.
All right. Thank you very much, Ambassador Bolton, for joining us for that very important all-comprehensive interview on the India-Pakistan conflict and a preview into Donald Trump's foreign policy as well. Time for a short break, but coming up on the other side, it's the third and final day of Commerce Minister Piyush Goyal's visit to the United States as both nations aim to finalize a trade deal. A special discussion with Jayant Dasgupta, former Indian ambassador to the WTO, when we're back. Welcome back. You're watching News Center. It's the third and final day of Commerce Minister Piyush Goyal's visit to the US as both nations aim to finalize a trade deal. Goyal has held meetings with Commerce Secretary Howard Lutnick and US Trade Representative Jamieson Greer. Both nations are hoping for an early harvest deal, and India is aiming for a total exemption from the additional 26% tariff. Abhimanyu Sharma is here with the details. Abhimanyu, what are you picking up?
Well, the Commerce and Industry Minister has already met the U.S. Commerce Secretary and the U.S. Trade Representative. He's likely to meet other top officials in the United States again. Now, apart from the first tranche of a bilateral trade agreement, which both the nations are looking to sign by the fall of this year, that is by October 2025, they are also looking to sign an interim deal before the 9th of July, when the reciprocal tariffs and the pause on that is going to end. So, India, of course, is looking to seal an interim deal, an interim agreement before the 9th of July with the US to avert any applicability of reciprocal tariffs from the American side. Also, speaking of several exports and imports as far as the demands are concerned, the US is seeking to export several agricultural products. However, India is likely to keep a minimum import price and also import quotas to protect its interests in sensitive sectors like agriculture and dairy. Apart from that, India is reluctant to allow any import of GM crops, of genetically modified crops from the United States, particularly alfalfa hay. However, India is open to allowing non-GM crops, but that, of course, would require a significant and explicit approval from the American side in form of a certification that a certain crop is not genetically modified. So that, of course, would entail due certification from both the sides. And as far as the interim deal, the interim deal is concerned, before the first tranche itself, not just goods, but even digital services and non-tariff barriers are likely to be a part of the entire mix. So clearly, India is looking to avert the impact of reciprocal tariffs, and government officials had also pointed out that given the recent trade data which was released a few days back, it can be witnessed that India has already started benefiting from the applicability of differential tariffs across countries. So the government remains positive about sealing an interim deal with the United States before the 9th of July.
All right, so optimism in the air as far as the Indo-US trade deal goes. Thanks, Abhimanyu, for joining us. To take this forward, I'm now joined by Jayant Dasgupta, former Indian ambassador to the WTO. Ambassador Dasgupta, there seems to be some amount of optimism that we will have an early trade deal. But do you feel the US will grant India a full exemption? Because this is the word that we're waiting for from the United States.
I think the US will come down from its perch of 26%. But whether it will restore the pre-Trump tariffs, that I'm not very sure about. So what I expect is that for the 90-day period, only 10% tariffs are in place. So maybe these tariffs will get reduced, but they will not come down to the pre-Trump tariff regime. So that is one thing. The other aspect is that India has now, I think, changed its stance and has said that it would like to have a three-stage deal with the US. The first one would be, of course, the interim deal before the 8th of July. The second one by about October 2025, when 19 other sectors will come in. And the third one, very importantly, will need US congressional approval. And that is something which President Trump will need if he is to reduce his tariffs from the pre-Trump levels, because that needs congressional approval.
Right. Ambassador Dasgupta, what we'd like to ask you is that India, for the moment, we hear, wants 0-for-0 tariffs. The Trump administration is keen to keep tariffs at 10% on Indian goods. If that were the scenario, would the interim deal be beneficial for us?
There are several factors which will have a bearing on this. The first one is what will be the tariffs on China and Vietnam and other competitors who also export more or less the same products that India does. Pharmaceuticals, textiles and clothing, leather, other low technology products which India specializes in, gems and jewelry, for instance, engineering goods. Now, if those tariffs are not going to come down for China, Vietnam, and the others, then even 10% will be an advantageous thing for India. But should they also come down to 10%? Yes?
Yeah, Ambassador Dasko, one more quick question that I wanted to ask you before we let you go. This is about agriculture. We believe that US is not just satisfied with reduction on tariffs on goods and services. They want entry for agriculture and dairy as well. India has already said no when it comes to genetically modified crops. But do you think we will be able to give US the kind of concessions they want on agriculture and dairy? This is a big demand. They want an all-encompassing trade deal.
On dairy, I think we will not allow the common products of dairy to come in. It will be the sophisticated kinds of cheese and other things which do not have a very large market in India. And also the certification, the sanitary certification that the milk which has been produced by the cattle, they have not been fed on animal, entrails, etc. So that is one thing. On the issue of GM, I think non-GM also, if they certify, we can allow. But for corn, soya, and a few other things, the tariff barriers will still be in place, or we may give a TRQ, which is a tariff rate quota, a lower tariff, substantially lower tariff for a limited quantity of products to be exported from the US.
Okay, thank you so much, Ambassador Dasgupta, for joining us on the program, putting the Indo-US trade negotiations in perspective. And we believe that there are one-on-one meetings and one-on-one dinner meetings also taking place between Piyush Goyal and his counterparts in the United States. With that, it's a wrap on this edition of News Center. More news and updates continue right here.
Welcome to Ingenomics. Next week, the MOSPI, or the Ministry of Statistics, will announce the fourth quarter and the full year GDP for last year, FY24-25. The CNBC TV18 poll shows that the GDP for the fourth quarter grew by 6.8%, much stronger than the 6.2 in Q3, 5.6 in Q2, and 6.5 in Q1. GVA growth, gross value added growth, will be more modest at 6.5%, or 6.2 Q3, 5.8 in Q2, and 6.5 in Q1. For the full year, our poll, that is for the current year, our poll threw up a GDP growth of 6.3% only. that is the FY25 poll, compared to Mosby's estimate of 6.5. We are still speaking FY24-25. And last year, of course, FY24, it was a solid 9.2%. Now coming to the current year, FY25-26, our poll threw up a number of, again, 6.3%. This compares with the Reserve Bank's forecast of 6.5%. Now, let's go back to FY25. If FY25, the numbers are way below even our poll's estimate of 6.3%, that can move the Reserve Bank to cut rates a little more aggressively. So the Q4 numbers are important for the upcoming Reserve Bank policy. It's the last data Reserve Bank gets before it goes into policy. Hence, to understand more as to what to expect, I have with me an elite panel of economists: Kaushik Das, the chief economist at Deutsche Bank; Aurodeep Nandi, the economist from Nomura India; and Anubhuti Sahai of Standard Chartered India. Gentlemen and Anubhuti, thank you very much for your time. Kaushik, well, the first question will be, we had a terrible shocker in the second quarter when we saw 5.6%. 6.8 is very respectable. Can you stand by that number? Have we seen enough evidence for such a strong growth?
Good morning, Lata. Our forecasts are exactly what you have just talked about, that our real GVA growth is around 6.5 for January, March of 25, and the real GDP growth is 6.8. As you mentioned, that this is coming from 6.2 in October, December, and the shocker that we got 5.6. Whatever I've seen in the leading indicators, I think we will get some sequential improvement in real GVA, which is more easily understandable, and probably show some improvement. Now the GDP calculation is more tricky because it brings in this element of calculating net taxes, subsidies. And what I just calculated and saw is that subsidies were down in January, February by about 34%, and January, March, my estimate is subsidies will be down minus 40%. So it is possible that you could get a little bit of improvement in the real GVA to 6.5, but my guess is that your real GDP growth could be even higher than 6.8, probably higher than 7% if these subsidies remain negative. If you remember that the CSO's implicit estimate for January, March GDP growth is 7.6, and that's why they've given that 6.5% average growth for FY25. We are at 6.3 because we have 6.8% for real GDP growth. I will stand by that, but I think the risk is more to the upside than the downside.
Oh, that's good news. I will come to what the Reserve Bank will make of it. But it is important to remember that the Mosby's subtraction, if you subtracted from their full year number, we did get a 7.6 for the Q4. So the upside surprise is possible. But Aurodeep, you do a heat map. I remember it was very popular with us during COVID. Now, the crop figures for the first count didn't sound very good, if I remember right. So can there be that kind of disappointment, agriculture or something?
Well, Lata, on the supply side, I think it's going to be better news because Rabi crop production has been good, so agri GVA growth should be fine. However, industrial growth, I think, is going to be weaker. We see this also in the IIP numbers, and services we expect should be better. The heat map that you refer to, if you in fact look at how consumption indicators have done this quarter on a year-on-year basis, it's actually moderated. We do a coincident activity indicator growth, and I mean, we are expecting that there should be moderation in private consumption, possibly moderation also in investments and exports. However, imports, the negative part of it, is likely to be higher, so more negative numbers, so the GDP growth number picks up. Also, the point which Kaushik mentioned is really important, which is the sort of GDP's GVA plus net indirect taxes. So the improvement in GVA it's incremental, 6.2 to 6.5%, and then you have also this arithmetic component that boosts up
GDP. Yeah. Okay, so are you also saying that an upside surprise to 6.8 is possible?
I mean, our baseline number is 6.7%. Again, there is a lot of volatility in the way GDP numbers come out. So, that could be the case. But overall, I mean, I would be focusing more on the components of growth. And there, if consumption is weakening and investments is weakening, I think that's the story to look at.
Okay, got that. I agree with you on this volatility of numbers. Anubhuti, to you, two questions. One, the GST numbers were still quite strong, so indicating that consumption should not disappoint. What are your thoughts on what might boost the GDP? And I think the more important worry for all of us is whether previous numbers will be recast. Any light you want to throw on whether they will upgrade Q2 numbers, which was the big disappointment? Any such expectations or fears?
Sure, Lata. So I think on consumption part, the first question which you put forth, I think, if we go by the broader set of indicators, we have a composite indicator and it tracks the non-agri and non-GVA growth, GDP growth pretty well. And it has stayed absolutely flattish vis-a-vis where it was in the December quarter. So there is no uptick to say so. Even if you look at, say, retail digital payments, which RBI gives, and club it with cash, cash transaction or ATM withdrawals by retail, it has actually decelerated. So it was averaging at close to 20% for the first 3 quarters of FY25. And in the last quarter of FY25, it has actually dropped all the way down to 14%. So I really don't see possibility of consumption actually surprising on the upside. It might be actually lower, and that would...
No, I agree with you on at least two-wheelers. I clearly remember Jan, Feb, our analysts were grumbling about two-wheeler sales not being good. So, okay, so you worry that Q4 consumption may be lower. Is your overall number therefore lower?
Yes, it is lower, Lata. So, based on what even Aurodeep mentioned, so consumption, if we go by on-the-ground indicators, doesn't show an uptick. Investment, yes, government started spending, but would it have been a massive increase? I doubt. So our GDP forecast is at 6.5% for the last quarter, and GVA is 6.2. But the GVA is also getting a lot of support in our view from agri. Last March, agri growth was just at 0%. So there is a favorable base effect, and a modest uptick in output can also make it look better. On your second question, I really don't know how the growth numbers would get revised for the last 3 quarters. There have been massive revisions, but it's highly possible that we might see an upgrade in the second quarter, GVA as well as GDP number, because usually in the past, if you look at analyst forecast, the first print of GDP and then, the subsequent revisions, I think then the error margin reduces. It was a shocker, so it's possible that we might see an upgrade there. And therefore, the growth rate across the year might look far more uniform than what we think at this point in time.
Okay. I will come back to the revisions to both of you in a minute. But I think the more important point is the upcoming policy. Kaushik, are there any likely downside surprises or shocks that might propel the Reserve Bank to be even more dovish? At the moment, they have a lot of support from the inflation numbers. For the full year, it is expected to be under 4%, so they have that confidence. But if growth doesn't need a crutch, you don't need to cut so much. So do you think there can be any shockers, any inputs from the GDP numbers for Reserve Bank?
So, Lata, optically, suppose you get a number like 7.5% on GDP, which says CSO is implicitly, showing in their forecast. Obviously, that will make markets a bit cautious about the fact that, is growth that kind of, on a slowdown path that people had thought. And then people will also think about FY26, given that there's been a reversal of tariff for China. Generally, the mood is becoming, more positive than what it was. So all these things can happen, but we also got an inflation number which is pretty low, and it'll remain like that. So if you think about RBI in the June policy, they will have to reduce their inflation forecast from 4% to, our current forecast is 3.5. I don't know whether RBI goes that low, but they definitely have to lower their forecast. GDP, I think, will not touch at this point of time, just having revised from 6.7 to 6.5. But on the margin, you're still revising inflation lower. and the fact that you've turned accommodative in April. So suddenly in June, if you come and pause and you say that for whatever reason you're not doing a rate cut, that will be more confusing, particularly because you've turned accommodative. So I have a call for June 25 basis rate cut. But the fact that RBI, in your own calculations, which I read very carefully, and it was a nice analysis of the dividend that RBI is expected to pay, I think it'll be a big number, and you'll have an effective easing of another 25 basis points through the liquidity channel. So in June, probably you'll get almost 50 basis points rate cut, 25 through the repo rate and 25 through liquidity. So that's why I have a forecast of August, RBI remaining on a pause and not doing anything. And then if required, then in October, they'll go for another last 25 basis points rate cut, bringing it to 5.5 repo rate. And I've written in my report that RBI probably will not go below 5.5, because even at 5.5 repo rate, your short-term rates fall to 5.25. That's good enough. One pointer, Lata, if I may just add to this debate about the GDP growth, which can inform your discussion as well. Sure. In 2019 calendar year, when Governor Das had started cutting rates from 650, they had brought it down to 515 by the end of 2019. You'll see that year, the calendar year growth average was 4.7% real GDP. This time we are talking about, even if growth slows down and say it goes to 6%, it is still 130 basis points higher than that below 5% growth. Why should then the repo rate go down to 515 when your growth rate is between 6 to 6.5%? So that's why we think the terminal repo rate should be 550, and the short-term rates can come down a little bit more because of the liquidity that RBI will be infusing through the dividend and what they have already done through the OMO channels.
Okay. Well, I want to come back to the policy discussion, but let me quickly get one future angle in as well, which is the current quarter. Aurodeep, of all the numbers, I find yours more pessimistic. Your, or rather, maybe realistic, who knows. Your forecast is 6%, and for the full year, you all stand at 5.8. Now, I would assume these are the global headwinds. But we've got this China rate cuts coming in. We've got, as Kaushik pointed out, huge liquidity infusion by Reserve Bank, as if what is already available is not enough. Today, the call rate is not where the repo rate is. It is at 5.75. It is already a 25 basis cut as far as the call rate is concerned. So would you want to upgrade, or do you still think that there are chances of a slowdown in the current year?
So first thing, Lata, global growth is one of the factors. The other factor is that urban consumption has been weak. It's not like we are seeing great income growth happening. And let's not forget, there's household balance sheet stress that is still there in the system. Also, private capex hasn't really recovered, and in a place where there's so much uncertainty both on the domestic and the global side, there is a big question of how much that capex recovery will happen this year. So the fact that we are below consensus is not just because of global growth, but because also of domestic factors. That said, you're absolutely right. Policy has turned counter-cyclical. Also, rural consumption doing better. There is the whole China plus one shift of supply chain to India. So there are positives, no doubt. But things like rate cuts, things like excess liquidity in the system, these will take time to transmit for credit growth to eventually pick up. So probably in the second half of the year, we will see that play through. But overall, we still remain bearish at 5.8%.
Okay, so the Reserve Bank will watch out for all that. I have to take a quick commercial break, but I need Anubhuti and Aurodeep's views as well on what the Reserve Bank might do with this GDP numbers, as well on other nuances that we have to watch out from the May 30th data. Back in a minute. Welcome back to Indianomics. I'm in conversation with Aurodeep Nandi of Nomura, Kaushik Das of Deutsche Bank, and Anubhuti Sahai of Standard Chartered Bank, all of them top-notch economists, and we are preparing ourselves for the GDP numbers, the fourth quarter and the full year GDP numbers for FY 24-25 that are going to be announced on May 30th. Anubhuti and gentlemen, thank you very much for your time. Anubhuti, I just wanted your word also, because your growth numbers for the fourth quarter are weaker than consensus. You are standing at 6.5, as you just defended. Do you expect that there is a chance that if there is a negative surprise, the Reserve Bank can push to 5 quarter?
I think, Lata, I mean, probably we will have to wait a little bit more before we start penciling in a 5-quarter kind of repo rate just as of now. At this point in time, I think terminal rate of 5.5% looks pretty good. There is definitely a lot more room when you are simply focused on inflation. There is a lot more room to cut if you are focused on the global uncertainties. But if we have to go towards 5-quarter or 5%, I think the trigger has to come from GDP growth numbers over the next few quarters. And there are viewers that while the current momentum has not been good, there can be few offsetting factors which can make FY26 look not as bad as what we are anticipating at this point in time. True, there is global uncertainty, but at the same time, as you mentioned earlier, policy has turned counter-cyclical. 100 basis points of rate cut immediately gives a saving of 0.3% of GDP to whoever has borrowed. And I'm only talking about the retail borrowers. I'm not talking at a economy level. The tax cut, which probably has faded away from our memory, that's another 0.3% of saving in the hands of consumer. It might not translate on a one-on-one basis in terms of increased consumption, but it definitely protects and defines a floor when it comes to GDP growth numbers. So our sense is, unless GDP growth for FY26 starts showing signs of slipping below 6%, till that point in time, 5.5% looks like a decent repo rate to bottom out at, especially given the very aggressive stance which RBI has taken on liquidity infusion.
Okay. Now, I polled a dozen economists, all top-notch. So my sense is no one gave me that bearish a number. The only 5.8 we got from Nomura was for the full year, but otherwise we haven't got a sub-6 number. So perhaps the Reserve Bank's hand need not be pulled. But Kaushik, what is your sense about any further informal sector data and therefore that colouring the GDP numbers? Because now the MOSPI is much better equipped. You've got monthly PLFS numbers and you have got this unincorporated as-used number. So do you think that can anyway impact positively or negatively the GDP number?
So Lata, first of all, we are not very negative on GDP growth relative to our peers.
Yes.
So we have 6.5% growth, and one thing which I should...
1 minute. You have 6.5 for the current year?
For FY26, yes.
Okay, you stand with the Reserve Bank there. Okay.
And remember, RBI reduced the growth forecast from 6.7 at a time when there was peak negativity about global tariff. And since then, a lot has changed, and there's been a reversal. IMF also cut the global growth from 3.3 to 2.8 when there was peak negativity. Now, a lot of people are considering whether growth can be higher in China from the peak negativity that we have seen, or in US. All these discussions are taking place. So it is possible that maybe RBI wouldn't have cut from 6.7 to 6.5 if the reversal had already happened. So we are comfortable at 6.5. To your question, informal sector data obviously makes the data set more robust. Normally, the data have been revised higher after incorporating all the broader set of data from the provisional data. So I would think that going forward, there could be a bias of revising up the forecast of the previous quarters as well. Also, one thing you should remember that April to September, the government will be spending their 11 trillion capex in the normal trend like each year, compared to last year, April, September, where they could not do much because of elections and then heavy monsoon. There'll be a big year-on-year bump on government spending related growth in April, September. Plus, what Anubhuti said, I think it's very good news for the consumers that inflation has come off. Tax rates have been cut, so real disposable income has increased. Monsoon is supposed to be above normal, so that's good for rural growth. And RBI has flushed the system with liquidity for allowing transmission to happen. Also, the bigger medium-term story is that India is cutting tariff rates in a big way, not just with UK, they'll cut with US, with Europe, New Zealand. So that's very good news for the consumers because inflation comes down in India over the medium term because of the tariff rate cuts. And that's like extra, additional savings with them, which they can spend going forward. So I would not be very negative on India's growth at this stage, given the reversals that have happened with the tariff. India probably will manage 6.5% growth this year and next year as well. But the only thing is that India's potential growth rate is probably 7% or higher. So relative to that, we are still on the lower side. And that's why we think RBI can probably come down to, 550, 100 basis points rate cut becomes meaningful to allow transmission to happen. But nothing more than that, because the deeper you cut and then if you see inflation or growth going up after a few quarters, market will pressurize RBI to reverse those rate cuts if you go very deep in the rate cut cycle, which then creates a problem for RBI because once you finish the rate cut cycle, you would want to wait for 1 year or 15 months before you start the rate hike cycle. So I think 550 is an appropriate terminal rate, but after June, I anticipate a pause in August, because you'll already get a 50 basis points rate cut through liquidity in repo, and then probably in October, the last rate cut.
Yeah, well, I have to rush to wind this down. Although all points taken about, the liquidity flush and the tax cuts and what Anubhuti and Kaushik are pointing out, but, there is uncertainty. Investment comes only when there's certainty. And that certainty has been very rudely shaken. Even after the reciprocal tariffs have now become more rational at 30%, I don't know how much investment will happen. And even the government's capex faltered. When you started looking at December, January, they were not, January, for instance, was not as good, although there was no election to pin it on. So therefore, do you think that, investment, just give us an idea of what you're expecting in terms of consumption growth and GFCF, that is gross fixed capital formation, anything that you want to train our eyes for the May 30th numbers?
If it's about FY26, then we expect consumption growth to weaken. Yes, there are positives, but we also need to consider that even things like rural consumption. Yes, it's picking up, but if you look at the rural indicators, you've got two-wheelers doing badly and some other tractors doing better. So it's not even the rural recovery is uneven, and our own analysis on rural terms of trade has been that it's going up, but it's going up and down also in that trend. You're absolutely right on the investment side of things. Even with tariffs possibly lower, there's still a lot of uncertainty. There's a lot of uncertainty on what kind of tariffs India will negotiate with the US, what the US will negotiate with China. If that is dramatically low, then will the China plus one model still hold? So I think there are a lot of ifs and buts. And in such a scenario, in the absence of strong domestic demand, it is natural that private capex sort of takes a backseat. A lot of focus will again remain on government investment trying to drive the engine. So maybe for investment, we are expecting it to sort of pick up this year compared to last year, which was really bad, as Kaushik mentioned. But I think overall, because consumption is on the weaker side, because global growth could be weaker, because of higher uncertainty, we are on the bearish side on growth.
Fair point. Actually, there are enough factors to be bearish, to be fair, that even urban consumption was stagnating. There were several indicators. And, uncertainty always means that the businessman will not open his purse. But there are positives in terms of defense, actually, as a propeller. In the past, we've always seen post-war-like scenario, there is a kind of an investment cycle pickup. So we could see some positives from that very unfortunate event as well. Let's see what May 30th throws up for us in terms of trends in Q4 and all of FY25. Thank you very much, Kaushik, Anudeep and Anubhuti for participating in this conversation. That's it on this edition of Indianomics. Thanks for watching.
It's funny when
Hello and welcome to Startup Street. I'm Arundhati Ramanan, and with me from the Bangalore studio is Ritu Singh. These are the top headlines from the startup world. Shiprocket files for an IPO with SEBI. Sources have confirmed to CNBC TV18 the IPO is likely to include both a fresh issue and an offer for sale, aiming to raise around 2,500 crore rupees. Proceeds from the IPO will go toward product development, tech upgrades, acquisitions, and expanding logistics and warehousing.
It's the right time. I think the business is in a good place, the org is in a good place, the sector is in a good place.
This is the right time to list, and India is the right market, says the top management at Walmart-owned fintech company PhonePe. Promises more diversification and profitability in the years to come. That's an exclusive. Movin' an integrated enterprise commute platform, acquires EFMFM, an enterprise transport technology company. Following this deal, Movin', which is already a profitable company, will see greater capacities to scale and add 50 additional global clients to its already existing roster of 400 clients. Former Snapdeal executive Jason Kothari has raised $15 million in a seed funding round for his new startup MyThing. Shah Rukh Khan's family office, Patni family office, and others have invested in the tech-first entertainment company. Elon Musk commits to leading Tesla for the next 5 years, but says he wants more control of the company, similar to Larry Page and Sergey Brin at Google and Zuckerberg at Facebook. Also promises to spend less on political donations after spending over $250 million to help the Trump campaign. That's a CNBC exclusive. On what's brewing today, Movin', an employee transport platform, has made its first strategic acquisition, bringing EFMFM under its wing. The deal boosts Movin''s client count by 50, taking the total to over 400, and makes it the first company to move more than 1 million employees daily. With over 100,000 vehicles now on its platform, this acquisition signals bigger ambitions, more innovation, more scale, and possibly more deals ahead. Joining us now to discuss this further is Deepesh Agarwal, the CEO and co-founder of Movin'. Deepesh, thank you so much for taking time out and being here with us on Startup Street. You know, let's start by you taking us through the deal contours. How much did you buy EFMFM for? And can you walk us through the strategic reasons behind choosing EFMFM for your first acquisition? What made them the right fit at this point for Movin'?
Thanks, Arundhati, and pleasure to be on the show. I think as a company, Movin' has been focused on safe and sustainable employee commute. Before acquisition of EFMFM, we already ferry 8 lakh employees in this country, and we do have presence outside the country. I think our acquisition of EFMFM, we've been sort of, I would also say that as a startup, doing your first acquisition is a interesting thing. It does take a lot of thought, energy. So we wanted to get it right. And I think apart from things like boosting client roster and revenues, I think what's very important is the ethos of the company match. And I think we've certainly been able to strike a right balance between all the 3 components which I spoke about in this mix. And that was the reason of acquiring EFMFM.
Right. And you know, what specific synergies do you expect to unlock through this acquisition? And how do you plan to sort of integrate the 2 platforms? And what will this mean for existing customers as well as the team at EFMFM?
Sure. So, Arundhati, I think one of the things which we've seen in India, and maybe I'll broadly speak about sectors like retail, hotel industry, construction. I think India is a growing economy, and with growing economy, it's normal to see unorganized sectors becoming organized. And when companies like us try to organize, I think we do find niche players. And in this case, it was EFMFM, which we found as a niche player, as a part of our strategy going forward, where we are trying to organize and see like-minded players. So I think that is the reason. And maybe going forward, while it's early to say, I think we will certainly be continuing on this journey of acquisitions going forward. Now, let's break down the question. In terms of the EFMFM clients, I think because what they bring to the table, I think passion for customers is what they've been, they really have been focused on. We're very proud to have their customers, some of them like Genpact, EXL, Shell on our rosters to sort of learn from them. So we will continue to serve them, hopefully from the offerings which we have now. They will have a broader set of offerings to choose from. And I think there are certainly very interesting things in the innovation quotient which EFM has done, which I think we will benefit to learning. In terms of their employees, we are certainly very committed. It has been a very lean and thin team, but we are very committed, and we've already onboarded them from different offices and included them in the Movin Sync team.
Sure, absolutely. So if you could then quickly take us through the kind of demand that Movin Sync currently has. And, you know, like you mentioned, with this acquisition, you also hope to add about 50 global clients onto your roster, right? So can you also quantify how much this will contribute to Movin Sync's top line in the coming fiscal year?
So Movin Sync as a company does the primary business is split into two segments. Both are employee commute related businesses, and as I mentioned earlier, we will now be touching 1 million employees in this country every day whom we ferry, which will be 20% of the IT BPO workforce in this country. So I think to your question of what will be the revenue contribution, I would say we are looking at a boost of around 10% of our revenues by this acquisition is what we look at. But I think hopefully when we do synergies, I think adding some of these global clients on our rosters will also open up opportunities for not just India, but outside India as well.
Right. So looking at opportunities outside India as well. So does this mean that the acquisition sort of is just the beginning of a broader M&A strategy for Movin Sync? What's the inorganic growth roadmap? Are you looking at other companies? What's the plan on this front?
I think we remain very cautious but very hopeful, and I think that's what we've always seen, and generally from our board members in the board meetings, as I've heard this line that doing acquisitions is the easy part. Integrating them into your DNA, making sure they are successful is the difficult part. And I think as a student, I've myself read about the acquisition strategies and how to integrate them. So I think we've been very cautious with this first integration and very hopeful. But as you hinted, we do feel that there is a certain value as we keep growing and becoming one of the largest players and increasing. I think inorganic and acquisitions do seem like a good playbook, I must say.
And, before I let you go, what's the broader growth outlook for Movin Sync over the next 2 to 3 years? Are you looking at new markets, global ones perhaps? What about, other segments that you're planning to tap into?
Sure. I think the new markets which we recently tapped into, which are similar like India, are countries which provide commute to their employees. While they're not as big as India, but interesting markets have certainly been Philippines, South Africa for us. Recently, we signed up clients in Egypt. So those are some of the interesting markets. Otherwise, Arundhati, what we've seen very interesting in India, which is also an interesting segment aligning with the impetus on manufacturing, has been the manufacturing segment. I think a lot of firms these days are opening up large units, and I think some of the global ones we see as in Foxconn, a lot of automobile manufacturers, and the Indian ones like Tata, etc., are putting their weight behind it. So I think that's a segment where we're seeing a lot of growth, and most of these units do happen to be outside of the city, and hence employee commute becomes an important need. So I think both globalization and within India also some of these newer segments are two important areas which we will focus on in the future.
All right, Dipesh, thank you so much for taking time out and being here with us on Startup Street, and we wish you all the best going forward.
Thank you so much. Pleasure to be here.
Moving on, news just coming in. IndusInd Bank has reported a 2,328 crore rupee loss in the fourth quarter. This after lapses in its derivative accounting came to light. The bank has also reported another suspected fraud of 173 crore rupees in its microfinance business. The management is addressing a conference call. Let's cut across live.
Again, the board has also taken a very serious view with respect of staff accountability across levels to reinforce the governance and compliance culture, and is in the process of taking actions for staff accountability. Number two, additional rigorous review. In addition, in light of the derivative accounting issue, the board has also worked with the management and the statutory auditors to undertake an enhanced and much more rigorous review as part of finalizing the financials, including thorough reviews by the internal audit department of the bank. As part of this exercise, the bank has identified the following significant matters which have been appropriately accounted for in the financials for Q4 24, financial year 24-25. Number one, microfinance portfolio. The reviews identified that over the first 3 quarters of financial year 24-25, there was incorrect recording interest income and fee income. The review has also identified the misclassification of certain microfinance loans which have resulted in under-provisioning and non-recognition of NPAs aggregating rupees 1,885 crores. The bank has addressed the underlying cause and is in the process of taking actions for staff accountability. Other matters. As part of the review, it was also noted that there were certain unsubstantiated balance in other assets and other liabilities accounts of the bank, and that an amount approximately of rupees 760 crore has been incorrectly classified as interest income instead of other income. Based on review of all these matters and reports received by the board suspects the occurrence of fraud against the bank and the involvement therein of certain employees, having a significant role in the accounting and financial reporting of the bank. Accordingly, the bank has directed necessary steps to be taken under applicable law, including reporting to regulatory authorities and investigative agencies, and to also fix accountability of all persons responsible for these lapses. The financial impact absorbed in Q4 financials in FY 24-25. The financial impact of all the above has been fully taken in the audited financial statements of the bank for the financial year 2024-25. The bank's approach towards financials has been to start FY 25-26 on a clean slate without carrying forward any of the past issues. The bank has thoroughly reviewed all the lines of accounting and has taken a conservative view in some of the accounting treatments. This has reflected in a few one-offs versus the business as usual run rate, which we shall delve deeper in subsequent sections. The bank's balance sheet remains healthy after absorbing all these changes with a capital adequacy ratio of 16.24%. I repeat, capital adequacy ratio of 16.24%, a provision coverage ratio of 70%, and an average liquidity coverage ratio of 118%, with an excess liquidity of rupees 39,600 crores. The liquidity remains comfortable in current quarter as well, with an average LCR of 139% in the first half of this quarter. I would now refer to the leadership transition. Following the findings of external review announced on 27th of April 2025, the bank's CEO and Deputy CEO had resigned from their respective roles thereafter. The RBI has advised the bank to submit proposals for appointment of the new CEO for RBI's approval by 30th June 2025. The board is at an advanced stage in the selection process and is confident that the recommendations will be submitted to the RBI in advance of the timeline prescribed. This will provide strong leadership and management stability at the bank. The board is determined to identify and expeditiously induct strong leadership with right competencies, strong ethics, and the ability to build and scale a robust franchise. In the interim, and as approved by the RBI, the Committee of Executives, which is Anil Rao and Sumitra Sen, is entrusted to oversee the operations of the bank. The Committee of Executives is guided by an oversight committee of the board comprising of the chairpersons of the board, the Risk Management Committee, the Compensation and Nomination Committee, and the Audit Committee of the board. The board of directors and the management team is committed to ensure a smooth transition. I would now like to reinforce the ethos of governance while executing the growth strategy from here on. The board is working with the management to bring in a cultural shift towards achieving high standards of ethics and governance. We want to build an environment of open and honest communication with all the stakeholders, prioritizing long-term sustainability over short-term achievements. Compliance with extant regulations in form as well as spirit is non-negotiable. A one bank vision, breaking the silos by laying a strong foundation, would ensure avoiding repetition of such episodes, providing uninterrupted execution on the bank's strategic growth objectives. I will now hand over to Soumitra Sen to take you through the highlights on individual businesses. Soumitra, over to you.
Yeah. Thank you, Chairman. Let me start with the vehicle finance, one of the business pillars of the bank. Our vehicle loan book at rupees 95,595 crores grew at 8% YOY and 2% quarter-on-quarter. The disbursements for quarter 4 was 12,273 crores, which was 3% YOY growth. Full year disbursements were at a whopping 47,600 crores. The industry volumes across categories have grown by single digit during the year. We have maintained stable market share across key categories of commercial vehicle, construction equipment, and passenger cars. We also consolidated our position in tractors as we reinforced our processes and credit underwriting. The asset quality trends have been improving since quarter 3. After the first half, which was slightly weak, the sequential improvement in gross slippages continued in quarter 4 as well. It was 0.74 last quarter, and it's 0.70 in quarter 4. All the vehicles segments except tractors saw a sequentially stable and improved gross slippages. We are refrained from selling NPAs to ARC during this quarter, and we focused on our own collection drives. This, however, optically increases the GNPA ratios. The restructured book in the vehicle finance continues to show a reduction. We started the year with 547, and now it's 119 at the end of financial year 25. And majority of this reduction has come from upgrades and recoveries. Looking ahead, improving fiscal spends, benign oil prices, falling interest rates, monsoon being absolutely fine, I think we should be supporting the recovery in the industry volumes. Let me now get into Bharat Financial. The outstanding loan book is now 38,169 crores. It's down 2% quarter-on-quarter, but 15% and YOY. The microfinance business showed signs of stabilization in quarter 4. The disbursements were up 1.4% quarter-on-quarter. We followed a very cautious approach for disbursements with 94% of disbursements in quarter 4 with the branches with low flows from the current areas and to customers and centers with high vintage with us. We have implemented the MFIN guardrails effective from April 1, 2025. This restricts disbursements to customers with not more than 3 lenders. With large customer base unique to us and our conservative ceiling on clients' overall exposure, the impact of the business has been limited so far. We have disclosed early trends in the delinquency buckets, and they have improved in both stock as well as fresh flows of delinquencies. Now let me give you a brief of the Karnataka situation. It's improving, and the current book net of the collection efficiency in Karnataka has improved from 96.4% in February 25 to 98.2% in March 25. As a result, the 31 to 90 days past due reduced to 2.3 in March 25, down from 4.1% in December 24. We have also disclosed trend in all standard overdue customers, that's 0 DPD to GNPA, which is heading back to normalcy. The slippages were elevated during the quarter due to the accumulated stress in the earlier quarters and misclassification of certain loan accounts, which was corrected in Q4. Now, Bharat Superstore, that's the merchant acquiring business under the BFIL banner. We have now 664,000 merchants under this program. The book is 7,260 crores, growing at 30% year-on-year. The share of non-MFI book has improved to 19% from 12% year-on-year. The total liabilities through BFIL now stands at 2,680 crores, up 3% quarter-on-quarter, and it has 19 million accounts. Overall, the portfolio stress witnessed last year is waning. As we see the portfolio quality improving in most states, we are cautiously focusing on disbursements in select geographies amongst clients with higher vintage. With the implementation of MFIN guidelines, further strengthening of controls, the Karnataka operations steadily getting back to normalcy, our focus is to ensure disbursement quality, dedicated efforts on collection and recovery, and continued diversification of the loan book. Now, let me brief you about the corporate bank. During the quarter, we let go some of the corporate loans for balance sheet management and liquidity managements. Consequently, our corporate loan book has come down by 16% quarter-on-quarter and 6% YOY. This was only a tactical decision, keeping in mind the short-term objectives of the bank. The overall strategy of scaling up granular and small corporates with selective exposure to large corporate continues to be implemented. The proportion of A+ and above rated customers at 77% has been steady YOY. Slight decline quarter-on-quarter versus 79% of last quarter. But as we go in for some high-rated loans, the weighted average rating was 2.57 versus 2.51 year-on-year. Now, let me brief you about the diamond business. It continues to show healthy growth, the asset quality with no SMA1 and SMA2. While growth is subdued due to weak industry demand, we are liaising with the stakeholders for suitable terms in bilateral trade discussions. We are closely monitoring the developments and are comfortable with the exposures as of now. The gross slippages in the corporate book, which were at 204 crores, mainly contributed by one restructured real estate amount accounting to 140 crores. The full gross slippages for corporate book improved from 44% to 0.44% to versus 0.54% year-on-year. The corporate restructured book also has now reduced to 147 crores from the 583 crores at the start of the year. Our SMA1 and SMA2 book collectively stands at 24 bips versus 20 bips quarter-on-quarter. Overall, while we have consolidated our corporate book during the quarter, we have resumed our disbursements selectively in focus areas, and growth in corporate bank should start reflecting in the coming quarters. Now, let's talk about the other retail assets. Our other retail assets maintained growth momentum with 17% YOY.
All right, so that was the management of IndusInd Bank addressing analysts after their fourth quarter much delayed earnings. We have the executive committee addressing the analysts in this con call. Keep in mind, IndusInd Bank has reported a loss of 2,328.9 crores compared to a profit of 2,349 crores in the same quarter last year. This is almost the first time in nearly 2 decades that IndusInd Bank has reported a quarterly loss on account of the discrepancies that have come to light. Importantly, the management says that they want to start FY26 with a clean slate, which means all of the discrepancies that had come to light, whether that was the derivatives hit of nearly 2,000 crores, the incorrect accounting of interest and fee income, the MFI hit, All of that has been factored into these fourth quarter and FY25 earnings overall, and the intention is to start with a clean slate. Of course, with all the extra provisions that are being made and the reversals that are being done and the hit that has been taken, the bank has reported a loss. There was also a degrowth in the corporate loan book. Gross NPAs have also inched up to 3.13%. But let me quickly bring in Prakash Diwan, who is with us, market expert. Prakash, thanks very much for staying with us. Quick thoughts on the numbers that you've seen. Is it as bad or worse than what you had feared?
So, Ritu, I think the numbers look bad because they seem to be bundled up in these yearly earnings, balance sheet. What's happened is you had piecemeal basis news flow around derivative losses, wrong accounting of interest income, and even the MFI portfolio. All of that probably put together seems to be resulting into this yawning gap on the P&L where they've got this 2,300 crore loss. So, and I'm sure the effective loss would be closer to about 3,000 crores plus. And that's why you see minus 2,300 at the year-end numbers. So the numbers don't seem out of place, won't surprise anybody, but it's the nature of, the announcement that makes it look very big. It's definitely disappointing. And what the bank is talking about, why they've done it, this seems like an attempt at kitchen sinking and saying, okay, we'll clean up things, start afresh. That seems to be the intent. But of course, the numbers are massively startling, when you add up all of those things that have led to this loss.
Okay, we also have Ashutosh Mishra, banking analyst, who's joining us now. Ashutosh, quickly, your take on the numbers before we cut back to that press conference and the fact that the board has decided to call these discrepancies a fraud. What are the implications of that, and do you expect any further hit beyond what has been disclosed?
Because if you look at the latest disclosure by the board, they clearly say that there will be further investigation, and if there will be further investigation, then there will be probability of few more losses coming in. Okay, so that's where I see that the only we will be reliably look at the things once the new management takes place of the bank. And in the call they are indicating that they are sending to the RBI very soon the three names, and post that probably investor will able to make the mind over whether everything is behind or not. If we take the example of previously as a Yes Bank out there, what we have seen that over the period of time, few more discrepancies come in even after first level of cleaning up. So in my view, we need to wait for one more quarter before making clearly announcing that everything has been accounted for.
All right, Ashutosh and Prakash, thank you very much for joining in. Unfortunately, that's all the time we had. But IndusInd Bank reporting a loss larger than what the street was anticipating. And as we heard from some of the experts as well, perhaps the fear on the street still remains that the worst is still not behind. This could be a kitchen-sinking quarter, but there could be more skeletons that tumble out of the closet. Importantly, the management, the board rather, also reiterating that RBI has given them a deadline of the end of June to submit proposals for the new CEO names, but they're hopeful of doing it before that deadline. So that is one major overhang that remains for IndusInd Bank for now, reporting a huge loss larger than what the street was expecting on account of identifying these discrepancies as a fraud, although the bank continues to say that their balance sheet is healthy with a total capital adequacy ratio of over 16% and a provision coverage ratio of 70%. Gross NPAs inching up to 3.13% and net NPAs at 0.95%. That was the IndusInd Bank earnings. We'll get you more details, but for now, we have to slip into a short break. We'll see you on the other side.
Sholay. I've seen it many times on the big screen, but I want to see it again, and probably Mughal-e-Azam as well. Pass. I'd say probably Andaz Apna. यार ये मैं आंसर करूंगा तो प्रॉब्लम हो जाएगा.
What have you got up your sleeve?
Well, we've got The Anarchy, which is a TV series adaptation of William Dalrymple's epic saga on the history of the East India Company. It really is a story that has to be told with that epic scope and scale, the way that the Game of Thrones or The Crown have been told.
So have talks begun with the Netflixes and the HBOs of the world?
Talks have just begun.
What are we talking about in terms of resources that you require to be able to put something like ballpark?
The per episode costs for shows like Game of Thrones and The Crown range anywhere from 8 million to 20 million an episode.
Now you believe that India's been poised to have its crossover or breakout moment, just as we've seen with the Parasite and so on and so forth. Why has it been so elusive?
Because we've been victims of our own success in a way that traditionally India has never really had to reach out to the world.
What's exciting you about the stuff that you're seeing being made today?
A show like Kohra, for example, right? It's very local, very rooted. But I think the beats of the way that the story unfolds is told in a very international way.
Are you also seeing a diversity from where these scripts are coming in?
I think the number of people from the smaller towns, I'd say even sometimes from villages, who reach out to us with, even if it's a concept note, it might not be a full screenplay, is quite significant.
What was the one that surprised you? What was the one that you were absolutely sure of?
Barfi was one which was the most difficult to pin down, but you knew it at a visceral level, you reacted to the material. Chennai Express actually was another film where, you know, there was a full narration that happened with a group of 20 people, and we were laughing our off and like falling off our chairs.
What was the casting call that you made that kind of worked out the way that you had imagined it to?
I think probably Dangal. And at that time, of course, Irfan, he was someone we had in mind. He would have done a wonderful job. But then I got a call from Amir at that time. Many other stars of his stature might not have been okay with playing an overweight wrestler who's like a bit of a has-been, who's living out his dreams through his daughters.
Hello and welcome to another edition of Young Turks Reloaded. I'm Shireen Bhan. The Indian media, entertainment and film business is poised for the next big wave of disruption. After a wave of corporatization and consolidation, industry is now grappling with a booming OTT market, a rising live entertainment economy and a film business that's yet to fully recover from COVID and the onslaught of video streaming. Today, we roll out the red carpet for a man who spent a good part of the last 2 decades mastering the art of storytelling, from delivering box office hits like Dangal and Chennai Express to producing game-changing series like Rocket Boys. He's now ready with his next big project. Siddharth Roy Kapoor, welcome to the Young Turks podcast. Thanks very much for joining us on the program.
Thanks so much for having me.
So let's start with the big reveal. What have you got up your sleeves?
Well, we've got The Anarchy, which is a TV series adaptation of William Dalrymple's epic saga on the history of the East India Company. It's one of those books that you just can't put down.
Yeah.
And when I first heard that William was working on this book, I actually found out about it a few months before it was going to be published. So I reached out to him immediately. He was kind enough to give me a manuscript. And I read through it, just chugged through it in one sitting, and realized that this was. Buff? I am a huge history buff. I am, and it's just
William Dalrymple cannot be done in a day.
Well, it was one of those things which just sucks you in because I've always been very interested by the history of colonialism and of course the Mughal rule, like sort of before that, and the way William writes, he writes with such drama, and the way he treats his characters, he just makes them live and breathe. And so I reached out to him instantly after that and told him I'd love to take on the rights. And, after a bit of back and forth, because he wanted to know what the vision was.
Yeah.
And we realized that we had exactly the same vision.
So
which
what
is
was
about,
the vision that you painted for him?
Well, the vision really is about how contemporary the subject really is. I mean, we talk about these global corporations which are larger than most nation states, being in multiple countries and having the ability to actually influence the world. Here's where it actually happened 500 years ago, where you had a global corporation with its own private army coming and taking over a subcontinent that was 25% of the GDP of the world at that time. And, you've got delicious characters in there, from Robert Clive to the Mughals, to the Dutch, to the French, to the Portuguese, to the Jagat Seths, the moneylenders. So it really is a story that has to be told with that epic scope and scale, the way that the Game of Thrones or the Crown have been told. And I think I've always had the ambition of being able to take our content and reach out to the world with it. And this is a story that we should be telling ourselves.
So this is going to be mounted for a global audience.
This is going to be mounted for a global audience.
And you've managed to bag a big name to do that for you.
So we've got Stephen Frears coming on board. I used to watch films like High Fidelity and Dangerous Liaison when I was, in college. And to imagine that the director of those epics is now going to be actually helming the anarchy is just...
And how did that come about?
Well, our partners Whip, actually, which is a US production company, they've made shows like Mayor of Easttown and Dickinson. Paul Lee, who runs Whip, was running ABC when I was at Disney and running India. And we stayed in touch for a long time. And then he started Whip and I started Roy Kapoor Films. And we were chatting about what we could do together. And when I told him about these rights, he said, wow, that's something I'd love to collaborate on.
Right.
So we got together, and through Paul and through Whip, we were able to reach out to Stephen. And he knows William, incidentally.
Okay.
And that helped. And he'd heard of the book, he read it and loved it, and that's how he came on board.
So when do we finally see this being converted into reality on screen?
Well, we're ready with our materials now. We're ready with the writing, and I think the next stage really is to figure out the right home for it, so the right platform. That's a process that's ongoing right
So
now.
how do you pick the right home for something that you're producing? I mean, give us an example in the context of this with the anarchy. How do you find the right home?
I think the platform that can actually give you the resources to tell the story in the way it should be told, and that gives you the global reach to be able to reach out to everyone who you believe the story will resonate with, would be the right platform. And I think, you can literally count them on one hand, maybe two. There are 5 or 6 platforms around the world that have the resources and have the ability to be able to give you that reach.
So have talks begun with the Netflixes and the HBOs of the world?
Talks have just begun. A little too early to sort of get into details around that, but it is exciting.
I would imagine that exciting. But, again, just break this down for our audience. Like, from the time that you actually decide that, okay, this is a script that you want to actually convert into something that goes to screen, to reaching out to a platform that could potentially house this, what are we talking about in terms of timelines? And then finally, the eventual execution.
It takes time. These massive projects take a long time, because what happens is that you need to find the right creative team to start with, the right writers, the right director. You then go through various iterations around drafts of scripts and pilots and Bibles. Then you find something that, okay, fine, this is something that we now all have bought into. We love what we've put down on paper, and that's when you take it to a platform. From that point onwards, it's really about getting the right platform on board, and then you start your pre-production. So the process can usually take anything from 3 to 5 years.
3 to 5 years, which also means that you have to have deep pockets to be able to sustain yourself for 3 to 5 years.
Well, if that's all you're doing, then yes. Thankfully, you do continue with life as usual while you've got these big projects that you're hatching.
Yeah.
So the good part is that you're making films and series and doing all that, good stuff, while keeping your eye on the prize, which is, large projects like this.
But, for a large project like this, with a global ambition and a global aspiration mounted to that scale, what are we talking about in terms of resources that you require to be able to put something down? Ballpark?
Well, the per episode costs for shows like Game of Thrones and The Crown range anywhere from 8 million to 20 million an episode. I heard the budgets of the latest Yellowstone, series were actually $20 million an episode. So you're talking significant funds. As I said, there are a limited number of global platforms that can actually have the ability to fund you in that manner, and those are the ones that you talk to.
And, link this back to what's happening in India when you're delivering for an OTT platform here in India. What do the costs? I mean, they're clearly nowhere in the vicinity of what we just talked about. But what are we talking about?
Well, in India, the budgets are pretty different. So I think you're talking anywhere from, if it's a show that's really quick and easy and like more intimate and a more controlled setting, it could be anywhere from 50 lakhs to 1 crore per episode. But if it's something larger and at scale, then it could go up to 4 or 5 crores an episode.
This global aspiration that you spoke of, and this has been something that you've been rooting for a long time now. You believe that India's been poised to have its crossover or breakout moment, just as we've seen with The Parasite and so on and so forth. Why has it been so elusive? What makes you believe that we're finally there?
So it's been so elusive probably because we've been victims of our own success in a way, because we have such a large captive market of our own that traditionally India has never really had to reach out to the world.
Right.
You've had the Indian audience and you have the diaspora audience that accounts for millions and millions of people wanting to watch the stuff that you're producing.
Yeah.
And so unlike Italian cinema or French cinema or German cinema, which has had to find new markets, we haven't had to do that. But I think the time has come now where you have a whole generation of filmmakers who've been schooled in an international style of storytelling, but who are still rooted and want to tell stories from their own country. And I think that actually gives you the ability now to really believe that you can reach out to the rest of the world. But I feel the more rooted your stories and the more local your stories, but with a global style of storytelling, those are the ones most likely to succeed.
So what's exciting you about the stuff that you're seeing being made today that gives you the hope and the belief and the confidence that we are ready to make that inflection?
With a lot of the stuff that we're making, especially on streaming platforms today, I think, you've seen stuff that is being told with a pretty global sensibility. I'd just give you a few examples, like a show like Kohra, for example, right? It's very local, very rooted, but I think the beats of the way that the story unfolds is told in a very international way, right? So I think it's about finding local stories and finding internationally appealing ways and global ways to be able to tell it.
When you look at a story, you look at a script, what draws you? What's the first thing that draws you to a story or to a script that kind of tells you in your gut that this is something that you want to take forward, this is something that you want to make? Which have been some of the examples where something's jumped up at you and it's been a success, but also where it hasn't and it's gone on to surprise you?
So the first thing is I react as an audience, right? I react as just someone who enjoys movies or enjoys shows or, just like a viewer. And so when I read something and I feel like, oh, wow, this is something that I would really want to watch, that's the first thing that really has to stand out from me.
And how many scripts do you get in a week?
Oh, we get a whole lot. I mean, we have a team that really, their only job is to sift through the material that comes in. I'd say anywhere from 10 to 15 scripts a week, probably, if not more.
Are you also seeing a diversity from where these scripts are coming in? I'll ask you this in the context of a conversation that I had with the founders of an audio streaming service. And they said that they're getting stories coming in from the interiors of UP, from Chhattisgarh, and those are the ones that are actually turning out to be their big blockbuster hits. What are you experiencing?
The same thing.
Really?
The same thing, which is very heartening. I think the number of people from the smaller, the smaller towns, I'd say even sometimes from villages, who reach out to us with, even if it's a concept note, it might not be a full screenplay, is quite significant. And we have a website and we have an email link that helps people to be able to just send us their material. And that, I think, has shown us the diversity in terms of the places from which we've been getting that content.
So what was the one that surprised you? What was the one that you were absolutely sure of and it delivered on that expectation?
I think probably Barfi was one which was the most difficult to pin down, but you knew it at a visceral level, you reacted to the material. Because, Anurag Basu has this amazing ability to be able to conjure up a world without really putting that much down on paper.
Yeah.
So he actually talked us through what he had in mind as far as the film was concerned. And he didn't have a complete screenplay, but just the characters and the world he was able to sort of envision and what more important than envision, actually communicate, just blew us away. So that was one of those leaps of faith that I'm so glad we took. Because it could have been very easy to say, yeah, just come back to us with a final screenplay and then we look at it. But it was one of those films where we said, no, we've made Metro together. We'd made Life in a Metro before that. And we had the confidence in him to be able to take that forward. Chennai Express actually was another film where, there was a full narration that happened with a group of 20 people, and we were laughing off and like falling off our chairs. And it was just, one of those films which you know that if this is executed in the right way, it's going to be a rip-roaring success.
It's interesting that you talked about the fact that it was a narration, it wasn't even a full screenplay or perhaps not even a finalized script. And I remember watching, I can't remember who it was, but these film stars saying that, when they actually, and this is like maybe 20 years ago, or even 15 years ago, saying that scripts were actually being written on set, dialogues were being handed over to you before you actually got onto set. How much of that process at the back end has changed, especially with corporatization and so on and so forth?
That's changed very significantly. Yeah. Today you have, fully completed screenplays with dialogues ready well in advance before you go into prep. Actors expect it, the HODs expect it, everyone expects it, and more importantly, those funding the film expect it, and rightly so. But you do need to leave a certain amount of flexibility for creativity to strike, right? So I think it's important while a scene is being played out, if, the writers on set or the writers called in, and there might be certain things that the actors and the director feel they want to play out differently. You always need to leave that
for some spontaneity.
But that can only happen when you're really well planned.
Yeah.
Because that room for spontaneity needs to be still within a controlled budget, within, a certain number of days of shoot. And that, I think, is important to leave space for.
So as a producer, what's the stuff that you sweat today? What's the small stuff that you let go? What's the stuff that you sweat today?
I think budgets, obviously, is something that everyone looks at very closely, and you should look at very closely as a producer. The script is something that you should really, really look at very, very closely, because you need to be completely convinced about every line that's in there. Either you get convinced or you're able to convince, but one way or the other, the entire team associated with the project needs to be on the same page. The casting is something the producer needs to be very, very closely involved with.
How involved are you personally with the casting?
I'm pretty involved with the casting. Having been around as long as I have, having the relationships one does, it's important to be able to pick on, pick up the phone on the people that you want to be able to cast and give them a feeling of how passionate you are about the material, so that they understand that it's something that they should give consideration to as well. So for the key cast, that's something I'm quite involved in.
What was a casting call that you made that kind of worked out the way that you had imagined it to?
I think probably Dangal was that one time that was a very important casting call, because I remember that we had a young girl in our creative team who came up with the idea, having read an article in the Times of India. And she came up and said that, that we want to make a film on these. I mean, wouldn't that make a great story?
Yeah.
The Fogart sisters. And I said, absolutely, you must go and, check it out and go and meet the family. She did. And she said, it's about the father and the daughters, not just about the daughters. And she came back and we spoke to Nitesh Tiwari. We just made a film with him just before that Chillad party. He loved the story. He went away and wrote a great screenplay. And then we started brainstorming on who to cast. And at that time, of course, Irfan was someone that we'd worked with already on Pan Singh Tomar and Metro and so many. He was someone we had in mind. He would have done a wonderful job. But then I got a call from Amir at that time saying that, he had time to sort of listen to scripts. And I immediately thought, what about this for him? And that's one call that actually really helped, because I think he was able to see the potential in it. Many other stars of his stature might not have been okay with playing an overweight wrestler who's like a bit of a has-been, who's living out his dreams through his daughters.
Yeah.
But he immediately saw the potential in it. Of course, in typical Amir style, he asked us if we'd wait for 5 years.
What was your response?
Our response was absolutely, because I think when you know him well enough, you know that he might say that, but it might be difficult for him to resist something that he loves that much. And so pretty much after a year after him saying yes, 5 years later, he came back and said he'd do it.
I think my research tells me been involved with 6 Indian movies that have made it to the Oscars.
Yeah.
So why do you think, or what do you believe has been that, the ingredient or the secret sauce that you've kind of meshed into the work that you did for these films to make it where they did?
Well, it's hard for me to be able to define that. I think it comes from the sensibility probably of the choices that one makes along the way. And thankfully, those are the ones that get selected by the Film Federation of India to be the ones that get sent for the Academy Awards. But it probably is because one has a bit of a global outlook on things. And I'm always looking for ways in which to be associated with content that has the ability to resonate beyond our borders. That probably might be the reason.
Speaking of the Oscars, the rules have changed now. You're going to have to watch every movie.
Every movie, I know.
Every movie. But what do you believe that? Do you believe that that's a good thing to do? And how do you see this changing things?
I do actually think that's a good thing to do, because I think it's only fair for a film to get judged as as compared to everything else. And it's probably not okay for members to be able to vote having watched only 10 or 15 of the films that are up for grabs. So it's definitely going to be a much more demanding process of the Academy members. But I was watching a lot of those movies anyway, so I think for me it shouldn't be too bad.
How much time do you actually spend consuming?
A lot. Firstly, I just enjoy consuming content. I think whether or not I was in this business, I'd still be doing it.
You do it irrespective.
Exactly.
Yeah.
I mean, I grew up watching copious amounts of films, so that in that sense, nothing's changed.
Nothing's changed, but a lot has changed as far as this business is concerned, and that's what I want to talk to you about. Where do you believe we're at? As I said, we've gone through that phase of corporatization. We've gone through a phase of consolidation now, especially as far as the television side of the business is concerned. Where do you believe the industry finds itself today?
It's at an interesting crossroads today. I think we've gone through a period of consolidation in the last couple of years, where you've seen a lot of consolidation amongst the top sort of corporates in the space, which has led to a certain less aggression in the calls being taken, the number of things being made, etc. Probably because organizations tend to go a little quiet when they are consolidating, merging, acquiring, etc., etc. And I dare say now that water's found its own level on that score, I think the next few months are going to see a lot more activity. The second part, of course, is that consumer habits have changed, and we have to acknowledge that. So I think what COVID did is really made people realize how convenient it is to be able to watch content at the tip of your fingertips.
Yeah.
And now to get out of that cycle takes much more. So to get someone to pay money to watch a film in a cinema hall, to go through the effort of booking the ticket, getting out of their house, braving the traffic, braving the ads that come before the film, braving an interval, all those things, it needs to be something really compelling. And which is why you've been seeing in the last few months a bit of a feast or famine situation. So the films that are doing well are doing incredibly well. I dare say they're doing better than they might have done even before COVID.
Okay.
But the films that are not working now have no flaw to how badly they can do. Which therefore means that the game has been upped as far as we're concerned, and which is a good challenge for us, because it means we need to give people something compelling, and then they will come.
Speaking about giving people something compelling, there seems to be almost a disconnect between what audiences want and what filmmakers are delivering. And why do you believe that's the case?
Probably in Hindi cinema, what has happened in the last few years is that we've been trying to be all things to all people, and therefore becoming nothing for no one, in a sense, right? Because we have such a large audience we believe we need to cater to, it becomes a little difficult for us to be able to figure out who our core audience is. And I know that's a little bit of a broad thing to say, but writers need to just write based on what the story they want to tell, and don't let that get diluted by feeling like I need to reach this audience and that audience, and the cities and the villages and the rural and the urban and the global. Just tell the story that you want to tell, and tell it with complete conviction. And I think then you will realize that audiences will come.
So do you expect 2025 to be a better year, both in terms of the quality of content as well as the pipeline of content? Because we've had a problem with both post-COVID.
I think so. I think 2023 was an incredible year. I mean, you had 5 movies crossing the 500 crore mark at the box office, which has never happened in Indian cinema before. 24 was a little bit of a lower year, and now 25, I'm hoping, will once again prove that, the audiences have come back to the cinema halls. Because for the movies that work, like I said, the sky's the limit today. And that gives me a lot of hope that if, the big movies this year fire and do incredibly well, and you always have a few surprises. So some of the smaller movies come in and just, like 12th Fail or like Munjia, for example, come and just surprise you. That really is the hope.
Speaking about making strategic bets at this point in time, and I want to talk about the economics of putting something together, either for the cinemas or for OTT at this point in time. What are the challenges as a producer for you? And do you believe that the costs will have to be reimagined as well and be repurposed for this new reality that we're talking about?
I do think so. And to some extent, we're already seeing a little bit of recalibration there when it comes to costs of actors, of heads of department.
Actors are taking salary cuts.
Well, I wouldn't say salary cuts, but they're definitely looking at now coming in more on the back end and taking less on the front end. So,
what does that mean exactly?
So which means actually enjoying the success of the film, if it works. So taking less upfront and then becoming partners in the success.
So it's going to become more revenue share going forward?
Yes. So there's a component of, obviously, something that's built into the cost already, which is a fee. And then there's sharing in the profit. And therefore, the upfront fee can be lower to reduce the cost of the project.
Yeah.
And then in success, everyone gains. So that, I think, is becoming much more prevalent as we go forward.
How much is the cost of talent of the key stars as part of the overall mix as far as costs are concerned for perhaps a big project?
If it's a big project, it could be as much as 30 to 40%.
30 to 40% is just the actor's cost?
Yeah. The lead actors. But, when you look at it, a lot of the viability of that project is based on those actors being in it. So I think when you look at it that way, you take out the drama from it and you take out the fact that, oh wow, it is 30 and 40% paid out to individuals. It's the same thing in Hollywood as well, right? If Tom Cruise is doing Top Gun, Maverick, a lot of that budget of Top Gun Maverick is going to be his fee, right? But that's because that film is going to get a massive opening because of Tom Cruise. And it's the same thing with our films. I mean, if Salman Khan or Amir Khan or Shah Rukh Khan or Hrithik Roshan are in a film, a lot of the economics are based on their presence in the film.
What about women?
Yeah.
Are the women getting paid any better?
They are getting paid better, but there's always room for
nowhere close to
parity.
Yeah. No. What is the difference that we're talking about today?
It's quite significant. It's quite significant. I mean, if you looked at it completely, without any lens, I do believe that it still is commensurate in terms of the commercial potential of those projects, because audiences have told us that they will come in certain numbers for certain kinds of movies, and therefore that, I think, is the up and down that does exist, whether you like it or not. But can there be more parity? Yeah, sure, they can.
In terms of monetization, I mean, what could be the next sort of wave of adding revenue streams? What are you considering at this point in time?
For the first time, global ratings agency Moody's has downgraded US sovereign credit rating, Moody's did not downgrade the US economy even during the 2008 financial crisis. But rattled by President Trump's trade war and its potential impact on the fiscal position of the United States, Moody's has now raised the red flag. President Trump and his team have shown some signs of backing off from the tariff war. They have cut a 90-day deal with China, which effectively brings the initial 145% tariffs to 30%. India is currently negotiating a trade deal with the United States to avoid higher tariffs. The UK has already signed a deal, and the Trump administration has promised more trade deals very soon. But where does all this leave the global economy? Nobel laureate and economist Paul Krugman vociferously opposed the initial tariffs. He is not impressed by the White House decision to walk back on the tariffs either. He still believes a recession is likely because of the uncertainty staring at businesses worldwide. Joining us to discuss the trade wars, the US economy, and a potential shift in the world order is the man himself, Paul Krugman. Thank you very much for joining us on CNBC TV18, Mr. Krugman. Let me begin by asking you about your assessment as to what have Donald Trump's trade policies done to the US economy.
Okay, so far, it's really hard to see the tariffs in the hard data. It takes time for them to show through, but we're likely to see a bump in consumer prices starting within weeks. So the inflationary impact of the tariffs is coming. You can see already that businesses have scaled back a lot of expansion plans, not simply because of the tariffs, but because of the uncertainty. If you ask me, what will tariff rates be 120 days from now? Nobody has any idea. And that includes Donald Trump. That includes his Treasury Secretary. And businesses are reluctant to make plans to make investments on that basis. So, yeah, I think we're probably now maybe slightly down, but still maybe 50% chance of a recession, but certainly an economic slowdown, certainly a bump up in the inflation rate. It's stagflation. Maybe it's stagflation light, but we're definitely heading for some kind of stagflation.
Right. Could you give us a sense of your outlook for the U.S. economy for the full year 2025 as a result of Trump's policies? You're saying that there is a 50% chance of a recession. And what could be some of the contours of the stagflation, according to you?
Well, okay. I mean, a sort of best guess is that we'll have little to no growth for the year. Maybe slightly positive, maybe slightly negative. If it's slightly negative, we'll call it a recession. If it's slightly positive, we won't. But from the point of view of how it feels to people, it'll be the same thing. Probably higher, almost surely higher unemployment, and quite surely higher inflation. Even with this very modest step back in the tariffs, tariffs are going to probably add 2% or something to the consumer price index over the course of the year. So, we had an economy, 2024 was, by any normal standard, a terrific year. Solid growth, inflation that was a fraction of a percentage point above the Federal Reserve's target, not in a way that anyone really noticed. 2025 is not going to look nearly that good.
Right. How do you react to the news about Moody's downgrading the U.S. sovereign credit rating down from AAA? What are the warning signs here, according to you?
Okay. One thing that you do need to say is that if a rating agency downgrades a corporation's bonds, I take that very seriously because I suspect that they know a lot that I don't. When they downgrade a country, they don't know anything that anyone studying macroeconomic data and studying the fiscal situation and so on doesn't know. So in itself, I don't think the Moody's downgrade is particularly informative, except insofar as it's telling you that a lot of people out there are looking at the United States and saying, is this still the America we knew? I mean, America certainly has, we have the resources. Yes, we have a lot of debt, but we have the resources to cope with that, to pay it down. And we've coasted for a long time on the belief that eventually our political system will do the right thing. If you look at the budget bill that appears to be on track to be enacted this week, this does not look like a country that can be trusted to do the right thing. It's a bill that will blow up the deficit with tax cuts when we're already at a basically, long run unsustainable deficit, supposedly paying for that with absolutely savage cuts in aid to people in need, which are probably, even with this government, not sustainable. Millions of people who voted for Donald Trump thinking he was going to make their lives better are about to discover that they have no health care. And this just, we do not look like a serious country. And how long can we continue to coast on the belief that we will once again become a serious country when the reality is we look less serious by the day?
Right. What do you think Donald Trump's tariff policies and some of his trade deals will do to the long-term confidence in the America story? Do you think Donald Trump will be able to make corrections in the next few months? Or do you feel what he has done is going to shake investor confidence in the long term?
One thing to understand about the tariffs, aside from the fact that they are really very high, we say that he's walked them back, but we still, we've gone back from a few days ago, we had the highest average tariff rate in 100 years. Now we only have the highest average tariff rate in 90 years. This is not a really big deal. We're still extremely protectionist. We had very low tariffs just a few months ago, and now we have an average tariff of, depending on which numbers you use, something between 15 and 18%. And even if that gets walked back, the fact of the matter is that we now have shown that we are a country that can do stuff like this. People don't talk about it a lot, but we have a lot of agreements. We have free trade agreements with multiple countries. We have broader tariff agreements under the World Trade Organization, and we have just ripped them all up. The Trump administration has just said, oh, deals, schmeals, agreements, treaties, never mind. We want to do something different. And even if they end up walking all of it back, which does not appear to be in the cards, the fact of the matter is that we now know that the U.S. can elect people who will do that. I'm sorry, I am sitting in New York here. I say that the Trump administration treats international agreements the way New Yorkers treat don't walk signs. They're a suggestion, not something that you actually have to obey. And what country will ever really take us seriously when we make promises? What business is going to make plans on the basis that whatever the current policy is something you can be relied on to continue? So no, we don't undo this. It'll take many years of responsible government, which we see no sign of happening anytime soon, many years of responsible government to get back to where we were 4 months ago.
Right. Do you also see this as having a major impact in terms of rebalancing of global capital markets and the role that the US stock market plays there?
Well, tariffs, there's a lot of evidence on what tariffs do to trade balances. They reduce the amount of trade, but countries that impose tariffs on their imports also usually end up doing a lot of damage to their exports as well. And there's no particular reason to think that this is going to do a lot to reduce the U.S. trade deficit. The only way in which it might is that the dollar gets weaker because people stop thinking of the United States as a safe place to invest. And I guess we need to see how that goes. But again, this really is an earth-shaking betrayal of everything that people thought about the United States. America has, mostly for better, though in some ways for worse, been the safe haven. America is the place where your money won't be expropriated, the place where policy will be sound. And now, all of a sudden, we are a place that doesn't honor its agreements. We're a place that, who knows what, and longer term, I worry, what happens to U.S. technology now that we seem to be systematically destroying our prestige universities, now that we seem to be cracking down on government funding of science. So all of this is, rebalancing is not the word I would use. I mean, undermining is probably a better word.
Right. So undermining of United States' position in global capital markets. Strong words from you there, Mr. Krugman. I'd also like to ask you about the weakening of the dollar. We've seen significant weakening against major currencies like the euro and the yuan and the yen. At the same time, higher volatility in the US bond market and stock markets. What is the trajectory, according to you, and what are the big causes for concern?
Well, I spent a lot of my career on financial crises in emerging markets. What's happening in the United States looks like a sort of very low-key, but nonetheless qualitatively similar thing. It really does look like we're getting a bit of a sell America trade, as if people are losing confidence in the United States, losing confidence in the dollar. Tariffs normally make a currency stronger because you buy fewer imports and so less demand for foreign currency. Instead, the dollar has gotten weaker. And I look and say, well, I think I've seen this movie before. Now, it's a very pale shadow of what we've seen before. The weakening of the dollar by a few percent does not look like the 80% fall in the Indonesian rupiah in 1998, but it does have, it rhymes a little bit with what we've seen before. And again, incredible that that's happening here in the United States.
On that note, we take a short break, but don't go anywhere. This conversation with Paul Krugman continues on the other side, and we will be talking to him about Donald Trump's recent remarks on Walmart and Apple. Now, when it comes to Donald Trump's trade deals, there was a lot of worry around his tariff war with China. But he has now walked back on it to some extent, and he has lowered tariff rates on Chinese exports to 30%, and China would be imposing 10% tariff goods on US goods flowing towards Beijing. So do you think this deal is now good for the world economy, or do you feel there are no winners or losers, or who is the winner in this?
Well, okay. No winners economically. This is destructive for everybody. And, it tells you something about how much we've lowered our expectations, that we think of as a 30% tariff as low. I mean, that's still a crazy high tariff. 145% tariff basically meant shutting off trade completely between the United States and China. A 30% tariff, there's some estimates and assumptions to be made, but when I run it through my model, I say this will only cut trade between the United States and China by 65%. We're still talking about a massive decoupling of the world's two largest economies, and this is a bad thing. It's a bad thing for both of us. If I had to say, I think probably in the long run, the damage will be greater to the United States, but it's actually huge damage to both economies. So how you can look at this and not say, my God, what have we just done, baffles me.
Right. Do you think Donald Trump has gone ahead with this trade deal under pressure from U.S. companies?
Oh, U.S. companies, U.S. markets, but also, we unfortunately, we're hearing more than I really wanted to know about the actual policy process. We know that major changes in U.S. trade policy come about because some members of his cabinet managed to catch him in his office, while other members of his team are in meetings elsewhere and persuade him to make major policy changes, and they sit in his office until he's posted the policy change on Truth Social, the world's greatest nation, and we're making policy basically based on who talked to the president last. God knows what the elevator operator will tell him next.
About what he said to Apple and Walmart, he literally told them to eat tariffs after Walmart said that they were having to increase prices as a result of the tariffs imposed by the U.S. administration. How do you think this is going to go down with the U.S. industry and the kind of precedent it really sets out by telling one of the largest retailers in America to go eat tariffs and absorb them?
Well, first of all, he's been telling us all along that China will eat the tariffs. Now he's saying, well, actually, they won't, so Walmart should eat them. So that's pretty funny. And I thought Republicans believed in free markets. Instead, we apparently believe in an economy where the president tells you what prices to charge, which is pretty bad. And it's just not feasible. I mean, the retailers like Walmart have a margin of a few percent. And when you're imposing reduced tariffs of 30%, saying, well, they shouldn't pass it on to consumers, that's just not going to work. Maybe they won't raise their prices. They'll just stop selling stuff. I mean, if anything, this is a recipe for empty shelves. But it's bonkers. And just last thing to say is, does Trump have any idea how complicated a modern economy is? He cannot go down the list of major companies one by one and tell each of them not to raise their prices. Even he can't put up enough tweets to do that. So this is crazy. This is just trying to avoid a bad headline. And it's going to be bad news for corporations who have to wonder, what can we do that won't run the risk of suddenly becoming an enemy of Donald Trump? I mean, a president who's decided to devote substantial amounts of his time to denouncing Bruce Springsteen and Taylor Swift, who knows what he might do to your company?
Right. That brings me to Apple. He said this during a press conference, that I've told Tim Cook that you cannot be manufacturing in India for the US market. It's fine. Whatever you want to do in India, you do for the country. But if you're manufacturing for the US, it has to be in America. How can he even dictate business or manufacturing decisions to any company for that matter?
Well, he has no legal right to make those kinds of decisions. But then again, legal rights are not something that the Trump administration seems to care a lot about. But it does, in a way, get at a fundamental economic issue, which is that a lot of the things that the U.S. imports are just not, the cost of producing them domestically is very high. We can do some things. We can certainly, you can imagine that the United States, the United States is not incompetent to manufacturing, and we've had some, semiconductor plants that have opened and have been very successful. But a lot of the production of something like an iPhone, significant segments of it are very labor intensive. Even you can't automate them completely. The United States is still a high wage nation. It's just not feasible to produce them competitively in the United States. And if Trump thinks that he can force us to do that, then I don't think it's possible. But if he tried, the increase in the cost of living for U.S. consumers would be insane. And actually, the cost of doing business, because a lot of the stuff that he wants to bring back to America is actually not even for consumers. It's stuff that businesses use. It ends up making a lot of business less competitive in the world.
Right. Do you feel that all of this, his criticism of certain policies of companies, all of this is going to slow down the capex cycle? Because companies will be like, hey, we don't want to invest anymore. We don't know what's happening at the White House, when policies may change. Let's not put up additional capacity. Let's not make fresh investments. And do you think this could lead to reduction in job growth as well in the U.S.?
Oh, yeah. The recession risk for the United States largely comes from, not even from the tariffs exactly, but from the uncertainty. I mean, if Trump just announced 10% tariffs on everybody forever, and people believed him, that would be, raise the cost of living, but probably businesses would start investing on that basis. If he keeps on announcing, well, whatever I said about tariffs yesterday, now I've completely changed, and the new tariff rate is good for 90 days. And by the way, whatever business decision you make, I may go out and denounce you and take revenge. A lot of companies are, you can just start to see it in the actual announcements, but there's truly a lot more of, hey, the safest thing to do, maybe the only safe thing to do, is to sit on cash. Don't stick your neck out. Any investment you make runs a substantial chance of being completely wasted money because policy just did a 180-degree turn before the investment had a chance to mature.
Right. On the beautiful tax bill that was set to come, as Donald Trump called it, it has been stalled for the moment, but many say that it's not completely off the hook and it may still pass the legislative process. This could increase the U.S. debt by at least $3 trillion to $5 trillion US dollars. How do you see this tax bill that would extend the major tax cuts to different taxpayers? Who is this going to benefit, and do you think this will go through the U.S. Congress?
I think it will go through. Actually, apparently the committee hurdle that held it up last week was crossed late last night. So this probably is going to go through, unless they're rushing it. It's kind of a bum's rush, because if the public got any wind of what's in it, it probably would fail. And the reason is not the tax cuts, not the deficits, although it is bad. It's clear, this is why Moody's downgraded, because this is highly irresponsible in terms of increased deficits. And, in the past, the United States has been able to shrug off worries about the deficit, but maybe that those days are coming to an end. But the savage cuts, I'm seeing something like 15 million people might well lose health care. A lot of people are going to lose nutrition aid. This is just an attempt to partially offset the cost of those tax cuts for the wealthy. They are going to, literally ruin the lives of millions of Americans. Many of them are people who voted for Donald Trump. So if this does get enacted, expect a tremendous political backlash because it's not just a dollars and cents. This is a massive act of cruelty.
Right. My final two questions, Mr. Krugman. On India, US and India are negotiating a trade deal. They may have an interim trade deal as well. How do you think this will be for both economies and your outlook on India?
Okay, I don't have a real outlook on India. I haven't studied it. I'm sorry. I just have nothing to add that probably every listener to this program knows more about than I do. In terms of a trade deal, I've actually been mentioning India as one of the few places where there could conceivably be a meaningful trade deal, because India, although it's come a long way down from the extremely high levels of protection it used to have, still India does have significant tariffs, and it can offer the United States concessions in the form of reducing those tariffs. It's very different. We had an alleged trade deal with the UK, which was completely meaningless. Had to be meaningless because the UK has less than 1% tariffs on US products. So the UK couldn't make concessions because there was nothing to concede. India could make some concessions, and maybe that's enough to make some difference. Maybe it's enough to make the United States for Trump to declare victory. In terms of the impact on either economy, it's really not going to be a big deal. India is, among other things, India is not close to the United States. It's not a neighbor. America is not India's biggest trading partner, and India, from the U.S. point of view, is a really quite minor trading partner. It's a growing economy. It's more significant than it used to be, but it's not nearly as big an economy as, say, the European Union, and it's not nearly as close as Canada or Mexico. So, U.S. business will not even notice, whatever the deal is. It will have no visible impact on the U.S. economy, and probably not much impact on the Indian economy either.
Right. And finally, as we see US and Donald Trump disrupting the global economy, disrupting the multilateral institutions, what does this mean for the rise of China economically? What are the big themes around China that you're watching out for and which possibly concern you?
Well, China has some serious problems. China is an economy that's built around torrid rates of growth, 8, 9%, and they still have a lot of their institutions are set up for that, but they can't do that anymore. Their working age population is shrinking. Their technology has advanced sufficiently that they can no longer achieve extremely rapid technological progress from borrowing. They're still formidable. They still have a lot of growth potential, but they're not managing it very well. They have excessive levels of investment with diminishing returns. So China has problems. But I have to say that in terms of global influence, this is the Trump administration is really making China great again. I mean, we are now in a world where China is a more reliable negotiating partner, can be trusted to keep its word far better than the United States. It pains me to say that. And China is an authoritarian regime, and they are generally not very trustworthy, but they're not nearly as erratic as my country has become.
All right, we come to the end of our program, but that was Paul Krugman saying that what Donald Trump has done with his tariff policies is make China great again and really damaged the credibility of America and the American government and America as a market as well. That's all we have time for. Thank you for watching. Goodbye.
Hello and welcome to India Business Hour. I'm Ashmit Kumar, and here are the headlines that we're tracking this evening. India is aiming for a full exemption from the 26% additional tariff imposed by the US in an interim trade deal. Commerce Minister Piyush Goyal has met US counterparts in Washington. India is hoping to seal an early harvest deal by July 9th and the first tranche of the deal by October of this year. India moves to fast-track trade deal negotiations with the European Union. Sources say India's chief negotiator is in Brussels to discuss an early harvest agreement by July, similar to the one with Australia. IndusInd Bank reports a quarterly loss of over 2,300 crore rupees. This is the first in 19 years after an accounting lapse. The bank also suspects a new 173 crore fraud in its microfinance business. RBI asks IndusInd Bank to submit names of its CEO candidates by the end of June. Festivals, weddings and the Mahakumbh takes Indigo's Q4 profit beyond 3,000 crore rupees. Revenue rises 24%, fuel cost eases by over 6% and load factor improves to more than 87%. Elon Musk commits to leading Tesla for the next 5 years but says he wants more control of the company, similar to Larry Page and Sergey Brin at Google and Zuckerberg at Facebook. Also promises to spend less on political donations after spending over $250 million to help Trump campaign. That's a CNBC exclusive.
I think it's the right time. I think the business is in a good place, the org is in a good place, the sector is in a good place.
This is the right time to list, and India is the right market, says the top management at Walmart-owned fintech company PhonePe. Promises more diversification and profitability in the years to come. That's an exclusive. The government begins its diplomatic outreach to take India's stance on terror to the world. 2 of the 7 all-party delegations begin their campaigns today. The delegations will focus on highlighting that Pakistan has sponsored multiple terror attacks on India since 2008. We'll explain why India had to suspend the Indus Waters Treaty. India's household savings rises 16% in FY24 after shrinking for 2 years. Savings in physical assets begin to taper. Savings in gold and silver ornaments grows at a mere 1%. Supreme Court grants interim bail to Ashoka University professor Ali Khan Mahmoodabad, who was arrested for a social media post on Operation Sindoor. But the apex court terms his post as dog whistling and orders a special investigation team to probe the matter.
This moment feels like 1,000 fire files lighting up a single sky, brief, brilliant, and utterly collective.
India's Banu Mushtaq creates history, becomes the first author writing in the Kannada language to win the International Booker Prize for her book, Heart Lamp. She shares the honor with translator Deepa Bhashti. Well, let's begin with a look straight away at the day's trading action. The market regained half of yesterday's losses, with frontline indices rising up to 1%. The Nifty has reclaimed the 24,800 mark, while the Sensex ended the day above 81,600. Led by the blue chips, mid-caps outperformed, while the Nifty Bank rose nearly 200 points. And well, easing trade tensions between Washington and Beijing has lowered the inflation and recession worries in the United States. Respondents to a CNBC Flash Fed survey have dialed down their recession and inflation outlook. However, policy uncertainty continues to remain high. Over 80% of the respondents, which include economists and fund managers, remain cautious about the tariff outlook. And well, it's the third and final day of Commerce Minister Piyush Goyal's visit to the United States as both nations aim to finalize a trade deal. Now, Goyal has held meetings with Commerce Secretary Howard Lutnick and U.S. Trade Representative Jameson Greer. Both nations are hoping for an early harvest deal, and India is aiming for a total exemption from the additional 26% tariff. Abhimanyu Sharma is here joining us with more details. Abhimanyu.
India is aiming for a full exemption from the 26% additional tariff in the interim trade deal with the United States, which it is targeting before the 9th of July to avert reciprocal tariffs, and is targeting the first tranche of the deal by October 2025. India's Commerce and Industry Minister has already met the US Trade Representative and the US Commerce Secretary at a dinner meeting in the United States, and is likely to meet more top officials in the United States. Goods and digital services are likely to be a part of the interim deal as per officials. Officials also explained that currently the US does not have the power to bring tariffs lower than the MFN rate, which will require approval from the US Congress. Officials further said that Indian products do not face the kind of non-tariff barriers in the United States like they face in the European Union. The import of GM crops from the US, however, is an issue as such crops are not allowed in India. While India remains open to the import of non-GM alfalfa hay, the US has been unable to certify the same due to unavailability of ample mechanisms to distinguish between GM and non-GM products. India is also aiming for a minimum import price or import quotas in sensitive sectors as part of the deal, apart from a cut on the 5% to 7% basic customs duty on its exports of labor-intensive products like leather and textiles. While it has been explained by several officials that Indian exports have started increasing to several geographies, as far as comparative rates or tariffs are concerned, India has offered zero duties on all goods, including automobiles and auto components, but wants to keep agriculture and dairy out of the trade deal. However, the US wants a bigger deal covering market access for US agriculture and dairy products. It remains to be seen by when some degree of consensus would be reached between India and the United States, based on which any deal is going to be inked, be it the interim deal or the first tranche of the deal, which both the sides are targeting.
Right, Abhimanyu, thanks so much for that. Now, ratings agency Moody's says India is better positioned than many other emerging economies to deal with the US tariffs and trade disruptions. Moody's said that India's robust internal growth drivers, along with a sizable domestic economy and a low dependence on goods trade, can help it withstand the tariffs and related disruptions. Moody's also sees room for rate cuts. The rating agency says that easing inflation offers the potential for interest rate cuts to further support growth. Now, India is also moving to fast-track trade deal negotiations with the European Union. Sources have told us that India's chief negotiator is in Brussels to discuss an early harvest agreement by July, similar to the one with Australia. Well, shifting focus now to earnings, IndusInd Bank has reported a quarterly loss for the first time in 19 years, weighed down by accounting lapses in its derivatives portfolio. The bank's reported a loss of over 2,300 crore rupees. Ritu Singh joining us now with more details. Ritu, tell us, decode for us the IndusInd Bank numbers and exactly what it translates into going forward.
Well, Ashmit, that loss of 2,328 crores is almost 4 times the amount that the street was expecting the bank to report. So a lot of concern there. As you said, this is the first time that the bank has reported a loss in nearly 2 decades. This is coming on the back of the various discrepancies that the bank has now found in its balance sheet. And importantly, the board has decided to categorize these discrepancies as fraud. It feels that certain people are involved and will be taking up the matter and reporting it to various investigative authorities to put accountability on certain people, which it has not been. We've already seen the CEO and the deputy CEO of IndusInd Bank step down last month, taking moral responsibility for these discrepancies. Now, the net interest income for IndusInd Bank on the back of this, again, it's down more than 43% over the previous year at 3,048 crores, also below what the CNBC TV18 poll had estimated. Gross NPAs have also ballooned, and this is again on the back of some of the MFI linked slippages that the bank has again experienced in this quarter. Gross NPA ratio at 3.13% and net NPA ratio also inching up to 0.95%. Provisions have also been increased accordingly. In terms of discrepancies, there's a new one that has come to light according to a report that the bank has now made public. It says its internal audit has found 173 crores as incorrectly recorded fee income in the microfinance book, which is an additional hit that the bank has had to take in the fourth quarter. We already know there was about 1960 crores of hit from the derivatives book and about 674 crores from the MFI MFI book, which the bank had disclosed. It also said that there was some unexplained, unsubstantiated income of 595 crores that was set off against the liability. So there's no financial impact of that on the P&L. Now, apart from this, importantly, the bank has also said that it has started the process of identifying the next CEO. The RBI has given the board the deadline of the 30th of June to submit the shortlist, but the board is confident it will be able to do so much ahead of that timeline. That is the big overhang that the street will now watch out for. Apart from that, the board, the chairman of the board addressing the analysts in the con call, making it clear that this was a kitchen sinking quarter. All of the losses that have been identified, or the hits that have been identified so far, have been accounted for, and going forward they intend to start FY26 on a clean slate.
At the outset, we acknowledge that these developments are unfortunate for any organization, and it's painful to see these taking place, particularly in your own. However, the board is determined to address all identified issues so that we can move and resolve to move appropriately forward. The board was not informed of the discrepancies, including at the time of approval of the financial results for the relevant accounting periods. The board has swiftly taken active steps in understanding and addressing all areas of concern holistically and disclosing progress transparently at all appropriate stages. The board and the management set forth its desire of maintaining trust in the institution by aspiring for and implementing higher standards of transparency and compliance. The RBI has advised the bank to submit proposals for appointment of the new CEO for RBI's approval by 30th June 2025. The board is at an advanced stage in the selection process and is confident that the recommendations will be submitted to the RBI in advance of the timeline prescribed.
And staying with earnings, Interglobe Aviation has delivered a strong set of numbers in the fourth quarter. Net profit grew by 60%, while revenue jumped by more than 24% on an annual basis. Madhya Mujawar joining us now for helping us decode these numbers. Madhya.
Well, festivals, weddings and Mahakumbh, these were the key drivers for Indigo's stellar numbers in the fourth quarter. Profit up 61% to 3,067 crores. Revenue from operations increased by 24.3% to over 22,000 crores. And here's what explains the strong performance. There's more capacity, more passengers and lower fuel cost. The airline's capacity increased by 21% to 42.1 billion available seat per kilometer. Fuel cost reduced by 6.6%. Passenger volume increased by 19.6% to 31.9 million passengers. Yield increased by 2.4% and occupancy or load factor improved to 87.4%. That was the quarterly performance. For the full year as well, Indigo fared quite well. Profit stood at 7,258 crores. However, it was lower than 8,172 crores in FY24. Now, revenue from operations increased by 17.3% to 80,802 crores. Capacity increased by 13.1% to 157.5 billion ASKs. Passenger volume increased by 11.1% to 118.6 million passengers. Yield increased by 1.3%. Load factor was again 86%. Fuel cost reduced by 3.1%. And what shows an expansion, Indigo's total fleet increased to 434 planes as compared to 367 planes in FY24. The number of destinations increased to 131 destinations versus 118 in FY24. Looking ahead, CEO Peter Albers said that the month of May will be a dampener due to airspace closures and flight cancellations given the Indo-Pak border tensions. Indigo cancelled flights to 2 international destinations, Tashkent and Almaty. 170 daily flights to border airports were cancelled for 8 days, and a flight time for 30 international flights increased by 20 minutes due to Pak airspace closure. Now, responding to questions on IndiGo's partnership with Turkish Airlines, the CEO said that the codeshare is well within the framework of air service agreement between the two nations. He also added that even if the partnership adds a single digit to its revenue, it is helpful for the airline. Listen into the bite.
Fourth quarter was very strong. April started strong, and clearly May will be a dampener. But looking at where we are today and how quickly after the ceasefire the traffic is returning, we're confident that yes, May will be lower, but basically as from June we will see a recovery of the traffic. IndiGo is fully compliant with all the regulatory frameworks and regulations which are there. And we have thousands actually of Indian customers booked, mostly beyond Istanbul, who are flying to their final destinations.
Well, moving ahead to the IPO corner, logistics firm Shiprocket is gearing up for its market debut. Sources have said that the company has filed confidential papers with market regulator SEBI. Shiprocket has plans to raise 2,000 to 2,500 crore rupees from its public issue. The IPO will also include a fresh sale of shares worth 1,000 to 1,200 crore rupees. Speaking to CNBC TV18, the company's CEO, Sahil Goel, has said that external pressures become lesser as the company becomes more fundamentally stable.
Point in time with the markets being the way that they are, it's uncertain.
Correct.
It's risk off, and so perhaps you will need to dial down and or dial up the IPO plans.
Correct. And agreed. So I think, and we've one has to react right to the market. I think the point is that as long as you build a fundamentally sustainable business, the external pressures of doing things which may or may not be good for the business at various times become much less. Right? That's the only thing I was trying to say, where the risk-reward ratio, you can stray off sometimes too far, and then you end up kind of having to make decisions.
Now, Walmart-owned PhonePe is also gearing up to go public. The top brass at the fintech company spoke exclusively to CNBC TV18 and said that this is the right time and India was the right market for the company to launch its IPO. PhonePe is also planning more diversification and is hoping to achieve profitability in the years to come.
I think directionally too, I think the company's at a stage where I feel like the core payments business, consumer and merchant combined, is at a stage of maturity and market leadership where we should, hopefully from here, remain sort of very, very stable and hopefully quite profitable in years to come. Conditioned well enough to say without setting any targets or goals. I think it's the right time. I think the business is in a good place, the org is in a good place, the sector is in a good place. Payments is still growing very rapidly. So if you're a market leader in a growth sector, I think it's a good time.
So Rahul, did the two of you sit and have a conversation about it makes sense to do it now? This is the right time, this is the moment, and we should go all in?
We did have a conversation. I think like Sameer mentioned, just given the current state of the org and the business, specifically on the core offering that is payments, given how exciting financial services and payments in India is, and the fact that we also have a few new businesses that we are diversifying into, we felt that this is the right time where the core business on the path to profitability, being able to actually nurture new businesses, is the right time to take PhonePe to the public markets.
To pay a hefty bill of 8,000 crore rupees to reverse flip and move back to India, I would imagine had its roots in this eventual decision, right?
Of course.
I think directionally, if the right answer for a business like ours is to list, then this is the right market. I mean, I think we're very proud of the fact that we are a household name or brand in the country today. It doesn't make sense to list anywhere else. So I think the reverse flipping was a precursor towards an eventual listing someday.
In terms of the opportunity to grow, what's the kind of headroom for growth that you see in each of these businesses? They're nascent today. What could they look like 5 years on?
We pride ourselves as is a platform that can be an intelligent distributor.
Okay.
So we've always tried to stay away from being a manufacturer as far as possible, but partner with the ecosystem in terms of being an intelligent distributor, which means let's not just be another lead generation platform,
right,
but let's be a platform that is clearly looking at what kind of problems can be solved by a particular partner for which kind of users, and make sure that we are able to actually surface those products at the right price to those consumers, so that we are actually value additive to both.
Now, Brookfield-backed luxury hotel Leela is set to make its debut on the Lal Street. Its parent company, Schlops Bangalore, has said that the price band of 413 to 435 rupees per share for its 3,500 crore rupee public offering. Speaking to CNBC TV18, Ankur Gupta, managing partner at Brookfield, said that the business today is 3 times bigger in the 5 years since Brookfield took over. He added that the company's motto is to make Leela a globally recognized brand.
In 5 years, through a period of a lot of global turmoil in the hospitality sector, the business today is bigger by almost 3 times. It has an amazing appeal internationally. It has been ranked as one of the best hotel brands in the world consistently for several years. And I would like to believe that the best years to the effort that we've put into this business are still ahead of the business. When we acquired the Leela platform, we realized that this brand has the potential to be what came from other countries and became a global phenomena. That does not mean that properties have to be in every country. The brand has to be globally recognized.
Well, here's a CNBC exclusive. Tesla CEO Elon Musk has committed to leading Tesla for the next 5 years. However, he added that he wants more control of the company, citing Larry Page and Sergey Brin at Google and Zuckerberg at Facebook as examples. Musk also promised to spend less on political donations, this after spending over $250 million to help US President Trump's campaign. In an exclusive conversation with CNBC, Musk also spoke about driverless cars.
We have cars driving 24/7 with drivers in the cars, and we see essentially no interventions. So we want to be very careful with the first introduction of unsupervised full self-driving, meaning that the car's driving around with no one in it. We want to deliberately take it slow. I mean, we could start with 1,000 or 10,000 on day one, but I don't think that would be prudent. So we'll start with probably 10 for a week, then increase it to 20, 30, 40. And I think by, say, we'll probably be at 1,000 within a few months. And then we'll expand to other cities, so expand to San Francisco, California, Los Angeles.
Coming up, India's household savings rises 16% in FY24 after shrinking for 2 years. But savings in physical assets begin to taper. And you can catch all CNBC TV18's news and updates on YouTube, Facebook, Instagram, X, and Jio Hotstar. Well, the government began its diplomatic outreach to take India's stance on terror to the world. 2 of the 7 all-party delegations began their campaign today. The delegations will visit over 30 nations in the next fortnight to highlight Pakistan's links with terrorism. Speaking to CNBC TV18, John Bolton, former US National Security Advisor, said that it is important for India to show that this was a terror attack emanating from Pakistani soil.
This is a problem that we simply cannot live with, and it's why India's responses clearly constitute legitimate self-defense. I just say I think it's important to get the kinds of information that you've just described, get it out into the world press, make sure that the case that India can make, should make, is important to provide legitimacy for the steps it takes militarily. So I think in future discussions, it's worth getting the ground rules straight with President Trump at the beginning. I think the fact he made a call, that Vice President Vance and Secretary of State Rubio made calls, trying to be helpful was a good thing. I don't want to discourage it, but I think he needs to understand how sensitive this is on both sides, and that in some cases, what goes on quietly out of the spotlight is a lot more important than what happens in the glare of the spotlights.
Well, financial savings of Indian households have bounced back after shrinking for 2 financial years. It rose by over 16% in FY24. However, government data shows that savings in physical assets began to taper. Sapna Das joining us now with more details. Sapna, take us through the government data.
Well, the trend is pretty interesting and probably on expected lines. So after a gap around 2 odd years, the financial sector savings for the Indian households, that seems to have bounced back. So as you rightly said, the numbers around 16% growth registered in FY24. If you compare it with the previous financial years, that was a negative, minus 26%. That negativity got further down, and then finally you have the comeback. Of course, what has happened in the meanwhile is that the physical assets, savings in the form of physical assets, that has really come down. So probably that has also helped in the bounce back of, financial savings for Indian households, so to speak. Now, in terms of physical assets, again, whopping growth of around 39% in FY22. That's now down to around 6.3% in FY24. Probably the real estate prices have really grown. And physical assets can be other things also, like car purchases, stuff like that. So, that is clearly tapering off. Last but not the least, also in terms of the savings in terms of gold and silver ornaments. So a whopping growth of around 51% in FY22, which is now just kind of fizzled out to less than 1% in FY24, obviously on the back of rising silver and gold prices. So that's one aspect of the data. Now, what it really shows is that why are the financial savings back for the Indian households? Probably there's a gush in terms of bank deposits on the gross side, but on the net side, the loan outgrowth, loans have actually outstripped the deposit growth. So that's one aspect. Second, the deposits that have come to the bank, so which are the companies which have suffered? It's the NBFCs. So there the deposit mobilization is not only negative, but also the loan disbursements are negative. That's a point to be noted. Also, otherwise, in terms of your gross savings, small savings has shown a big jump of over 50% in FY24. That's a very stable source of, financial sector savings. Also, in terms of your mutual funds, insurance funds, and pension funds, they have grown by a whopping 16%. So all said and done, these trends are likely on expected lines. And of course, this is FY24 data. The Ministry of Statistics will come out with the next set of data next year, sometime in May. And it'll be equally interesting to watch what has happened in FY25 as far as the Indian households' financial sector savings are concerned.
Right, Sapna, thanks so much for that. We'll, of course, come back to you to get more on that. Moving ahead, Supreme Court has granted interim bail to Ashoka University professor Ali Khan Mahmoodabad. He was arrested for a social media post on Operation Sindoor. However, the Apex Court termed his post as dog whistling and ordered a special investigation team to probe the matter. And before we wrap, writer Banu Mushtaq has scripted history. The 77-year-old became the first Kannada author and the second Indian to win the prestigious International Booker Prize for her book named Heart Lamp. This is the first time that a short story collection has won the International Booker Prize. Heart Lamp features 12 short stories written between 1990 and 2023 and captures the hardships of Muslim women living in southern India. Heart Lamp was translated from Kannada to English by Deepa Bashti, who will share the prize with Banu Mushtaq.
If I may borrow a phrase from my own culture, this moment feels like 1,000 fireflies lighting up a single sky, brief, brilliant, and utterly collective. To even stand among these extraordinary finalists is an honor to me. I will never forget, and I accept this great honor not as an individual, but as a voice raised in chorus with so many others.
And with that, it's a wrap on this edition of India Business Hour. Thank you so much for watching. News and updates will continue right here on CNBC TV18.
Markets regain half of yesterday's losses. Nifty and Sensex end 0.5% higher. Nifty reclaims 24,800. Mid-caps outperform index, the benchmark indices and gains nearly 1%.
Dixon Technology cracks in trade after it misses the revenue mark on stagnant mobile sales and weakness in consumer electronics and home appliances. However, the management guides for 40-45% growth in the top line next year.
IPO market warms up with 6 firms lining up for a listing in May. Bellrise Industries 2,150 crore rupees IPO opens for subscription today, while Leela Hotels looks to raise 3,500 crore rupees at a price band of 413 to 435 rupees. Hello and welcome to Markets Forward on CNBC TV18, your go-to show where we aim to get you all the key data points to gear you up for the next day on the next trading session. I'm Vinny Motiwala and with me is my colleague Reema. Reema, hi.
Hi, a pretty good session, right? We managed to recoup part of yesterday's losses. The Nifty held on to the 24,800 mark. The Sensex gained close to about 400 points, and we pretty much snapped a 3-day losing streak. The mid-caps outperformed while the benchmark indices were up 0.5%. The mid-cap index was up nearly 0.8%. Good advanced decline ratio. The advanced decline ratio nearly had about 3 stocks advancing for 2 stocks declining. No sector closed in the red. But, you know, the big gainers include defense, realty and pharma led today. The Nifty Pharma Index was up nearly 1.25%. So you had gains in stocks like Cipla, Sun Pharma and BEL. That was a big winner on the way up, on the way down. Indus Bank under pressure ahead of its numbers. Stock ending lower by 2%.
Absolutely, Reema. While, yes, the Nifty did manage to close about the 24,800 mark, one factor that one should keep an eye out on that, you know, we have closed below the 25,000 mark consecutively for the third trading session. So today, that recovery has surely come in versus what we had seen in terms of the last 3 trading sessions. Nifty is up almost 0.5%. Broader markets, like you already mentioned, saw the outperformance. And other than that, we have realty as a sector that's doing well as well in the last couple of trading sessions. Nifty Realty, we had a lot of gainers coming in, DLF, Phoenix Limited as well, which was passing in trade. But yes, that's what is exciting in terms of market. At least we've seen some bit of a recovery. But well, here's what we have in store for you all in today's show. We'll start with the top movers and shakers of the day with Vivek. And well, the stocks of the day were Dixon Technologies, Sun Pharma, JK Tyre. We will give the key reasons why these stocks were buzzing in today's trading session. Last but not the least, we'll delve into the key market events to watch out for in tomorrow's trading session.
And let's get to our first segment of the day, and that's the big stock movers. Vivek is now at the big wall.
Well, thank you so much for that. Snapping a multiple day losing streak, advanced decline ratio very strong. Not much to complain about for the bulls today. Well, in the list of gainers, the first stock on the radar has to be one from the defense pack, a very strong bounce back across most of the defense names. Solar industry, this particular stock, good set of numbers, strong management guidance coming about, stock higher by over 5%. Bharat Electronics, one stock you alluded to. Remember, The company gave a very good set of numbers. The margin guidance that the company gave in the conference call is something that has led to EPS upgrades. The stock ended higher, over 5%, the top Nifty.